level eases out now with 3 days of strikes already. So what you're seeing across Asia this morning is actually some green. Markets like Japan are doing fairly well. Japan's up 1% actually. The Hong Kong market is absolutely flat. It's directionless. Mainland China also, maybe a little smidge of a green. That's all you're getting. There's some data that's come out of China. I'll come back to that in just a second. US futures also, for what it's worth, US futures after the complete slam dunk on Friday are indicating that we might have a positive opening. But it's very early on in the day. So let's see how some of these things progress. The VIX should keep that in mind. I mean, the huge spike in volatility on Friday, CBOE VIX was up 15%. And for us as well, the India VIX was up 7% because this was this new joker in the back with what's happening in West Asia. Crude has continued to climb. It's not a very big leg up, but nonetheless, we're still getting another almost $1, 1% up on crude oil prices. Now, what has happened is that while there is no talk of choking the Strait of Hormuz so far, the attacks are hitting oil infrastructure in both countries. So what we got over the weekend was Israel hit the South Pars gas field. It's the largest in the world. Two of the wells were hit over there. And then there was a strike at an oil depot in Tehran as well. And on the Israeli side, at Haifa, the oil refinery has been damaged. So oil infrastructure is getting targeted. But as of now, the Strait of Hormuz seems to be operational. So that's the good news. Gold, while, I take Prashant's point that it's not like there's a huge rush towards the dollar or the US Treasuries as safe haven, gold has continued to play that part. And again, this morning, you're seeing a little bit of an uplift after a 1.5% move on Friday. By the way, so what has the US president said in all this? Among the latest posts, here's one that kind of caught my eye. He's going on to say that Iran has to make a deal. There's no choice. Iran must make a deal before there's nothing left and save what was once known as the Iranian Empire. No more death, no destruction. Just do it before it's too late. But that's the operative part of what was a really long post. So let's see if, some of that mediation indeed comes about or not. Now, for us, because of these global events and the risk off that we had globally, the market's attempt to go above the trading range, that really fizzled out. The Nifty all of last week could not make a decisive move above 25,100. Will the global unease kind of end? Will we get back to, taking the top of the range or not? That's something to keep in mind. The flows were negative. So FIIs sold off, not too much, but 1,200 crores of selling is what we had on Friday. Domestic institutions were offering support with 3,000 crores of buying. Very quickly, two stocks in news. Z, I'll watch out for. The board is going to be meeting today, and there are two sets of board meetings that Z is doing. First is with an investment banker who's supposed to bring all kinds of options on the table, including fundraising, a business review, what more can be done on the business. And then there's a second board meeting where the board will deliberate on what the investment banker has told them. Let's see. And for Bajaj Finance, the record date is today, the stock split and the bonus. That is happening. By the way, just to circle back to Asia, I said there's some fresh data out, so let's put that on the board and leave that with you as well. Retail sales are up 6.4%. That's actually pretty good. It's beaten estimates of about 5%. It's also much better than the April data of 5.1%. So retail sales are looking strong in China. Industrial output has slowed down. It's down to about 5.8% versus 6.1% in April. So mixed data out of China this morning and mixed mood in the Asian market territory, at least for now. Nigel.
Well, geopolitical tensions, they have taken center stage. No two ways about it with regard to global markets. In the near term, risk of trade is likely to play out, which means that, asset classes like gold could see some bit of buying, while equities could remain a little bit skittish. That's in the shorter term. However, in the longer term, history suggests that wars or any kind of conflicts like these normally provide the best entry opportunities for long-term investors. So keep that in mind. Don't lose heart. Prepare yourself for near-term volatility. But in the longer term, actually, some of these opportunities do provide great entries. Well, moving to what happened in index futures. Well, if you look at it, the FIs, they continue to add some short positions, while clients, they did the opposite of that. They added close to around 3,400 long positions. And because of their addition that we saw on the short side, the short positioning has moved to around 81%. Long positions of the FIs, they're holding at around that 19% odd mark. So it's at the upper end of what we have seen with regard to a range. Even if you look at it in absolute terms, remember the shorts, they did cover out. We went down to around 86,000 contracts. In the last few trading sessions, the FIs, they have added shorts here again. And that's why, in fact, it's moved up a tad bit on that front as well. We're currently at around 1 lakh contracts on the short side. Moving to the options data then, the PCR continues to hold at around 0.9 odd because we've seen a lot of action both on the put as well as on the call side. So the call writers, they believe that they've got the higher levels covered. And that's why the 24,700 call added close to around 25 lakh shares. The premium out there is around 170 rupees. But what's giving you hope is we did bounce from the lows in Friday's trading session. And the 24,500 put, well, that continues to see a good amount of addition. Which brings us to the levels. Going by the options data, going by the technical levels, I think the 20 DMA, that becomes a reference point. So 24,850, that's a bit of a resistance just in the near term. The longer term resistance comes in at around the 25,200 odd mark. Support going by the options data, going by the recent low that we've seen, this level you don't want it to break on the downside. 24,400 to around 24,500 or thereabouts. The Nifty Bank as well, well, that did end below the 20 DMA. However, the recent low is something that you'll want to track, and you wouldn't want it to break this 55,100 odd. Keep in mind, this is an index that went to 57,000 at the start of the week, and then it's pulled back closer around 3% or thereabouts. So that's the broad range that you're looking at. Stocks that I'm looking at, well, I'm looking at Vedanta for today's trading session. And the reason is they're going to be meeting in the next couple of days to pay out a dividend. We'll tell you a little bit more about that. In Friday's trading session, it bounced off the crucial support zone, 20 and 200 DMA, coming at around that 440 rupees or thereabouts. And crude oil prices have spiked. Well, that's a play on crude oil prices moving up as well. So Vedanta is the stock that I'll keep out on my radar from here on. Let's keep an eye on it.
Okay, all right, got it. So Vedanta is going to be on our radar for sure. Thanks for that, Nigel. Let's quickly get started with the equity call of the morning. Chetan Sheth of Nomura says that in the near term, he believes the market will focus on geopolitical developments in West Asia, where tensions between Iran and Israel have escalated quite significantly. He says while previous geopolitical events have typically caused only temporary market volatility, they advocate some caution given the strong rally in equities amidst unprecedented policy uncertainty, suggesting a potential for de-risking and profit-taking. He adds Asian stocks could be particularly vulnerable, though through two channels. The first is sustained higher oil prices impacting oil importing countries and risk of sentiment affecting high beta markets more severely. So that's Nomura advising caution.
Okay, well, some technical calls coming through as well. So this is Lawrence Belanco of CLSA who says that there is no change to their outlook for the Nifty as the price action continues to hesitate following the May to June price momentum divergence. He says this has resulted in the market forming a minor consolidation pattern between 24,400 and 24,462 and 25,116 and 25,200. 25,116 for the longest time, of course, has been that upper end of that range. He adds, as long as the current consolidation corrective price action remains above the upper boundary of the cited double bottom that coincides with the 200-day moving average at 23,807 and 24,067 area, they would still expect another thrust to the upside and likely new all-time highs for the market. Okay, well, we have Richard Jenska. He's a Group Chief Economist at ANZ Research. Richard, good to have you with us here. Good morning. Thanks very much for your time. You know, I just want to quickly get your sense on this absolute lack of safe haven demand, which is showing up with bonds and U.S. Treasuries. You know, how would you explain it, Richard? It's quite unusual.
Well, I mean, I guess the language of the question is quite strong. You know, absolute lack. I mean, equity markets in general haven't responded all that poorly to what's happened either. I think the fundamental question, is there a global shock of enough significance that you would expect the dollar and the treasury market to be responding substantially? And look, and we shouldn't, of course, gloss over the enormous human cost of what's happening in the Middle East, but the size of the economies is relatively modest. There have been long-standing tensions between these regional economies. So, you know, we can't say this has come out of nowhere. It doesn't seem to particularly affect trade. It does affect oil prices, and the oil market has moved. There's a bit of a bid in gold, of course, on the back of it. But I think so far it's not just a US asset market signal. I think the signal from most markets is this is an oil market issue, but really not a global economic problem.
But a big oil issue is a global economic problem, isn't it? I mean,
if it's a big oil issue, oil's up $10 from the lowest levels we've seen in quite a long time. And again, that doesn't look like it's an oil shock. It looks like it's a price adjustment. The oil market perhaps a month ago was adding in an excess supply discount. Now it's adding in potentially a restrained supply premium, but oil is well within the recent range of recent years. Again, it's a price move, but I don't think this is anywhere close to an oil shock.
Richard, that's an interesting take, and it's good to have that perspective that beyond the $10 to $12 increase in price of oil, at least right now, it hasn't damaged too much. Which then brings us back to the other core issue, and that was trade, right? That there is a trade deal now with at least China, and the US seems to be indicating that it could push back the timelines beyond July 9th with trading partners which are negotiating, quote unquote, in good faith. So, what do you think will the market take away from all this? And, do you have a sense on the general direction of equities then?
Look, I think the probability of some 80 trade agreements being reached in 3 or 4 months was always extremely low. So I think the potential for timelines being pushed back from early July is not a surprise. Of course, it is good news that seems to be some of that looks like it's likely to occur on the back of the US recognising that's required rather than again using that July 9 date to play more brinkmanship. But a handful of countries having their agreements extended obviously doesn't mean that everybody has their agreements extended. And so there's still a lot of water under the bridge. But what we do know is the US administration does seem keen to ensure there's not too much economic or market damage from the trade agreements, and I think that is the most important signal.
Hi, Richard. Good morning. Good to have you on the show. Thanks a lot for joining in. Well, let's circle back to India then. India, if we have a supportive RBI out here, they have, pepped the system with a couple of rate cuts. The currency market out here is fairly stable, and we are likely to be one of the fastest growing economies. What is your view on how the Indian economy is shaping up? Best placed, you would say?
Well, you've given quite an optimistic story there. Certainly before the RBI's most recent meeting, maybe you wouldn't have been quite as optimistic, but that monetary injection has sent a very strong signal. And then, of course, we've had some indications from inflation as well that kind of upside surprise seems to have ended, and potentially we're in for some lower tracking in inflation. That's unambiguously good news. And India, as we know, a relatively closed economy, not as open to the global trading system as other economies in the region, and perhaps reading the tea leaves a bit, seems to be in quite a good position with the Trump administration, which again suggests one of the key risks that people are looking at, namely what the relationship with the US, how that relationship develops between any individual economies and what trade agreements are likely to come. India also stands pretty well on that point as well. So I agree with your conclusion. India looks like a very solid story in a global economy that's dealing with quite a few headwinds.
That's good to know. That's music to our ears, Richard, for sure. Just a quick word on China as well. I was just looking at the data that came out this morning. The retail sales numbers were good, but industrial output has been cooling. But now they have a deal, or at least a semblance of a deal with the Americans. So what's the assessment at these present tariffs that are being spoken about? Where does that leave the Chinese economy?
Yeah, China and the US have a framework for an agreement. Obviously, there's a lot of detail to work through, as we've already seen. That detail will matter, particularly around rare earths and some of the other very sector-specific issues, US technology exports, for instance. But we've had some better news. I think China economically, the shifts in the global trading system are an issue for China. Its production sector is heavily reliant on that external demand. So the pickup in retail spending is welcome. It would surprise me if that was sustained at the sort of rates we saw in today's numbers. That doesn't seem consistent with what we're seeing in terms of household behaviour, but also in terms of just the gradual decline in population and the loss of consumers in China, likely to be a drag on consumer spending as well. I think in a world that looks like it's in quite a lot of flux, probably what we can say about China is solid and consistent.
Oh.
All right, Richard, thank you very much for joining us. Appreciate your time here on CNBC TV18. Good conversation. and a good perspective as well. 2 points there, Surabhi. Have you heard from China, by the way, that they're okay with what Trump announced?
No, because remember, the last we heard was when both presidents sign off on the deal.
But have you heard from the other president? No, right?
We haven't heard anything at all because then the missiles started getting...
That is what I'm saying. So I don't think that deal, even
It's
a
not done.
framework deal, I don't think I mean, rare earth for allowing students into universities. I mean, we'll have to see if that is the deal which China really agrees to. And by the way, over the weekend, there was news that Taiwan and Taiwan Semiconductor has stopped the sale of some high-tech technology to Chinese companies. So that's not going to be taken very well because of the implication that maybe it's prompted by the US in that sense. So this is still far from done in that sense. 78 points on the GIFT Nifty is what you have, about 1/3% higher. Let me just quickly run you through what's lined up here on the program as over the next 2.5 hours or so. 8:35. We have the S&P Global Commodity Insights experts joining us to talk about, of course, oil prices and where we go from here there. 9 o'clock, you'll have Amit Anwani of PL Capital to talk about key trends in the capital goods and defense space. 9:20, Shiv Puri of TVF Capital Advisors will be talking markets. 9:30 in the morning, Prestige Group with their thoughts about F526, outlook, demand strength. Sandeep Ghosh of Birla Corp will be speaking with us at 9:40 to focus on the cement sector outlook. 9:50, Sunil Vaswani of Container Shipping Lines Association and Dushyant Bulani of Federation of Freight Forwarders Association in India will join us to discuss the impact of tensions and, of course, the actual real conflict on the ground between Israel and Iran. And it's the economy. 10:15, Lata in conversation with Navdeep Suri, former ambassador to the UAE and Egypt, about the likely course of the Iran-Israel war. So it's a lot about geopolitics this morning.
Well, time to slip into a quick break. We've got a lot of stock-specific action track for you, and we get to that in just a bit on the other side of this break. For the time being, I give you a sneak peek into the list. Vedanta, SpiceJet, Godrej Properties, ONGC, Oil India, all of them will be reacting to positive news flow. While we've got 5 apiece today, on the negative side, Sun Pharma, Asian Paints, Berger Paints, IOC and BPCL will be reacting to negative news flow. Take that break, come back, get into further detail on all of these names.
Welcome back. So the cues across Asia are actually not too bad. I mean, even US futures have been flashing a little bit of green. Some of the Asian markets are also trying to move beyond the Friday fall. Let's pull up the implied open. We'll get some sense of how things are. Hang Seng is still flat. The Japanese market actually is doing a little better, 1% higher. And the implied open, I think, is going more with Japan than with China, because we're getting a sense that we might start 70 to 80 points higher. Well, that's the overall setup. What's the individual or specific stock level action looking like today? We have a team standing by with a CNBC-TV18 list of top stocks to watch. There was a fair amount of pharma news over the weekend. Let's start with the Sun Pharma. Ekta, morning.
Morning. Well, yes, Sun Pharma is in focus because the US FDA completed the inspection at their Halol facility. They've issued them 8 observations. The plant, remember, was inspected from June 2nd to June 13th. It has an import alert on it since December of 2022. So these 8 observations and what the nature of the observations will be quite critical. Now, additionally, there is succession planning which is taking place at Sun Pharma. Kirti Garnaukar is now appointed the MD of Sun Pharma effective September 1st. This is succeeding Dilip Sanghvi, who is stepping down and will be focusing on the specialty portfolio and the strategic oversight. Kirti, remember, has been with Sun Pharma since 1996. Separately, the company says that this marks the culmination of a structured succession plan at Sun Pharma. Dilip Sanghvi, remember, he's the Alok Sanghvi, who's the son of Dilip Sanghvi, was elevated to COO in Feb 2025, and his daughter Vidhi Sanghvi was made director in May 2025. So we've been seeing the signs, and now eventually Sun Pharma is going to have a new MD come 1st September.
Okay, all right, Ekta. Thanks a lot for that. Well, I'm looking at Vedanta, actually. They put out a release that they're going to be meeting in the next 2 days to consider paying out their first interim dividend for this fiscal. Remember, they've been a dividend machine of sorts, and they've also put out the record date. Now, Vedanta will be in focus because of this, meet that we're looking at with regard to a dividend payout. So the street will be a little bit excited on that. They have some part of their EBITDA that comes in from oil as well, and the spike in oil prices will be good for them. And also the third factor is they're very, very close to announcing that demerger date by the second quarter is when you're expecting it. So all of this will keep the stock in focus for today's trading session, going with some green on this name. That said, we had a bit of a turnaround quarter coming in from SpiceJet. Vinny joins us to tell us more about those numbers. Vinny?
Hi, good morning. So yes, a turnaround quarter surely coming in for SpiceJet. Overall, in terms of FY25 also, their revenue, this is the first time they've reported, the profit. This is the first time they've reported a profit in 7 years. So that is a good number coming in there, 48 crores versus 404 crore loss last year. So improvement there. There was a Forex gain versus Forex loss. That is also a factor that comes into play. Other than that, they've actually seen a reduction in terms of fuel cost, airport charges, maintenance costs. Passenger yield, that has seen an improvement in FY25, 5.18 versus 4.9 last year. Improvement in terms of revenue efficiency is what the company is seeing per seat kilometer, which is a measure that you take in aviation, as well as market share remains stable around the 3.3 to 3.4%. So keeping an eye out on that. Revenue. Now, overall, when you're looking at that revenue number, there is a decline coming in. Why? Because there was a revival plan which was there for grounded fleet for the company. Now, that has taken a bit of a backseat. There's a bit of a delay coming in. Yes, it's in a process and progress over there, but still a bit of a delay versus what the street was expecting. And that is why an impact in terms of revenue. So we are expecting green, given that, numbers are good in terms of profitability, margin front as well. But do not forget, Q1 FY26 could be a bit of a bleak quarter given the global tensions that are coming in, and this was already highlighted by Interglobe Aviation as well. So let's watch out for that. As of now, green is what we could expect for SpiceJet.
All right. Thanks very much, Vinny, for that. So that's SpiceJet for you. Godrej Properties is the next one. Ria has got details here. Ria, morning.
Good morning. Godrej Properties will be in focus today since the company is set to develop a 14-acre land parcel in Bangalore. Now, this is for a premium residential development with a saleable area of about 1.5 million square feet, and it has a revenue potential of around rupees 1,500 crores. Now, the company has stated in its press release that this is an important micro market for them, and it continues to see strong demand. And remember, earlier the company had also said that they expect to undertake business development worth about rupees 20,000 crores in FY26. So overall, positive news flow for Godrej Properties, expecting it to open in the green today.
Okay, Godrej Properties going ahead with more plans in Bengaluru. Got that. Thanks for that, Ria. Let's now talk about the flare-up in crude oil prices. Of course, it was quite the headline on Friday, but even this morning, the bid is still on the upside. Manisha is here with more details. Manisha, so tense developments over the weekend.
Oh, well, yeah, absolutely. But you know what the markets really are reading is that we haven't seen a direct attack on the energy facilities, nor have we actually seen a wider conflict. So the initial thing is what the markets have already factored in right now. As you said, it was 7% of gains on Friday is how we shut the weekend. But we also are trading nearly a percentage point on the higher side for the crude oil prices right now. So Brent did hit 78.5 on Friday, trading around 75 at this point in time. The street will continue to watch on the Israel-Iran exchange attacks. The markets also are looking at possibility that the conflict could push more restrictions on Iran oil. These are the premiums that can build in on prices. Even more interestingly, on Friday, you saw the highest volume on August 2025 $80 call option. So the markets do believe that you can see those prices going forward from here. Interestingly, it was the shorts that were unwinding. Fresh longs in futures is something that has been missing, is the reason you haven't seen more follow-through buying coming in for the crude oil prices. But from here on as well, the statements coming in from Trump warning Iran against attacking U.S. facilities in the region. Also, Trump setting tariffs for trading partners in coming weeks as a statement as well are some of the factors that do add to uncertainty, keeping the crude oil prices in favor.
All right. Thanks very much, Manisha, for that. So, oil, of course, a lot of the discussion over the next couple of hours, through the course of the day, actually, is going to be centered around what happens here. Well, let's quickly run you through the list of stocks that we put out. So, Vedanta, SpiceJet, Godrej Properties, ONGC, Oil India are stocks with some green this morning and potential negative news flow. Sun Pharma, Asian Paints, Berger, Indian Oil Corporation, and PPCL. So downstream stocks perhaps a little under pressure once again. We'll take that quick commercial break here. We're going to focus on oil with, as I said earlier, the guest at... Okay, I think we have Surabhi, the S&P Global Insights guest with us.
Yes, absolutely. Crude oil dominating the headlines considering the developments in West Asia. So let's discuss this with Zui Huang, who's Director of Research and Analysis at S&P Global. Thanks so much for joining in. I really hope I got the pronunciation of the name right. But what's your sense, given what we've seen? I mean, till now, there is no talk of negotiation or de-escalation. But there's also no clear commentary on whether Iran is going to try and choke off the Strait in any way, the Strait of Hormuz. So what about your opening thoughts, Zui? How have you looked at the last 3 days of developments?
Thanks for having me. By the way, you are pronouncing my name in the right way. So absolutely,
Glad.
in the last Friday, we saw the oil prices spike by more than 7%. And even today, I think we saw all the high opening of oil prices before gradually going down a little bit. I think the two key messages from S&P Commodity Insights, the first one, I think, is more, yes, all of the tensions between Israel and Iran will definitely cause potential market concern about the disruptions of the oil supply. But so far, the target from by Israel targeting Iran is more focused on, number one, military, number two, nuclear facilities. And there's no deliberate tensions from Israel to target the oil infrastructure or the trade flows, not to mention the trade through the Strait of Hormuz. And number two is also very important, right? So over the weekend, we saw a lot of the fire exchange targeting for example, the refineries in Tehran refinery and also the gas treatment facilities in the South part in Iran. But all of that is more constrained within the domestic market of supply-demand balances. It is still not being impacting the exporting market so far.
So would you say that if the conflict remains in the boundaries of what we've seen, that there's no move to have some sort of an oil embargo at the Strait of Hormuz, and if it doesn't target any further refineries or any other specific oil storage capacity, then do you think the market has seen the worst of the price shock?
I think so far, based on the mass market reaction, the answer is yes. So first of all, if you're just looking at the history, the Strait of Hormuz actually has never been closed. Even during the Iran and Iraq wars in 1980s, actually it hasn't been never closed. And number two, for example, right, so if really Iran triggers some attacks targeting those vessels transiting through the Strait of Hormuz, we're actually not talking about only 1.2 million barrels per day of crude oil exports solely coming from Iran. We're actually talking about more than 20 million barrels per day of crude oil and refined product supply to the entire world. And that will drag the Iran into the tensions not only between Israel, but also between the other Middle East oil producers. And we think that is something that Iran definitely cannot afford to.
Let's get to a couple of levels then. The worst case scenario, where do you see crude oil prices move? Because, even with the geopolitical tensions, it's not yet got past the high that we saw on Friday, which was around $78 per barrel mark. Where do you see it headed? Because as it is, there was a supply issue. The OPEC has it in their power as well to pump a little bit more crude into the market. So best case and worst case scenario, where do you see crude oil prices move to?
So first of all, for the extreme bullishness, right? So if we say in the next coming days or weeks, if there's major disruptions for only Iranian crude oil export and infrastructures, and we're talking about at least 1.5 million barrels per day of crude oil exports coming out of Iran, we will likely be paralyzed in that kind of extreme scenario. Then next year, we will see the Dated Brent will likely ramp up, standing above $70 per barrel at least. But we think that is very unlikely. And in the relatively bearishness scenario, I think so far, which is our base case, we think that the current tensions between the two sides to the oil fundamentals will likely be very short-lived. After summer, when the crude oil burn is finished, when the refinery spike up is finished, we think gradually the oil market spike prices will be turning into a bearish mode, leading to the crude oil inventories. And then given that additional barrels pushed out by the OPEC Plus in coming rounds of negotiations and monthly meetings, we think the Dated Brent prices will likely stay and reach to around 50s by the end of this year.
Oil prices Brent around 50s by the end of this year.
Yes.
Well, we won't complain as an oil importer. Major oil consumer India definitely won't complain with $50 a barrel. Zway, before we let you go, do you look at gold as well? Because obviously this entire geopolitical situation, it led to an upward bid. Any thoughts there?
For gold, for the moment, I'm more focused on the crude oil market, but I do see the spike in prices of gold in past days because of risk assessment in the market.
Okay, all right, got that point. Thank you very much. Good perspective. It's good to get that context that beyond the immediate geopolitical headlines, you're saying that demand supply in the crude oil market is very, very comfortable, and at least S&P sees crude oil prices heading lower by the end of the year. Well, with that, let's quickly move forward. We'll take a break, come back on the other side. We'll have Dipan Mehta joining in. We'll discuss some individual stock ideas and, of course, look at the other cues as well.
Welcome back. You're tuned in to Bazaar Morning Call and hope you're having a good start to the week. Well, let's get in Deepan Mehta, who joins us on the show. Hi, Deepan. Good morning. Good to see you in as always. Well, it's an interesting phase for global markets yet again with this, Iran and Israel conflict not showing any signs of de-escalation, not as yet as well, though that's the hope. But we have a lot of stocks that are going to be in focus. Now, crude oil prices has spiked up. That obviously will be one focal point. That's why we'll have Vedanta in focus among other stocks like ONGC and Oil India. But I wanted your view on Vedanta. They're going to be considering a dividend in the next couple of days. There's a demerger, which means it's a special situation that will play out in the next 2 months at most. And also, you have valuation support on this name. What's your view on Vedanta?
Good morning, Nigel, and thank you for having me on your show. I think we are positive on Vedanta and have said so, I think, in the past as well. Amongst the best metal stocks to own at this point of time, as well as the fact that, yes, I think whenever they are going to, split the company and have separate listing, some amount of valuation unlocking will take place. And I think that after that, if the promoter group decides to exit out of one or two of these businesses, it will make the holding company even more secure. And whatever last around the holding company, those also will get resolved. And the company has been gradually expanding a capacity as well. So generally positive. And one last thing, Vedanta's earnings are very much dependent on Hindustan Zinc. And Hindustan Zinc should do extremely well because of higher silver prices. So from that point of view, one could consider buying Hindustan Zinc along with Vedanta because that's a separately listed company and will remain independently listed. So I think that's just one aspect which comes to mind.
Okay, Vedanta in focus, got that. Deepan, I was looking at the price chart of Z and Z has turned around quite interestingly. I mean, along with the whole market recovery in April, May, Z's had a good rally. Maybe we can pull up a one-year chart of Z. The stock had hit a low of around 90. And since then, now it's back to almost 137, 138. The board is meeting today. They could be considering all kinds of options to drive the business forward, maybe even fundraising. Yeah, that's the recovery I'm talking about. So March is when it hit that low of around 90. And since then, it's managed to recover, though, of course, still down on a 12-month basis. Any interest in this company and stock, Deepan?
I think that we are putting it back on our watch list. And the reason for that is that the management's intense focus on improving the profitability, especially the profitability of Z5, their OTT venture. And that's still bleeding, although losses have come off significantly. And once that starts to break even, which is the plan in the next year or so itself, that will give a big delta to the earnings of Z. And valuations are attractive. I think all uncertainties around management, around merger are over and done with. And I think the company will find its place as a player in the media market. And you could expect earnings to move up because of lower losses. And eventually, I think P multiples also can improve for Z. So it's a great counter-tactical play. And investors, who prefer to go in for distress assets and look for turnaround stock, I think Z is a great investment opportunity from that point of view. So constructive and very positive on Z. But look, it's a company which keeps on swinging surprises from time to time. So we hope that there are no new surprises in terms of any issues in the balance sheet or any such deals that the management has done in the past.
Okay, so Z, you're still weighing it a little favorably to see if this turnaround happens or not. But speaking of turnaround stories, SpiceJet finally has turned in a profit. But it's turned in a profit because revenue is down. I mean, they still don't have enough planes up in the sky. Would you view this as a potential turnaround, or is this a strict stay away?
I think if you have a high risk appetite, certainly you can look at SpiceJet as well. And clearly, I think it's very that there are going to be only at best 4 players in the Indian aviation market. But look, I think all our bets are on Indigo at this point of time. The largest listed company with holding market share, and last few quarters have been very good. Track record also has been excellent as compared to SpiceJet. So I think if you have a high risk strategy, you could get a decent outperformance in SpiceJet as well. But I think from a more stable and consistent performance point of view, still prefer Interglobe Aviation.
Still prefer Interglobe. Deepan, hi, morning. BSC is down some 10% from the recent highs. Any thoughts here?
Prashant, I think valuations are just too high for a business which is so impacted by regulatory changes and which day of the week the expiry takes place. and kind of cash market volume share not growing as anticipated. Sure, it's a great story, done excellent progress last few quarters or so, regained a lot of its lost glory, but valuation, at these levels, 70, 80 times, I'm not so sure it can give a great outperformance going forward.
The other areas are going to be defense. Again, I don't know, the news flow will continue. So the G7 meeting is on, starting today. This conflict, of course, keeps defense spending and all these things quite alive. NATO meeting is next week, where formally NATO perhaps may adopt the resolution to increase defense spending to 5% of GDP overall, compared to some 2% they spend right now. This morning, there are some reports that Japan and EU are planning a major upgrade to defense cooperation. So lots of chatter, but who's going to be supplying to and exports, etc. Companies like BEL have spoken about export opportunities, but the exports about $100 million for BEL can grow. But what is your sense here, defense, Deepan?
First of all, no, I think for exports to grow in a meaningful way, it's a very long-term kind of process. And again, they have to go through many hoops and many clearances before they can start exporting. There'll be government clearances also required. So it's a great story, sounds good, but it's not going to be immediately lead to higher earnings for any of the defense companies. Secondly, I think a lot of the positives have got captured in the stock price as well. I think all of these defense companies are trading at extremely rich earnings multiple, anywhere from 50 times to 150 times or so. And in the past, whenever we invested in such high P multiple stocks, although the earnings come through, the price doesn't go really anywhere, and opportunity is lost from that point of view. So I think as a strategy, investors should remain invested in the defense stocks which they have, because there's a lot of fancy around these stocks and a lot of investor interest and momentum. But I don't think the risk return favors a fresh investment or increase in positions in defense stocks.
Okay, point taken. And I think it's a good story, but is it a good stock to buy after the run-up? That's the question, and that's really important if you're an investor and not just sort of an observer. And they've been a point taken in that sense. We'll take a quick commercial break here. We're going to come back. Technical trades with Sudarshan and Mitesh on the other side. Conversation with Deepan continues as well. Okay, welcome back. Of course, markets looking like they get a bit of a higher start, but then we'll have to look at it on a company by company, stock by stock basis once things kick off in that sense. Deepan, lots of primary market action also in a way starting. Any thoughts on any of the recent issues which have looked good? By the way, we've had over the last 6 months, 7 months, lots of companies which have listed lackluster demand, and then 3 months, 4 months later, markets realizing maybe there is some value here. So all kinds of things going on. But for example, Friday we had this Oswal Pumps issue which opened. Any thoughts?
See, I think what you said, there's a strategy in that also, that where investors can avoid the IPOs because hardly any allocation takes place over there. And then on listing, there's a lot of flurry of activity, momentum. And then once things settle down, especially as a test, I think see 1 or 2 quarterly numbers. Because that's the real test for a good company, that after listing, what kind of performance comes through. And then see if the performance is really good, lives up to the expectation of investors, and valuations may have come off because of less momentum and less speculative activity. Those are good entry points. And for the record, Prashant, I think a lot of new ideas in the next few years will come from these new listings because a lot of innovative businesses, a lot of concept businesses have got listed. They're all in the small mid-cap space, and they're all in the kind of sectors where there is massive growth, unlike the mature sectors. So from that point of view, we are always looking for listings, new listings after 6 months to 1 year of listing. And I think a lot of interesting companies have popped up over there.
Okay, all right, Deepan, stay with us. For the time being, I think we'll slip into a short break. As promised, we'll come back with some trading ideas. Sudarshan and Mitesh will be joining in on the other side. We'll also get some pre-open rates as well. Don't go anywhere.
Okay, welcome back. So the cues across Asia, like we've been saying, are not too bad because some of the major markets like Japan, they're managing some green. And the implied open was telling us that, yeah, that's the Hong Kong market, still lackluster. But the implied open is telling us that we'll at least start with a bit of a bounce back. So let's discuss the trading setup and, of course, individual stock ideas as well. We have Sudarshan Sukhani and Mitesh Thakkar joining in with the latest. Gentlemen, good morning. Hope you both had a good weekend. So at least the implied open, Mitesh is telling us that after being in a range, consolidating and, weak by Friday, maybe there's a bounce back in store this morning. How would you play it?
So, Subi, I think I've been maintaining that this breakout failure which happened beyond 25,050 and the markets came below it again, which happened on Thursday. So just that we are back into the range. So 24,500 came into play early in the Friday morning with that gap down. Now, on Friday itself, the market had opened gap down. So that gap upper level is at about 24,800 and about, 2530 zone. So as long as that gap is not getting filled, I think don't turn positive. Just wait for the market to give a directional bias. My sense is that 24,500 remains a very key strong area. I would turn bearish only if we start breaking below that. But we'll take mild short positions or some put spreads or put option positions around the 24,800 mark, expecting the market to be choppy within this 300-point range. 24,850 on the upside to about 24,500 on the downside. So broadly, try to short it there with some small positions, try to cover around 24,500. Beyond 24,850, turn mildly positive. Below 24,500, turn slightly negative.
Okay, so basically 350-point range. Mitesh, thanks for that. Gentlemen, morning. Sudarshan, what about you? How would you look at things?
Yeah, good morning. Well, I have a different view. On Friday, the markets fell and that was normal. But the important point is that at 24,500, the Nifty said, this is the low of the trading range that was developed earlier, and I'm not going below it. And that level has held. Now, that is a message that this market is not really keen to go down and look for lower levels. It will go up whenever it wants. But if it is not going lower, at least for the time being, we want to become buyers. So the buying idea is wait for an intraday dip, go long, keep a tight stop at somewhere around 24,650, which is just below Friday's low, as per Friday's close, and then stay long and see what happens.
Okay, all right. Fair enough. So the buyer says to look for buying ideas in that sense. Sudarshan, what would your specific calls be?
Well, it's all on the buy side then. Tech Mahindra is a buy with a stop under 1625. BEL, again from the defense stocks, is a buy with a stop under 387. Glenmark is a buy. Glenmark has been doing remarkable things. Look at the charts. It's been an outperformer. Stop under 1640. And DLF, which is recovering from a decent correction, is a buying opportunity. The stop under 838. So it's an all buy list.
Mitesh, what about you? What are your trades?
I have one sell and three calls in the buy side. I still believe that, a lot of stocks are showing promise and can go on the upside. So I have a buy on Max Health with a stop at 1209 for targets of 1250. Glenmark features in my list as well for targets of around 1720 and a stop below 1644 is what I would look at. Astral is a buy as well with a stop at 1508 for targets of 1570. And one sell call, that's ITC. And generally, FMCG as a pack is slightly mildly negative to me. So ITC could possibly go down to 400, keep a stop at 420.
Okay, all right. Mitesh and Sudarshan, thank you both for joining us with those trading ideas. So one sell, three long ideas, buy ideas coming in from Mitesh this morning. We'll just quickly take a look at what's happening with the pre-open session, although maybe just a look, that's it, right? Ignore it. The GIFT Nifty was indicating a higher start, so we'll wait for at least 5 minutes before we look back at it. Let's get you an exclusive news update now. Sources tell CNBC-TV18 that the GST Council is likely to consider replacing compensation cess with two other cesses. My colleague Timsy is here with details. Timsy, morning.
Well, that's right. What we are given to understand from sources is the fact that the upcoming GST Council meeting could deliberate upon the proposal to have two new cesses which will replace the existing compensation cess. Sources clarified that these two cesses could be one health cess and the other could be a clean energy cess. However, this will be moved forward formally through the recommendations of GOM on compensation cess, which is chaired by MOS Finance Pankaj Chaudhary. The GOM on compensation cess is soon likely to hold its final meeting, under which there will be these recommendations which will be proposed for the council's consideration, and sources indicated that the GOM states are formally likely to agree upon this proposal as there is near consensus. Also important to note here is the fact that the council, which will discuss on this proposal formally once the GOM recommendations are put forward, might see some resentment from states. That's also something that sources shared, because states agreed to levy compensation cess only for a 5-year period, which was extended to pay off the back-to-back loans that were taken to give the compensate the states on the 14% guarantee, which was committed upon while introducing the GST in 2017. So let's see whether legally this proposal can be moved forward. Also, if there is an alternate, then what is that alternate? And yes, whether states will finally agree to give this particular share to the center, because compensation cess currently is given only to the states. Something that we'll have to wait and watch for.
Okay, all right, MC, thanks very much. So compensation cess will go away as planned, but then other cesses could, come as replacements, like MC is saying, maybe the health cess and some other, levies might also come in, which basically means that perhaps there's absolutely no hope of reduction for sure in terms of the effective GST rate on items like cars or even tobacco products. They've been very quickly, this is a moving story, and I think it'll get hotter and hotter as we get closer to the next GST meeting in July. But what's your take on some of the large auto stocks, which are right now above 28%, most of the big cars, the big SUVs?
No, that's wishful thinking that they will reduce the GST on anything at this point of time. Let it take place. I think no point speculating about these events as of now. This is a tricky subject, and there are a lot of vested interest in not reducing any of the GST rates or, clubbing them together, because a lot of state governments are heavily dependent on GST revenues for funding all the various subsidy schemes which they have announced. And as such, there's a big crunch as far as state governments are concerned. So I wouldn't bank on any reduction in the GST rates in the upcoming meeting.
Okay. All right, Deepan, we'll leave it there. Let's see how this progresses. Good conversation as always. You have a good trading day, and we will connect again soon. 9:03, so the pre-open rates are still coming in. And actually, it's still down. It's not as rosy as what the implied open was telling us. That was telling us it will be about 80 points higher. Pre-open, not that enthusiastic. 15, 16 points lower on the Nifty in the pre-open. Defense as a space continues to be in focus, and this is the one pocket of the market that continues to see a fair amount of trading action given the news flow. So let's talk about this. Amit Anwani, who looks at a lot of the defense stocks at PL Capital Group, is with us. Amit, good morning. Thank you for joining in. Even as we were discussing the domestic replenishment pipeline and what will happen with orders, now there is this, there's global conflicts everywhere, including in West Asia. Stock prices have also run up, so we need to, get the valuation perspective in place as well. But let's start with a very fundamental question. While companies may eventually want to cater to exports, do you see any of the current listed players being able to do that? Would there be any one or two companies, if you could share names, maybe Bharat Forge, I don't know, where exports could become a real opportunity, given that everybody is, arming or rearming, and global conflicts are seem to be like they're here to stay?
Right. Thank you, and morning to everyone. So just to put things in perspective, if you see the export for FY25 was about 24,000 odd crore. Last year it was 21,000 odd crore. And if you see past 5-year basis, the export has been growing, and government is talking about at least 50,000 crore export by FY29. That's the target to reach. So now if I see the private sector contribution, I would say my understanding and whatever data is available, almost 60 to 65% is export, which is going out for private sector. And this is especially largely pertaining to defense electronics and few platforms which we have seen, which are related to vehicles and related to, I think now we are talking about missiles to the friendly Indian countries, which is going on. So having said that, if you see the kind of global conflicts which has evolved, even Operation Sindoor and now the Israel-Iran, definitely there have been private companies who have been in trade with Israel as well. And after the Operation Sindoor, there's a lot of inquiry traction. Our check with the companies indicate that there's a lot of inquiry traction.
Amit, just checking that number that you gave us.
Yeah.
If I understood you correctly, you're saying out of India's total defense exports, which are somewhere around 23,000 crores, 60 to 65% of those exports are coming from private sector players, right?
That's right.
Within the listed ecosphere, which are the companies that you think over the next 2-3 years can really capitalize on this export opportunity?
Right. So I think if you broadly see, there are a lot of DPSU names as well as private names, but export currently as component, for example, Bharat Electronics have been talking about export, but current numbers are hardly 7-8%. They want to go at least 10% of revenue. And I'm assuming that definitely they'll be targeting a few geographies arising out of the current conflicts where they can export. So that is one. BDL has been talking about increasing export. HL, I would say, very long term, they're just at 4-5% export, but they're also talking about in engagement with few geographies for export. And there's a lot of list of long private companies, which is not under my coverage, but just to discuss, I think Tata Advanced System is also in talks for few platforms in exports, and then Astra Microwave, data patterns. I think many companies are focusing on exports, and I would say all these conflicts at first would definitely benefit defense electronics other than platforms, because platforms takes a lot of time to get approvals also. And I think our core strength, because of the offsets in the past, which all the smaller private companies have done, we have good potential with respect to the defense export in electronic side.
Right. And when you say electronics, Amit, hi, morning. What exactly do you mean? What kind of things?
Right. So we are talking about electronic warfare systems. We're talking about a few radar platforms which we have been exporting, optics as well. For a few platforms in Israel, few companies are exporting. So I think there's a long list of.
And of course, apart from that, there is the artillery and the ammunition, etc., which is more, You know, the other thing, so for example, if you followed news flow over the last 10-15 days, companies like the Korean giant defense company, Hanwha, I mean, with everything which is happening, right, you want supply chains close to you. So at times of conflict, you don't want to depend on imports from somewhere else, right? So, you know, Korea Aerospace Defense, these are all setting up shop in Europe. I mean, in the sense they're setting up manufacturing in Europe to supply to those European countries.
Right.
Do you see that also as a... but of course, we're talking about platforms, etc., which is not the case with India at this point in time.
Right.
Is that going to be a bit of a requirement when you look at this export potential? You know, defense spending will go up substantially, but maybe, you know, countries would like to be supplied from their own homeland and not from far away.
Right. So I think this would be pretty long term. But if you see what is happening in the near term, is that wherever we have good trade relations, whether it is Israel and wherever we have been procuring the long term platforms, I think clear-cut advantage with respect to export emerges. So I think in the near term, whether it is trade with Israel now, and many companies are exporting both sides from Israel. And I think even with respect to Europe, when I think few French companies are already doing offsets with Indian companies. I think in the first leg, this will emerge as an opportunity. With respect to, I think, supply chain closure, I think definitely that makes it more reliable. But I think that is very long term. I don't see that.
Okay, Amit, I'm so sorry.
Yeah.
Amit, I'm so sorry I'm cutting you off just because we're running into market opening very quickly. So the opportunity is there, domestic and export. Problem is stocks have run up. So kharidna kya hai?
Right. So if you see, I think almost there's 40-50% runoff which has happened from Feb. We talked about last time then when there was concern about numbers coming in. For me, I think shipbuilding is expensive. Almost 45-50x trade. I think even defense, Bharat Electronics is expensive. I think HL has still headroom, trading at about 36x my number. And there's still more than 1 lakh crore pipeline. They're already sitting at 1,20,000 crore. So I think there could be some headroom, but definitely valuations are currently concerning across defense electronics, especially the private defense electronics company. Despite this very strong pipeline, which is sitting for next 4 to 5 years, if I talk about.
Yeah.
So definitely, currently valuation-wise, I still feel there's a headroom for HL to maybe 5,500 plus. Also, we have target price of 5,500. Okay. But I think for few companies, I'm concerned right now with valuation.
Yeah, absolutely. Amit, thanks very much. Good speaking with you. As always, appreciated. 9:10 call. Sudarshan is here. Sudarshan and Mitesh. Sudarshan, what do you have?
Well, it's BEL. Consider buying BEL with a stop under 387.
Mitesh, what about you?
I'll go with a buy on Max Health for target of 1280.
Okay, all right. Thanks a lot for that, gentlemen. Well, let's highlight a couple of stocks. I'm looking at NMDC, 2 brokerage calls coming in today. Citi is one of them. They have a sell rating on the stock with a target price of 60 rupees. They think that NMDC's prices could correct in the near term. Few factors they've given out. Point number 1, NMDC's price premium to export parity should normalize. They point out that currently it's at around 40% premium. In the past year, it was at around 20% premium. So that's why they expect it to correct a little bit. Lloyds Metal, they've cited this example that company is looking to increase their iron ore capacity from around 10 to around 25 million tons in the coming fiscal. So that's definitely going to put pressure on pricing. They also expect domestic steel prices to correct as steel imports pick up. And they believe that iron ore market is likely to remain in a small surplus in 2025. Finally, they wind down on the valuations point that the stock is trading at around 6 times EV per EBITDA, which is not particularly cheap. Kotak is the other brokerage that is written on it. They have a sell rating, target price of 55 rupees. They say NMDC has cut prices marginally in this month, but they expect further cuts in the coming months. They also go on to highlight that domestic iron ore prices are at an 8% discount to import parity that compares with around 20% historically. They also point out that ongoing weakness in steel prices could trigger some kind of normalization. And finally, they also make that point with regard to ramping up of merchant iron ore mines in India and weaker exports. That's what could add some pricing on pressure. They wind the note down with pointing out that fundamentals of seaborne iron ore market remain challenging. So both Citi as well as Kotak have a sell rating on the stock. So keep an eye out on that one today.
All right, Nigel, thanks very much for that. So keep an eye out on these names as we are awaiting market open. There's less than a minute to go for the first rates to start to come up, and we will take it from there. Upstream oil companies and downstream oil companies, both ends of the spectrum. Although there was a recovery, mind you, the downstream companies like IOC, HP, BP also came off the lows quite a bit. But that is oil prices themselves. They were up 13% at one point, and they finally were up about 7% by the time we closed. So there was a bit of a recovery in oil OMCs as well. Upstream companies, Oil India and ONGC mainly, they were sort of trading up. So that's a sort of basic straight cut kind of moves that you usually expect with these large moves in oil whenever they happen. But apart from that, of course, there is a fair bit to track as well. So the pre-open in the Nifty has left us with a small 10-point, 13-point move. Sensex is down about 84, so it's a bit of a mixed kind of start, which we are seeing. So 24,700 on the Nifty, and the Nifty Bank at about 55,570. They are absolutely flat rates. You've got the small cap index, which is down about 0.5%. The mid cap index will come up on your screen. And I think there also it's 70 points, 70-point greens. 58,340 is where the mid cap index is at. That's it's absolutely unchanged, flat, whatever you want to call it, across the board, except the small cap space, but there is a little bit more pronounced kind of move on the downside. More up than down though, 30 up and about 20 down. That's the Nifty heat map, which is coming up on your screens right now. 56 points. So looking a little better on the Nifty, about a 0.25% higher, 24,774. Surabhi.
Okay. So now it's actually a 50-point move on the upside, looking good. What's up? Power Grid, about 1.4% higher. By the way, you're seeing a very different rate on Bajaj Finance today, right? Because stock is looking at a 4:1 bonus and a stock split as well. So therefore, the price has adjusted. Bharti Airtel 1% higher. Cipla is about 1% higher. L&T is managing 0.5%. BEL, UltraTech Cement, so lots of stocks. And actually, even the Bank Nifty's turned positive. Now, it was red, but it looks like it could be changing direction. HDFC Bank, for instance, up about 0.5%. HCL Tech, Infosys. So actually, it's a wide recovery, you'd have to say, overall. And it's cutting across tech, some IT names, some economy names like L&T as well. On the downside, Sun Pharma is lower by about 0.5%. Market is going through the interpretation of the latest observations for the Halol plant for the company from the US FDA. Reddy is also lower, about 0.5% on the lower side. And then there is Coal India, which is a little weak. Other than that, now the bias seems to be getting positive. 60 points up on the Nifty.
Well, that's right. So we keep an eye on a couple of names. SCI has moved up. That's up close to around 6-7%. So big up move is what you're seeing on that name. Vedanta is another stock that's moved up. Remember, they have that, meet for dividend payout in the next 2 trading sessions. And the oil price spike as well bodes well for that. So that's up close to around 1.5%. Besides that, keep an eye out on PI Industries. We had made this point in the second half of trade, even on Friday. Quoting an Equerris note, well, they said that, in fact, the export data was very, very strong out there. And take a look at the move you're seeing on PI Industries. Big move out there. Stock up close to around 4%. For the first 2 months, that's for April as well as May, you had the revenue number, export number, that was up by 20%, and Equerris was factoring in a 30% uptick in terms of EBITDA. So clearly, they're factoring better operating performance. Besides that, name another couple of big stocks that are moving. You have FDC from the broader markets. That's up close to around 9%. I'm not sure what's the news piece on this one, but that's moving very, very well. And Eris Life Sciences, that's another name that's up close to around 5%. So big move is what we're seeing on both these two stocks in today's trading session. On the flip side, Blue Spring that listed last week, that continues to be at lower circuit. That's down close to around 5% or thereabouts. But you have to say that it's actually an encouraging looking start to trade. The Nifty is up close to around 80 points. The 20 DMA comes in at ballpark, 24,835 approximately. So you'll want to keep an eye out on that mark. And the Nifty Bank, you'll want it to get closer to around the 20 DMA as well. So good start to trade.
Yeah, no, absolutely. 80 points now on the Nifty. So we've got, 24,800 coming through. There are lots of momentum, individual names. Reliance Power, for example, I think is up 70% this year. It's up another 3% this morning, almost 69. Second largest volume traded gainer coming through this morning. MCX is up about 2.5%. That is our power. Look at 3.6 million shares now. MCX is up 2.5%. MCX, of course, had a move last week as well. So third largest volume-led gainer. HBL Power, basically, 4% higher. Fifth largest volumes on the NSE, at least at the word go. GE Shipping is up, coming up with 2.5% gain. Shipping Corporation, of course, 4. GE Shipping is up 2.5%. Bellrise, by the way, recent listing, that is coming up with a 3% pop at this stage. What else? I mean, Midhani is up about 1.5%. You go down the list, there's more, but I mean, point is volumes dry up very fast. Cosmo first, right? I mean, it's basically seen a little bit of consolidation, but it's up 5% this morning, although volumes are not very large at this point in time. So that's the overall picture. Jubilant Ingreva had that massive move on Friday. It basically moved up from 680 to about $800 on Friday. It's coming off a little bit, just 2.5%, but it's got volumes on it, so that's why I'm mentioning it. HDFC AMC is down about 1% or so. Intellect is down about 3% or so as well. So that's broadly the lay of the land as far as the market open at this point. Shiv Puri is with us, founder and managing director at TVF Capital Advisors. Shiv usually sort of comes on and joins us from Singapore, but I think he's joining us from a very hot and sweltering Delhi. Shiv, good morning. Good to have you with us here. Come to Bombay. I think it's much better weather. It's raining and it's monsoons are finally here. I think you are coming. So.
Yes, I am. Yes.
How are things going, Shiv? I mean, markets, of course, doing their own thing, and despite all the turmoil in the world, equity markets pretty unaffected, at least the big global markets largely unaffected in that sense, right? Dips have been shallow, swift sometimes, but very shallow, short-lived, and always money looking to buy, especially here in India. What's your assessment now, Shiv?
Well, I think globally, if you look at it, the biggest worrying factor is really geopolitics. And as long as geopolitics remains localized, it doesn't become a global problem, markets are seeing past it because earnings are still pretty good, at least in the West. In some of the big tech names, earnings have done very well. Here in India, you're seeing the last 1 year where earnings have slowed down. But as I look forward, you've seen a few things happen that I think will be quite constructive for the markets. So first is that liquidity in the system has gone up. You've seen the Reserve Bank cut interest rates, cut CRR, and that's an important factor. Second is you're starting to see pickup in rural consumption, which is always a good thing. Third is government capex seems to be coming back on stream again. And the two other areas, which is private capex and urban consumption, are the only two things that I think have plateaued. And a lot of that is because a lot of urban consumption is because of the tightening by the lenders for unsecured lending. So if you look at the layout for the next sort of year or 2 years, the backdrop seems pretty constructive. And finally, I'd say, come September and December, you'd see that in the base effect as well, because that's when you really saw the earnings slow down last year. So you'll have a favorable base as you go later in the calendar year.
Yeah, and then maybe, eventually those earnings numbers start looking good. Shiv, good to have you on the show this morning. Thank you for joining in. So since you sound fairly optimistic and constructive on equities, including perhaps India, what's the approach to the market now? What parts to buy? Where do you still see some semblance of, let's say, valuation sanity, if not valuation comfort?
Yeah, so they say you need three things to have a constructive market, right? You need liquidity or easing liquidity, which India has. You need a good long-term fundamental story, which India has. And you need cheap valuations, which India does not have. So it's the third part that is going to be a little bit of a limiting factor in terms of returns. But if you look at valuations, there's quite a big disparity between what you see in the large cap established names versus what's happening a little bit in the mid and the small cap names. And I've always had this fundamental view over the last 2 decades that the big companies do end up getting stronger. And we're seeing that. We see companies in India with 20, 50, $100 billion market capitalizations, growing at very, very healthy rates. So if you're seeing sort of the larger cap names, the names in the indices continue to power ahead, I think that at reasonable valuations is a pretty good place.
Let's get to your top sector focus then, Shiv. What are you bullish on? I recall, in the past, we've spoken about that IT a little bit cautious on that space, and that's been pretty much on the ball with regard to that call. Currently, how are you placed in this evolving global landscape? You have Trump's tariffs that are at play, geopolitical issues as well. Which is the sector you're most comfortable on?
Well, I think more than sectors, there's a lot of opportunity on a bottoms-up basis, which is the way we've always thought about investing globally. And if you look at but sectors, financial services, healthcare, especially hospitals, consumer discretionary, are probably three areas that are looking pretty good. I don't think much has changed. When we were talking about a year ago, I was talking about the same things. So I think that still looks pretty good. And there are, different pockets of interest. You look at the online recruitment space. There is a particular company that's, continues to do well, and that has diversified its business. So you have to just look at some of these bottoms-up opportunities. But I would highlight those 3 or 4 sectors.
Shiv, that second point that you said that a bull market needs 3 things, good long-term story, liquidity and valuations. That second point, liquidity, let's face it, the money that mutual funds were getting every month, those flows have halved from the peak. It's still not hurting because the SIP book is very, very strong. But could that become a concern if the market doesn't rev up again? Because FPI flows have been patchy at best. Your thoughts?
Yeah, so I think liquidity is 2 parts, right? One, of course, is flows, but the second is what the Reserve Bank does, liquidity in the system, which has been very tight the last few years, but now has loosened considerably. So it's also liquidity in the economy, and that's sort of where I was coming from more.
Yeah.
Okay, take your points. We're talking more from a monetary markets point of view. But just to complete, my question was really that we don't have very strong MF flows as of now. And foreigners, I mean, we keep hearing that India is a great long-term story, but we yet to see a very consistent one-way move in terms of foreign flows.
Yeah, but I think one of the things we've seen in the last few years, right, is the dependence on foreign flows has declined significantly for the strength of the Indian equity market. And maybe over the last few months, things would have slowed down, but we've also come off very high numbers. In absolute terms, the numbers are still very strong. I don't think significant more liquidity from a flow standpoint is needed into the equity markets. Once the economy starts picking up again and you're starting to see the conditions perhaps laid out for that, and the equity markets start responding, typically capital tends to flow with a little bit of a lag.
No, absolutely. Point taken. So the three areas, right? Financial services, hospitals, I remember you've had a long-held view, and consumer discretionary. These are the three buckets where you are looking at looking for opportunities. Financial services, I remember, it's all large caps, right? In that sense, Shiv? I mean, it's a place littered with lots of accidents, across, banks, NBFCs, MFIs, except the top tier in that sense. And that's where those are positions you hold?
And that's exactly the opportunity, Prashant, in financial services. It's because it's littered with accidents, the ones that do not get into accidents tend to compound really well over the long term. I mean, very few people would realize that over the last 12 months ending March, the fiscal year ending March 2025, the largest private sector bank was the best performer in the Nifty. So it's also a case where if you avoid the accidents, you actually get significantly ahead.
And just to revise your thesis on hospitals and what you own here, and how are they looking now? Because, I mean, lots of names have run up. Even some of the what used to be laggards, Narayana Health, etc., new all-time highs, strong performances over the years. What's the thesis now?
Well, hospitals as a category actually is a very tough business, and it's historically not done well globally. But in India, we have a few things that are different. Number one is highly underpenetrated. And so if you have quality care at scale is very important. So brand and scale really matter in this business. And you're able to build clusters in the major markets that have established need for healthcare. If you're able to attract the right doctors, therefore attract the highest paying patients, it becomes a virtuous cycle where the return on capital can be very, very high. And it's one of those industries I think you look at in India and say, if there were a few more hospitals or a few more hospital chains, you don't see the beds will be lying empty. The beds are lying empty if there's a problem with quality or consistency in healthcare that's provided.
Valuations are still okay, Shiv?
Valuations there have run up a bit, but I think, again, it depends on how the company is allocating capital. There are very few companies who are doing it smartly, where they are becoming effectively quite capital-light through brownfields, through management contracts, etc. And so, the downside on hospitals is it's a capital-intensive business. And if you're able to solve for that, it becomes a very attractive business.
All right, Shiv, final question before we let you go, leading into our next discussion on real estate. What's your thoughts on the theme, the real estate theme here in India? The developers who join us on the channel say they're in the initial years. Some believe that maybe we're in the latter years. How are you placed on the real estate stocks? And also, if not the real estate stocks, do you have a view on the ancillaries, say the pipe makers, cement, or the likes?
So we've never done anything in real estate, so I can't really comment on that. But in terms of the ancillaries, I think the important thing to keep in mind out there is what is the moat of the business? What's the barrier to entry in that business? There's certain ancillaries where that's very high and they've done very well. But in most cases, it is fairly commoditized, and pricing tends to be the decisive factor, which makes the business a lot less attractive. So to me, that's the number one thing to keep in mind for the ancillaries there.
Shiv, consumer discretionary, the third one, which you kind of alluded to. Talk to us about what exactly are your ideas?
Well, so over there, if you look at, perhaps one of the most successful retailer in India, it's a very difficult business, retailing. And if you get it right, some of the wealthiest people in the world globally, whether it's the Waltons or whether it's the Adidas family or whether it's the Aldo family, etc., have done it through retailing. And it doesn't necessarily have to be grocery retailing. That's not the only way. But there is a retailer who's I think really started to crack the model the last few years, and the upside there is huge because the market's very underpenetrated at the moment.
For educational purposes, nothing else. Shiv, which one? Sorry, which one are you talking about? Are you talking about the whole spectrum? You're talking about Trent or Titan or?
Well, I can't talk about names, Shant, but I think you're on the right path. Your guesses.
Okay, all right. Got that. I think we'll leave it there, Shiv. Good speaking with you. Appreciate you joining us and running us through that view. Helpful. I mean, in terms of when you sort of look through the day-to-day moves, to have a framework in mind. And I think Shiv has provided us with some of that, especially as far as financials and healthcare and especially consumer discretionary retail is concerned. So that's Shiv Puri of TVF Capital. Markets are up about 60 points. 24,774 is where we are at, guys.
Okay, all right. So the market's actually doing better than what the pre-open session was indicating. Seeing some stability on the green side, at least for now. So the next sector that we're putting on the radar is real estate. And specifically, we're talking about Prestige Estates. Now, Prestige had, a bit of a, if you can say, lackluster, not such a great year FY25 because a couple of the launches and projects got delayed. Which is why for the full year, the new sales picture was slightly lower. But their guidance is very strong for the current year, FY26. They're saying that the launches planned are for 44.8 million square feet, almost 45 million square feet, compared with about 25.5 that they did in FY25. And likewise, their pre-sales target is 27,000 crores for this year. Mr. Irfan Razak, Chairman and Managing Director of the Prestige Group, is with us. Mrs. Razak, great to have you on. So that's what we really want to try and understand, that, the nuts and bolts behind the numbers and where the optimism comes in from. Can you take us through, what's going to drive it? You've been launching a lot of projects here in the Mumbai market as well. NCR is a market. You've got a JV going in Chennai. So what makes you optimistic that the development this year, the pre-sales this year, will be substantially higher than the last one?
Good morning. Thank you. Actually, we had to bring in a lot of inventory in the last financial year, which got delayed because of various reasons like approvals, RERA number and other stuff. But that's behind us. And this quarter itself, current quarter, we've done a lot of launches, especially our NCR project, which is the Prestige City Indirapuram, and that's done extremely well. And we have a slew of launches that are lined up in Bangalore, in Chennai, in Hyderabad, as well as in Mumbai. So all this, sum total of that, we are pretty confident that the guidance that we've given this year will be surpassed. So that's the whole idea. In fact, this current quarter has also been a strong quarter, and I believe it will be one of the strongest quarter the company has had ever. So this helps us in that confidence. As I said, we've launched the Prestige City Indirapuram this quarter, and we've did the Prestige Gardenia Estate, a plotted development in Bangalore. Now we're gearing up to launch the Prestige Pallavaram Gardens in Chennai, and a whole lot of other projects as we go along. And there's a lot of excitement in the system. The market is good. Okay. Basically, there is demand, and there are people who are ready, willing, able to buy and to invest, and that gives us the confidence.
So that's an overview on the year. I just want to get a broad sense on pricing as well. Then we'll get into the various factors, including what you're saying is a strong Q1. Last year, your average realization across the portfolio, I believe, was around 14,113 to be very specific. So 14,100 rupees, give or take, which was substantially higher than the previous year. What is pricing telling you in all of your different key markets? Is there further elbow room? What is the kind of price appreciation you'd expect across the portfolio this year?
See, we do not want the price to run away very fast, and that's not good for the market, not good for the consumer itself. So our endeavor has always been to see that when we bring our product to market, it's priced sensibly. The company's bottom line is protected, At the same time, the affordability is not reached in terms of the buyers. Now, this is a challenge. Yes, land price has gone up, the construction price has gone up. So we have to sort of do the balancing act and make sure that the size of the product is right. At the same time, the ticket size has to be affordable. So it has gone up. There's no doubt about it that the price, if you look at it per square foot or ticket size, price itself has gone up. But then we don't want it to breach a barrier that the product becomes completely.
So a range, maybe some rough range. I understand that your intention is not to really squeeze out your buyer. But given the realities at hand which you describe, I mean, 10%, 15%, single digit, what's the kind of price rise that you think will be palatable?
I mean, I won't give a percentage like that, you see, but if you ask me now, it depends. Each segment of the market is a different pricing. Now, if you take the luxury market, it's a different, acceptability on the price. If you take the mid-market, even a single-digit price hike also will be a problem. So I believe that the balance has to be there. And if you ask me, in the mid-market, a price increase between 5 to 7% is imminent, and it'll happen. And that's where we'll try and control it. And of course, in the luxury market, it'll be much larger.
Got that. Mr. Raza, good morning. Always good to speak with you. Prashant here. The big Indirapuram project, sir, could you give us what is the status now?
We've launched the project, 2 components of it. The last component, Mayflower, we've just locked in for RERA. We're waiting for that. All 3 components of the project is totals to about 4,000 units, out of which 3,400 have been launched. And it's done well. I mean, there has been a good response, and people have responded positively, and the numbers are pretty healthy.
3,400 out of 4,000 have been launched, and is it possible to define? I mean, when did all of them go online in terms of being launched, and what's been the response quantitatively? If you can give us a sense.
Yeah, I mean, to give you numbers, we launched 3,400 units. That was in this quarter itself. And we are pretty happy to tell you that we have almost sold 2,800 to 2,900. The numbers could vary because there's a dynamic change every day. But that's the level of sales that have happened, and that totals to quite a large amount of sales, which is 7,000 plus crores only in this one single project. And also the collections on this project have been pretty strong.
All right. Hi, Mr. Razak. Good morning. Good to see you in. Nigel on this side. Sir, a couple of quick questions. Prestige Hospitality Ventures, the DRHP you have filed. By when do we see the IPO?
See, we filed the DRHP. Now we are waiting for the nod from SEBI. As soon as the nod comes from SEBI, the bankers are working on it. All the compliances have been done. And we believe that if everything goes well, we could hit the market as soon as we get the SEBI nod.
So sometime in the middle of this fiscal would be a fair guesstimate?
Yes. We are trying hard to see that we bring it in this fiscal. If possible, maybe in the next quarter itself.
Okay. And what kind of quantum of money will you be looking to raise?
Yes. In this, there'll be 2 parts. One is an OFS and the other is a dilution, primary dilution. All put together, we'll be looking at about 3,500 plus crores.
All right. And that brings me to what is the current debt in your books and what kind of capex have you lined up for this year?
On the hospitality side, there is substantial capex, but then now the way we have planned is to, the whole objective of this issue is to see that we clean up the entire debt in the books that is available for the hospitality. And that gives us elbow room to do further acquisitions if we, as and when the growth capital will come. So that will help the cause of the company itself. And we have a slew of operating assets. At the same time, the largest asset that's under construction, which we hope to complete, is the Delhi AeroCity Hotel, which is St. Regis and the Marriott Marquis. And that's the largest hotel in the country in terms of keys. At the same time, it's a big convention and exhibition center of 225,000 square feet.
Okay. All right. Very quickly, what about the Pali Hill project? That's a much awaited, one of the newer projects, newer geographies that you got into. How much of it has already been sold out? You have a celebrated Bollywood couple opposite, Ranbir and Alia have moved in. How much of it has already been sold out, and by when do deliveries start getting rolled out?
Yeah, see, Pali Hill is actually the smallest of the projects that we are doing in Mumbai, and the most challenging because the terrain is such. And we've, like you rightly said, we've got high-profile people living all over. So the overall construction time itself that it takes is slower than what you would do in a normal development. But the good news is that we finally got out of the ground, and the structure started coming up, and that should take us another couple of years to complete. Having said that, we are happy to say 2 weeks ago, we completed 3 developments in Mumbai, the first of it by Prestige. One was the Prestige Jasdan Classic, which has got the occupancy certificate and ready to start taking deliveries to customers. And the Prestige Siesta Tower in the Mulund component of Prestige City. And that also is completed, and that's 400 odd units. And then it's the rehab office building in Mahalakshmi, which is called the Prestige Turf Tower. Even that has been ready. So we have managed to, in the short span of about 4 years, complete 3 large developments. And all these developments are ready for delivery. And we are at it, and many more in the pipeline, including the Daffodils, which is the Pali Hill. And in terms of sale, that's done well. We've almost sold about 70% of the stock.
Okay. All right. Lots of stuff coming up here. The skyscraper, the sky is littered with the ongoing construction. Maybe with rains here now in full flow, perhaps maybe a little slow, but I think otherwise it's been a really under construction city in all ways, more ways than one, with developers, but also the government really now cranking up on some of these projects. Thank you very much. Appreciate you joining in and running us through all of those details. That is, of course, Prestige Estates in focus. But we're not going to stray too far away from real estate, Nigel, to cement now.
Well, that's right. Let's focus on cement. Earlier this month, the West Bengal government, they invoked the incentives for cement players. How does this development impact various businesses? What's pricing, demand trends as well? To discuss this and more, we're joined by Mr. Sandeep Ghosh, the Managing Director and CEO at Birla Corp. Hi, Mr. Sandeep. Good morning. Thanks a lot for joining in, sir. Let's talk about the good news first with regard to the green signal, with regard to that limestone mine that you'll have got. How does it help you all in terms of visibility? And with your current limestone reserves, how much can you expand capacity organically?
See, Nigel, there is not much of a change. We don't change our strategy quarter to quarter. And I thought that's something you and the market should give us credit for, because we have stated a strategy and we, stick to it, and that's stay on course. And that's been, so this particular, mining thing, don't see that in isolation, this acquisition. These are all part of our longer term strategy in terms of protecting our place in securing our existing markets, and in due course making organic growth. So this is nothing I would look at immediately. This is part of a large continuum, and no dramatic change because of this one particular auction bid.
All right, got that. So that's out of the way, but it's a step in the right direction because your raw material gets secured. So that's good news, I guess, from a longer-term standpoint.
That's the point to note, Nigel. We had indicated to the market that after consolidating, getting ourselves to a certain place, then we will look at new expansion, whether it is brownfield, greenfield, and expanding. And our objective is to secure our core markets over there in value terms, and then also expand in our adjacent or the secondary markets. And that is the direction we are moving, and in line with the guidance which you provided consistently.
Okay, all right. What about these incentives, the issue that's crept up in the West Bengal government? What's your comment on that? And were you all factoring in that in, or you all were not factoring it in the first place, so it doesn't change things big time for you all?
See, we've been waiting for it for a long time. We have been, nobody can blame us on patience. And so we are patient also to see, because we are not the only people affected. There are a lot of people with much larger stakes have been affected. So I don't think it's played out yet, or we have heard the last word on it yet. So we are also observing the situation and seeing how it progresses and what are the options. So right now we are not particularly rattled by this particular development.
And you don't think it'll have a contagion impact? If I remember correctly, I think on a yearly basis, your incentives are to the tune of around 100 crores, right?
See, this is particularly only you're talking about the West Bengal. West Bengal, our incentives had ended long time back. So this is all pertaining to the past.
Okay, all right. But you don't believe that it could have a risk on other states as well, right? A contagion impact?
I don't see that happening. This is very exceptional. And all other states, I think they have been pretty good at meeting their incentive commitments.
All right. For the industry, I wanted to understand, how do you read things, because you have exposure to various parts, central, north, parts of east as well as west. How are the demand trends? There was some kind of softness. I'm looking at a DAM Capital note earlier this morning, and they're suggesting that demand hasn't been that great because, you had an alteration with Pakistan. There was some delay in terms of spends. But how do you read the demand situation? And also, what about pricing? The hope is that FY26 will be a far better year for cement prices. Do you believe so?
See, FY25 was a washout.
Yes.
That's a very abnormal year. So obviously that cannot contain. Now, when you talk of prices, I'm not the one who really looks at a very bullish situation. I think a nominal increase in prices, if it sustains through the year, that'll be good for the industry. We had a fairly good exit point, and if somewhat an improvement over that, if we continue to do without any major slides in this next 2 quarters, then I think the industry will be on a good footing.
What about the JP Cement asset? You have already laid out your plan to go from around 20 million tons to around 28 million tons. And the capex as well, you have already outlined around 4,300 crores approximately. There's a JP Cement, that there have been bids that have been invited. Are you part of the bidding process? Have you submitted a bid?
We are not at all part of the bidding process. We haven't, that's far too big, far too complex for a company of our size to look at. And I think it is for the big boys, big players, because it's coming as a composite, offer. So somebody will have to have the ability to unravel all parts of it. And that's not really our cup of tea.
You're doing organic expansion around $80 per ton, roughly $80 to $85 per ton. At what kind of pricing would it make you interested in an inorganic opportunity? Because the problem is, for organic, it still takes a couple of years. For inorganic, it could be relatively faster, though you may have to pay a bit of a premium. So your thoughts on that?
I don't see too many inorganic opportunities coming our way, Nigel, to be honest, because it has to have a clear fit for us in our relevant geographies. And I don't see anything coming their way. And right now, it's because we are committed to the brownfield expansion, etc. We cannot abandon it at this juncture. So we'll have to be, if something really, really attractive comes, just like the way Reliance came a few years back, we may have to look at some innovative solution. But right now, I don't think that's taking up too much of our mind space.
I recall that big breaking announcement came in post-market hours. It caught people by surprise. Anyway, let's focus on this year then. FY26, as you said, nothing much has changed. But in terms of an outlook, both in terms of volumes, industry, I think people are working with mid-single digit to high single-digit growth. How much will your company grow in terms of volumes, as well as EBITDA per ton? Last year was a washout, but the past quarter was very, very good in terms of an EBITDA per ton. What kind of a run rate will you maintain?
Nigel, I don't have to repeat anything within a month. You spoke to our CFO less than a month ago, so our projections have not changed, and that's what I told you. So we are, in terms of growth rate, the market we're expecting, as you said, 7 to 8% growth, and that's what we will also grow in terms of volumes. In terms of EBITDA, I would not comment at this juncture.
Got it. Thanks a lot, sir, for joining in and giving us all of those details on terms of a broad outlook on the cement space as well as for your company. Appreciate you speaking to us here on CNBC-TV18.
Thanks so much.
All right. Well, that's the cement discussion, and focus markets, by the way, are absolutely flat. There's nothing at all on it. 24,700 is where the Nifty is at. And look at the market breadth, by the way. It's now completely turned. Yeah. So 2,000 stocks are lower and 500 stocks are higher. So this is the exact opposite of what it looked like in the morning. The Nifty Bank, by the way, is down 100 points, which means it's down about 0.25% at this stage. So, sorry, Surabhi.
No, go on. I was just saying that even for the large caps, mid caps, of course, the index is down a whole 1%. But even the large caps, and we were, in the market conversation earlier, the Nifty was up 80 points. So it's just not been able to hold at all.
It's not been able to, and I think we're flatlined now. Absolutely, literally flatlined. Now, the big story, global story, of course, is the entire Middle East flare-up conflict, and it's not. Targeted in that sense. It's spread out, getting spread out even more between Iran and Israel. Is it going to impact shipping lines in any meaningful way? So let's get some perspective. Sunil Vaswani is with us, Executive Director at Container Shipping Lines. And he's, of course, the association. And Dushyant Mulani is President at Federation of Freight Forwarders Association in India. Gentlemen, good morning. Great to have both of you here. Appreciate it very much. Prashant here. Sunil, if I can start with you, if you can give us some context. So as viewers here, what's happening globally? The big one, of course, has been this the Strait of Hormuz, which has never been closed, but it's not a non-negligible risk because if things happen which have never happened before, who knows what can happen. We've had President Trump, for example, saying, well, we'll have peace. Then he's saying, sometimes people have just got to fight it out. So no one really knows which way this is going to go. But just give us the state of play for shippers. How does this work out?
So morning, and thanks for having me on the show. Now let's break this up into two parts. As far as the shipping lines are concerned themselves, we are rather living under uncertain circumstances. And by now, over the last 5 years, the shipping lines have actually learned how to, play along depending on the scenario. So right from the time the COVID struck, and then the Red Sea crisis, and the US tariffs, and now the Iran-Iraq conflict, Iran-Israel conflict. So we've been actually deploying and redeploying our fleet depending on the current, on the scenario at that point in time. Now, let's break it up into two parts. One is the Suez Canal, the Red Sea and the Suez Canal, Bab al-Mandab, and the other one is the Strait of Hormuz. Now, as far as the Suez Canal is concerned, most of the shipping lines have already diverted their ships over the Cape of Good Hope. So over the last 1.5 years, most of the lines are already flying the ships around the Cape of Good Hope rather than going via the Suez Canal. So if that's a fear that the freight rates will go up because the lines have to now go over the Cape of Good Hope, barring a couple of lines, by and large, all of them have already moved over the Cape of Good Hope. So that's done. So I don't think that is going to change or make any difference to a great extent. Point number two, the silver lining on the cloud is that over the last 1 year, the freight rates have also dropped. Like, for instance, to Europe, the rates had dropped by about 50%. And to the US, they have dropped by about 33%. So, again, this fear that the rate levels might go up or whatever it is, they are still at this point of time lower than what they were the last year. So your base is low at this point in time.
These are container rates.
Point number two.
These are container rates? Container.
The container rates. I'm talking about
container rates, Please go on.
Yeah, thanks. And as far the other one is the Strait of Hormuz, the Persian Gulf, the upper Gulf, Now over there, most of the lines, the large carriers, they're all long-haul carriers. So they don't essentially cater only to to that sector. The lines that do call there to Jebel Ali are essentially calling for transshipment services. Now, as of today, there is no war risk or anything that's a premium that's been announced. The insurance companies have not increased anything, but we've got to wait and watch how the situation goes. And also the bunker costs. Bunker costs could possibly go up. They already started moving up. So we can't rule out, to what extent those costs will go up, and then to what extent that will be passed on to the trade. But as things stand, nothing has changed. But these are really uncertain times, and it's really too early to say anything. So I would keep my fingers crossed. But I would say it's a matter of concern, but it's not a panic situation. Thank you.
That's great context. So what you're saying is that container lines anyway were most of them because of, all the Houthi attacks, etc. I think anyway they were plying around the Cape of Good Hope.
Yes.
So whatever impact had to happen has perhaps happened. And you said that year on year, container freight rates are down by how much?
So by about, I'm giving approximate percentage, about 50% as far as India to Europe is concerned, and by about 33% as far as India to the US is concerned. So, so if you give me 2 minutes more, while we talk about the US tariffs, and we are also concerned simultaneously about the US tariffs, so there also, our base rate levels are currently lower than what they were last year. And of course, as per the latest news, we are hopeful that some sort of an agreement would be in place, which would be mutually beneficial. So let's hope for the best and take it forward from there. Thank you.
Okay, fair point. Let's just bring in Mr. Dushyant Mulani into the conversation as well. Mr. Mulani, what's your assessment? Hearing Mr. Vaswani, it seems like at least for now, at least on the container side, there is no immediate threat of a huge rise in freight rates. What is it that you're hearing? And I don't know if you're looking at the tanker market as well. Could there be some issues there? Oil prices are rising, but the Strait of Hormuz is still open. Your thoughts?
Yes, thank you. Good morning, all. First and foremost, I definitely respect what my friend Sunilji has conveyed here. Point is that this conflict is very volatile. Nobody knows that how long this is going to last for. And the repercussions of this will be known to the entire logistics sector and trade and industry in next week or so. That's my assessment. We've been talking to a lot of people on the global front, in the region rather. And the Strait of Hormuz, which controls approximately 20 to 25% of global oil supplies, there will definitely some disruption is expected very soon. As far as the Indian trade and industry is concerned, these kind of events, global events, do throw up challenges, and India needs to build its own logistic security, which is very crucial, as important as defense or food security for our country. Whether it was Red Sea or earlier conflicts or COVID, that time Indian exporters have faced cost escalations. Fortunately, past 12 months, there has been softening of freight rates. But this challenge, which is there at present, where it is going to lead to, it's too premature. We are in very active dialogue with the Ministry of Commerce and Ministry of Finance. We are trying to work out and envisage how these shocks can be absorbed by Indian trade and
Mr. Mulani, if I can just come in. You said we are expecting some disruption in the Strait of Hormuz.
Yes.
Is that the chatter within the shipping community? That or is that like an educated guess?
No. Rather, it's the feedback is coming from the trade and industry side quite a lot, from the logistics sector, and across the region. Just last night, we had a detailed interaction with our peers in that region, Middle East region. And they are quite worried. People are taking a very cautious note because in that Strait of Hormuz, which at the narrowest point is about 33 kilometers between Oman and Iran, that's been a very troubled point. And the signals are coming up. People are taking a very cautious note of it now.
I mean, there's no way to know, as I said, in terms of what's going to happen. But Mr. Vaswani, that is a bit of a choke point, especially important for oil more than anything else. What's your sense, sir?
You've hit the nail on the head. It's more for oil. And that's why I touched upon the topic of bunker prices, because then that would impact everything. That would impact container shipping as well. As far as Iran is concerned, of course, this is my personal opinion. No one knows what's going to happen. But at least Iran or the Houthis may not necessarily strike, because it will only hurt Iran's supply of oil or the supplies into the Gulf, But what could happen is, in the crossfire between Israel and Iran, if some of the missiles or some of the bombs just hit the ships, then that would be dangerous. Then, because then the ships would possibly back off, and they might cut their services, or the ones that do operate would, of course, definitely impose war risk premiums, and the cost would rise. The services could get impacted. But as I said, as of now, the services are still going on. Even till yesterday, the ships that had to ply there have been plying. So let's wait and watch.
Let's hope it doesn't come to it. But I think, as both of you acknowledged, no one really knows in terms of how this is going to impact things. I think everybody's just sort of looking at the last two instances of flare-ups when it's been pretty limited. I mean, the impact has been limited and short-lived. And I guess that's what you can go with. Because otherwise, I mean, the consequences could be more severe. Mr. Vaswani, thank you very much for joining us and explaining to us the state of affairs right now. And Mr. Mulani, thank you very much for the feedback that you've gathered and your perspective on the matter as well. Well, I think, what we're going to do is take a quick commercial break here. Markets have flatlined, nothing on the indices at least. Broader markets, of course, down more. Manisha is going to come in and talk to us more about commodities. Stay tuned.
Welcome back. So the equity market has given up much of its early opening gain. Let's figure out what's happening with commodities. We have Manisha joining in. Manisha, of course, it's this West Asia conflict that everyone has has their eyes on. You tell us, for commodity, I mean, what does it mean?
Well, a couple of things really, and two things that have continued to gain. One is gold. It's $50 away from its all-time highs, and the other is the crude oil prices. We've been talking about it constantly. I'm just going to drill deeper into details here, where we did see 7% of gains in the previous Friday for the crude oil prices. With that, it was 13% of gains in the previous week. It's a second straight day of very strong gains continuing for the crude oil prices. But importantly and interestingly, while we did see 78.5 on the higher side on Friday, we are trading below 75 at this point in time. So even as weekend did bring in a lot of more information and news, we haven't seen the crude oil prices take a lot of support from that. Well, while of course there are fears and there are fear premiums being built into the crude oil prices that the escalating tensions could disrupt supplies from Western Asia, there also was one interesting report, and they did give a spike to the crude oil prices. That was that the Israel attack on giant South Pars gas field in Persian Gulf has led to one of the platforms getting shut there. Not too much of an impact coming in from there. Trump also has warned that there could be more restrictions on Iran oil going forward. Also, if it attacks U.S. facilities in the region, then there would be higher repercussions on that. And then the markets also have seen Trump trying to set up dates for coming weeks as that 90-day period gets over. The markets also have seen very strong volumes coming on Friday. We haven't seen a repeat performance of that happen today. But August 2025, $80 call option saw 33,000 contracts on that. The total contracts were 66,000. And of that, half of that in sense of options market went into 2025, $80 there. Now, if the prices have to go higher from here, you will need to see more fresh longs coming in. What we saw on Friday was shorts unwinding their purchase positions, but there were no fresh longs into the trade there. The second, if there is a direct attack on the oil facilities, on energy infrastructure, then you will see crude oil prices going up. Or if it is about a broader regional conflict and more countries start to come together taking sides, then you would be looking at crude prices going up. Until that doesn't happen, markets do not believe that you're touching $80 in a jiffy when it comes to crude prices. Now, Strait of Hormuz, of course, has been an important conversation, but remember, we keep telling you that it never really has been shut. There have been days when we've seen delays in sense of Strait of Hormuz, but that 18 to 22 million barrels per day that we see passing through that area never really has seen any shut there. And Iran, of course, is important. It produces 3.3 million barrels and exports nearly 2 million barrels per day of crude and condensate and fuel as well. And the markets do believe that it would continue to come in. What you really need to watch out going forward from here is Iran telling mediators that it is not open to ceasefire negotiations while under Israel attack. The second thing you will need to watch out is the G7 meeting, where the Israel-Iran agenda is on top here. And then apart from that, it's a barrage of monetary policy meetings happening in this week. The top, of course, is the Bank of Japan. That happens tomorrow, likely to leave interest rates unchanged. The second important meeting, of course, is the US Fed on Wednesday, where there would be a signal of whether or not there are further rate cuts coming in the month of September. And then it also has to be about China's central bank, where they are going to decide on loan prime rate. You also have Swiss National Bank, Bank of England. So there are 6 national banks or central banks meeting in this week talking about monetary policy, and much of an impact on real estate, asset classes and currency would come in from these.
All right, Manisha, thank you very much for that. So that's commodities in focus, and they very much remain top of mind across the board. Well, let's focus on some stocks as well. The market's not doing very much, but stocks are. Tata Motors is the first one we want to talk about. Sud is here with details. Good morning.
Morning, Prashant. So Tata Motors is top Nifty loser, is down 5%, and it's on the back of because JLR is holding investor day. JLR, remember, contributes 70% to Tata Motors' total consolidated revenue and almost 80% to its profit. And today, ahead of its investor day, JLR has released its outlook for FY26. And by the first look, that outlook is looking muted. On the EBIT margin front, company is saying that in FY26, EBIT margin is going to be in the range of 5 to 7% against 8.5% that company has reported in FY25. On the free cash flow, it's saying that it's going to be close to zero in FY26 versus 1.5 billion pounds reported in FY25. But company is expecting both EBIT margin and free cash flow to improve going forward after FY26, basically over FY27-28, and its medium-term target on the EBIT margin is to get back to 10% level. Now, on the US tariff also, company has made certain comments. It's saying that it's it continues to engage with both US and UK governments. On UK exports to US, tariff is going to reduce to 10% from 27.5%. But another major market from where JLR exports is Slovakia, for where exports tariff remains around 27.5%. Also on China market, it says that while premium market faced challenge in FY25, JLR has outperformed the market, and going forward, it's looking to unlock growth in China via licensing of Freelander to its JV, that is JLR's JV in China. Also, it has made certain comments about order intake and leads for Range Rover, where it was up 37%, order intake was up 15%. Similarly, for Sport, order intake was up 34%, leads were up 39%. And lastly, on the investment front, it's saying that by FY28, it's going to invest total 15 billion pounds. So overall, as far as outlook is concerned for FY26, it's muted, and that's the reason you are seeing a big downtick.
That explains the near 5% drop on the stock. Sudarshan, thank you very much for that. That's Tata Motors in focus today. Well, this is a stock on the way down, but a stock which has positive news flow and commentary around it is actually PI Industries. PI is up 4%. That's because Morgan Stanley has turned quite constructive on PI. Let's find out why. Ria, tell us, what is Morgan saying?
Well, yes, Surabhi, Morgan Stanley has come out with a note on PI Industries today. They've upgraded the stock to an overweight rating with a target price of rupees 5,000. In fact, they've also raised their multiple on PI's agrochemicals segment to 23 times, and they've raised the segment earnings target by 7%, which was actually offset by the drag in the company's pharma segment. Now, Morgan Stanley has said that PI has the highest exposure to agrochemicals in their coverage, and they believe that the company should see a three-pronged volume increase across domestic exports and the new molecules businesses as well. They've estimated that the new molecules and biologicals segment will each comprise a third of custom synthesis exports and domestic portfolios by FY28. They also think that multiples can re-rate 20% higher to levels seen around between 2022 to the first half of FY24, which was a period of robust exports momentum for the company. So overall, for the industry, they do expect a more constructive volume-led agrichem cycle in 2026, which is going to support stronger asset runs and operating leverage-led margin tailwinds as well. And out of the entire segment, they are positive on PI Industries, and the stock is resultantly higher in today's trading session.
All right, 4%, that's a big one in a market which is absolutely flat. Thanks very much, Ria, for that. We'll take a quick commercial break here. We're going to come back in just a bit. It's the economy with Lata on the other side, and she's going to be speaking with Ambassador Navdeep Suri about the likely course of the Israeli-Iran conflict and, of course, implications for India and the region. Stay tuned.
Welcome to It's the Economy. The most important topic today, the escalation of missile strikes between Israel and Iran, which has worsened hugely over the weekend, and there doesn't seem to be any end in sight to the war as of now. Casualties on the Iranian side seem to be higher, both in human and, more importantly, in economic terms as well, with Israel bombing South Pars, the world's largest gas field, and hitting a key processing unit. The only ray of hope, if one can call it that, is President Trump tweeting late on Sunday that, and I quote, Iran and Israel should make a deal and will make a deal. We will have peace soon between Israel and Iran. Many calls and meetings are now taking place. Well, to understand the triggers for this war and how and when it may end, I have with me Ambassador Navdeep Singh Suri, a retired diplomat who has served in India's diplomatic missions in Cairo, Damascus, Washington, London, among other countries. Ambassador, many thanks for joining us and giving us your time.
Pleasure to be with you, Lata.
Well, so if I can start by saying at the outset, after looking at the last 4 days' flow of news, does it look like we have a prolonged conflict on our hands?
I don't think so, because I frankly don't think that Iran can sustain a prolonged conflict, considering the rate at which its missile delivery capabilities, its energy facilities are being degraded. In a funny way, even though Israel is a small country, it's an unequal contest, because Israel is a technological superpower. It is the military superpower in the region, and it enjoys the unlimited backing of the Americans. Whereas Iranians, a lot of what they have put together is largely their homespun jugaad. And so I think there are limitations within which the Iranians will be operating. And I wouldn't be surprised in a couple of days' time, once Iran has had the psychological satisfaction or the moral satisfaction that they've landed a couple of blows, that people start looking at pathways out of the current situation.
Will it go to a point where the Israelis or even the Middle East looks for a change in the regime in Iran? Will that be the way this will end? Or will it go that bad?
Hard to say at this point of time. Whatever chatter I am picking up, even Iranians who are disgruntled against the regime for very valid reasons, whether within Iran or outside Iran, seem to, at this point, feel that what Israel is doing is attacking Iran, not just the regime. And so people are kind of tending to get united behind the country rather than just the regime that they may not particularly like. So I think that's a question mark. There is no love lost for the Iranian regime in the Arab world, I must say, not just with Israel. They have been guilty of interfering quite blatantly in the affairs of neighboring countries, starting, of course, with Iraq, but then Syria and Lebanon and Bahrain, and the Saudis have their own angst. But I don't think we are at that regime's change moment yet, though nothing would please Netanyahu more than a regime change in Tehran.
Okay. Well, how seriously should we take the U.S. President's tweet that talks are happening and, peace will come, the war will end? Are you expecting a quick end, as in a couple of days?
Should we go by the past record of the president's tweets and and draw our conclusions from that? I think we've all learned that the Ukraine conflict wasn't solved in 24 hours. And he claims to have resolved India-Pakistan, and certainly he thought he would resolve the long festering issues of the Middle East. The reality is that these are very complex issues, and they need months and months of fine negotiations by experts to try and come to some kind of a resolution. So on your particular question, I'd take President Trump's tweets with a very large spoon of salt. I think, Lata, the larger issue, perhaps, for a channel like yours, is that if Iran is driven to a point of desperation, and it has in the past threatened that it could block the Strait of Hormuz. Then we really need to look at what the consequences could be, because those are, to my mind, that is the single biggest regional and global ramification that could emerge out of
No,
this.
actually, Ambassador, that was going to be my next question to you. Do you think Iran would threaten that and even actually execute that threat? Do things get that bad?
You know, it is their extreme option. They've done it once before during the Iraq-Iran war. The consequences today could be much worse. You know, between the Saudis, the Kuwaitis, the Qataris, and the Emiratis, they ship about 21 million barrels a day out of the Strait of Hormuz. That's 1/3 of global seabound oil supplies. So, you know, some analysts say that should Iran take that extreme step? And it is a doable step. You know, when you look at the shipping channel that takes you through the Strait of Hormuz, that's barely 3 kilometers, not even 3 kilometers wide. So you can knock out a couple of tankers and effectively block the channel for a while. And that would really send shockwaves through the global system. I think it would also make us painfully aware that even today, after our strategic petroleum reserves in Visakhapatnam, in Mangalore, and Padur, our own oil reserves today, the strategic petroleum reserves, are barely 10 days requirement for us. So, you know, that really is an extreme situation. And, you know, I just hope that the Iranians are not pushed to a point where they feel that that's the only option left for them.
Okay, but, you know, that's the side which the US also will take. I mean, even for the US, the rise in oil prices is anathema for the president. That was one of his big promises, that he will keep crude prices down. So clearly, they will work in that direction. But regardless, your base case now is that this will not be a prolonged conflict because Iran can't afford it. That is a very big consolation you're giving the market.
I think so. I think, you know, Iran's capacity to sustain a long-distance conflict of this nature, given the technologies that today are available, the means that are available to Israel to keep degrading Iran's energy infrastructure, keep degrading its missile capabilities. And combined with the fact that Israel itself has a very robust anti-missile defense system. You know, if you look at the hundreds of missiles that Iran has fired at Israel and see how many actually managed to penetrate its air defenses, it's a fairly small number. And Israel would probably feel that it can absorb that much of the pain. But I think for Iran, the situation continues to become more and more grave. And that's what I feel, that it would be hard beyond the next 3 or 4 days for Iran to be in a position where it can deliver major blows to Israel. Okay. And would probably, you know, that's why I say that both sides will be looking for a pathway out at that point of time. Okay. I don't think, and the Israelis curiously have also acknowledged that they don't have the capacity to knock out Iran's nuclear capacity. They've struck Natanz, but they can't do very much about Fordo. So, you know, it's not as if Israel will be able to claim victory that I've destroyed Iran's nuclear program.
That indeed is going to be my last question. Are there any, you know, compelling reasons why Israel also will want to just end? Was the whole idea just to give Iran a warning that they should not continue to help Hamas or any of the other outfits? Was it a limited attack even from Israel's point of view?
You know, there should be a lasting, enduring lesson for Israel somewhere in all of this, that you know, it's easier to start wars than to achieve objectives. I think Gaza is a stark reminder that after 20 months, Israel still hasn't been able to destroy Hamas. So you know, you can win battles on the battlefield, but whether you win the wars, I think, is the moot point here. And I don't think Israel achieves its objective of destroying Iran's nuclear program. That's why
the 5+1 nuclear agreement was so important, which was done during the Obama government, that it put caps on Iran's nuclear program, which were verifiable. And then Trump comes in, Trump 1.0, and tears up the agreement and leaves the Iranians free to start increasing beyond those caps their enrichment program, and puts you in the situation that you are in today. So, there is a room for diplomacy to achieve objectives that you may not be able to achieve through war. And you've done the war, and you will again probably have to fall back on diplomacy to take you forward.
Well, the key leaders are meeting in Canada for G7, and hopefully everyone will prevail on the US president to prevail upon Israel. Let's hope your guess will prevail, that on both sides there will be compelling reasons to restrict this conflict to fewer days rather than a prolonged war. At the moment, crude at $74, $75 is still manageable. Let's hope it doesn't go to a point where the Gulf of Hormuz is blocked and things are escalated beyond economic sustainability for many of us. Thank you very much, Ambassador, for joining us.
Thank you, Dada.
Okay, so that's the key point. Hopefully, both sides don't have a reason to prolong this conflict. That's it on this edition of It's the Economy. After break, Chartbusters.
Tata Motors is the top Nifty loser ahead of the Jaguar Land Rover Investor Day. The outlook provided by the company is below expectations, with free cash flow expected to be close to zero in FY26.
And brokerage firm Morgan Stanley upgrades PI industry to an overweight. They raised the target price to 5,000 rupees a share. They're expecting agrochemical-led volume growth for the company going ahead. On the back of that, the stock is up 4%.
SpiceJet surges as the company reports its first annual profit in 7 years in FY25, led by cost reduction and higher passenger yield.
NMDC slips as brokerages, Citi as well as Kotak, they issue sell ratings on the stock. They expect the company's iron ore prices to be cut further. Citi sets a target price of 60 rupees per share, while Kotak has a target at around 55 rupees a share. Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel and joining me today is Ekta. Well, Ekta, the market started off a little bit skittish, but as we speak, actually the market's at the high point of the day. Pretty good times. Top of the screen is telling you the picture.
Hi, Nigel. Yes, absolutely, except for the mid-cap index at this point in time. But nonetheless, that's also flattened out. So let's see whether that ekes out any kind of improvement. But as of now, we have the Bank Nifty, which is up around 154 odd points. We have the Nifty, which is up around 0.5%, along with the Sensex as well. The advanced decline ratio looking good, as in not looking good, but seeing some sort of improvement. Let's see whether there's any kind of crisscross as the day goes on. But nonetheless, let's welcome Shivangi Sarda from Motilal Oswal Financial Services for a technical check on the markets. Shivangi, hi, welcome to the show. Well, it is definitely volatile times because of a lot of moving parts globally when it comes to, market cues. But as of now, we've started on a firm note. We're up around 0.5% for the Nifty. How would you approach today's trading session?
Very good morning, Ekta and Nigel. Thank you for having me. So we've seen that the markets have been a little affected by the global concerns, but the good part is that support-based buying has been strong from the last trading session itself, and we've seen that it is comfortably holding well above 24,700 mark. So this will become a crucial level right now for Nifty. To hold these levels would mean a bounce back move towards 25,200. While a hold below the same could see some weakness and profit booking towards 24,442 levels. But overall, we've seen that the buying has been stronger and buy on decline to continue for this index. India VIX has been causing some sort of a discomfort, but overall, we've seen that, it has softened below 15 levels. So till the time it holds below 15, there will be some volatility, but not a major cause of concern. Talking about Bank Nifty, we've seen that this index has been underperforming. And, from the last two trading sessions, even though we've seen that there is some sort of a comeback of the bulls, but follow-up is slightly missing with momentum. So till the time it holds above 55,500, we could see momentum towards 56,000 odd levels, while the support can be seen at 55,350 marks. So a close range for Bank Nifty, rather a small one because of the less momentum and lack of follow-up here. So this is the outlook for the index.
Okay, all right. Hi, Shivangi. Welcome back and congratulations to you as well as your soulmate as you tied the knot. Congratulations. Wishing you all a happy married life in the time to come as well. Well, Shivangi, besides the call on the indices, give us your stock calls as well.
Thank you so much for the best wishes, Nigel. Now, talking about the stock-specific idea, first up on my radar is Muthoot Finance. This stock has come out of a Poland flag pattern formation breakout on the daily frame, and we've seen that from the last 3 weeks, consistently there has been price and volume surge here. Now, RSI is showing positive signs of divergence here, and it is holding well above its previous hurdle levels, which is now acting as a support. So clear real role reversal has been seen over here. So this one's on radar for the next targets of around about 2750 levels and with a support of 2550 levels. Now, the second pick on my radar is MCX, which is also gaining momentum from the last two trading sessions. Now, MCX has been respecting its upward sloping channel from the last 13 trading sessions. And we've seen that, there has been good volumes as well over here. Now, interestingly, MCX has retraced from its crucial levels on the daily frame So this clearly indicates that a good base formation has been done here. So looking at this stock for the next targets of 8,100 levels with a support of 7,600 zones.
Yes, all right. Thanks a lot for that, Shivanki. Well, let's shift focus to our special segment, where we get you a few ideas for profit from Money Control Pro. Kanchi Shah of moneycontrol.com joins us to talk about a stock that she's tracking very closely. Kanchi?
So the company that I've chosen for today is Mphasis. It has delivered a resilient Q4 performance, defying its global macro headwinds with 2.9% sequential revenue growth in constant currency, which is highest in 3 years. Deal wins remain strong with a record of $390 million in total contract value, marking the second consecutive quarter of broad-based momentum. But it is the company's strategic shift towards AI which has led for the transformation that's catching investors' attention. With 65% of its pipeline now AI-driven, which is up from 55% in Q3, Mphasis is doubling down on client-specific innovation, savings-led transformation, and intelligent automation. The banking and financial service segment continues to be the growth anchor, supported by wallet share gains and new wins. Meanwhile, the non-BFS pipeline grew by 99% on a year-on-year basis, signaling a very healthy diversification. Unlike peers, Mphasis remains relatively insulated from tariff-related uncertainties due to its limited exposure to retail and manufacturing sectors. The company has narrowed down its FY26 EBIT margin guidance, slightly accounting for ramp-up cost of large deals and continued investments. The management remains quite optimistic about its FY26 growth, and it says that it will outpace FY25, which will be driven by potential recoveries in logistics and healthcare. Valuation-wise, the stock trades at PE of 22.7 on FY27 estimates. Given strong deal momentum, focus on AI and resilient verticals, investors may consider accumulating the stocks gradually on market dips.
All right, thanks very much for that. We'll take a short break, but as we do that, here's a quick note. CNBC-TV18 Access is a premium membership-based service available on CNBC-TV18.com. It offers members exclusive content, market intelligence, and expert thought leadership. The membership includes access to CNBC-TV18's flagship events, interactions with our journalists, along with curated studio tours, e-learning sessions, and masterclasses, and curated lifestyle benefits designed for an immersive and enriching experience. It empowers members with premium business intelligence and unique lifestyle benefits, the power of insight, the privilege of access, exclusivity, experiences, and influence, yours to claim. Become a member. Log on to cnbctv18.com/access/plans.
You have stood up and stood by many of India's dreamers.
I became a magnet for entrepreneurs. So there's one man who will hold our hand and take us all the way.
So what is the art of deal making?
So whenever the deal maker wants to become too big, well, I'm God. Okay, you say this and you say that kind of attitude, not literally, but I've seen that. What percentage of people you think die, Shireen, with regrets in their hearts?
A very large percentage.
So this risk of failure, fear of failure, is the one that makes people die with regret.
What is holding us back?
Promote and protect the good. Prevent and punish the bad. We prefer to be slow rather than fast. That's how we are a chalta hai country and not a daudta hai country.
The lack of speed would be, if you were to IPO India today, that would be on the risk factor side in the DRH tree, right?
I wouldn't IPO.
You wouldn't IPO?
But to IPO, I must have a new story.
You have a special place in your heart for Charlie Munger and Warren Buffett. What have you taken from them that continues to guide and shape how you think today?
Understanding of balance sheet, because balance sheet is accumulation of good and bad.
How do you find India positioned in this mix today?
We have a resilience, we have a stability, we have a wisdom of our own. But वो हम एक scene दिखाते हैं, फिर we have a long break. Stop that.
Interval थोड़ा लंबा हो गया.
बहुत लंबा हो जाता है.
Welcome back. Well, you're still tuned into Chartbusters this Monday morning. It's turning out to be a session where we are seeing a little bit of a further dip coming in for the mid-cap, so down around 103 odd points. And the bank Nifty also just about higher by around 0.2%. Just watch out for a couple of stocks on the upside. ONGC, SBI Life, Cipla, a couple of these stocks are managing to hold up well, along with even HDFC Life from the insurance space. So just watch out for a couple of them holding up with a gain of anywhere between over 1% to close to 2%. But Nigel, you're watching NMDC.
Well, that's right. Two brokerages have written on NMDC and both of them are negative. So let's start off with the first one. Citi, they have a sell rating. They have a target price of around 60 rupees. They think NMDC's prices could likely correct. And they've given us a few reasonings. So they're pointing out that NMDC's price premium to export parity could normalize. Currently, it's at around 40% premium. In FY25 itself, it was only around 20%. So that could normalize. Next up, they're also pointing out that companies like Lloyd's, Metal and Energy, they are enhancing their capacity from around 10 million tons to around 25 million tons in FY26. So additional supply could come into the market. They also expect domestic steel prices to correct as steel imports pick up. And they believe that the iron ore market is likely to remain in small surplus in this calendar year, that's 2025. They further go on to point out that NMDC is trading at around 6 times EV per EBITDA, which is not particularly cheap. So that's Citi's view. Moving to Kotak's view, they have a sell rating. Their target price is 55 rupees per share. They say that NMDC has cut its iron ore prices marginally in June 2025. They expect further cuts in the coming months. Iron ore prices, domestic iron ore prices, they point out, are an 8% discount in comparison to import parity. That compares with around 20% historically. So that's the reason why, in fact, they believe that maybe there could be further pressure on pricing. They also point out that the ongoing weakness in the steel prices could trigger some kind of normalization. And finally, they make the same point that, merchant iron ore miners in India, they're ramping up production. In addition to that, you have weaker exports. That's what could add to some kind of pressure on pricing. So put all this together, two brokerages, Citi as well as Kotak, they're negative on NMDC, and it's weighing on the stock down 1.5%. Let's focus on SpiceJet, though. That's trading higher after reporting its first annual profit in 7 years. Vinny joins us to dissect those numbers for us. Vinny?
Hi, good morning. So good set of numbers that's coming from SpiceJet in Q4 FY25. Overall, an improvement in terms of profitability for Q4 as well as for the whole year as well. So for FY25, like you mentioned, profits are, they're reporting a profit for the first time in 7 years. There is a reduction that we've seen in costs, especially for the company. So whether it's fuel costs, airport charges, as well as maintenance charges. Passenger yields that are there, those are also they've moved up higher, 5.18 versus 4.9 last year. In terms of revenue, efficiency per seat kilometers that you measure in terms for aviation, that has seen an improvement as well. Market share has remained stable at around 3.38% in the last few months as well. So stability in terms of market share. Now, one concern that comes in is that in terms of revenue, that is down almost 25% on a year-on-year basis. Why? There's a delay in terms of revival for the grounded planes that they do have. So that is a concern that's come in there, and that is why the revenue has not seen an uptick so far. So once that revival plan actually comes into action on a faster pace, then we'll see an improvement in terms of revenue as well. But as of now, operationally, whether you look at the EBITDA or the profitability of the company, we've seen an improvement on those fronts, and expenses, those are coming down as well right now. They're moving in terms of the changes from dry lease, wet lease, as well as owned planes as well. So that is also something that will, going forward, support the company in terms of their operational performance. So interesting to watch out for SpiceJet, though Q1 FY26, according to Indigo, is expected to be a muted quarter. So that will be something that we'll watch out for as an indication.
Okay, all right. Thanks very much for that, Vinny. So that's on SpiceJet. But let's go across to Sudarshan now. He's here with us to tell us about IGL.
So over the last 2 to 3 months, Delhi EV policy has been in focus, and we have been hearing from several reports about the expected announcements the Delhi government might make related to EV. Now, over the weekend, there is a report from Hindustan Times which says Delhi government is going to revise electric vehicle policy, and in that policy, it may ease transition deadlines. But more than that, what is the most important part is Delhi government is looking to revise cab aggregator and delivery service policy, which was announced by previous government, that was Aam Aadmi Party's governments, in November of 2023. And that policy says it aimed to license and regulate any aggregator delivery service provider. Also, it aimed to license and regulate e-commerce entity having more than 25 vehicles in the fleet. Now, after that, Citi has written, because the cab aggregator is very important part for IGL. Now, what does Citi say? First, it has a buy call and target is 250 per share. It says, Aam Aadmi Party government's policy in 2023 had mandated all electric fleet by 2030, and this had dampened IGL's volume growth prospects. Targets were always very hard to realistically achieve, but practical and realistic approach by new government could provide boost for IGL. Now coming to cab segment. So cab segment overall contributes 12 to 15% to IGL's volume. Now, if any revision is done or the policy, if it's eased, it will be positive for IGL's volume. Second, policy, reports also say that replacement of CNG three-wheelers are also not being considered, and this contributes around 3 to 4% to IGL CNG volumes. And last part is Delhi DTC bus electrification is almost complete, and in IGL CNG volumes, it's now down to almost 2% versus 7 to 8% that it used to contribute a few years ago. So overall, it's looking positive for IGL. If there is any revision or easing in the EV policy, we might see in Delhi by Delhi government.
Okay, all right. Thanks a lot for that, Sudarshan. Well, let's get in some commentary we got earlier today. TVF Capital Advisors Siv Puri spoke about the concerns for the markets looming around the political issues that's playing out, and also his key focus sectors. Let's hear him out.
Globally, if you look at it, the biggest worrying factor is really geopolitics. And as long as geopolitics remains localized, it doesn't become a global problem, markets are seeing past it because earnings are still pretty good, at least in the West. In some of the big tech names, earnings have done very well. Here in India, you're seeing the last 1 year where earnings have slowed down. But as I look forward, you've seen a few things happen that I think will be quite constructive for the markets. So first is that liquidity in the system has gone up. You've seen the Reserve Bank cut interest rates, cut CRR, and that's an important factor. Second is you're starting to see pickup in rural consumption, which is always a good thing. Well, I think more than sectors, there's a lot of opportunity on a bottoms-up basis, which is the way we've always thought about investing globally. And if you look at but sectors, financial services, healthcare, especially hospitals, consumer discretionary, are probably three areas that are looking pretty good. I don't think much has changed. When we were talking about a year ago, I was talking about the same things. So I think that still looks pretty good. And there are, different pockets of interest. You look at the online recruitment space. There is a particular company that's, continues to do well, and that has diversified its business. So you have to just look at some of these bottoms-up opportunities. But I would highlight those 3 or 4 sectors.
Well, interesting comments coming in from Siv Puri earlier today. For the time being, though, we'll slip into a short break. You come back, we'll continue our focus on markets and stocks that are moving around as well.
carefully.
Welcome back. Well, the Nifty and the Nifty Bank are a very, very crucial juncture at this point of time. I say that because both of them are hovering around the 20-day MA as that graph is telling you. The Nifty just marginally above that level and the Nifty Bank very, very close to the 20-day MA. So this is an important point. On the headline index, you'll want us to build on from here, and that's why, in fact, this is an important point. The 20-day MA on the verge of conquering that. However, I think the bigger story is playing out in the broader markets. Just pull up the crisscross lines. As Ekta and me were highlighting at the start of the show, you had more number of stocks that were declining than advancing. Now those lines are getting a little bit closer to each other and the mid-cap index as we speak has moved into the green as well. So good move is what we're seeing out there. Stocks like Polycap have seen a good recovery from the low point of the day. You have Suzlon as well that's seen a good recovery from the day's low. So a couple of stocks, they are bucking the trend, Ekta, from the broader markets. Good times, it seems.
Yes, absolutely. So let's see whether this kind of recovery sustains as the day goes along. But moving on for now, India-Europe Free Trade Agreement talks have progressed further. Abhimanyu is here with the latest that he's picking up from his sources.
Intense and productive discussions are continuing between India and the European Union for a free trade agreement between both the sides. Now, both the sides are looking at an early harvest deal similar to the one India had signed with Australia. Both the sides have increased the frequency of meetings from quarterly to monthly. Government sources have also indicated that the European Union has been sensitive to India's concerns which have been raised so far, and the good relations have been reflected in the strategic dialogue. Also, it has been pointed out by government sources that even the European businesses based out of several EU countries have also objected to issues like carbon tax and the EU deforestation regulation over concerns of business being adversely impacted. Also, EU has objected to quality control orders which have been issued by India in several sectors and has termed them non-tariff barriers. On the other hand, India has said that QCOs will equally apply to Indian businesses unlike the EU's internal concessions for its own SMEs. Also, India has offered that mutual recognition can be given in areas of technical barriers to trade and sanitary and phytosanitary measures. Now, both the sides are looking for an early harvest deal by the July of this year. It remains to be seen how early the discussions are going to be concluded.
Okay, all right, Abhimanyu, thanks very much for that. Well, shifting focus now onto the latest on the Air India crash at Ahmedabad. At least 87 people who died in the Air India Ahmedabad-London plane crash have been identified through DNA testing. While authorities handed over the bodies of 47 victims to their families, nearly 600 doctors, assistants and drivers have been roped in to hand over the bodies identified through DNA testing. Outside the Ahmedabad Civil Hospital, the medical superintendent of the Ahmedabad Civil Hospital gave an update on the developing situation in a press conference. Listen.
एयर इंडिया एयरक्राफ्ट होनारत में सिविल हॉस्पिटल में आए हुए मृतकों के शव में से 92 शव की डीएनए मैचिंग हो चुकी है. 92 of which the individuals are 87 because there is duplication. डिस्पैच जो हुए हमारे यहाँ से शव ले जाने वाले की संख्या 47 है. बाकी जो पेंडिंग है उसमें से 13 लोग अभी D4 में वेटिंग में चल रहे हैं. दूसरे 2 घंटे में 8 लोग और आ रहे हैं. दूसरे शव की या दूसरे रिश्तेदार की डीएनए कंफर्मेशन के लिए वेट कर रहे हैं. वैसे हमारे पास यहाँ पर 12 लोग हैं और फैमिली के साथ डिस्कशन करके आने वाले 11 लोग हैं.
Well, on that note, though, we'll have a wrap up on this edition of Chartbusters. You stay with us. The team of Trading Hour is waiting by.
Good morning. It's a very, very strong start to the week in a world which is full of negative news as of now. The only positive right now is the screen. And you're watching Trading Hour live from the CNBC-TV18 Motilal Oswal studios. I am Hormas Hatakia. With me today is Vinny Motiwala. Vinny, good morning. Started off a little slow, but now we are picking up pace, and the bulls would hope that this pace sustains.
Absolutely hoping for the pace that sustains, given that, like you were mentioning, the global uncertainty. But as of now, more than 0.5% of gain is what the Nifty is managing to hold on to. So that's something interesting. The mid cap, let's look at that as well. It was in the red at around 10. Now that's also come to the green as well. So that is going to be interesting in terms of the trading session. Mid and small cap also performing in terms of the recovery that we've seen coming in the market as well. It did slip in the red, the market, and then again we saw that recovery. So hoping that this is something that we will see sustaining through the day as well. In terms of the top sectoral gainers today, we have IT that's managing to hold on to gains. So let's keep an eye out on Nifty IT. PSU banks a bit subdued in today's trading session. Other than that, Hormas, at least from the Nifty 50 point of view, we have SBI Life, ONGC managing to hold on to good gains. And on the flip side, Tata Motors a bit subdued.
Tata Motors not having a very good day, of course. And the usual suspects are leading the gains today. It is IT that is moving higher, be it Infosys, be it TCS, large cap IT leading the charge for the Nifty. And of course, with contributions coming in from HDFC Bank as well. So it is the three heavyweights that are powering the Nifty on today. Almost 200 points higher now on the index, 0.7% at the highest point of the day. But just as Vinny highlighted, Tata Motors, not a very good day for the stock after some subdued commentary coming in for JLR. Sudarshan is here to take us through the fine print of that. Sudarshan.
So JLR plays very important part for Tata Motors because it contributes almost 70% to its total revenue and almost 80% to its net profit. And the reason the stock is down because JLR is holding Investor Day meet today, and ahead of Investor Day, it's released investor presentation in which it has given FY26 outlook. On the EBIT margin front, it's saying that in FY26, EBIT margin is likely to be in the range of 5 to 7% versus 8.5% that company reported in FY25. Also on the free cash flow, it's saying that in FY26, it's expected to be zero versus £1.5 billion that it reported in FY25. But beyond FY26 or FY27-28, it's saying that it might see an improvement on both free cash flow and EBIT margin front. And the medium-term target for EBIT margin is to get back to 10% level. Now coming to company has made certain comments related to US tariff announcement. It's saying that it's in engagement with both US and UK governments. As far as UK exports is concerned, their tariff rate has reduced to 10% from 27.5%, but other important market that for company is Slovakia, where tariff rate remains around 27.5%. Now coming to the Chinese market, where it's saying in FY25, premium market was very challenging, but despite that, company has outperformed all the other peers. Now going forward, the growth that company is looking to unlock in China is via its JV that it's going to license to JLR's JV in China. And also going forward, it's saying that in China, the growth might improve. Over FY24 to 28, it's saying that total investment that company is looking to make is $15 billion. But the main reason why stock is under pressure is because of FY26 outlook. And by the first look, it's looking muted, but we'll be tracking JLR very closely because Investor Day will last through the day.
Okay, absolutely, So we'll wait out for more updates or anything that comes in on that front. But as of now, Tata Motors among the top Nifty 50 losers, down 4%. But on the flip side, we have PI Industries that's in focus today. Why is that so? What is the buzz around this one? To talk about that, we have Ria joining in with us. Good morning, Ria.
Well, good morning, Vinny. PI Industries has been in focus today on the back of a note from Morgan Stanley. They've upgraded the stock to an overweight rating with a target price of rupees 5,000. In fact, they've also raised their multiple on PI's agrochemical segment to 23 times, and they've raised the segment earnings target by 7%, which is offset by the drag in the company's pharma segment. Now, Morgan Stanley has said that PI has the highest exposure to agrochemicals in their coverage, and they believe that the company should see a three-pronged volume growth increase across domestic exports and new molecules businesses as well. They estimate that the new molecules and biologicals segments will each comprise a third of customs synthesis exports and domestic portfolios by FY28, and they have also said that multiples can re-rate by up to 20% higher to levels that were seen between 2022 to the first half of FY24, which was a period of robust exports momentum for the company. So overall for the industry, they've said that they expect a more constructive volume-led agri-chem cycle in 2026, which is going to support stronger asset runs and operating leverage-led margin tailwinds as well. So PI remains one of the top picks for the brokerage, and the stock is resultantly higher in today's trading session.
At the highest point of the day, PI Industries. Rhea, thanks a lot for that. And an upgrade coming in for Naveen Fluorine as well. Of course, an upgrade to equal weight from underweight, and of course, a price target raise for that stock as well. But not doing very well for itself at the lowest point of the day still is Naveen Fluorine. But take a short break. It's a double century on the index now. 24,915 is where we stand. So the bulls making a charge back towards that 25,000 mark. Get you more on that on the other side. Take a short break. All things commodities with Manisha Gupta up next. Stay tuned.
Welcome back to Trading Hour on CNBC-TV18. Now we'll put the spotlight on the commodity space because so much is happening on the global front. What are we watching out for today? Manisha, good morning. What are we keeping an eye out on? In the morning, we spoke about crude. Right now, what's your focus on?
Well, with the way the crude prices have been moving and there is concern when it comes to the Strait of Hormuz or for that matter within the Middle East, we also have seen the Baltic Dry Index surge quite a bit. On Friday itself, it was trading 2.5% on the higher side. It gained 20% in the previous week and it is up by nearly 2% in the Asian markets on Monday today here. Well, a rally does reflect strong global activity, one. And the second part is with the kind of concerns that you're looking at. In any case, the container and shipping rates have been on the higher side. That is what is impacting. It has also boosted earning for many of these shipping companies, by the way. And it also translates into higher freight rates per voyage there. So that really is working quite positive for many of these shipping companies and overall the sector as well. I'm just breaking it down right now. There are three parts to Baltic Dry Index. One, of course, is the Capesize Index. That has gained up by 5% in the previous week. This is the one that transports higher, bigger cargoes to the tune of 150,000 tons as well. This includes iron ore and coal. The Panama Index, which is the mid-size ships, also saw a gain of around 4.5%. That one is trading at a 2-month highs right now in the Asian markets. This handles 60,000 to 70,000 tons of cargo therein. And the smallest is the Supramax Index. This also is trading at a 2-month highs. So very strong gain across levels. Parallels is what we've seen within the shipping industry. While this is a global index, but when you look at the containerized freight index, well, that only tracks the Chinese movement, and that also has surged quite strongly, up by nearly 40% in the last month. So whichever sector that you see or time zone that you see within the international markets, this is a segment that seems to be really, really running up.
Oh, yes, and that's showing up on the shipping stocks as well. GE Shipping, Shipping Corp, both of them up for the second day in a row today. Manisha, thanks a lot for that important update there on the shipping segments as well. Now, Apurva Sheth, the head of research at Samco Securities, is now joining in for a quick chart check. Apurva, good morning. Thank you for joining in. We are back above that 24,900 mark, heading back towards 25,000. Do we cross that? Do we have the legs to cross that decisively yet again and move back towards that 25,200 levels before this conflict broke out? And what are your stock recommendations for the morning?
Hi, good morning, and thank you for inviting me on the show. I believe that we will have to wait and watch for the markets to, give us some decisive move above that 25,200 mark. We have been in a range between 24,500 and 25,000 for last 15 days. And it seems quite difficult given the geopolitical situation that we might break above this level. So I would rather wait and watch and let the Nifty move decisively before we take a strong long trade on the Nifty. On the stocks front, I believe that Narayan Hrudayalaya has a good potential to move upwards. So the stock has been trading sideways for quite some time, and it has also found support around the 50 DMA, and it's forming a flag kind of a pattern on the weekly chart. So from a short to medium term perspective, we can keep a stop loss of 1,800 and a target of 2,200. And on another contra trade that I would like to take is Bajaj Finance. I would like to take a short trade on Bajaj Finance. Now the stock has gone X bonus and X split today. And in our backtest, we have observed that 90% of the times the stocks trade lower after they go X split and X bonus, simply because of the increase in liquidity in the stock. And from a technical standpoint as well, we have seen that Bajaj Finance is trading in a sideways range, and it's forming a double top kind of a pattern. The volumes have been reducing compared to the previous peaks, and the RSI is also forming a bearish divergence. So looking at this into perspective, I would like to take a short trade on Bajaj Finance. The stop loss will be 978 and a target would be 850. These are spot levels.
Okay. Apurva, thank you so much, for joining in with us, talking about what we should be looking out for in the markets as well as stocks. That is going to be interesting to watch out for. Thank you so much for that. But on that note, we're going to slip into a very short break. When we return, we'll discuss the potential GSE changes with MS Money partner GSE Deloitte India and Bipin Sapra, tax partner at EY. So wait for that.
You have stood up and stood by many of India's dreamers.
I became a magnet for entrepreneurs. So there's one man who will hold our hand and take us all the way.
So what is the art of deal making?
So whenever the deal maker wants to become too big, I'm God, okay, you say this and you say that, kind of attitude, not literally, but I've seen that. What percentage of people you think die, Shireen, with regrets in their hearts?
A very large percentage.
So this risk of failure, fear of failure, is the one that makes people die with regret.
What is holding us back?
promote and protect the good, prevent and punish the bad. We prefer to be slow rather than fast. That's how we are a chalta hai country and not a daudta hai country.
The lack of speed would be, if you were to IPO India today, that would be on the risk factor side in the DRH.
I wouldn't IPO.
You wouldn't IPO?
But to IPO, I must have a news story.
You have a special place in your heart for Charlie Munger and Warren Buffett. What have you taken from them that continues to guide and shape how you think today?
Understanding of balance sheet, because balance sheet is accumulation of good and bad.
How do you find India positioned in this mix today?
We have a resilience, we have a stability, we have a wisdom of our own. But वो हम एक scene दिखाते हैं, फिर we have a long break. Stop that.
Interval थोड़ा लंबा हो गया.
बहुत लंबा हो जाता है.
Welcome back to Trading Hour on CNBC-TV18. Now, sources tell CNBC-TV18 that GST Council is likely to consider replacing the compensation cess with two other cess. How is this going to be impacting, in terms of the tax formation? What will it be in terms of cess that we're seeing coming in? MS Money, partner GST Deloitte India joining in with us, as well as Mr. Bipin Sapra, tax partner at EY, to talk to us about this. Mr. Money, as well as Mr. Sapra, good morning. Thank you so much for joining in with us. Now, this is what we're picking up from sources today, that, they are looking to replace this compensation cess with health cess as well as clean energy cess. Mr. Money, I just want to start by understanding how will this process work. So health cess as well as clean energy cess, how will both these be implemented then? Right now, compensation cess is one, right? It's for all the products that are there. Now, health, will it be separate? Energy, clean energy, will that be separate? How will this be working?
So, before I answer that question, I'll just step back a minute on the subject of cess itself. We have to bear in mind that when the GST law was being drafted in 2015-16, with a lot of suggestions which came from businesses also, the GST replaced a bunch of taxes and a bunch of cesses. And at that point of time, it was agreed that the GST would function as one tax. It would not have cesses and surcharges attached to it. However, at that point of time, the group of ministers felt that in order to defray the costs relating to compensating the states for the collections under the VAT law in the past, there needed to be a mechanism to compensate them. And that is why for a period of 5 years, strictly for 5 years, in the initial part of GST, 2017 to 2022, the cess was introduced and agreed. Subsequently, because of the pandemic, when collections went down due to slowdown in industrial activity, the government took a loan from the Reserve Bank in order to compensate the states, and to defray that loan and to pay back that, the cess was extended to 31/3/26. Now, in any conversation that happens on cess, we have to keep a fact point in mind that having a cess in the GST law is not in line with the architecture of GST that was agreed by all the stakeholders, including stakeholders from business. Because the moment we have a cess in the GST law, and what you are now saying is that there are likely to be two cesses in the GST law, we are tinkering with the architecture of something which was intended to simplify indirect taxes. And there has been some amount of simplification that has happened. More simplification needs to be done by rationalizing the rates. We are at that stage now. At this stage, if we extend the cesses with two more cesses, it is going to complicate things. To come specifically to the question that you asked, the compensation cess that applies today does not apply to all the products that are taxed under GST. It applies to certain categories of products only, which can be put in two buckets. It applies to large number of automobiles. It applies to a large number of tobacco and related products. So what could potentially happen when the compensation cess period of 31/3/26 ends could be that in respect of tobacco products, there is a health cess. And in respect of automobile products, there is a clean energy cess. But the moment we accept both these propositions, there are more questions than answers. For instance, how will the health cess be used? Is it going to educate people on the ill effects of tobacco? Is it going to be in some ways linked to the cancer universities and cancer research? We have not heard anything on that. Similarly, very importantly, when we come to clean energy cess, is it a cess that is not going to be applied on hybrid vehicles? Is it a cess that is going to be applied on all vehicles, irrespective of the fuel used and irrespective of the length of the car and the usage of any other material? So that is what has to be answered when we think of cess. Ideally, what businesses would expect is we should not be substituting one cess with another cess just in order to defray the revenue considerations.
Correct. Gentlemen, good morning. Thank you for joining in. Mr. Sapra, same question to you. Do you agree with what Mr. Money says, that this introduction or a potential introduction of two cesses instead of one complicates the process? And now that GST collections have started to stabilize, do you see the need to do something like this?
So I agree with Mani fully in terms of that replacing one cess with other doesn't make sense. And I'll also step back a little. What you have to realize is that compensation cess is being levied on articles on which 28% GST is being levied, except maybe in cases like coal, where it was always a clean energy cess. It was being levied on 400 metric tons, 400 per metric ton, to really offset something like a indirect carbon tax. But the remaining everything else has been a revenue which the compensation cess has been distributing to the states depending upon their needs till a couple of years back. And since then, whatever was distributed and has to be paid back to the RBI, the loan which the central government was taken, that was the purpose why compensation cess has continued and will continue till March 26. Now, the purpose of creation of a GOM is to see that these are considered as sin goods, may or may not be sin goods, but on which 28% plus compensation cess has been levied. If a GOM has been mandated to look at what to do with the rates, because somewhere in the minds of the government, they do not want to reduce the rates which they consider as sin goods. They would want to keep this revenue for the purpose of rationalizing of rates, streamlining of GST structure, and bring this in. What you have to realize is roughly around 8% of the compensation cess is almost 7 to 8%, somewhere around 125,000 CR. And that's a lot of revenue to be brought into the GST system, which can be used for rationalizing rates, or maybe reducing 12% rates to 5%, or whatever, or maybe 28% to 18%. Things like that, which can be attempted once this revenue comes into the fore. And a GOM of center and states has been mandated to do this, increases our hope that, or increasing our thought that there might be GST rates which might be getting tinkered, and these cesses may not get created. So replacing cess with cess doesn't make sense. So coming back to your question, that will put revenue in the hands of things which may be used for a certain purpose. But is that what the GST revenue is supposed to be done, or really bring down the other rates, needs to be seen.
Absolutely. Mr. Mani, you were highlighting, right? The purpose of the cess was actually to compensate state for the revenue losses, is what we've highlighted. That was the main purpose. Now, do you think the structure also possibly could change in terms of the breakup for state government as well as in terms of the central government? Is that a possibility of a change?
Look, I would just reiterate that the compensation cess, when it was brought in, was a temporary measure. And all businesses that were impacted by the cess were told that, please bear with us because we have to compensate states. Give us 5 years and we'll find out a mechanism. Now, 5 years is over. Now we are on the cusp of the 8th year of GST. And when this cess ends, it will be in the 9th year of GST. So by making a cess a permanent feature of the GST, we are altering the entire structure of GST. And one of the things that the government could look at, if there are revenue considerations that they need to keep in mind, is to see whether they need to marginally increase some of the GST rates. Because the law in GST permits the GST rates to go up to 40%, which is 20 plus 20. So there is a provision enabled in the law by which the GST rate can go up to 40%. Should they invoke that and therefore increase a 28 marginally to maybe a 30 or 32? Or do they want to have a cess? Because a cess as it stands today is again a complicated piece of legislation. In respect of cars, for instance, the rate of the cess depends on the fuel used by the car. It depends on the length of the car. It depends on the horsepower of the car. Now, that's not a kind of structure that we have when we talk of ease of doing business in India, when we say that we need to make the tax law simple so that everybody can understand. So if they need to look at it from a revenue perspective, they should also be looking at, do we have a 2% increase for cars? It goes up from 28 to 30 for all cars. Leave it over there. But then, as I said before, industry needs to be taken into confidence. The auto sector, the tobacco sector are two key constituents of GST collections. There is a large amount of collection that they give month on month, which is why we are seeing record revenue figures. So these two sectors need to be first taken into confidence, their suggestions obtained in terms of what is the best way for the automobile companies and for the customers. And then possibly a way out needs to be found out in terms of how do we proceed now.
All right, gentlemen, we're running out of time, but it's a long-awaited discussion and a long discussion at that. Thank you so much for sparing time and joining us today. We'll see what the final outcome of this eventually turns out to be from the GST Council. There's some reports there and CNBC-TV18 news break as well on this cess, compensation cess. Of course, take a short break. The Nifty is slightly cooled off from the highs of the day, though. Still 170 points higher, so no complaints from the bulls. More on the markets with Rakshit Ranjan of Marcellus on the other side. Stay tuned. Welcome back. Continuing our conversation on the markets now. Rakshit Ranjan, the portfolio manager at Marcellus Investment, is joining in. Rakshit, good morning. Thank you for joining in this conversation about this CNBC TV18 news break from last night about a potential increase in clean energy cess for the auto sector or for the syn goods for that matter. What does that do to that auto sector as a whole? Because it's already more of a double whammy for them, right? Because already they are struggling with sluggish domestic demand, and then you would add to increase their cost. There is a lingering tariff uncertainty as well. What does that do to the sector now?
Yeah, I mean, this is one of many things affecting that sector, and I think the answer to your question has to lie in the ability of a company to pass it on to customers whilst protecting cash generation, or maybe even use this in a smart way to maybe become better than their competition. But overall, for the sector, I think in in the auto OEM space, the quality of competitive advantages are only with a select few companies is what our view is, and hence such externalities matter a lot. So provided you are with companies where they can either absorb these costs, impact for the end customer without passing it on, and still protect their margins through either efficiencies or actually use it to their benefit, it's good. Otherwise, these are headwinds currently for the sector.
Absolutely. Some of these headwinds that are coming in for the sector as well. And obviously, we had that investor day that is going on also for Tata Motors. And, we spoke about that earlier on in the show about how JLR is talking about the outlook for FY26. So that'll be key to watch out for. Rakshit, good morning and thank you so much for joining in with us. My point is to talk about overall in terms of the valuation. How do you see that shaping up now? You'll normally follow a bottom-up approach, right? So what are you looking at in terms of stocks, mid-cap, large-cap? Where is it that you are finding value right now?
Yes, so valuation is certainly one of the bigger risks that an investor needs to try and avoid in the current market, because the current stock market environment is very different from, let's say, what prevailed over the 2021 to 2024 period. During that 3 years, FY21 to 24, earnings growth rates for even Nifty overall were in the 20s CAGR for 3 long years. That's a very healthy earnings growth. And in that kind of an earnings growth momentum, valuations become a smaller contributor to share price returns than earnings itself. What we are now in is earnings growth in FY25 was pretty weak. For Nifty, it was, I think, 13-14%, if I'm not wrong. And last 3 quarters of FY25 were around the 10% mark at best. In this kind of an environment, valuations become super important. If you've got negative earnings surprises on a richly valued company, there are massive downsides. So yeah, the way we are looking at it, bottom up, look for companies where there can be positive earnings surprises. Look for building a portfolio where valuation is a risk you've taken care of through position sizing, let's say, and go particularly for competitive advantages, because in this kind of an environment with weak external earnings growth, moats become very important. Capital allocation becomes very important. Tailwinds aren't there for broader sectoral calls.
So where are those sectors that fit your criteria, Rakshit? In just a couple of weeks from now, we'll start getting business updates for the ongoing quarter as well. And considering how FY25 was, with this low base that kicks in, say possibly from the second quarter, if not the first, where are those sectors that you're anticipating a positive earnings surprise?
So, I mean, our sectoral orientation in the portfolio is an outcome of the bottom up. But still, if I have to sort of call out where that outcome currently looks like, one of our largest exposures today in the portfolio is in the healthcare sector, where it would be combination of hospitals, diagnostics, pharma, and even via the health insurance piece in terms of the drivers of some of the companies that we've picked up. That's one of the larger exposures. Along with that, a little bit on engineering, exports, but particularly very deeply moated high ROC companies. Those two are the areas where in the last, say, 6 to 12 months, we've increased exposure. Besides this, there are lots of opportunities where we can see our portfolio companies trying to dig out efficiencies to drive earnings growth faster than top line growth, because top line growth in the current environment is not so easy to come by, given the tailwinds aren't there from the broader economy as strong as they used to be till a year ago. So those 3 buckets, I would say. Healthcare, maybe a little bit of engineering, exports, manufacturing, and then margin expansion through efficiencies.
Okay. So anything on the front of, defense, were you all on the boat as well, or anything on the PSU sides? Did you all jump the boat as well that time?
No, we didn't get into either of those 2 sectors. in the entirety of our fund so far. And the reason is our approach, our philosophy is to take calls from a very long-term standpoint with bottom-up company-specific strengths which generate high ROCs rather than sort of change sectoral orientation basis the various headwinds or tailwinds from a macro perspective only. So yeah, we've avoided those two spaces.
But to counter your point, Rakshit, isn't defense technically a longer gestation play as well, right? Because the market is currently factoring in that there will be an increase in defense expenditure, there will be more order inflows, and considering the fact that the world is only heading towards more conflict instead of peace, that the export prospects of these companies would also go up. But are you saying the fact that their current growth does not justify the kind of price that the market is giving them currently, even for a longer period of time?
Partly that, but also it's not always that a top-down tailwind leads to bottom-up high ROC for a business. That connection is something that we are yet to get convinced about in some of these sectors. So I do totally agree with you on the top-down tailwind. That this is a sector where there's increased and sustained government expenditure, not just government expenditure, even otherwise you can see the direction in which some of those businesses might be headed in terms of their order flow and all. But it's the long-term moated orientation of bottom-up stock picking where the connection so far between the top-down and the bottom-up hasn't yet been convincing enough for us.
Okay, and Rakshit, any thoughts coming in on the financials front as well, banking side, anything that you've looked there?
Yes, so I think in the near term, given how we've seen the interest rate cycle progress more recently, for the banks, I think the first half of this year might be a lot more muted earnings growth, not so much for the NBFCs. And hence, that's one sort of differential orientation that we've got for the two types of lenders in our portfolio from a position sizing perspective. But having said that, still sticking to lenders with very high quality of credit selection, stable balance sheets, and particularly on the banking side, comfortable valuations. So yeah, I think the space does look attractive for the banks. FY26 for, let's say, something like an HDFC Bank, which is part of our portfolio, should be much better than FY25, and FY27 should be even better than FY26 in terms of their loan to deposit ratios coming under sort of tolerable levels, and hence credit growth picking up. But yeah, first half of FY26 for the banking side, earnings growth only should be challenging, but I guess that's built into expectations.
Rakshit, thank you so much for sparing time and joining us today. Looking forward to having you more often on this platform. Rakshit Ranjan of Marcellus on his sectoral ideas. Take a short break. More on the markets on the other side. Stay tuned.
Welcome back to Trading Hour on CNBC-TV18. Nifty as of now is managing to hold on to 0.7 to 0.8% of gain. But IGL, that's what we're going to put the spotlight on. What is happening in IGL today? What is the latest update here? We have Sudarshan joining in with us to give us all those details. Good morning, Sudarshan.
Good morning, Vinny. So over the last few months, you would have seen several reports related to Delhi EV policy. And now there is another update that has come over the weekend. As per Hindustan Times, there is a report that Delhi government may revise electric vehicle policy and likely to ease transition deadlines. But more than that, what is the most important part is that if government goes ahead and revise cab aggregator policy that the previous government of Aam Aadmi Party had announced in November of 2023, and that policy had aimed to license and regulate any aggregator and delivery service provider, and also regulate e-commerce entity having more than 25 vehicles in the fleet. And after that, Citi has come out with a report. It has a buy call on the stock, that is IGL, and target is of 250 per share. It says Aam Aadmi Party government's policy of 2023 had mandated all electric vehicle fleets by 2030, and this had dampened IGL's volume growth prospect. Now, it believes that targets were always very hard to realistically achieve, but now new government's practical and realistic approach could provide boost to IGL, because cab aggregator segment, if the policy is revised, this is important because this segment contributes 12 to 15% to IGL's volume. Now, the another part which is important is the report also says that replacement of CNG three-wheelers are also not being considered, and this also contributes 3 to 4% to IGL CNG volumes. And last part is Delhi DTC bus, that is for which electrification is almost complete, and now its contribution to IGL's volume has fallen to almost 2 to 3% versus 7 to 8% what it used to contribute few years ago. So overall, if the policy is revised and electrification norm is eased, it will be positive for IGL, and that's the reason you are seeing an uptick in the stock price today.
Positive indeed for IGL. Easily a 25% upside is what Citi is projecting, 250 rupee target. Sudarshan, thanks a lot for that. The other one though, SpiceJet came out with results a few days ago, and many surprisingly positive ones at that.
Absolutely, surprisingly positive ones, because for the full year, if you look at it, they've actually reported a profit after 7 years. So that is surely something that is marking in and coming in for SpiceJet. Just quickly taking you through the numbers, right? They've reported a profit, 48 crores is the profit versus 404 crore loss last year. Do not forget, obviously, there was a foreign exchange gain this time versus a loss last year. So that's a factor. The QIP that has come into play this year as well. Then there's a reduction that is in fuel costs, airport charges as well as maintenance charges. Overall, fuel costs on a year-on-year basis down by around 31%. We're seeing charges for airport fees, that's down by 22%, maintenance costs down, that is 23% as well. But all this also comes into factor that, there are some of the planes that are still grounded, and the revival of grounded planes is much slower than that was expected, and that is why the revenue is seeing a impact coming in, 25% decline in terms of revenue. Now, obviously, what we're also watching out for is rental charges. So rental charges are up 11%. So maybe there's a change and shift that we are watching out for in terms of leasing of airplanes versus owned airplanes. That will be important to watch out for as well. All in all, market share has been maintained at 3.38% for the year. Their passenger yield, that's also seeing an improvement, 5.18 versus 4.9 last year. Revenue efficiency is improving for revenue per seat kilometer as well for the company. So all in all, good numbers that have come in for the company, whether you look at specifically in Q4, though FY26 Urmas, that could be a bit of a worry, because Indigo had also highlighted that given these geopolitical tensions, you don't know how things are going to shape up for the airlines. And that is why a bit of a slowdown in terms of the revival is a bit of a worry we'll watch out for going forward. And that is why, looking at the stock today as well, opened up in the green, and that's come off, because you have that worry coming in of, are you actually going to be able to revive those planes that are there?
Indeed, and keep an eye out on that. Vinny, thank you for that update on SpiceJet. Take a short break. More on the markets on the other side. Stay tuned. Welcome back. Now, the India-Europe Free Trade Agreement talks have progressed further. Abhimanyu, it's with the latest that he's picking up from his sources.
Intense and productive discussions are continuing between India and the European Union for a free trade agreement between both the sides. Now, both the sides are looking at an early harvest deal similar to the one India had signed with Australia. Both the sides have increased the frequency of meetings from quarterly to monthly. Government sources have also indicated that the European Union has been sensitive to India's concerns which have been raised so far, and the good relations have been reflected in the strategic dialogue. Also, it has been pointed out by government sources that even the European businesses based out of several EU countries have also objected to issues like carbon tax and the EU deforestation regulation over concerns of business being adversely impacted. Also, EU has objected to quality control orders which have been issued by India in several sectors and has termed them non-tariff barriers. On the other hand, India has said that QCOs will equally apply to Indian businesses, unlike the EU's internal concessions for its own SMEs. Also, India has offered that mutual recognition can be given in areas of technical barriers to trade and sanitary and phytosanitary measures. Now, both the sides are looking for an early harvest deal by the July of this year. It remains to be seen how early the discussions are going to be concluded.
Okay, Abhimanyu, thank you so much for that. But with that, we're absolutely out of time on this edition of Trading Hour. You're seeing the indices, all of them are managing to hold on to green. Mid-cap has picked up pace as well. So good afternoon, that's surely shaping up. And with that, we'll wind down this edition. Thanks from Hormaz, myself, as well as the team who put this show together. But don't go anywhere. Halftime Report is there to take all the action forward.
Market off, morning lows, stocks push higher even as the Israel-Iran conflict rages. IT and energy gain while consumer durables and autos drag.
Tata Motors arm, Jaguar Land Rover, tells investors its profitability is expected to take a significant hit in FY26 and its free cash flow can dive to near zero from £1.5 billion last fiscal.
Sun Pharma will get a new MD on September 1st. Kirti Ganaukar as founder and current CMD. Dilip Sanghvi steps back to focus on strategy and the specialty portfolio.
The GST Council may dispense with compensation cess and replace it with health and clean energy cesses. Demerit items like tobacco, cars, high-end bikes and private airplanes may see some GST rates revised upwards to offset the removal of cess.
Experts say there has been no significant trade or logistics disruption as yet, and Israel has mostly steered clear of targeting Iran's oil assets. This has reined in oil prices and shipping rates so far. Very good afternoon. You're watching Halftime Report on CNBC-TV18 live from the CNBC-TV18 Motilal Oswal studio. I'm Ekta Batra and with me is Vivek Iyer. Well, it is turning out to be a session where we're picking up a little bit of pace for the mid-cap index. So we're up around 0.3% as we speak. We have an advanced decline ratio which has improved as the day has gone along as well, and in fact has turned onto the advancing side. So maybe the advanced decline ratio graph should come up for you, and that'll give you a sense in terms of how exactly the trajectory of the day has gone. Separately, the Bank Nifty is up around 0.4%, so there's been a recovery which has taken place for the Bank Nifty as well. As you can see on your screen, there has been more of an alignment of the advances and the declines. So as the day goes along, let's see whether there's any kind of crisscross which takes place. As of now, 1:1 is currently where it stands. Lot of stocks in focus in terms of specific volumes as well as price action. So, for example, from the broader markets, we have Vodafone Idea, which is buzzing in terms of high volumes and price. We have stocks such as Reliance Power, which is down around 1.3%. Yes Bank, which is one of the usual suspects in terms of volumes and price action, is showing some amount of traction. And from the Nifty space, we have stocks such as Tata Motors, Dr. Reddy, Sun Pharma, all of these stocks which are lower in today's trading session. On the upside, a couple of the insurance plays are dominating, SBI Life and HDFC Life. Hi, Vivek.
Good afternoon, Ekta. Well, very interesting cues, especially given the fact that we actually expected the markets to see quite a bit of a dip, but sharp intraday recovery. The small cap index continues to trade with minor cuts, but still quite a bit of a recovery coming in there. Well, a couple of stocks on the radar. First one is HDFC AMC, a JP Morgan downgrade coming in on the stock. The stock opened quite weak, but post that, when you're looking at HDFC AMC, it's seen a very sharp intraday recovery, now trading near the day's highest point. But one stock that's taking it on the chin today is Tata Motors. This is ahead of the Jaguar Land Rover Investor Day. The outlook provided by the company is below expectations. Sudarshan joins in with more details.
So Tata Motors is in focus because JLR plays very important part as far as Tata Motors is concerned. In FY25, JLR contributed almost 70% to its revenue and almost 80% to its FY25 net profit. Now today, JLR is holding Investor Day, which will be going through the day. But ahead of the meet started, JLR has released investor presentation in which it has given FY26 outlook. On EBIT margin front, it's saying that in FY26, it's going to be in the range of 5 to 7% versus 8.5% that company reported in FY25. On cash flow, it's saying that it's going to be almost zero, basically close to zero against 1.5 billion pounds that had seen in FY25. But beyond FY26, over FY27-28, it's saying that it's going to basically it will try to see look for an improvement on both EBIT margin and also on the cash flow. And now the medium-term target is to get back to 10% EBIT margin level. It has also made certain comments related to US tariff. It's saying that it's in engagement with both governments of US and the UK. So UK exports to US, for that tariff is going to be reduced to 10% from 27.5%, which is the current tariff. But for the other important market, which is Slovakia, for JLR, for that tariff remains around 27.5%. Next important market for JLR is China, in which it's saying in FY25, premium market was very challenging, but JLR has outperformed the peers. Now going forward, the company is looking to unlock growth potential via licensing of Freelander to JLR's EV, and the first Freelander that company is looking to launch is in H2 FY26. Over FY24 to 28, total investment plan that companies plan to make is of £15 billion. But the main reason why the stock is under pressure because of the FY26 outlook that company has given. By the first look, outlook is looking muted because of the EBIT margin. It's expecting a drop of almost 200 basis points. But the focus will, because the investor day will go on through the day, so we'll be tracking very closely what does management say.
Thank you so much, Sudarshan, for joining us, giving us a sense of what exactly one can expect as far as Tata Motors is concerned. The JLR outlook is muted, in line with most of the European automakers who've given a very muted as far as calendar year 2026 is concerned. But one stock that's doing quite well in the session is PI Industries. It's gaining on the back of a positive brokerage update by Morgan Stanley. The brokerage upgrades the stock to an overweight rating. Ria joins in with more details.
Well, yes, Vivek, PI Industries has been in focus today. As you said, Morgan Stanley has upgraded the stock to an overweight rating. They have a target price of rupees 5,000, and in fact, they've also raised their multiple on PI's agrochemical segment to 23 times, and they've raised the segment earnings target by 7%, which is offset by a drag in the company's pharma segment. Now, what Morgan Stanley has said is that PI has the highest exposure to agrochemicals in their coverage, and they believe that the company should see a three-pronged volume increase across domestic exports and the new molecule segment as well. They've estimated that the new molecules and biologicals segments will each comprise a third of custom synthesis exports and domestic portfolios as well by FY28. And they've also said that they believe that multiples can re-rate by 20% higher to levels seen between 2022 to the first half of H1 FY24, which was a period of robust exports momentum for the company. So overall, they have a positive view on PI Industries. Remember, on Friday as well, Equirus Capital had highlighted a few points for PI Industries. The overall exports for the company rose by around 32% on a year-on-year basis for May 25, and the pyrosulfane exports also surged by around 150% for this period. Now, they've said that the 20% rise in revenues that the company has seen between April to May 25 is likely to result in a 30+% increase in EBITDA for the period, and this is despite the fact that the company has seen a broad-based decline in realizations across all of its segments in key products. So overall, a positive view coming in for PI Industries, and the stock is up around 4% today on the back of this.
Okay, all right, Ria, thanks very much for that. Well, we do have the main WPI data, which is coming at around 0.39%. This is versus 0.8% on a month-on-month basis. There's a deflation which has taken place in fuel and power, as you can see, and there's been a reduction in terms of the inflation for the manufactured products at around 2.04%. Primary articles also in deflation by around 2% but and has increased as compared to the previous month. We do have Lata with us, and we have Aditi Nair, Chief Economist at ICRA, joining in for a discussion on this. Lata, over to you.
Well, actually, it's a pleasant number. I mean, unless people are worried about deflation. Coming in at 0.39%, the poll actually showed 7%. 0.7%. So it's far lower than what the poll indicated. The important part is that almost every vertical of inflation has shown a month-on-month fall. For instance, the WPI fuel and power group is down month-on-month by 1%. The primary articles index is down, again, 0.1%. Only the food index, actually, let me read. The all commodities index is also down 0.1% month-on-month. Now, May is not a month where things actually fall. Food prices rise. But because, the winter crops always see vegetable prices lower. But at this point in time, the May WPI food index is up by only 0.1%. That's like much lower than the historical average that you get. And as you can see, onion inflation at minus 14.4 is flashing, and month on month again up by about 0.2. Remember, this is wholesale. So those of you who are saying that's not what I get at the mandi level, please remember we are talking about wholesale prices, APMC prices, or even in iron and steel and others, the price at which the wholesale market purchases. And there things are clearly showing very, very low inflation. In fact, in basic metals and such things, the index is down 0.2%. So perhaps the global slowdown is catching, and we are seeing commodity prices respond to that as well in the month of May. Cereals inflation has definitely been a positive. That's at 2.56% YOY. The YOY rise was 3.85 even for April. So cereals clearly month on month is falling, and so did pulses. This is something we saw even in the CPI. These are weighty items in the food basket, and those have fallen in May compared to April. So the marginal rise in vegetables has been compensated. Vegetables normally rise more in the month of May. Let me toss it to Aditi Nair, who has been waiting by. Thank you very much, Aditi, for your patience. Your thoughts, just 0.39, the poll was 0.7.
Thank you, Lata. We were also at 0.7, and I must say that the undershooting is quite broad-based across all the major groups. We've seen the actual number coming in a little bit lower than what we had projected. Now, interestingly, I think there are a few factors that are going to change the trajectory going forward. Firstly, on the food side, you're quite right. We just haven't seen that seasonal uptick in perishables that we normally see as the temperatures get hotter. And we had an early onset to the monsoon. The monsoon got stalled, and now I think the rains are picking up again. So all of this could have an impact on how perishable prices pan out going forward. And of course, the overall trajectory and distribution of the monsoon will be very important going forward. On the global side, however, things are quite different and more uncertain and perhaps less benign. We've got the rupee depreciating a little bit. We've got the sharp jump in crude oil prices. And I think this again is going to affect the non-food side of the WPI in the current month. While we do expect the WPI inflation to increase a little bit going ahead, but it's still going to remain really at very low levels for most of the year.
You know, the sharp question for the market will be twofold. First, no difference to the core, the terminal repo rate from the RBI. Will it, with the inflation coming, WPI inflation falling, will there be any small hopes that the governor doesn't stop at 5.5 but goes to 5.25?
So Lata, that's anyways what I was expecting, 5.25. Let's see. I do think we'll have a pause in August, given the very strong signal that was given through the way that the policy
stance changed.
There. Yeah, and the stance changed. So, and the fact that the CRR cut itself has also been upfronted. So we do think August is going to be a bit of a pause. After that, you know, whether we get that final rate cut in October or not will depend on so many different factors. So while we do expect the WPI to remain pretty tame, the fact is that crude oil prices have gone up pretty sharply, and that will start seeping through into a lot of other prices as well. How much of an impact it has on the CPI inflation? Because, you know, crude doesn't enter the CPI. It's the and the RSPs don't change very fast for petrol and diesel either. So the impact of this on the CPI will tend to be a lot more limited. We're working with a 3.5% average CPI forecast for this year, which is lower than the MPC's 3.7%, which is why we still think that October could be live.
One final quick question. You know, if the WPI is going to be so limp at 0.39, and look at the average, it has been 0.85 before that. I think practically from March, we have seen very, very minimal numbers in the WPI. Okay, 0.85 was April, May 0.39. This will mean that nominal GDP will be very low, and our tax buoyancy depends on the nominal GDP. So are we going to fall short on tax collections? As it is, there is a big tax giveaway of 1 trillion rupees.
So Lata, lots of moving parts to this as well. Definitely nominal GDP growth is unlikely to be materially higher than 9% this year. That's the number that we've been working with. And if we look at the tax collections themselves, because of the large tax, foregone because of the income tax relief, we always had a little bit of a concern about whether the absolute number was going to be raised or not. But there is an underlying good news, which is that the actual nominal GDP base for last year is higher than what had been put into the budget. And because of that, the fact that we're now projecting a lower nominal GDP growth for FY26 is actually getting nullified.
Okay.
So it's more a question of the headline tax numbers, whether they're going to meet the target or not so much a GDP base issue.
Yeah, to be fair, the GST collections have been very good. We had even 1 month of 13%, which is, of course, May, that got reported in April. And even thereafter, we got 11%. So perhaps moving parts, as you say. Thank you very much, Aditi Nair, for joining us with your thoughts. Well, this is not a policy driving inflation number because CPI is the one that the RBI is mandated to look at. Nevertheless, the fact that this is so limp, at 0.39 indicates that the core inflation pressures are going to be very muted. Core inflation was 4.2 in the last number, but that was more because the base was 3.1 year ago. And it looks like going forward, even if it remains at 4, the continuing pressure of manufactured products inflation is simply not there. So long as we get a good monsoon, we are home and dry.
So clearly the RBI is shifting its gear towards growth.
Yeah, it has already shifted, but I don't think there's anything in this number to expect that they will go from 5.5 to 5.25. I think the governor was pretty clear that the space is very limited, which is why he brought the stance back from accommodative to
neutral. Okay, all right, Lata. Thanks very much for that. So that's the May WPI data standing at around 0.39%, lower than what our poll had thrown up and lower than the 0.8% figure in the previous month. We'll take a short break. We'll get you more on the markets and stocks once we're back. Stay tuned.
You have stood up and stood by many of India's dreamers.
I became a magnet for entrepreneurs. So there's one man who will hold our hand and take us all the way.
So what is the art of deal making?
So whenever the deal maker wants to become too big, I'm God, okay, you say this and you say that, kind of attitude, not literally, but I've seen that. What percentage of people you think die, Shireen, with regrets in their hearts?
A very large percentage.
So this risk of failure, fear of failure, is the one that makes people die with regrets.
What is holding us back?
Promote and protect the good. Prevent and punish the bad. We prefer to be slow rather than fast. That's how we are a chalta hai country and not a daudta hai country.
The lack of speed would be, if you were to IPO India today, that would be on the risk factor side in the DRHP, right?
I wouldn't IPO.
You wouldn't IPO?
But to IPO, I must have a new story.
You have a special place in your heart for Charlie Munger and Warren Buffett. What have you taken from them that continues to guide and shape how you think today?
Understanding of balance sheet, because balance sheet is accumulation of good and bad.
How do you find India positioned in this mix today?
We have a resilience, we have a stability, we have a wisdom of our own. But वो हम एक scene दिखाते हैं, फिर we have a long break. Stop that.
Interval थोड़ा लंबा हो गया.
बहुत लंबा हो जाता है.
Welcome back. Well, IGL is seeing a sharp surge today on the back of a bullish note from Citi. Sudarshan has more details.
So over the last few months, there have been several reports related to Delhi EV policy. Now, over the weekend, there is a report from Hindustan Times that Delhi government is looking to revise electric vehicle policy and may ease transition deadlines. But more than that, what is most important part is the report says Delhi government may revise cab aggregator and delivery service policy, and if this happens, this will be hugely positive for IGL. Now, Citi says it has a buy call on the stock and target is 250, and believes that earlier government of Aam Aadmi Party in the policy announced by that government in November of 2023 had mandated all electric fleets by 2030, which had dampened IGL's volume growth prospect. But if this policy is eased by the new government of BJP, this will boost volume of IGL. Why does it believe that? First, because cab aggregator contributes around 12 to 15% to IGL CNG volume. If the policy is eased, there also volume growth may increase going forward. Another part is, as per the revised policy, and the report says replacement of CNG three-wheelers is also not being considered. And currently, CNG three-wheelers contribute around 3 to 4% to IGL CNG volumes. And last part is Delhi DTC bus, which is the government bus for which electrification is almost complete. And now the contribution to IGL's volumes by DTC is just 2 to 3% versus 7 to 8% what it used to contribute few years ago. So overall, if the report is correct and if Delhi government goes ahead and eases EV policy, it will be taken positive, and also it will boost IGL's volumes, and that's the reason you are seeing an uptick in today's stock price of IGL.
Thank you so much, Sudarshan, for joining us and giving us a sense of what exactly Citi is making as far as IGL's prospects are concerned. But one stock that is under pressure today is NMDC. This after the stock reacts to a bearish call from Citi as well as Kotak. Nigel joins in with more details.
Well, that's right. There are two calls that have come in from brokerages on NMDC. One is Citi and the other one is Kotak. Let's start off with the Citi note. They have a sell rating. They have target prices at around 60 rupees per share. They think that NMDC's prices could likely correct, and they've given us a few reasons on that front. So they say that NMDC's price premium to export parity should normalize. Currently, it's at around 40% odd. In the past fiscal year, it was only around 20%. Next up, they point out that Lloyd Metal and Energy, they have announced their plans to hike their iron ore mining capacity from around 10 million tons in the past year to around 25 million tons in the coming year. So additional supply in the system. They also expect domestic steel prices to correct as steel imports have picked up, and they believe that the iron ore market will remain in a small surplus in this calendar year itself. They wind the note down by saying that the stock is trading at around 6 times EV upon EBITDA, which they don't believe is very, very cheap. Moving to Kotak's note, they have a sell rating. Their target price is at around 55 rupees per share. They highlight that NMDC has cut its iron ore prices for the month of June, but they're expecting further cuts in the coming months. They also point out that domestic iron ore pricing is at an 8% discount to import parity. Historically, it's been at 20%. Now, ongoing weakness in the steel prices should also be another trigger that will put some pressure on pricing. And they also point out that there's a ramp up in merchant iron ore mines in India. That coupled with weaker exports, that's what will put pressure on pricing as well. So the sum and substance is both the brokerages are highlighting that they're expecting prices to come down. They're not very confident with regard to the global iron ore markets itself. And they're highlighting that there are merchant miners that will ramp up production, which will put further supply into the market, thereby pressurizing prices. So that's what Citi as well as Kotak have to say, both of them with bearish notes on NMDC.
Okay, all right, Nigel, thanks very much for that. So that's on NMDC, which is in focus in today's trading session. Well, we need to take a break with the news that we have the Nifty, which has picked up pace, so up around 0.7%, and the advanced decline is now firmly on the advancing side. So around 3,200 stocks advancing to around 3,000 stocks declining. So seems as though that gap is narrowing and will continue to probably do so if in case this current trend continues. Mid-cap index at the high point of the day, up around 0.3%. Take a break. Sudeep Shah of SBI Securities will join in with some trading calls. Stay tuned.
Welcome back to Halftime Report. Well, Nigel has stayed on. Nigel is going to give us a quick F&O update as far as market internals are concerned at 12:30 midday.
Well, that's right, Vivek. That's actually an encouraging trading session if you look at it. Both the Nifty and the Nifty Bank, from the day's low, they've seen a good recovery. Now they're at a very, very crucial point because at around 10:30 a.m. when I was on air earlier today, at that point of time, we went towards the 20 DMA, but we've not crossed it decisively. Now, as the chart is telling you, the Nifty is still hovering around the 20 DMA and the Nifty Bank as well, that breached the 20 DMA on a closing basis in Friday's trading session. That as well has crept up a little bit. So you'll want on a closing basis both the Nifty and the Nifty Bank to conquer this mark. But the real story is in the broader markets actually. The mid-cap index has moved into the green. Even if you look at the crisscross lines, at the start of trade, you had less than 500 stocks that were advancing. That number, the number of stocks advancing, that's moved to around 1,000 stocks. So crisscross lines getting closer to each other, that's telling you that your portfolio as well is looking quite good. Now moving to the options data. Today, the put writing has come back. At the 24,800 put, you should pull that up for you on the screen. You have the 24,700 put as well. That as well, big open interest built out there, and the premiums hovering in that vicinity of around 60 to around 80 rupees. There is some out of the money call buying, but the Nifty is facing aggressive resistance at around the 25,250. So for the time being, you have the 25,300 level that's seeing a good amount of open interest build up. So a bit of a punt. Suppose we have de-escalation on the global front and you have a couple of domestic triggers as well. Maybe we get to that mark, explaining why the premium has moved up even on that one. So the levels that I'm looking at, since there is writing at around the 24,700 mark, the premium's roughly around 60-70 rupees. I'm going with a level of around 24,630. You don't want that level to get breached on a closing basis today. Well, on the upside, that 25,000 odd mark, that's the line in the sand. If in fact the bulls can get towards the level and hold it above those levels, the bears, they'll be scampering for cover. Keep in mind the FIs are net short with more than 1 lakh contracts on the short side. So I'll keep an eye out on this 25,000 mark, very, very crucial. Stocks that we're looking at, well, Tata Motors, it had a good run, good pullback, but today, in fact, the news has been quite disappointing. So that's why it's telling you some of those longs, they are unwinding their position. So bulk of long unwinding is what we're seeing out there. GMR Airports is a bit of a short covering bounce that's playing out. So the open interest is down and the stock has moved up a little bit. While you have a KPIT, there's a mix of activity actually that's taking place out there. Because there is some open interest build up, close to 3 to around 4% open interest build up, and the stock as well is moving up. Keep in mind, this is one of the rank underperformers, but the tech index is fighting back, and KPIT Technologies as well. There is a sense of long build up on that counter. So on a closing basis, the 20 DMA will be the crucial mark both on the Nifty as well as on the Nifty Bank. Back to you guys.
Okay, all right, Nigel. Thanks very much for that. Sudeep Shah of SBI Securities now joins in to discuss more details on the technicals of the market. Sudeep, hi, welcome to the show. Well, for the Nifty, just about moving towards 25,000 slowly and steadily for the Nifty at this point in time. How crucial is that level, and what are you tracking for today?
Good afternoon. See, what we feel is that last several sessions, like starting from Wednesday, Thursday, Friday, all these 3 sessions, markets have seen some kind of selling pressure from higher levels on account of these geopolitical jitters that we've witnessed in the last 4 or 5 sessions. But important is that today's price action is showing that irrespective of the early morning volatility, this 24,700, 24,750 zone is getting guarded. And we feel that the initial range for the week could be between 24,700 and 25,050, 25,100 thereabouts. And beyond 25,100, if we see any de-escalation of the geopolitical crisis, then the rally could straight away go up to 25,500, 25,700. It could be a faster short covering. As Nigel was just mentioning about the net shorts in the system, now the long short ratio at 19% as on Friday's closing does indicate that in case of slight de-escalation, we could see a big rally in the next few sessions. So what we feel is the best case scenario here would be 24,700, 24,750 to act as a support from here on and slowly crossing 25,100 and thereafter achieving the next levels in due course.
So Deep, you've given your view as far as Nifty is concerned. What are the individual stocks that you like? Any buy-sell ideas for us?
Vivek. Rick, a couple of stocks that are there on our radar. We like the IT space. In the last few sessions, Nifty IT has given a decent breakout on relative on the ratio charts. Relatively, it's looking more stronger compared to Nifty. So one stock which is from the IT mid cap space, which is there on our radar, is Persistent Systems. Now, Persistent Systems has managed to cross 5900, 5930 zone, and it's now ripe for a decent breakout on the daily, weekly, and monthly charts. So from here on, we feel that 5800 could act as a strong stop loss. And on the upside, 6300, 6400 zone can be revisited in the coming few weeks. So that is one stock. And the other stock which we like is from the NBFC space, and that is Aditya Birla Capital. A strong move in the last 1 month, and irrespective of the market volatility, we've seen Aditya Birla Capital getting support at lower levels, and from there building on to the rally that it has witnessed in the last few weeks. So from the current levels also, we feel that looking at the weekly and the monthly charts, we feel that this stock could head up to 260, 265 levels in the coming few weeks, and can be bought with a stop loss at 238.
Thank you so much, Sudeep, for joining us, giving us a sense of your view on the markets as well as the individual trading calls. Well, it's now time for a short break. On the other side, Manisha Gupta joins in with Shivanshu Mehta of MCX. Stay tuned.
Welcome back. Shivanshu Mehta, head bullion at MCX, now joins us. Shivanshu, hi. First of all, congratulations are in place because back-to-back, we're looking at more products and assets being launched on MCX. You, of course, are going to be talking about the monthly options when it comes to silver, which is getting launched today, 5 kgs and 30 kgs. I want to take a step back and ask you on how the reaction has been to gold monthly options, and is that what pushed you to get into silver as well?
Yes, thanks, Monisha. In fact, just for perspective, as per the FIA study, you would be aware that MCX is the largest commodity options exchange globally by the number of lots traded. And for gold as well as silver is the second largest globally. Now, in keeping with that, our options seem to have come of age in terms of participation by both the bullion and jewelry fraternity for hedging, as well as by the investors and the retail traders, basically. So yes, we introduced the monthly options in gold in the benchmark 1 kg contract in the month of November last year. And for the remaining portion of the year, November to 31st March, the turnover was seen 3x. And this basically brings a lot of benefits for the small to medium hedgers because the premium becomes economical. There are various tenors of different number of days available for hedging jewelers who can hedge their inventories better, flexible pricing, etc. So we remain committed to the hedgers, and we did this. So yes, the numbers basically in FY24 gold options was around 6,100 crores, which reached for the FY24-25 to 28,100, and that is the kind of numbers we saw. And with silver, as you're aware, this portion of the year we have larger tenors between September to December and December to March. So we feel that this is the right time. We were waiting for this time to launch monthly expiries in both the silver options that we have. Yes.
Just to get a sense on the kind of volumes that we see from MCX, Shivanshu, whether it's about bullion, energy, vis-a-vis metals, where do you see a better traction coming in?
Yes, I think if you talk about bullion, the growth has been across the board in bullion futures as well as options, both. And as you're aware, it serves the industry with a domestic price benchmark as such. And the spot and futures integration is seen via the delivery nature of our contracts. We saw 600 tons of silver being delivered for the calendar year. And I think that again proves the point that both as a hedging platform as well as for retail investors who may like to do a cash and carry calendar spread, etc. There are various use cases that these products are serving. And I think definitely the growth has been more seen, evidenced in options of late, maybe with the geopolitical and the macros playing out. People have understood the test use case for options, and that's an encouraging sign.
You've recently done away with the additional margins as well. Do you think that that would be supportive as well in getting more participation?
Yeah, as leaders, we've always remained committed to serving the industry whichever way we can. Yes, the additional margins in both gold 2% as well as silver 3% have been rationalized, and I think the industry has given a thumbs up. I think it makes way for efficacious hedging and better capital deployment into the physical bullion and jewelry industry, keeping the cash management better. I think these things are playing out. Yes.
So clearly, Shivanshu, risk management and hedging are one part that is done on the platform. How are you also looking at investments, SIPs, and silver, of course, being an industrial metal as well? Do you see the industrial companies side of industry also coming in here?
Yes, we've had the patronage of silver in terms of the importers, refiners, traders, as well as the end-use industry on the MCX, along with gold. And as such, that has only been growing. And like I said, that silver also sees heavy delivery volumes, which again proves the point of spot to futures integration. And as far as your other question is concerned, SIP, yes, we have the coin products in the gold 1 gram, 8 gram, and 10 gram recently we launched on the 1st of April. So people can accumulate these products in electronic form via our Commerce e-warehouse receipt management system. They can hold them, they can take the physical delivery out as and when they desire. So maybe evidenced in the numbers, yes, we've seen in the silver 1 kg format, 1 kg bar has gained popularity as a retail product. We've seen more than 600 tons delivered since it was launched or introduced in 2020, 21, thereabout. So yes, I think people are using these contracts because they come with a delivery period towards the end, all of them, compulsory delivery, and there's a funds pay in and payout on each one of those days. So it behaves like the spot market for that portion. And yes, there's tremendous vibrancy in the SIP environment as well via these contracts.
Thank you so much, Shivanshu. Thank you so much, Manisha, for joining in, giving us a sense, number one, of what exactly the commodity market is doing and also the prospects of MCX going forward. Well, we'll now slip into a short break. We'll get you more on the markets and stock-specific action on the other side.
Welcome back. You're still tuned into Halftime Report on CNBC-TV18. Galaxy Surfactants is buzzing a trade as per a Motilal Oswal report. The company on its capital market day has outlined an ambitious but well-structured growth map. We have Upasna joining in to tell us more about this.
Well, certainly, company has highlighted an ambitious and well-structured growth roadmap in its investor meet. And here are some of the important key highlights given up by the company. Over the next 5 years, company has given a guidance that it plans to double its volume and grow its EBITDA by 2.5 times while sustaining the ROCE greater than 22%. Also, it has given a key internal goal to achieve EBITDA per kg of rupees 25 by FY30. Now, this EBITDA growth is 50% of incremental EBITDA it expects to come from the organic route via categories such as hair care, oral care and body wash, in which company enjoys a very strong presence. Around 30% of this EBITDA growth is projected to come from the new product portfolios is what the management has highlighted, and the remaining 20% will be driven by the new avenues including collaborations and strategic partnerships. Now, Motilal Oswal is of the view on the back of this that going forward, volume growth of the company will be driven by its focus on R&D, increased wallet share and also acquisition of new customers. It has also estimated a CAGR of 6% over FY25 to FY27, which will be mainly driven by companies improving volumes in specialty care segment is what the brokerage has highlighted. So on the back of this, brokerage has reiterated a buy rating on the stock with a target price of 3,180 per share. And we can clearly see the stock surging in trade today.
Okay, all right, Upasna. Thanks very much for that. We'll take a short break, but here is some good news for our viewers. India's business news leader is now just a click away, introducing CNBC TV18's all-new app. Get instant access to breaking news, in-depth articles and financial world updates just at your fingertips. Download the CNBC TV18 app now from the Apple Store or Google Play Store, or just scan the QR code on your screen.
Welcome back to Halftime Report. Well, select segments of the markets are continuing to see a very sharp rebound. Look at the entire Nifty metal index. That's trading near the day's highest points. All of the metal stocks, in fact, most of the steel companies are now trading near the day's highest points. So if you could pull up names like Tata Steel, JSPL, JSW Steel, all of these stocks are doing quite well in the session. The other set of stocks that are doing quite well is the cement pack. So if you pull up a name like an UltraTech as well as an ACC, those stocks too today have seen quite a bit of a rebound. But Ekta, you've been tracking the pharma domestic as well as export data. How does the data look?
Well, I'll start with the domestic data, which is from PharmaRack, the domestic growth for the month of May. So the IPM, which is the Indian pharma growth, was 7.2%, but we've seen a couple of companies outperform that. So Sun Pharma has outperformed with a double-digit growth of 11.2%, Alchem following suit at around 10.3%, Torrent Pharma at 10.8%, and Dr. Reddy's at 11.2%. Ipca and JB Chemicals have grown 10.8% and 10.7% respectively as well. Now, interestingly, in terms of the segment that grew, the anti-diabetic therapy segment was up 6.7%, which was led by non-insulin injectables, which is basically Mounjaro, which is tirzepatide as well as semaglutide, which have really driven growth within the anti-diabetes segment. And Mounjaro's India launch in 2025 has seen a strong uptake, according to PharmaRack, in the urban clinics already. So that's an interesting piece of information there. Now, Goldman Sachs has separately written a report with regards to the export performance data from key CDMOs in the month of May. So, for example, Laurus Labs has seen strong growth. It's up 104%. We've seen Blue Jet up around 29%, Syngene up 23%, Sai Life Sciences up around 18%. Weak performance from Gland Pharma down 24%, Divi's Labs down 23%, Newland also, which is down around 59%. Smaller companies, according to them, may show volatility due to shipment bunching in specific months. So that's the overall data for both the export as well as the domestic data. Generally, for the export data, you don't see exact, correlation in terms of the earnings, but it's just an indicator.
Laurus clearly stands out, right?
Yeah, Laurus stands out.
Ekta, a couple of weeks ago, we had told the street about how Sun Pharma's one of the important facilities was undergoing the US FDA inspection. They've given an update to the exchanges on that, and along with that, rejig as well as far as the management is concerned. Tell us more.
Well, yes, Sun Pharma, the US FDA has issued 8 observations to their Halol facility. The plant was inspected from June 2nd to June 13th. And the plant, remember, has been under import alert since December of 2022. It was issued a warning letter at that point in time as well. Now, additionally, so what happens is that we really need to assess what the observations are like, those 8 observations. The fact that they've received 8 observations and the stock hasn't moved is somewhere, the street is probably already factored in that maybe Halol is a facility which should be probably counted out for some time. And Sun Pharma is going ahead in terms of growth X of Halol. So I think maybe that's a fair assumption to make, because generally 8 observations, the number is indicative that, is indicative. It might not indicate the seriousness, but it's a large number of observations. But nonetheless, separately, there is a rejig which is taking place at Sun Pharma. Kirti Ganaurkar is now appointed the MD of Sun Pharma, and this is effective 1st September. He's succeeding Dilip Sangvi, who will now focus on specialty portfolio and the strategic oversight. And Mr. Kirti has in fact been with Sun Pharma since 1996. The company says it marks a culmination of a structured succession plan. Remember that Alok Sangvi, Dilip Sangvi's son, was in fact elevated to COO in Feb 2025, and his daughter Vidhi Sangvi was made a director just last month itself. So it seems as though this plan was in the works.
Thank you so much, Ekta. Sun Pharma definitely in the news today, an update on an important facility, management rejig, all of that. Despite that, stock largely muted in the session today. But with all of that, it's a wrap on this edition of Halftime Report. Business Lunch will take all the action ahead.
Markets have surged to the highest point of the day. The stocks are pushing higher even as the Israel-Iran conflict rages on for the fourth day in a row. IT and energy shares are the top gainers, while consumer durables and auto stocks are the big drags. Tata Motors' arm Jaguar Land Rover tells investors its profitability is expected to take a significant hit in FY26 and its free cash flow can dive down to near zero from £1.5 billion last fiscal. Sun Pharma will get a new managing director on the 1st of September this year. Kirti Ganorkar, the founder and current CMD, Dilip Shangvi, will step back to focus on strategy and the specialty portfolio. The GST Council may dispense with its compensation cess and replace it with health and clean energy cesses. Demerit items like tobacco, cars, high-end bikes and private airplanes may see GST rates revised higher to offset the removal of cess. Experts say that there have been no significant trade or logistics disruptions yet as Israel and mostly steered clear of targeting Iran's oil assets, and this has reined in oil prices and shipping rates so far. Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I am Hormuz Fatakia, and it's a good day for the markets after the pain that we saw over the last two trading sessions. The Nifty continuing its rebound from Friday's low of 24,472, and now we are up almost 450 points from those levels. At the highest point of the day is where the index stands, 0.8% higher, a 200-point gain for the index, and led convincingly by the index heavyweights. HDFC Bank, Reliance Industries, IT is also a contributor there, Infosys, TCS, all of them contributing to the gains. L&T also a big contributor as well. The broader markets are doing fairly okay for themselves as well after recovering from the opening lows, be it the mid-cap index and the small-cap index. The mid-cap index up 300 points now, recovering from the day's low, and it's almost a 1,000-point recovery from the lows, and the small-cap index too has moved into the green now, 0.3% higher on the small cap index. And part of this gain is also courtesy the Dow futures. So the Dow futures are up 200 points as we speak, despite there being no let-off in the conflict that currently rages on between Israel and Iran. And that is where we begin the show, as the hostilities have now deepened with the conflict entering the fourth day. Both sides firing new waves of missiles overnight and this morning as well, amidst international pleas for diplomacy and de-escalation. Now, Iran strikes earlier this morning have hit an Israeli oil refinery and damaged part of its power grid. Now, CNBC's Dan Murphy is here with the latest updates on this ongoing conflict.
Israel's latest airstrikes inside Iran mark a significant escalation, not just tactically, but strategically. By targeting oil depots, missile launches and nuclear-linked facilities, Israel has really made it clear that it is prepared to act unilaterally and decisively against what it sees as an existential threat. So what exactly did these strikes accomplish? Well, first of all, Israel has inflicted a heavy blow to parts of Iran's military and nuclear infrastructure, and it has severely hit the IRGC. But it has also inflamed tensions across the region, and it has made the path back to diplomacy more difficult. Of course, adding fuel to the fire, Prime Minister Netanyahu has refused to deny reports that Israel proposed assassinating Iran's supreme leader. And asked whether regime change is the goal, he responded only, "We'll do what we need to do." That statement alone signals how expansive Israel's strategic ambitions may be and how far it is willing to go. Meanwhile, President Trump has also sent mixed signals. He said the US had nothing to do with the Israeli strikes, but also warned any Iranian attack on US assets would be met with the full force of the American military. And yet, in the same breath, Trump said he believes there is a good chance of a deal between Israel and Iran, adding that sometimes they have to fight it out. That combination of military threat and diplomatic optimism reflects a long-standing US strategy. Support its ally, but leave the door open to negotiation. The question now is whether either side is willing to walk through that door. Iran, under attack, is unlikely to engage in talks from a position of perceived weakness. And Israel, emboldened by its ability to strike deep inside Iran, may feel this is its moment to press harder. For now, it seems the path is one of escalation, not de-escalation. What happens next may depend less on missiles and more on whether the political will exists to pull the region back from the brink.
Pull the region back from the brink is where it stands. Dan Murphy there with that report. Let's also listen into what experts make of these ongoing tensions.
Netanyahu is clearly talking in terms of regime change. That has been his perhaps dream for quite some time. Whether that can be achieved by military means, like he's now trying, is, I think, highly debatable. At the very most, if there is a sustained military campaign of the sort that now seems to be coming, he can probably achieve a regime collapse in Iran. But whether a regime collapse will lead to stability, to put it very, very mildly, that is highly debatable. So the long-term aims of the Israeli operations are not clear. Of course, he's saying that he will reduce the ability of Iran to make a nuclear weapon, and he will succeed with that short term. But of course, over time, he might actually stimulate the Iranians in the years ahead to actually go nuclear.
So far as the current scenario is concerned, for a few days, I can foresee this counterattack and attack between these two parties. But the regional players have been playing a very reasonable role in terms of having neutrality in this conflict, and also at the same time trying to make ways between these two parties. So I see that in the forthcoming days, we will see some negotiations happening between these two parties. But at the current time, we have to be ready for the upheaval.
Now, as the global crude oil market continues to remain volatile, be it S&P Global's Zhu Wei Wong believes that crude prices could dip to as low as $50 a barrel by the end of this year. Listen in.
After summer, when the crude oil burn is finished, when the refinery and spike up is finished, we think gradually the oil market spike prices will be turning into a bearish mode, leading to the crude oil inventories. And then given that additional barrels pushed out by the OPEC Plus in coming rounds of negotiations and monthly meetings, we think the dated Brent prices will likely stay and reach to around 50s by the end of this year. At the moment, I'm more focused on the crude oil market, but I do see the spike in prices going in past days because of risk assessment in the market.
Some flashes on your screen, and this is courtesy a Money Control report. The long-awaited HDFC Bank arms, HDB Financials IPO could be launched by the end of June, and that is what Money Control is reporting. A 12,500 crore IPO is what has been proposed. A 2,500 crore issue of fresh shares, and a 10,000 crore offer for sale by HDFC Bank. And the timeline is likely to be by the end of this month, which is in a couple of weeks from now, is what Money Control is suggesting for HDB Financial's IPO. HDFC Bank, though, currently at the highest point of the day and nearing record high levels as well, and of course the top contributor to the gains on the Nifty. Now, the Indian Embassy in Tehran has also released a statement that it is continuously monitoring the safety and security of Indian students in the region. Now, in some cases, students are being reallocated to safer places within Iran, while other options are also under consideration. The embassy also remains in touch with the community leaders to ensure the safety of these students. Meanwhile, the U.S. Embassy in Israel and all its consulates will remain closed today, and this is after the U.S. Ambassador to Israel, Mike Huckabee, posted on X that the building has suffered minor damages from concussions of Iranian missile hits. However, no U.S. official has been injured. We take a short break, but just before we do that, CNBC-TV18 Access is a premium membership-based service available on CNBC-TV18.com. It offers members exclusive content, market intelligence, and expert thought leadership. The membership includes access to CNBC-TV18's flagship events, interactions with our journalists, along with curated studio tours, e-learning sessions, master classes, and curated lifestyle benefits. Now, designed for an immersive and enriching experience, it empowers members with premium business intelligence and unique lifestyle benefits. The power of insight, the privilege of access, exclusivity, experiences, and influence is yours to claim. You can become a member by logging on to cnbctv18.com/access/plans.
investing.
Welcome back. And among the underperformers in today's session, even as the index is trading with gains of around 200 points, is Tata Motors, and that is after the company's arm Jaguar Land Rover's profitability is set to take a hit. Sudarshan is here with more on this. Sudarshan, tell us more.
So JLR plays very important part for Tata Motors because it contributes almost 70% to its total revenue and almost 80% to its net profit. And the reason the stock is down because JLR is holding Investor Day meet today, and ahead of Investor Day, it's released investor presentation in which it has given FY26 outlook. On the EBIT margin front, it's saying that in FY26, EBIT margin is likely to be in the range of 5 to 7% versus 8.5% that company reported in FY25. Also on the free cash flow, it's saying that and in FY26, it's expected to be zero versus 1.5 billion pounds that it reported in FY25. But beyond FY26 or FY27-28, it's saying that it might see an improvement on both free cash flow and EBIT margin front. And the medium-term target for EBIT margin is to get back to 10% level. Now coming to company has made certain comments related to US tariff announcement. It's saying that it's in engagement with both US and UK governments. As far as UK exports is concerned, their tariff rate has reduced to 10% from 27.5%, but other important market that for company is Slovakia, where tariff rate remains around 27.5%. Now coming to the Chinese market, where it's saying in FY25, premium market was very challenging, but despite that, company has outperformed all the other peers. Now going forward, the growth that company is looking to unlock in China is via its JV that it's going to license to JLR's JV in China. And also going forward, it's saying that in China, the growth might improve. Over FY24 to 28, it's saying that total investment that company is looking to make is $15 billion. But the main reason why stock is under pressure is because of FY26 outlook, and by the first look it's looking muted, but we'll be tracking JLR very closely because Investor Day will last through the day.
Sudarshan, thanks a lot for that. Near the lowest point of the day is Tata Motors, 4% lower on the stock on a day. The index is up 215 points. Let's get you an exclusive news update now. Sources are telling CNBC-TV18 that the GST Council is likely to consider replacing the compensation cess with two other cesses. Timsy is here with more on this. Timsy, what are your sources telling you?
Well, that's right. What sources are indicating is the fact that the upcoming GST Council meeting could be announcing a major decision, that is replacing the current compensation cess which is levied on sin goods such as aerated drinks, cars and tobacco products. That could be replaced with two new cesses, health cess and clean energy cess. What we are given to understand that the GOM on compensation cess, which is headed by MOS Finance Pankaj Chaudhary, is likely to hold its final meeting anytime soon, through which they will give their final recommendations to the movement towards two new cesses which will be under consideration for the GST Council. And if GST Council agrees, then these two new cesses could kick in from 1st April next year, because the compensation cess window is ending on 31st March 2026. Now, if this happens, then what is the procedure? Well, the procedure, according to the current law of GST, no new cesses can be introduced. A cess can be introduced only via an amendment in the Constitution Amendment Bill, which can be done only after Council's approval. Secondly, there's another option. Sources indicated that currently there are two cesses which work under the indirect tax regime, apart from the GST products, which is health and infra, which is road and infra cess, which is also AI, that is agriculture infra development cess. But that goes separately under the indirect taxes in the budgets, and it gets diverted through the states through the consolidated fund devolution. So that could be another process, but most likely states will not agree to go through the consolidated fund of India process. They would want it to be part of the GST regime, and yes, right, if at all, then it needs to be shared with states, and center is what center would want. currently compensation cess is only for the states. States are being compensated for the 14% guarantee that was given at the time of launch of GST. So let's see what is the fresh roadmap ahead once this proposal actually goes through. Back to you.
Timsy, thanks a lot for that. And some exclusive updates there coming in from Timsy. Take a short break. More news and updates continue on the other side. Stay tuned. Welcome back. Now the latest from the tragic Air India flight crash at Ahmedabad. The Gujarat government has begun handing over the bodies of the victims to their families. Madhiya is here with a live update. Madhiya.
Well, an extremely hot afternoon outside the mortuary complex here at the Ahmedabad Civil Hospital. The families of the victims of the plane crash continue to wait to collect the mortal remains of their loved ones. Some families have been given the mortal remains while many others continue to wait for their turn. Just moments ago, we saw former Chief Minister Vijay Rupani's mortal remains being handed over to his family. The coffin was covered in Indian flag. Senior party leadership, police officials, and there was Chief Minister Bhupen Patel, who was also present here. He paid his last respect. The body was then flown to Rajkot for the final rites. Over 270 bodies have been recovered so far, but there are many people who continue to be missing. Rescue workers continue to pull out body parts from the rubble. We understand that there were 242 passengers on that plane. One survived. So 241 passengers were from the plane. But there were many others who were also in the hostel complex. There were many others who were standing below the building. Not all bodies have been recovered so far. So that process still continues. The DNA samples are being matched. Many DNA samples are now matching, and as and when the DNA samples match, the bodies are being handed over to the families. On the investigation front, the black box was recovered. There are Boeing officials, other investigating teams that are visiting the crash site. Even today, some officials visited the crash site. Only then, after the black box is investigated, the recordings are, studied.
Right.
Is when officials will understand what caused the 787 Dreamliner to crash seconds after it took off.
That's the most important update that we all await. Madhiha, thank you for that information live from Ahmedabad. Now, in further aviation-related updates, Boeing 787 Dreamliner aircraft continues to face snags with a Chennai-bound British Airways flight from London returned back to base after developing a technical snag. Another Air India Dreamliner en route from Hong Kong to Delhi was also forced to return after developing a suspected snag mid-air. Now, in non-Dreamliner incidents, a Saudi Arabia Airlines Airbus aircraft with about 250 Hajj pilgrims landed in Lucknow after developing technical snags mid-air. And a Lufthansa flight headed to Hyderabad from Frankfurt was also disrupted following a bomb threat. Prime Minister Narendra Modi is on a three-nation tour from the 15th to the 19th of June. He has become the first Prime Minister to visit Cyprus in 20 years. Cyprus is the first country he has visited after Operation Sindoor. He is also slated to attend the G7 summit in Canada before finally leaving for Croatia. The G7 summit has begun in Canada's Kananaskis. The three-day summit will see the leaders of 7 most industrialized nations, which are likely to deliberate in the ongoing crisis in West Asia and Donald Trump's trade tariffs, among other issues. Now, apart from the G7, leaders of India, Australia, Brazil, Indonesia, South Africa and South Korea are also expected to attend the summit. And shifting focus back home, at least 6 people have died and several tourists were reportedly swept away after an iron bridge over the Indrayani River collapsed in Pune on Sunday afternoon. Now, according to officials, Yesha is bringing us more details on this. Yesha.
Right here on Indrayani River, this is the Kundamala area in the outskirts of Pimpri-Chinchwad in Pune rural. This was a bridge which collapsed late last evening. Around 3 p.m. was when this incident took place. As far as details from the locals are concerned, they've mentioned that because of heavy rains in the last couple of days in Pune and Pimpri-Chinchwad area, this very river is flowing beyond its capacity, and which is where this incident took place. It's a popular tourist spot, and this being a weekend around monsoon when it was a lush green area, and it being a monsoon getaway kind of a place, was where there were more than 150 people who were present on this very bridge. Right now, the visuals that you see, this was in fact a cement bridge which was connected to another iron bridge. The structure of the iron bridge has collapsed. This was only for pedestrian. In fact, on the way towards this place and even at the start and the end of the bridge is where there are notices that have been put up saying that people should not use this bridge because it's in dilapidated condition. But despite that, this being a tourist spot and it being a monsoon weekend was where there were more than 150 people who were present on this very bridge. In fact, when this incident took place, there were local teams, rescue teams, local disaster response teams and NDRF teams, as well as teams from Pimpri-Chinchwad and local police which had rushed to the spot. They had rescued around 50 plus people from this spot. 51 people have been rescued. 4 people have lost their life, which includes 3 men. One 6-year-old child has also lost his life. This is because this very bridge, which is in dilapidated condition, was also used for commute using two-wheelers as well. You can in fact see two-wheelers which are now still there on that very bridge. So far, the rescue operations by NDRF have been stopped because all the missing people have already been found, but a drone was used to take the final stock of the situation, and the rescue teams are also still doing a recce of this very place so as to ensure that no person or anybody which is still trapped inside are left here. So the final stages of the investigation is on here, and several police officials have also visited the site to understand what really happened, what transpired that led to the collapse of this very bridge.
Isha, thanks a lot for that. We call time on this edition of Business Lunch with that update. We leave you with the market at the highest point of the day, the Nifty nearing the mark of 24,950. From me and the team that put this show together, thank you so much for watching. Midcap Radar on the other side.
Good afternoon and welcome to Midcap Radar, live from the CNBC-TV18 Motilal Oswal studio. I'm Vamakshi Doria and with me is Vivek Iyer. Vivek, a good afternoon to you. Today, there's absolutely nothing to complain about, and like the grey, gloomy weather outside, the market is in a sea of green.
That's right. It's not Monday blues for the market. Rather, it's a sea of green that you're seeing across all of the indices. In fact, even the small cap and mid cap index that was sulking at the start of the session have recovered quite sharply. But we have quite a lot lined up on the show. Let's start off with the top headlines. Markets off morning lows. Stocks push higher even as the Israel-Iran conflict rages. IT and energy gain while consumer durables and auto lag. Mid cap index lags but still 1,000 points off the morning lows.
IGL shares rally 4% today after sources tell CNBC Awaaz that the Delhi government is likely to revise its electric vehicles policy, easing the deadline to transition from petrol and gas-powered vehicles in the process.
Laurus Labs gains after May export data for the pharma industry. The company's exports surged over 100% as per the data from Goldman Sachs. India's domestic pharma market rose 7.2% in May 2025.
Galaxy surfactant surges 4% after Motilal Oswal says that the company on its capital market day has outlined an ambitious but well-structured growth roadmap.
PI Industries gains after Morgan Stanley upgrades the stock to an overweight rating and raises the target price to Rs 5,000. The brokerage expects the company to see a three-pronged volume increase across domestic markets, exports, and new molecules.
Well, it's a day that can be defined as the day of recovery. We've seen good momentum build up right from the get-go. It's a one-way street for now. When we look at the mid-cap index as well, that is doing quite well. But when you look at the advanced decline ratio, it is largely in favor of the decline. So therefore, the gain on the mid-cap as well as small-cap index is lower as compared to that of the benchmark indices. As far as some sectoral indices are concerned, most of them are in the green, and today the gains are being led by the Nifty IT pack. Metal pack is also doing quite well. Nothing to complain about as far as the broader markets as well as the benchmark indices are concerned, but there are some stocks that are moving around in trade, and in our special segment mid-cap movers, Hormaz will take us through that list. Hormaz?
The widening, yawning gap between the advances and the declines is now narrowing because the markets are wide awake. You can see the mid-cap index at the highest point of the day. So we will start off with the gainers then today in the broader markets. And there are a significant number of that. You can Nugent Software, the last few minutes, the spike that has come in, 6% higher there on that stock. Gland Pharma, 4% higher there. Atul having a good day in the office as well. Some of the newsmakers in today's trade. Then you look at IGL after news reports as well, 4.5% higher on that stock. PI Industries on the back of a positive brokerage note, and Shipping Corporation extending gains but off the highs of the day. Some rebound is seen in some of these capital market names that were under pressure last week. Look at 361 WAM at the day's high. Anand Rathi is up 3.5%. MCX2 is up 3%, nearing the highs of the day. So some rebound seen in some of these capital market names. Stocks that are doing well on the volumes front, look at Aster DM. Pharma as a sector is doing well in general. RHI, Magnesita, KPIT Tech also gaining on the back of healthy volumes. And lastly, some names that are bucking the trend. That number is constantly declining, and look at DB Realty. Alembic Pharma is down to the lows of the day, and Jubilant Ingravia, after a very sharp move on Friday, is seeing some bit of profit booking at higher levels. Back to you guys.
Thank you so much, Hormaz, for joining in. It's a very good time to get a quick technical check on the market. Ruchit Jain from Motilal Oswal Financial Services joins us now. Good afternoon, Ruchit. Well, did you expect the kind of momentum, and do you feel that at current levels we can see further upside for the Nifty?
Yeah, hi, very good afternoon, Vivek. Well, if you look at last 15-20 days, then 24,450, 24,500 has acted as a rock solid support for a market, irrespective of what the reasons are. Whenever our market is corrected towards that range of 24,500 or 450, we are witnessing fresh buying interest over there. Friday's low exactly is within that range itself, and today we have seen a follow buying again after the Friday's pullback move from the lows. So I think the overall trend still remains on the positive side itself until these important supports are intact of 24,450. I think any kind of dips that we are witnessing are getting bought into. So overall, I think momentum remains positive. On the higher side, 25,250 is the level that we are watching out for, and once that is surpassed, we would expect a resumption of the broader trend in the index as well. But for now, it remains a buy on dip market. Clearly, whatever dips are coming, they are getting bought into. So keep a stop loss below 24,450 and use any declines as buying opportunity.
Well, Richard, that remains a buy on dips market according to you. But what are you buying in these dips?
Yeah, so I think there is an up move. Today we have seen that the broader markets have been doing well. Initially, the large cap stocks were doing well. I think defense is one space which positionally looks quite good, because we have seen that many of the stocks which have corrected for 3 to 4 trading sessions have taken support around the 20-day EMA and has resumed the up move. So BEL within that space, Bharat Electronics look quite interesting over here. A broader uptrend that has been seen in since the month of April itself. 20-day EMA has acted as a support, and the stock seemed to have resumed its high top, high bottom structure. So BEL would be my first pick, where one can go long on with stop loss below 386 for potential targets around 427, 428. And within the banking space, selective banks are looking good. Indian Bank is one stock where if you do comparative analysis with other PSU banks, then the stock has relatively stood quite well. So relative outperformance within the sector is seen, and technically the trend is looking quite positive over here. So Indian Bank can be bought at current levels with stop loss below 610 for potential short-term targets around 665.
Thank you so much, Ruchit, for joining us, giving us your view on the markets as well as your stock-specific idea. Well, we'll now slip into a short break. The management of Belrise Industries joins us next to discuss their Q4 earnings.
Welcome back. You're watching Midcap Radar on CNBC-TV18. Let's focus in on Belrise Industries. The company reported its Q4 earnings today. The stock has surged since, and the company's reported revenue growth of almost 49%. The margins have expanded too. To discuss the quarter gone by and the way forward, we are now being joined by Sumed as well as Swastit Badwe, promoters of Belrise Industries. Good afternoon, gentlemen. This is Vamakshi joining in. I'd first like to ask you about, your growth prospects going forward into FY26. Last time when you joined us, you did not give us a specific number. So, in case, if you can give us a specific number, and X of the H1 business that you've recently acquired, what was the growth like in FY25?
I can take that. So to answer your question, which, as you said correctly, we didn't answer last time, we expect to grow in the mid-teens over the medium term. This will be funded both by organic as well as inorganic acquisitions. And we expect this to be possible given the order book that we have in place today. In terms of the H1 acquisition was actually acquired only on the 28th of March. So there's no real impact of the H1 acquisition to our FY 2025 numbers.
Understood that. Well, what we want to understand from you is we get that you do almost 60 to 65% of the total assembly work when it comes to Bajaj Auto. So going forward, who are the other manufacturers that you're in talks with? And secondly, especially when it comes to the two-wheeler markets, what is the kind of growth that you're penciling in over here?
Firstly, to your point, we are not able to comment that it's for Bajaj Auto or for any other OEM, as opposed to
Sure.
be naming any of our OEM customers going forward. Thank you.
No problem. But what is the kind of order book that you're expecting? And what are the total number of customers that you have out there? And are you in talks to onboard new customers in that particular segment?
Right. So in the two-wheeler industry, we have a market leadership. So in the two-wheeler industry, almost 1 out of every 4 chassis that you see on the Indian roads or exported from India is manufactured by Bellrise. So as you'd appreciate, the chassis is a very safety critical part of the vehicle. It really allows for the complete vehicle to remain more durable in the longer term. And we have really built our expertise over there. To answer your question, we work with almost all of the two-wheeler OEMs in the country. So all of the top 6 two-wheeler OEMs we work closely with. Now, some of the new age EV OEMs that are doing well in the market, we're also working closely with them. So in the two-wheeler space, we'll think about launching new products. So there's 3 new products that we're adding to our kitty in this fiscal year, which will lead to our content per vehicle going up by 45 to 50% in the two-wheeler segment. And secondly, we'll also look to increase our content per vehicle between OEMs. So the ideal content per vehicle that we have today is 12,500, but it's not 12,500 with all of our OEMs. So we'll look to reach that 12,500 content per vehicle range with all of our key OEMs going forward.
Sure. And, with the H1 acquisition that you just mentioned, you were looking to expand your four-wheeler contribution. So can you help us understand what your revenue mix will look like going forward between two-wheelers, CVs, four-wheelers? How would that shape up?
We're currently at about 12.5% with respect to passenger cars and commercial vehicles as a percentage of revenue. We expect that to grow significantly in the next 2.5 years at double-digit growth. And the idea is to focus on, while continue to focus on the two-wheeler industry, we believe there is a larger opportunity for us to grow in the four-wheeler industry where we have a lower base right now.
Sumedh, quick comment.
Yeah.
Pre-IPO, what was the debt level? We understand post-IPO, you paid close to 1,600 crore. So what has the debt now come down to? FY26, what will be the interest cost savings? And could you give us a guidance? You gave us a top-line growth guidance in the range of 15%. Could you also give us a guidance for margins as well as profitability?
Right, sure. So pre-IPO, our debt levels are approximately in the ballpark of 2,600 crores. Right. As you know, we raised 2,150 crores, out of which 75% was going towards debt repayment. So about approximately 1,600 crores of that was going towards debt repayment. That has already been been paid down after the IPO. So now 2,600 minus 1,600, about less than 1,000 crores of debt that's on the books. Going forward from a margin perspective, we expect margins to be stable.
Sure. And, I have to ask you this because, this has been widely talked about. There have been curbs on rare earth elements. While you may or may not use them directly, but I'm guessing there is some sort of second order impact on account of probably, some sort of delays in the production lines from customers. So could you help us, if there is any such impact on production for you?
So obviously no direct impact.
Sure, yeah.
In terms of utilizing magnets. We're unable to comment on our customers and how that impacts their schedules or productions. However, we're fully confident that the Indian government will be able to figure out a positive way going forward. Ultimately, the automotive industry makes up a significant portion of the economy, and we're sure there'll be a solution pretty soon.
But any second order impact for you? Not direct, but second order?
Second order, obviously, if there's a certain reduction in the number of in the volumes of OEMs as a result of the magnets, there would be an impact.
Understood that. Swastika, if I could get you into the conversation as well. give us a couple of trends that are panning out. Number one, how are raw material trends? Do you typically have longer term contracts with your suppliers? And how are trends coming in over there, especially post the imposition of the import duty of steel? And secondly, are you seeing a significant shift away to the EV space? Do you expect going forward there could be some volume dips that could happen?
So on the raw material side, I think raw materials today are not a major factor in our profitability. Most of our raw material prices are settled on a back-to-back basis, which means the OEM and the raw material producer will settle on a price, and irrespective of what happens in terms of volatility quarter by quarter or year by year, it's compensated to us on a quarterly basis. So we don't really get affected by this whole volatility in raw materials that's being seen in terms of the import prices, going up and down. In terms of what we are excited about, I think high tensile steel is something we're very excited about, because high tensile steel is something that we've acquired through the H1 acquisition.
Right.
So high tensile steel will really allow us to do lightweighting. So perhaps a steel sheet that was 2 mm, with high tensile steel, we'll be able to get that 2 mm down to maybe 1 mm or 0.8 mm. So it'll allow us to provide more lightweighted raw materials and components to our OEMs. At the same time, due to the malleable and ductile properties of high tensile steel, we'll also be able to increase the durability of our components. So it's a kind of double effect that we're having due to the inflow of high tensile steel, and that will kind of lead to us doing better in terms of lightweighting going forward.
Sure, and just a word on your margins, Sumedh. So you mentioned that you are expecting margins to be stable. So 12 to 13% range for FY26, that is the guidance that we should work with?
We're not giving guidance per se, but we're saying stable, so yeah.
All right, and are there any levers to sort of improve your margins, because your contribution to the four-wheeler segment will go up, so definitely that could be margin accretive as well, right?
Yeah. So the four-wheeler and commercial industry usually is a little margin accretive as compared to the two-wheeler industry. However, the main caveat over there is the volumes. There's been a lot of shifts in rankings between four-wheeler and commercial vehicle OEMs that we've seen in the past 24 months. So as long as the commitments given by the OEMs are honored within say plus minus 5% range, we expect margins to potentially go up by a little bit. That being said, it will depend a lot on the order that we're manufacturing. So the program for which we have won the order and how well that program does in the short term.
Thank you so much, Swastik, as well as Sumedh. There's an investor call later today, and all eyes will be number one on the export trajectory and also, growth, especially when it comes to going beyond the two-wheeler mark. So that'll be something that we'll wait and watch out for. But we'll now slip into a short break. We'll get you more on the markets and stock-specific action on the other side. Stay tuned. Welcome back to Mid-Cap Radar. Well, the market continues to build onto its gains, but one particular stock that is standing out is IGL. The stock is seeing a sharp surge today on hopes of healing as far as the Delhi EV policy is concerned. Sudarshan joins in with more details.
So over the last few months, there have been several reports related to Delhi EV policy. Now, our sister channel CNBC Awaz is reporting that Delhi government is considering making some changes to the EV policy that government is calling 2.0. And under 2.0 policy, it may give more time to all these all these companies for transition to electric vehicles. But beyond that, what is most important is government is also considering making some changes to aggregator policy, that is cab aggregator policy of the previous government of Aam Aadmi Party that was announced in November of 2023. And as per that policy, all the cab aggregators had to be transitioned to electric by 2030. Now, if Delhi government makes some changes to that policy, that can be taken positively for IGL because cab aggregator contributes in the range of 12 to 15% to IGL's volumes. Now, Citi also has written today a note on IGL. It has a buy call on the stock and target price is 250. It says AAP government's policy of 2023 had mandated all electric fleets by 2030, and this had dampened IGL's volume growth prospect. But if new government tries and does easing to this policy, this will help improve the volume of IGL. Like for cab aggregator, it contributes 12 to 15%. Another important part is CNG three-wheelers. Citi believes that replacement of CNG three-wheelers is also not being considered. If this is not considered, that can also be positive because CNG three-wheelers contribution to IGL's volumes is in the range of 3 to 4%. One last point is about Delhi DTC bus. It used to contribute 7 to 8% to IGL's volumes, but over the last few years, there has been a drop in that, and now the contribution is just 2 to 3%. And Citi believes that electrification is complete, so now it will not have major impact as far as IGL is concerned, and that's the reason today you are seeing a big up move in the stock price. It's up currently more than 5%.
Well, thank you so much for that, Sudarshan. So better volume growth prospects is what the street is penciling in for this particular counter for now. It's up almost 5%. Moving on then, Galaxy Surfactants is buzzing in trade as well. As per a Motilal Oswal report, the company on its Capital Market Day has outlined an ambitious but well-structured growth roadmap. What is that? We are now being joined by Upasana to take us through that.
Well, certainly, company held its Capital Markets Day and it has laid out a very ambitious growth roadmap for the next 5 years. Now, let's just look at the key highlights. Now, company says that over the next 5 years, it plans to double its volume and grow EBITDA by 2.5 times while sustaining ROCE greater than 22%. Its internal goal is to achieve EBITDA per kg at 25 rupees by FY30 is what they have said. And the contribution of this incremental EBITDA, 50% of this will come from organic growth via categories such as hair care, oral care and body wash. Mind you, company experiences a strong presence in these categories. Around 30% of these incremental EBITDA growth is projected to come from company's new product portfolio, and the remaining 20% will be driven by new avenues such as strategic partnerships, collaborations is what the company has indicated. On the back of this, Motilal Oswal believes that going forward, the volume growth will be driven by companies' focus on R&D, increased wallet share and even acquisition of new customers. On the back of this, it estimates volume CAGR over 6% from FY25 to FY27, driven by improving volumes in the specialty care segment. Company has, beg your pardon, the Motilal Oswal has reiterated a buy rating on the stock with a target price of 3,180 per share. And we can clearly see the stock surging in trade today.
Well, thank you so much for that, Upasana. Galaxy Surfactants up and away in trade today on the back of that note from Motilal Oswal. But that's all we have in this edition of Midcap Radar. It's a green-looking screen. Don't go anywhere. Your stocks when you return.
Hello, good afternoon. You've tuned into Your Stocks, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much for tuning in as always. And surely we've seen that pace of recovery coming in for the markets. From red, we moved to the green and managing to hold on to those levels. So no complaining in terms of the market today. We are holding on to 24,950, around that mark. Almost near the day's highest point is what we're seeing the Nifty is trading at right now. We also have the mid and small cap. So let's pull up the Nifty mid cap, because that was a bit of an underperformance that we saw at the during the first half of the trading session. But now that also picked up pace. That's also recovered. Day's highest point for the Nifty mid cap as well. Small cap too, trading with gains of almost 0.5%. Nifty Bank also managing to hold on to some bit of a green there as well. So yes, Nifty Bank is also among the gainers coming in terms of the move. IT among the top sectoral gainers at one point of time. So that's interesting to watch out for, whether it's Infosys, TCS, all these names also are buzzing away in trade. What's trading in the red today? All the sectors actually have now moved to the green. So nothing is in the red. We've seen that recovery. No complaining there. Nifty Pharma, 0.03% gain. So yes, let's watch out for there. Hoping for this to sustain in the last couple of hours of trading session as well. But yes, that's how the market setup is looking like. Not much of a Monday blue coming in here. Instead, we're seeing a good green coming in on the screen. But this is a show where we solve all your stock related queries. And to just solve that today, we have Ashish Gal of Wave Strategy Advisors joining in with us, as well as Parthiv Shah of Tracom Stock Brokers joining in with us to just do that. Ashish as well as Parthiv, thank you so much for joining in with us on the show. Ashish, a quick check on the markets. Today surely versus what we were expecting, given the global tensions, it's a better day than what one envisaged. What are we watching out for in terms of levels? Do you think this time, if we see the Nifty cross that 25,000, is it going to sustain? Because that's a mark I don't think we sustained, and we've sustained over a period of time right now.
Hi, Vinny. Afternoon to you and all the viewers. If you look at, like what we discussed last time, Nifty has a very important support around 24,490, 24,460 zone. It has tested that zone multiple times, including this time, and bounced back sharply on the upside from there. So despite of the event or the war, the levels are working very, very importantly. And on the upside, I think if it crosses 25,000 this time, it's going to sustain. It's going to head towards 25,300, 25,350 mark, because there has been multiple attempts. And despite of the crude oil price going up, despite of the volatility in the global markets, we are still sustaining about the mid Bollinger Bands on the daily time frame chart. So that's bullish for me. I think any dip from here around 24,850 will be an opportunity to buy again, keeping 24,700 as a stop loss for someone who wants to buy, aiming for 25,200, 25,300 levels on the upside.
Okay, keeping an eye out on those levels over there. Even the support, which has been very strong, is an important one to watch out for. But let's get started with the query segment now. And we have Jinsi. The first query is coming in from her, who's writing to us from New Delhi. This is an investment query. So she wants to know if it is good to invest in Cochin Shipyard as well as SBI for the next couple of years. 1 to 2 years is her time horizon. Parthiv, what's your view coming in? Cochin Shipyard, obviously we know the shipbuilders, defense side, they're doing well. But does it merit buying it at these valuations? What's your thought on that? As well as SBI.
Very good afternoon to you, Vinny, and our viewers. Firstly on Cochin Shipyard, no doubt I think the valuations are a little elevated, as you rightly pointed out, quoting at around 55 trail multiple, and on a forward basis, if you're to put a multiple, it's around at 40 times. But I think when I look at the capability of this company and the current order book, the company is sitting at an order book of around 21,500 crores. And more importantly, 78% of that order comes from the defense sector. And we are seeing a sense of urgency even from the government in terms of trying to develop the shipbuilding industry for the country, because India has one of the highest and the longest coastal lines. And a lot of the shipping industry is now dominated by China, which is always not a good sign. And I think we have wasted a lot of forex in terms of importing a lot of ships. So that is why I think it seems like in the upcoming policy action as well, government will take a lot of steps which will benefit key players like Cochin Shipyard, who have massive capacity. And also they are expanding their facilities big time. And the total capex is being talked of somewhere around almost 2,500 crores, which is a sizable increase in their gross block. So we believe that, the long-term future is intact and the investor has a 2 to 3 year horizon. Certainly, I think Cochin Shipyard looks very interesting. Talking about SBI, I think again, the valuation wise, I think it's not looking expensive. And our sense is that the bank has turned around well, all in terms of ROEs, ROAs, the net slippage ratio. I think looking at the current book and the way now the management has guided for even growing the advances to the tune of 12 to 13% on such a huge book, I think that is very consoling. And our sense is that going ahead, SBI will play catch up in terms of its valuations vis-a-vis that of the private sector larger players. So SBI also looks good at current levels.
Okay, SBI as well as Cochin Shipyard, good one coming in on the fundamental front. On the technicals, both these, how are the charts looking like, Ashish? And is it the right time to wait for this one or buy this one? Or do you wait and actually some bit of a correction is what they could buy it at?
See, if you look at Cochin Shipyard, I think the stock went towards 2,500, corrected towards 2,060, which is the 20 DMA, and showed a bounce back from there. So I think one can enter here from a short-term perspective, aiming for around 2,600 levels on the upside. And on the downside, maintain a stop loss of around 2,065, which is an important low it created yesterday. As far as SBI is concerned, I think the stock is outperforming. We can clearly see the financial sector has been outperformance, and Bank Nifty has touched lifetime highs. SBI should do that. It's the right time to buy SBI at the current levels also. And on the downside, the support for the SBI is going to be around 760 levels. And on the upside, we can expect it to touch the previous peak high, which is 870.
Okay, keeping an eye out on these levels over there. Next query also is an investment query for today. We have Alan who is writing to us from Goa. He wants to know, and he actually wants to invest rupees 50,000 in the market. How should he start with this? Parthiv, your view coming in right now. If they're looking at stocks, 50,000 is what he wants to allocate. What should he be doing?
Obviously, we don't know what is the exact risk appetite of the investor. But my humble suggestion would be that if Alan is a first-time investor in the equity markets, bringing a sum of around 50,000, I think mutual funds would be the route because one, he gets a diversified portfolio. Two, he gets very well-managed advice via the fund manager. And more importantly, I think there is a good chance of compounding his wealth to 12 to 15% over the next 10, 15 years. Anyways, if he's looking for direct stock exposure, though the amount is small, I would still recommend it to divide the amount into two parts. One, I would suggest, something like a TCS looks very good for a first-time investor because the valuations are looking more attractive. And we all know that the IT sector is going in a down cycle, but the total contract values are very strong and the execution capabilities will improve over time. And TCS has always proven its ability to re-rate once there has been a down cycle. So I think TCS one looks good. And two, I think in terms of the fertilizer industry, we're very upbeat. So we believe something like a Coromandel International is one company where over the longer horizon, the prospects look very, very good. It's a Murugappa Group company, very well managed group. The group total market cap is now almost 3 lakh crore. So such are the type of companies a first-time investor should have in their portfolio for very long horizon.
Okay, some good names coming in there for the long term is the view there. On the technicals, Ashish, what would you suggest him to look at?
There are three topics that I would recommend he can keep it in the portfolio. One is possibly Tech Mahindra. We can clearly see the stock has started outperforming after quite some time. And IT sector as a whole, I think, can start delivering now. It has been a lot of correction that we have already seen in terms of price, either or in terms of time. So Tech Mahindra is one of the picks. Bajaj Finance from the financial space, I think, can outperform from here on, so we can add on to the portfolio. And from the auto space, TVS Motors. Two-wheelers, I think TVS Motors is doing exceptionally well. So these are the top three picks which he can add in the portfolio.
Okay. There are a lot of names that have gotten on the technical as well as the fundamental front. The next query for today is coming from Gautam, who's writing to us from Mumbai. 5,000 shares of Coal India. The price is 382 rupees per share. Right now, also the stock is just trading around the buy price, just making some bit of a profit here. He wants to hold it for the next 12 to 18 months as well. Should he continue to hold the stock or maybe look at something else? Parthiv, what's your view coming in? Coal India, it's obviously one of those companies which also gives dividend. So sometimes, those cash cows which are there, which manage to give you dividends. So that's also a factor that you have to play into. But does it merit holding it, or should they just book out the little bit of a profit they're making and look at something else?
Surely worth holding it because I think besides a very good dividend paymaster, it is also a near monopoly. And if you read into the management commentary, they said that there is no shortage of demand. I think the demand is fantastic. It's just that in FY25 they were not able to ramp up their volumes because of a heavy monsoon. But if you look in terms of the outlook guidance that they've given for FY26 and 27, they're talking of touching almost 875 million tons of coal mining and selling in FY26 and increasing that to 900 million tons. And, over the next 5 years, it could also be upwards of 1 billion ton. That is a huge capacity in terms of, mining of coal. And Coal India has, very good quality mines. The cost of mining is really low. So it's a company which will continuously generate humongous cash flows and which will be paid out in the form of dividend because the biggest beneficiary is also the government of India. So we believe that valuations are not very expensive here, and for a 2-year horizon, Coal India looks interesting.
Okay, and Coal India on the technicals, what's the view?
The technicals, Coal India has been consolidating since March of this year. We can clearly see it has been moving in a very broad range, possibly forming a triangle pattern and then yet to give a breakout. So continue to hold on over here if you are invested. And on the downside, I would suggest that use 382 as a stop loss. And there is a possibility it can break out on the upside, followed by 407. So if 407 is taken out, we can expect 425 or higher levels. So risk reward looks good at the current levels.
Okay, let's move on to the next query for today. This is coming from Lakshmi, who's writing to us from Bangalore. She's holding 200 shares of Bandhan Bank. Price is 285 rupees per share. Wants to know the future prospects for Bandhan Bank. Bandhan Bank on the fundamentals. Is it a better play that one should watch out for, or are there other names, Parthiv?
Oh, very frankly, I believe there are other better names than Bandhan Bank. One, I think Bandhan Bank has a lot of sensitivity to the microfinance loans based on its book, and the guidelines from the regulators also change, of course, for the good of the health of the industry. Because I think last entire year we have seen how the microfinance loans have plagued a lot of these companies in terms of the stress on their book. As a result of which, I think names like Bandhan Bank also are not getting re-rated further. And I think the performance is quite okay. They've grown their names by around 11%, and the operational profit has also grown by around 11%. The stock is no doubt cheap, but we believe a name like Federal Bank looks more interesting, where I think after the change of management in terms of the top CEO, who comes from Kotak Group, I think it looks very, very interesting. They are making all the right calls to improve the retailization of this bank and also improving the balance sheet quality. We believe that Federal Bank at 1.1 times price to book multiple on an FY27 basis is very, very interesting.
Okay, and Bandhan Bank on the technicals, is it one of the good bets to hold or on the charts, or do they switch to some other bank?
See, Bandhan Bank has relatively underperformed if you look at the other banking names. But having said that, I think the stock has started showing some kind of positive price action. It has managed to bounce back from its previous pivot support of around 172. And there is a possibility we can reach towards the level of 200. So overall, over near term, Bandhan Bank looks to be okay. One can continue to hold with a stop loss of 172. And on the upside, 200 is the target.
Okay, keep an eye out on those levels over there for Bandhan Bank. On that note, actually, we're going to sip into a very short break. And as we sip into the break, unlock a new dimension of business intelligence with CNBC-TV18 Access. Our premium members only experience on CNBC-TV18.com, from market-moving insights and thought leadership to exclusive access to marquee events, journalist interactions, studio tours, and high-impact learning sessions. This is a truly elevated experience, with members also enjoying curated lifestyle privileges and perks. The power of insight, the privilege of access, exclusivity, experience, and influence. Yours to claim. Become a member. Log on to CNBC-TV18.com. Access plans. Welcome back to Your Stocks on CNBC TV18. We are talking about all the stock-related queries that you all have sent us, and we still have with us Ashish Gal as well as Parthiv Shah to solve just that. Next query for today, gentlemen, we actually have is coming in from the viewer who is Padma Kumari, who is writing to us from Andhra Pradesh. She's holding 50 shares of GMR GMR Power, I beg your pardon. This is at a price of 100 rupees per share. She wants to know if she should continue to hold this or sell at the current levels. Parthiv, your view?
We are not very upbeat on this particular company, GMR Power and Urban Infra, because I think if you look at their business mix, almost 61% of the business segment comes from the energy part. And they have two coal-based plants. One is 1650 megawatt and the other is 350 megawatt, which brings in the majority value of this particular company, which is currently quoted at a market cap of around 7,800 crore. If you look into road and transportation, around 18% comes from there, and EPC is remaining 10%. I think it will require a lot of working capital for this company to ramp up its infra business, and the past track record hasn't been that great. And in the current valuation, I believe a lot of positivity is seen to be captured in. So I would avoid this counter and suggest the investor for long-term investment, you should look at players like L&T, which are sitting at a very huge order book of 5.8 lakh crores, and that is continuously going up. The guidance has been pretty good for next year, and over the next 5 years as well, we believe the type of capacities that they are building in, they'll play a major role in India's infrastructure.
Absolutely. So switch to an L&T. So get out of the stock, you're making some bit of a profit, is the view coming in on the fundamentals. On the technicals, Ashish, do you also have a similar view, or are the technical charts indicating something else?
No, I think the stock has not performed at all. Since it has been September last year, it has still dragging and not able to give any kind of a movement. And even if it goes up, it comes down very fast. So my recommendation is better to be out from here on the stock. And something like a KEC International looks much better choice than GMR Power.
Okay. So let's so better choices coming in than GMR Power. That's the word there. Let's move on to the next query for today. This is coming in from Joseph Kurian, who's writing to us from Mumbai, holding 3,500 shares of South Indian Bank. Price is 28.3 rupees per share. Wants to know whether it makes sense holding this one or getting out of the stock. A lot of banking names have come in today. Parthiv, what's your view on South Indian Bank now?
I think it's an interesting pick because one, the valuations are extremely cheap at around 1.6 times price to book multiple. And again, here also we had seen the change of top level management, after which I think a lot of positive steps have been taken. And in the last couple of quarters, the net slippage ratio has started to come down. And I think the bank is now focusing more on the secured side of the asset on the balance sheet. And we believe that results of which will be witnessed over the next few quarters. But I think valuation wise, it's very cheap and no harm holding this bank at this juncture.
Okay. That is the view coming in there for South Indian Bank on the fundamentals. On the technicals, what's your view, Ashish?
See, on the technicals, we can clearly see the stock has shown some kind of an outperformance. It was around 23 in April and now quoting around 29 odd levels, 29.30. So the overall undertone looks to be bullish over short term, and one can continue to hold here, maintain a stop loss on the downside at 28.50, and on the upside we can expect a target of around 33 levels.
Okay. Keep an eye out over there on the levels over there for South Indian Bank. Next query for today, Alan Matthews writing to us from Kerala. 65 shares of Asian Paints, 2,900 rupees is the buy price. Long-term outlook for the stock is what he wants to know. Parthiv, obviously so much is happening around the paint space, the competition coming in as well. Your view for Asian Paints, does it merit holding it now for a long term?
I think the biggest concern here is massive competition by Grasim, by the Birla Opus brand that they've launched. And I think some channel checks also suggest that, people are experiencing that, Birla Opus is picking up in terms of the dealer distribution fraternity. And I think Asian Paints, if you see, since the last 3 years, the stock has massively derated in terms of valuation. It used to quote at around 65 trade multiple. Currently, after the devaluation, both in terms of the price correction and time correction, it is still at around 54 trade multiple. And last 3 quarters, we have been witnessing very, very tepid volume growth, because in decorative paints, I think hardly you've seen Asian Paints underperform, go below 5% in terms of volume growth. and last 3 quarters were really bad. So I think looking at that, one does fear that the competition is reaping in. We saw JSW Group also eyeing ExxonMobil assets, and this particular sector is getting very in competitive wise very intensive. So that is why we believe that one should avoid a counter like Asian Paints right now, allow a few quarters to go, and then we can take a call.
Okay, avoid right now. Maybe after a few quarters, one could take some of the call coming in on the fundamental front. Technicals, Ashish, what's your view? Because Asian Paints is not one of those performers, right? But they look at in the last 1 year, nothing exciting that's happened from there for them in terms of a stock move. So what are we watching out for on the technicals?
I agree that it has been an underperformer, but if you look at the price action, I think there is a very important support for the stock, which is around the zone of 2,150 to 2,170. It has found multiple times support over the since past 6 months in this zone and is trying to bounce back. So there is a possibility we might again reverse back from here on. And on the upside, 2,500 level is what we can aim for over near term. And on the downside, one can maintain a stop loss of around 2160 levels.
Keep an eye out on those levels over there for Asian Paints. But with that, we are absolutely out of time on this edition. So thank you so much, Parthiv, as well as Ashish, for joining in with us on the show and, as always, helping our viewers solve their stock-related queries. And viewers, thank you so much for tuning in to CNBC. But you have the last hour of trading, which is still left. And to take you through just that, we have closing bell up next, so don't go anywhere.
to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Muted start for Shanghai. Taiwan index is down. Hang Seng is down.
I think there's a good chance there'll be a deal.
24,936, which is the 61.8% retracement of the recent move. So 24,700 on the Nifty, and the Nifty Bank at about 55,570.
I don't think that Iran can sustain a prolonged conflict.
Started off a little slow, but now we are picking up pace, and the bulls would hope that this pace sustains.
Important part is that almost every vertical of inflation has shown a month-on-month fall.
Decision that is replacing the current compensation cess which is levied on sin goods such as aerated drinks, cars and tobacco products.
The day of recovery, we've seen good momentum build up right from the get-go.
Okay, well, early jitters or whatever you want to call it, but no jitters afterwards. The markets rocketed higher, and we are up 200 plus points on the Nifty. So good going. Broader markets, though, are still a little sluggish. There are more stocks down than up, but large caps are doing just fine, as you can see on the Nifty and the Sensex. So lots to talk about. This is Closing Bell. We're coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant Surabhi and Nigel with me. Guys, afternoon.
Hi, good afternoon. Folks, so even as those missiles keep falling on both sides, in Iran and in Tel Aviv and in Israel, markets have simply marched on because it's not just an India-specific rally. You look at what happened in Asia.
Yeah.
Even the Hong Kong market, which was a little sluggish in the morning, finally ending with a flourish. Europe is up. US futures are up more than 0.5% right now.
Well, that's right. And in fact, the important part today is that 20 DMA in both the Nifty as well as the Nifty Bank, that's got defended. And as we speak, on both those two levels, we're trading above that. So that's encouraging. And as Prashant said, for majority of the trading session, the number of stocks declining have been more than the number of stocks advancing. But I think they were waiting for our cue because in the last 2 minutes, the number of stocks advancing has just moved beyond the number of stocks, declining. So pretty good times there. That's one chart. That's the next chart. And the third one comes up for you, which is telling you why your portfolio actually will be feeling quite good in comparison to the morning. They have kissed each other. And now it seems, one is, the advancing ones are higher.
Describe.
Okay, that's a very colorful description for sure. But guys, I was just thinking, in any other world, it would be surreal, right? When you know that rockets are being fired by Iran and Israel.
And the advanced decline ratio is kissing each other.
The high point of the analysis so far. But even otherwise, like I said, it's not just India, it's all over the world.
Yeah.
I mean, what war, what geopolitics? Doesn't look like it.
No, absolutely. It's absolutely the case. And it's tragic what's happening at a human level and all of that. It's tragic, actually. And one just hopes it doesn't, become one big another sort of disaster in terms of loss of lives and displacement, etc., etc. We've seen in so many countries over the last couple of years now. One doesn't hope, but markets, of course, are a different animal in that sense. I just want to make one point. We are at this point, as we begin this edition of Closing Bell, we are exactly at the 61.8% retracement of the decline that we've seen from the high to the low that we saw on Friday. So this is it. I mean, so this is a very short-term way of looking at if there's more momentum. And this is the level we put out, 24,936. We put out two levels, 24,848, 50% retracement, 24,936, 61.8% retracement. This very short move that we had. So beyond that, I think, maybe we look at, higher levels once again. Immediately 25,100, 25,200, those levels which the market took out for a brief period before selling off, I think come into sharp focus again. So that's essentially where we are at. Let's just quickly run you through, how to position yourself in the last hour. Mitesh is back with us. Mitesh was telling us, that maybe we're in a bit of a range, 300, 350 point range in the morning. If that range is to be, if we go back to that range that you were talking about, Mitesh, we're at the upper bound of that range. What does one do from here?
So, Prashant, actually, we have crossed that first level, which was 24,850.
But again, I think, the chart hasn't improved drastically. So we'll assume that this range has just, seen an extension on the upside, which is back to the 25,050 level, to about 24,550, 500 on the downside. So I think the index is not giving clear signals, so you must wait it out. There will be phases when the market is, indecisive in the sense that it itself is trying to build a base for the next move. And in that process, I think, you might be trapped into taking a trade. So I would, just hold my horses. I think the market, the good thing is that the breadth is good, as Nigel was pointing out, it's improved on the positive side, and some of the stocks are positive. So we're trading with a positive bias on stocks. But on the index, I'm avoiding it because I'm not very clear as to what the short-term movement could be.
And the stocks, Mitesh, what to do last hour?
So the PI Industries is one of them. I think that's opened with a gap up today and then has sustained. It's a buy with a stop at 40.80 for targets of 4,300 or thereabouts. And the other one which I like is Policy Bazaar. I think that's a stock which did very well, rallied, and then kind of came to some kind of a consolidation, but now it's again picking up. So we'll take a tight stop at about 1887 here and look for a target around 1965.
Okay, got it. So those are some individual stock level trades as well. Mitesh, thanks very much for that. By the way, it's not just maybe fintech. Some of the insurers themselves, those stocks are doing quite well. On the Nifty, if you see SBI Life, HDFC Life, these are among the top 5 gainers on the Nifty this afternoon. The broader point is that the move that we're seeing today, it's important to note that it's not a narrow move, definitely not in terms of market cap. It's not even narrow in terms of sectors. It's not like 4 IT stocks and 2 banks are taking the Nifty higher. It's very, very diverse. UltraTech Cement in top leadership position. The life insurers, like I mentioned, there are a lot of global-facing commodity players that are doing well today. JSW Steel would be an example. There's Trent, there's Infosys. I could go on. Long list of winners today. It'll be best perhaps represented in the sectoral heat map. Let's see if we can put that up on the screen, because a whole range of sectors are rising higher today, from real estate to financials to IT. Let's see if we can get the heat map up in a bit. So the short point is that this is a big, very, very comprehensive move that's coming in. That's obviously the composition chart. And overall, there, look at that. That's what I was talking about. It's all green. It's a wide, market-wide move today. So definitely sort of can't take your eye off it. Well, now that we've shown you all the green, let's talk about the one red that deserves mention, and that's Tata Motors. On such a good day of trade, Tata Motors is languishing. It's down 3.5%. In the morning, it was down almost 5%. And that's because the company has sounded fairly cautious in the investor call that it held. Let's go across to Sudarshan and figure out what the highlights were, because investors definitely are a little worried, Sud, on the Tata Motors commentary.
That's correct. So in a day when market is seeing an all-round gain, one stock that is not participating in the rally is Tata Motors. It's top Nifty loser. It has recovered from lows, but still down more than 3%. And the reason is JLR's muted outlook for FY26. Remember, JLR is holding Investor Day meet today, and ahead of Investor Meet started today, early in the morning, JLR released investor presentation mentioning FY26 outlook. So first on EBIT margin, it's saying that it's looking in the range of 5 to 7% versus 8.5% that company reported in FY25. So almost 200 basis points lower margin that company is looking at in FY26. Second, free cash flow. It's saying that in FY26, free cash flow is likely to be close to zero against 1.5 billion pounds reported in FY25. Now, beyond FY26, in FY27 and FY28, company is saying that there might be an improvement on both fronts, margin as well as free cash flow, and medium-term target is to get back to 10% EBIT margin level. Now coming to US tariff issue. Company is saying that regarding the UK exports to US, tariff rate is going to come down to 10% from 27.5%, and company is in engagement with both the governments, UK and the US. But one major export market for JLR is Slovakia, where tariff rate is going to remain at 27.5%. Now coming to another major market is China, where companies say in FY25, while premium market was very challenging, JLR has outperformed the peers, and going forward, to unlock the growth potential, company is saying that it would be via its JV, that is the JLR JV in China, and the first Freelander that company is looking to launch, that is in H2 of FY26. Now regarding the investment till FY28, from basically over FY24 to 28, company is looking to make total investment of $15 billion. But the main reason stock is under pressure today is because of JLR's muted outlook.
Okay, all right. Thanks a lot for that, Sud. So that's the lone stock actually that's not been able to recover too much of lost ground from the morning trade. Devin Chokshi, the MD at DR Chokshi Investment, who joins us on the show. Hi, Devin. Good afternoon. Well, JLR has its own issues, and that's why Tata Motors is under some pressure. Though from the recent low, it did have a good pullback. What's your view on the stock?
Hi, Nigel. Good afternoon. I think whatever the negatives are seen, they are all in price as I see it. I think the valuation-wise, the company is comfortably placed. Slightly cautious and muted outlook, agreed. But at the same time, I think few events are going forward important. They are launching newer models in the JLR portfolio. They are likely to, I think, gain significantly large amount of traction, market share in the portfolio. The demerger of the passenger vehicle, commercial vehicle business portfolios could possibly unlock the valuation potential, I think, which possibly I think is not fully getting reflected into the stock price. That's my second point. Third point, I think more or less the company has completed the program for cost reduction, and that is basically helping them in maintaining the margin, improving margin by some percentage points. So that is again, I think, becoming positive. So as I see it, I think, yes, the company has gone ahead with little muted guidance on JLR, but at the same time, I think most of the negatives, as we see, I think, are in price today. So maybe I think the market could experience the contra buy in this particular account.
Okay, that's a word on Tata Motors. Got that, Devin. Thanks for that call. Let's also focus on one more stock. We've discussed Tata Motors, which has been falling quite a bit today. The other is PI Industries, and PI has been gaining on the back of a positive note that Morgan Stanley put out, saying that perhaps, the worst of the whole chemical cycle is behind us. Maybe things are turning, and at least they seem to be quite optimistic. In fact, they are overweight on PI Industries. Ria has more. Ria, what's the Morgan Stanley thesis?
Well, yes, PI Industries has been in focus today. Morgan Stanley has upgraded the stock to an overweight rating with a target price of ₹5,000. They've also raised their multiple on PI's agrochem segment to 23 times, and they've raised the segment earnings by 7%, which is offset by the drag in the company's pharma segment. Now, what Morgan Stanley has said is that PI has the highest exposure to agrochemicals in their coverage, and they believe that the company should see a three-pronged volume increase across the domestic exports and the new molecules businesses as well. In fact, they've gone on to say that they estimate that the new molecules and biologicals segment will each comprise a third of the custom synthesis exports and domestic portfolios by FY28. And they think that multiples can re-rate by 20% higher to levels that were seen between 2022 to the first half of FY24, which was a period of robust exports momentum for the company. So overall, for the industry, they're expecting a more constructive volume-led agrichem cycle in 2026, which is also going to support stronger asset runs and operating leverage-led margin tailwinds.
Okay, all right, got it, Ria. Thanks very much for that. Devin, back to you on PI Industries. I mean, a lot of these chemical stocks have fallen off the radar for so long that you wonder if, if indeed the cycle is turning. What do you think of PI, or is there anything else in the chemical space that you like?
No, certainly, Sylvie, good afternoon. I think the company is definitely showing good signs of growth from current levels. On one side, the input costs have remained subdued, 7x of the situation which currently we are experiencing of sudden shoot up in the price of crude oil, and I think the following impact on the derivatives of crude oil that could possibly derail to a certain extent this kind of a outlook. But otherwise, if you minus that part, which is immediate, I would think that their input cost probably remains under control in the current financial year, which was not the case in last 2-3 years. Second most important point, I think, is in the area of the custom synthesis in the pharma space, where probably I think we are likely to see an additional turnover contributed into the books by the company in FY26, and that should have the positive impact onto the margins as well as on the top line and the bottom line performance. So reasonably confident about the prospects going forward. However, I think if you look at the trailing valuation, then probably I think the stock appears a little bit expensive. In my viewpoint, I think we'll have to allow a couple of quarters to pass by to make a view on the current financial and the next financials, outlook, and to justify the little expensive valuation at which the stock is trading. But nonetheless, I think one would like to buy this particular philosophy that good companies are never cheap. Maybe probably you're buying this company from the point of view of 2 years since, and that's slightly expensive, but yes, justified for investment.
Look at something like a Camlin Fine. I don't know if there is any news flow or what has changed, but basically it was till about 2 months back, was really a laggard, right? But from 150 kind of levels where it was 2 months ago, and that was a level it was back in 2018 as well. It's basically doubled in the last 2 months. So that is an incredible move that we're seeing here on a Camlin Fine. So, big one and big re-rating is what we've seen. Look at something like Newgen. Newgen is coming up, some 8% right now. These are smaller names, but doing very well. Sterlite Tech, of course, I think we've highlighted is a very small name, but big volumes. I think volumes today on Sterlite Tech is the highest, I think they're highest ever volumes on Sterlite Tech today. If I've got this right, going back to 2007, 2008. I don't think we've had volumes this large ever on Sterlite Technologies. So 47 million shares, 48 million shares on that coming through. Maybe we could put out an alert as well. Teamlease is up 5%. Nelco is up sharply, some 5.5% and so on and so forth. So, big list of volume-led gainers, but not the traditional sector. It's very, very stock specific, something from here, something from there. So it's not a bigger, broader move. Anything on Camlin Fine, Devin, or the sector per se, if you track it?
No, Prashant, I think I haven't seen this company of late, so may not be completely updated with the information, I suppose.
Right. Another thematic idea is, I've heard this from many investors, office. That is AWFIS, and we've had the management with us lately after numbers. Up 6% today, 682. They basically rent your office model. Sounds like a great idea. But again, have you looked at this one, Devin? It's not that old in terms of listing.
Yeah, but the last one which I saw was the valuation. And I think, frankly speaking, the valuations are not fully justified in the current price, in my viewpoint. They are sounding to me, I think, fully priced a little expensive at this level. Though the potential and the prospects remains brighter based on the commentary that we have read in this company, I would think that not fully comfortable with the valuation at which I think the stock is quoting today. Maybe today too much of momentum is basically fueling the upside in the stock. But one will have to really see how much this momentum would get converted into the actual profit performance for the company. So we'll wait for a while before making any view on the stock.
All right, Devin, metal stocks have bounced actually quite well today. What do you like from here? Even NMDC, earlier this morning, we were highlighting that there were two notes that came out. One was from Citi, the other one was from Kotak. Both of them were saying that they have a sell call on the stock. They're expecting pricing to come down. They're saying the captive mining, the merchant mines, they're going to be producing more. Case in point being a Lloyd Metal, who's going to produce from 10 million tons. Now they're going to produce 26 million tons, 25 million tons plus. Any view on NMDC or any other stock that you like?
We have been liking the copper commodity in particular, and we also feel that I think even the steel as a commodity probably I think is fetching relatively better price in the global market today. And given the kind of situation in which they are, the cost of energy is remaining low. So input, I think the margins are being protected now with the lower cost of energy. As they see, I think the mix of the renewable energy into the portfolio, the profit margin is showing the uptake in every subsequent numbers I think that we have been receiving. So we remain relatively more confident about, I think, the commodities, the steel as well as the copper, both of them. Of course, zinc and silver has already been talked about. They are actually in a good uptrend, but at the same time, I think I would bet on copper as well as the steel as commodity from investment point of view.
Okay, all right. Got that, Devin. Thank you very much for joining in today and sharing your perspective on the way the market's been moving. And it's been moving higher, really. I have to say, by the way, a lot of stocks. I mean, look at Sterlite Technologies. Remember, Sterlite had a very good run last week as well because there was this BharatNet order, which obviously they're part of the chain at different points. So 15% up on it once again today. IGL is up 6% because it seems that Delhi will not be very aggressive with its conversion to EV targets. So it's benefiting IGL. and a whole host of other names, including Galaxy Surfactants, Sheela Foam, Subros, 17% up on Subros. So the broader market truly thriving this afternoon. Okay, well, on that note, let's take a very quick break. We'll come back on the other side. Atul Mehra, fund manager at Motilal Oswal Asset Management, will join in with some perspective.
You have stood up and stood by many of India's dreamers.
I became a magnet for entrepreneurs. So there's one man who will hold our hand and take us all the way.
So what is the art of deal making?
So whenever the deal maker wants to become too big, well, I'm God, okay, you say this and you say that, kind of attitude, not literally, but I've seen that. What percentage of people you think die, Shireen, with regrets in their hearts?
A very large percentage.
So this risk of failure, fear of failure, is the one that makes people die with regrets.
What is holding us back?
Promote and protect the good. Prevent and punish the bad. We prefer to be slow rather than fast. That's how we are a chalta hai country and not a daudta hai country.
The lack of speed would be, if you were to IPO India today, that would be on the risk factor side in the DRHP,
I
right?
wouldn't IPO.
You wouldn't IPO?
But to IPO, I must have a new story.
You have a special place in your heart for Charlie Munger and Warren Buffett. What have you taken from them that continues to guide and shape how you think today?
Understanding of balance sheet, because balance sheet is accumulation of good and bad.
How do you find India positioned in this mix today?
We have a resilience, we have a stability, we have a wisdom of our own. But वो हम एक scene दिखाते हैं, फिर we have a long break. Stop that.
Interval थोड़ा लंबा हो गया.
बहुत लंबा हो जाता है.
Welcome back. We have the market, which is doing just fine, 200 plus points in the Nifty, 24,931. Market breadth is also flipped, some 100 points in favor, 100 stocks now. Advantage of 100 stocks, basically. It's that crisscross happened as we were starting the 2:30 the closing show. Atul Mehra is with us, fund manager, Motilal Oswal Asset Management Company. Atul, good to have you with us here. Good afternoon. It's just a power of inflows and more inflows. Very shallow dips, and those dips are bought. This morning when we started, I was wondering that if a potential war in the Middle East cannot lead to some gain in the dollar or a demand for US bonds, I mean, what will? Very little else will. But maybe, as someone, a guest in the morning pointed out, they've not reacted because maybe it's a localized kind of event and it's not going to spread out. At least that's the view the market are taking. If it spreads, then maybe we will see the dollar spike. Otherwise, I mean, all these macro indicators are very well behaved. The dollar to begin with, which are crucial for EM flows.
Yeah, hi Prashant. Good afternoon. Yes, I think there are two factors at play. First is, I think there is this local inflow and strong local sentiment by the dip kind of attitude that we've had from investors across the board. And that's why we're seeing fairly steady inflows continue. So even on the ground, I think sentiment, if we meet investors, if we meet a lot of IFAs, etc., the sentiment on the ground is extremely strong. So I think that is one key factor which is quite supportive of Indian markets. And second is, I think after what we've seen in the last few months, like US was a no-brainer 10-year long only, which is now starting to incrementally get questioned in some shape and form, where people are now looking to, at the margin, diversify away from US into other assets. Now, US being such a large part of global equity markets today, even a small incremental shift away from US will have very large inflows in other parts of the world. So these two in combination is, in my opinion, what is leading to fairly resilient Indian markets. And what we've seen also lately is, if you look at so many liquidity events like block deals, etc., going through, and that is perhaps keeping a little bit of lid on the market because of some amount of liquidity getting absorbed by these blocks. In the absence of these, you would have seen the markets being perhaps much higher than where we are today.
Absolutely. And those blocks and all that paper supply is definitely mopping up the flows coming through. By the way, on the screen, we have important flashes coming in from the Commerce Minister. This is, I think, and he's speaking on a whole range of issues, including the all-important bilateral trade agreement with the US, saying that it should definitely happen by the fall, and they're trying to do a smaller first tranche of sorts, perhaps within the July 9 deadline itself, and also saying that they're, of course, engaging with China on the rare earth matter and looking to call a meeting of all the shipping lines and the shipping ministry itself to understand what the West Asia conflict could mean for us in terms of just freight rates. Anyway, that commentary is on your screen. But to go back to what you were saying, Atul, and I know that no one's really saying it out loud in the mutual fund fraternity as well, but the fact is that, like you said, there's all this paper supply coming in, and the inflows on the equity side are no longer as strong. I mean, sure, SIPs are, but there have been redemption in other sort of funds, and the net inflow number is half of what it used to be at the peak.
Yeah.
Is that a risk?
So, Subhi, what is typically observed amongst investors, like if you look at any kind of history of flows, what tends to happen is whenever you have like a correction from a peak and prices come back to the previous high, there is a natural in terms of redemption cycle that picks up because people want to get off from the bus at the price they came in at originally. So if you look at even this month's equity inflows, while the gross inflows are flat on a month-on-month basis, redemptions have gone up by about 5,000 crores on a monthly basis. So that's why if you look at the net inflow number, it's down by about close to 5,000 crores from 24,000 crores to about 19,000 odd crores. So I think that is something that is really playing out. So the gross inflow remains fairly strong. And what you will perhaps see is after a point in time, after markets like consolidate at the current levels and some of the redemptions are through, the gross to net conversion that we've seen in the past, that start to accelerate again. So the point is that if you look at, I think like I was mentioning earlier, the sentiment remains very strong. You have a little bit of, I would say, in terms of decline in flows. But even now, like most people that we talk to on the ground, the outlook remains very strong on flows as well. So maybe it could consolidate at these levels for a few months' time and start to pick up again.
All right. Hi, Atul. Good afternoon. Good to see you. When the last time we met, we were in the same room where there was so much of buoyancy and so much of interest. What do you think is going to break the back of the market? Because you keep throwing bad news, the dip keeps getting bought into. One would have imagined that maybe going by the cues we have had in 2025 so far, we should have been closer to around 22,000 odd on the Nifty. But actually, we're still holding at 25,000. So what do you think can break the back of the market, one? And two is you all had raised some cash, right? What are your current cash levels?
So I think firstly, when it comes to just answering your second question first, so our funds are in cash depending on fund to fund and depending on fund manager to fund manager. So as such, the fund that I run is less than 1% cash, but we have differing levels of cash at the AMC level across funds. So that's to with the second question. I think first, when it comes to what could lead to a decline, so the key underlying theme has been on the inflow side, which has been quite supportive on the markets. So I think if you have like 1 or 2 months time where your net inflows get towards net outflows, that is when I think there will be some level of panic that could set in, especially in mid and small caps. Because you haven't seen a time, I think, at least in the last 5 years now, where you had a net outflow on the mutual fund side. Because the key narrative on the markets has been around flows. And if you get like 2-3 months of negative net inflows, then that could really question the near-term buoyancy in the markets. Other than that, I think some of these geopolitical events, if they escalate further, like we have obviously no clue about which way some of these things are headed. But if some of these things escalate and you have a global risk of coming about, that could be another risk factor. Other than that, I think local, if you look at it, the business sentiment amongst corporates is very buoyant, and there is a lot of activity in the capital markets generally in terms of IPOs, in terms of QIPs, and so on and so forth. So that is where I think we are in terms of the questions you asked.
I know you can't be stock specific, but can you give us some way to think about what is looking interesting, what is still looking, what themes, micro themes, etc.?
So financials, I think, continues to be the top of the pack in terms of preferred sectors. And what we saw in the last month in terms of the RBI action also was quite robust, quite beneficial for the financials pack. So I think that is one pocket which continues to remain very attractive in terms of valuations as well as business outlook. The second thing I want to highlight is when it comes to, say, some of the more premium-oriented plays like real estate. So what we have seen is lately the sales numbers for some of the premium developers are extremely strong, and what we've seen is within a few days of launch, you had the project sellout really happening. So the premium end of consumption again remains very, very robust. So these two pockets specifically. Additionally, I think telecom also as a sector, there is an expectation in the next 6 to 12 months of an IPO by Jio, for example, and you would also look towards some level of tariff increase happening. And that again remains a fairly robust sector. You have more like a very consolidated kind of market and very high visibility on growth, cash flows, margin improvement from here on. So I think these three remain the top of the line. Incrementally, IT also looks good because you've had a fair bit of correction lately, and stocks are now starting to outperform again. So we should obviously look to in terms of commentary in the Q1 results. But that is again a sector which at the margin is looking good.
Okay, all right. So chasing lots of ideas there. Looking to build on to the portfolios. Just to complete the point that Nigel was discussing earlier on cash levels, for the funds that you manage specifically, what are average cash levels for you?
It's less than 1%. So
Less than 1%.
Less than
Got it, got it. And that explains, you've got so many ideas up your sleeve, so I'm sure that that money is getting deployed. Good conversation. Thank you so much for joining in, and we look forward to another one soon enough. Well, that's the view coming in from Motilal Oswal AMC. We have to take a break, come back on the other side, and of course a check on dealing rooms, all the buzz and the chatter with Nimesh, and then some final trading ideas for the day coming up with Mitesh as well.
Welcome back. You're tuned in to Closing Bell. We are coming to you live from the CNBC-TV18 Motilal Oswal newsroom. Well, good time to get you Nimesh, who joins us on the show to tell us what is he picking up in terms of D-Street chatter. Nimesh, negative news, the dip gets bought into yet again.
Absolutely.
Tell us, what are you picking up?
Absolutely, Nigel. A decent pullback and largely led by IT and bank stocks today. And that's helping the Nifty to gain nearly 1%. I guess today's rally is also backed by some institutional buying. So the flows are positive is what I understand. And there is going to be a small MOC buy as well at LD FID. So last 30 minutes, you might see further reaction in some Nifty names on the back of that MOC. The sector which stands out today is insurance. Big move on those individual insurance stocks today. And those are well bid as well is what I understand from large institutions. So it looks like this is backed by FI buying or institutional buying into insurance names. Technically, 24,800 is the first level to watch on the downside, and then the 24,450 level. So clearly, looks like some bit of momentum seems to be backed by FI buying, and maybe this will get extended to the mid and small cap as well. We're seeing first signs of a bit of outperformance in the broader markets as well today.
Nimesh, in terms of individual stocks, what's on your list today?
Well, the first stock on my list is KPIT Tech. The entire IT has done well, but KPIT Technology stands out. Big gainer today and large volumes as well. The city is anticipating a corporate development very soon. A potential large order win is the buzz as far as KPIT Tech is concerned. So that's something to track there. The second stock is PSP Projects. Again, some bit of infra seems to be back in focus, and PSP Project stands out largely on back of HNI buying. So some bit of larger HNI interest seems to be back in PSP Projects at current levels. The third stock is GAIL. We saw Morgan Stanley tactical buy in the morning, but there is buying interest as well is what I understand. And that explains a recovery from the intraday lows in GAIL. For GAIL, the near-term trigger would be the tariff hike, which is well anticipated in the market. So maybe in the next 1 month, the Morgan Stanley report suggests that maybe in a month's time, you'll hear the tariff hike, and that will be positive for GAIL. So that's the trigger there. And last, the two stocks where I'm expecting large block deals very soon. Indian Hotels as well as Vishal Megawatt. Both stocks are up in trade today, but I understand there will be large block deals very soon in both those names.
Wars or oil shocks or anything, the blocks don't stop, right? So we'll track these two names as well on the blocks calendar. Nimesh, thanks very much for that. Well, with that, let's go across to Mitesh and get some final trading calls in for the day. Mitesh, so what would you work with?
Looking at the way the index is closing in positive, that we are not, coming off to highs, I think it might be wise to take some VTST calls. So I have a VTST Supreme Industries with a stop below 45 or 4 and target of 45, 50, 45, 60 can break that. A couple of IT names are also doing well. So HCL Tech is a VTST with a stop at 1713 for targets of 1715.
All right, thanks a lot for that, Mitesh. Let's talk about a couple of big buzzing stocks. IGL, that's seeing a sharp surge in trade today on hopes of easing in Delhi's EV policy. Sudarshan joins us to fill us in with a quick analysis on that front. Sud?
So over the last few months, there have been several reports related to Delhi EV policy, and now we understand from CNBC Awaz has reported that Delhi government is likely to ease the EV transition policy and may extend the timeline for that transition. But more than that, what is the most important is Delhi government is also looking to ease the cab aggregator policy announced by the previous government of Aam Aadmi Party in November of 2023. And that policy had aimed at regulating not only cab aggregators but also e-commerce players having more than 25 fleet. Now, Citi also has a note on IGL having buy call and target is 250 per share. It's saying that previous government's policy of transition to entire all electric fleet by 2030 had dampened EGL's volume growth prospect. But now this new government looking to ease that policy may help volume increase because cab aggregator forms 12 to 15% to IGL's total volumes. Another positive part is the CNG three-wheelers. As per the details that we have, CNG three-wheeler transition is unlikely, and that will be positive because CNG three-wheelers contribute 3 to 5% to IGL's volume. And last part is Delhi DTC bus, for which electrification is almost complete, and that is no more a concern because its contribution to IGL's volumes has already fallen to 2% from the level of 7 to 8% that it used to contribute till few years ago. So overall, it's looking positive for IGL, and that's the reason you are seeing a big up move. It's up currently more than 6%.
Okay, that's IGL explains the big move on the stock. So thanks very much for that. Let's stick with some of the other stocks that are buzzing around today on the back of news flow as well. And the next one is Galaxy Surfactants. There is a Motilal Oswal report, and I think Motilal has taken quite a favorable view on the stock, and the street is taking note of that. We have Upasana joining in with the details. So what exactly is this note saying?
Well, Surabhi, company has held its capital market day in which the company has outlined an ambitious structural growth roadmap for the next 5 years. So now let us look at the key highlights of this. Over the next 5 years, company plans to double its volume and grow EBITDA by nearly 2.5 times while sustaining the ROC more than 22% is what they have highlighted. It also has an internal goal to achieve EBITDA per kg of nearly about 25 by FY30 is what they have said. Now, company expects this incremental EBITDA, mainly 50% of it, to come from organic growth from categories such as hair care, oral care and body wash. Mind you, company enjoys a strong presence in these categories. Around 30% of these EBITDA growth is projected to come from the company's new product portfolio, and the remaining 20% will be driven by the new avenues such as strategic partnerships, collaborations, and various other solutions. Now, Motilal Oswal believes that going forward on the back of this, volume growth will be driven by company's strong focus on R&D, increased wallet share, and even new customer acquisition. It estimates a volume CAGR of nearly about 6% from FY25 to FY27, driven by improving volumes in company's specialty care segment. On the back of this, the brokerage has reiterated a buy rating on the stock with a target price of 3,180 per share. So we can clearly see the stock surging in trade today on the back of this.
Okay, all right. Thanks a lot for that, Upasana. Well, let's hop across to Ekta. She's here to tell us about the pharma export data. Ekta, take it away.
Well, yes, Goldman Sachs has come out with a report with regards to the export performance of key pharma companies in May of 2025. So the export performance on a year-on-year basis for a couple of companies such as Laurus Labs, Blue Jet, Syngene, SBI Life Sciences looks good. Laurus Labs up 104%, Blue Jet up 29%, Syngene up around 23%, and Sai Life Sciences up around 18%. There was a weak to mixed export performance from the likes of Gland, Divi's Labs and Newland. Gland Pharma was down 24%, Divi's Labs was down 23%, and Newland, according to the Goldman Sachs report, was down around 59%. They have also indicated that smaller companies may show volatility due to shipments bunching up in specific months.
Okay, all right. Ekta got that. Thank you very much for the details there on Pharma. Let's bring in our next guest on the show. We've got Anand Tandon joining in to take us through the last lap. Anand, good to have you on. So lots of stocks buzzing around on news and the markets turned around irrespective of the Middle East conflict. What do you make of things? I mean, overall, the resilience the market is showing. Would you be advising more buying or stay on the sidelines because the market's just marching on?
Well, I assume that most people are already invested in the market, at least those who have an interest in it. And therefore, this is not the time, in my view, to be actually adding up your equity exposure. The market may be a lot more sanguine, but the reality is that the geopolitical situation is beginning to get worse. And I don't see any way that there can be an exit very easily. I mean, at the end of the day, you are likely to have, now with Israel and Iran in the fray, there is no easy ramp off that I can see without a little more destruction and perhaps an escalation from this stage. So net, while we may continue to ignore the obvious, the fact remains that things are not incrementally getting better. So neither is the global demand getting better, nor are the commodity prices improving in our favor. I mean, one of the major positives for the Indian stock market was that oil prices were low. That is no longer the case, and though they haven't actually reached a danger level yet, and they are still moderate, but the downside is perhaps now not very likely given the destruction in the facilities we've seen in Iran. So net, don't increase exposure in the equity markets. Ride whatever you've got.
But Anand, you have been sounding cautious for a while, right? But couple of stocks you like, couple of pockets of, couple of stocks should be good, right? Should be better placed than others. Taking your point on board that this, this oil spike up is not very, very good. Maybe the equity markets are not particularly cheap, no ways. But there'll be a couple of stocks. If you could share us some ideas, what you're positive on?
So at this stage, I am not. So first of all, I don't think that it's a good idea for somebody to be looking at individual stocks. Broadly, when you are looking at a macro kind of situation, the best thing is to ride, as I said, the entire market. If you look at the results that have gone by, the larger cap companies have done the best in terms of the earnings growth. Now, one could argue that they haven't performed the best in terms of the stock market. But, the stock market performance is not something that one can predict. It will follow its own rhythm, but eventually it will catch up with earnings. At least that's the model that one works with for the moment, for the lack of a better model. From that context, I think, as I said, just stay with your asset allocation. If you've got X amount in the equities, why simply not buy the index? Because all said and done, that is what it will converge to. Overall, as I said, the small caps have done the worst in terms of the earnings growth. The mid caps have done slightly better, and the large caps have delivered you a 7% earnings growth on a year-on-year basis, which is nothing to shout about, frankly, given the valuation we are at. So, I'm not going to be recommending any particular stocks. There are sectors that one is already overweight on. Your banking, financial sector we've been talking about for a while. Most of them have also run up. So rather than doing bottom fishing, cherry picking at this stage, stay with the investments and just ride it out.
Okay. One such sector where maybe you can argue that at least valuations haven't run up too much because stocks haven't done anything in a while is the chemical space, Anand. And now we've started to get a trickle of positive news. A couple of brokers are getting positive on stocks like PI Industries, Galaxy Surfactants we were just discussing. Do you like anything here?
So the specialty chemical space is, first of all, not a market-moving space. That said, the last time we saw a spike in this was about 5 years ago. And since then, many of the companies have actually gone ahead and increased capacity, and that cycle is now coming to an end. So many companies in the frontline chemical space are now at a stage where the capacities are in place, the capex is behind you, and therefore there is a potential of growth. The challenge, however, will be that many of them are actually export-oriented, and therefore we still have to see where they are going to export to. and whether or not we are going to be up against China, or we are going to be able to export to the larger markets in US and so on. So, but broadly, as I said, from a cycle point of view, they are probably positioned right. And since they haven't done much in terms of the stock market, there is a likelihood that you may actually get some kind of positive surprise in terms of the earnings. Hardly a market moving sector, but as I said, overall, it is well positioned. It could be an area where you could increase your exposure to.
Anna, and you look at a couple of sectors where you see dips and then that gets bought into. One such sector that comes to mind is real estate. We had Prestige Estates, Mr. Irfan Razak, who joined us earlier today. And when we were having that conversation with him, the stock was down close to 2%. He sounded quite optimistic in terms of going into new markets, taking a 5-6% price increase. And he said demand is fairly good as well. The stock used to be 2,100. It went down sub that 1,500 odd mark. And today from the day's low, it's up close to 4%. Any view on this name or any other real estate stock?
First of all, when do you think that a management will tell you that they are in trouble? So it is very unlikely that you should take positive commentary from managements as anything of an indicator. Why are they, if Bangalore is the largest market, if they are moving out of Bangalore and looking at newer market, why is that? By all means, they should continue to increase their exposure and increase their already market-leading position in the market in their home territory. New markets means new relationships with new governments, new ways to get permissions and so on, all of which is cumbersome. The reality is, I can tell you about my city, for example, since I'm sitting in Hyderabad, the year-on-year sales in Hyderabad real estate is down 33%. So no, I am not bullish on the real estate. My own view is that, with IT not doing well, real estate will also suffer over time because that's incrementally new IT professional hires are the largest demand creators for property. And that's not happening now. So for me, real estate is not something that I would be overweight on.
Okay, all right. 12 minutes to go for market close. I want to talk about insurance companies with you, Anand, when we come back after a quick break. Stocks are higher. So maybe that coming up. We'll take a break. We are back on the other side. Here's some opinion we got from TVF Capital Advisors. Is Shiv Puri. We spoke with him in the morning, based out of Singapore, foreign investor. And 3 areas: financial services, hospitals, and consumer discretionary. Those are what he likes. Listen in.
Globally, if you look at it, the biggest worrying factor is really geopolitics. And as long as geopolitics remains localized, it doesn't become a global problem, markets are seeing past it because earnings are still pretty good, at least in the West. In some of the big tech names, earnings have done very well. Here in India, you're seeing the last 1 year where earnings have slowed down. But as I look forward, you've seen a few things happen that I think will be quite constructive for the markets. So first is that liquidity in the system has gone up. You've seen the Reserve Bank cut interest rates, cut CRR, and that's an important factor. Second is you're starting to see pickup in rural consumption, which is always a good thing. But I think more than sectors, there's a lot of opportunity on a bottoms-up basis, which is the way we've always thought about investing globally. And if you look at but sectors, financial services, healthcare, especially hospitals, consumer discretionary, are probably 3 areas that are looking pretty good. I don't think much has changed. When we were talking about a year ago, I was talking about the same things. So I think that still looks pretty good. And there are, different pockets of interest. You look at the online recruitment space. There is a particular company that's, continues to do well, and that has diversified its business. So you have to just look at some of these bottoms-up opportunities. But I would highlight those 3 or 4 sectors.
Okay, welcome back. 7 minutes to go for close. You know, earlier today, I spoke with Alvaro Pereira, the chief economist at the OECD. We spoke about a bunch of things, and this bit was interesting, and that's why I want to play out a quick bit. He thinks that the use of AI and what is coming, and they've released a recent paper as well, could really widen productivity. Productivity gains that US, for example, has compared to the rest of the world, which is a problem. Listen in to this conversation.
The variable that we are not talking much, but I think is going to have an impact on major economies are going to go is the evolution of productivity, in particular related to AI. And so we just came out with a recent report that shows very clearly that AI is it's a rare technology, what is called a general purpose technology, that will have a significant impact on the productivity and the production and the organization of work. And we expect, in fact, that this impact is going to be between 1.2, 1.5% per year over the next 10 years in the United States, and a little bit less in many other countries. We think that, obviously, if you look at what is happening in the last 2 or 3 years in terms of productivity, there's a big gap opening up between the United States and most countries of the world. The United States productivity is growing right now about 2.5, 2.7%. That has not to do necessarily with AI, but it has to do with the reallocation that took place during COVID. More than 22 million jobs were lost and created. These people usually went to either create their own firms or to larger firms, so productivity went up. There's much larger in the United States, much larger investment, especially in digital technology, much larger than most countries, and this is having an impact again on our productivity. And on the other hand, we also know that firm dynamism went up after COVID in the United States, and this will tend to boost productivity. Now, if you take this into account, that there's already a widening gap between the United States and most countries of the world in terms of productivity. And on top of this, you're going to have AI, in which the United States are much more advanced in this field. It's very likely that this productivity gap will widen. This will have a consequence for monetary policy, for fiscal policy, and for industrial policy, as you mentioned. So I think this is going to be, in the near future, the topic going forward.
Well, that's a slice of a very interesting conversation I had. So you should tune into the all-new CNBC-TV18 Prime. We bring you insights from policymakers, business leaders, economists, shaping both the world and India's future. Every day at 12 noon, we have the Global Reset, which airs. We have the Big C focused on currencies, commodities, cryptos, 1 o'clock, and then Global Lens at 8:30 in the evening. We have Parishad sort of championing that. So lots of new programming on CNBC-TV18 Prime. I think Anand is with us of course, on markets. Anand, so just a quick word on the life insurers, as I was saying before we left off. Many believe this is the year for life insurance companies. Valuations relative to history are not that expensive. It's a sector where there is a lot of growth with regards to high penetration levels, etc. What's your sense?
Well, there is still a long runway. However, the penetration is quite good now. I mean, if you actually look at the number of policies sold, it is at least as much as many of the larger markets. But the only issue is that the numbers in terms of the level of coverage is not very high, which allows you still a value-based increase that is quite likely will continue for a long time to come. The problem is that most of life insurance in India is sold as investment products, and that's not a good thing. There is not enough coverage. But that being said, there is no question that it's a sticky product. Therefore, once you get the client in, you don't lose them very quickly. And that allows companies to actually do quite well. Valuations are relatively cheap. If you take LIC, it's actually trading less than its NAV, as it were. Of course, the change of the new business in LIC doesn't move the needle very much in terms of the share prices. So you are looking at the private sector companies to do better. And there again, the valuations have actually shrunk over the last many years and are on a declining trend. So from that perspective, as and when the market actually begins to recognize reward higher growth again, there should be money to be made in these companies, and they are trading relatively cheap.
Anand, on the point of penetration, the conversation I had recently, last week, with a private insurer. They're tying up with a public sector insurer. And of course, this is his version. I had to check the numbers, but he basically said, without naming the bank, large private public sector bank, he says, he was asking me to guess what is the percentage of that PSU bank's CASA customers which have insurance coverage. And he told me it's 1%. And I found it tough to believe, but that's another way to look at penetration, right? By the way, that one, not any, basically any insurance, no insurance, only 1% has. So I think we can cut the data in a lot of different ways.
Well, I would imagine that, it depends on what you mean by 1%. It's probably 1% that the bank has managed to sell. It may not be that the client...
No, I checked. And I was surprised. How is it possible? Has to be more than 1%. But I will check. It's unfair to put put that question to you. I will check at my end. I will maybe connect again. Stay with us, Anand. Allow me to just wrap up things, because I think the market is shutting. And we'll just come back and talk more. 24,950 is where the Nifty is at, 220 points higher. So it's about 0.9% in the green. What a difference the session has made, right? It's like as I was saying earlier, it's like a perfect it's a symbolic day and shows a larger trend, which is what? By the dip. So sometimes those dips have been a little sharper, spread over a few weeks, but they've always been short-lived. And I think today has been that kind of a day. So early jitters, but very short-lived, and the markets kind of moved on, never looked back. Even broader markets kind of worked their way through, and we end with reasonable gains across the board. Advanced decline is positive, and so on and so forth. I think, as I was saying earlier on the Nifty, you have HDFC Life and SBI Life as some of the biggest gainers. Some of the older economy names, BEL, UltraTech Cement, ONGC were the other gainers. They were Tech Mahindra, Apollo Hospitals, all in the range of between 1.5% to 2.5%. I mean, the only big noticeable loser was Tata Motors with a 4% cut. Everything else on the downside was was down less than 1%. And actually, you only had 5 names out of the 50 stocks which end the day in the red today. Guys.
Okay, and for the broader market as well, not a bad day at all, because look at the kind of moves we've got. Gland Pharma 5%, IGL 6.5%. The chemical stocks that we've been discussing, Galaxy Surfactants 5-6% higher. Sterlite Technologies, after winning that BharatNet order, 20% on that stock. Suven Life Sciences, Office, Prince Pipes, I could just go on and on. Short point is that it's been a very good day for the broader market as well, and very well-rounded session with many, many sectors participating. Well, that's where we'll take your leave on this edition of Closing Bell. Many thanks for watching, but do stay tuned. We have Markets Forward coming up next.
Strong day on the trade on the Lal Street. Nifty and Sensex gain nearly 1%. Nifty nears the 25,000 mark. IT and realty lead from the front. Broader markets gain in line with the blue chips.
Tata Motors armed Jaguar Land Rover tells investors its profitability is expected to take a significant hit in FY26 and its free cash flows can dive to near zero from £1.5 billion last fiscal.
Sun Pharma will get a new MD on September 1st in Kirti Ganarkar as founder and current CMD Dilip Sanghvi steps back to focus on strategy and the specialty portfolio. Hello and welcome to Markets Forward, your go-to show where we aim to get you all the key data points to gear you up for the next trading day. I'm Ekta Batra and with me is my colleague Vinny Motiwala. Hi Vinny, well it turned out to be a session where we did see some amount of green on the screen and a good pullback for the markets, especially in the second half.
Absolutely. An interesting day coming in, not much of a Monday blue. At least we saw good green for the screen. Recovery from the day's lowest point. Nifty up more than 200 points. So I think there was nothing to complain about in today's trading day as well, specifically.
Yes, absolutely. And you know what seemed to have stood out is that the Nifty is inching towards 25,000 and we're probably making our mark towards that. Separately, the advance decline ratio did definitely turn in favor of the advances. So if you saw, we started off extremely weak. But by the end of trade, you can see that crisscross that took place and the advances, in fact, took over the declines and that seemed to have stood out. In terms of stocks, we had ONGC, a lot of the life insurance stocks. We had others such as UltraTech Cement, all of these stocks which really gained, giving you a sense that the gains that we saw was sector agnostic in today's trading session.
Absolutely, and a lot of the broader end of the market also, the mid and small cap, because Nifty mid cap saw very good recovery as well. So that is something that we should be keeping an eye out on. Nifty mid cap, look at it. It was in the red significantly and then that recovery came up for the Nifty mid cap. Similarly for the Nifty small cap as well, a good move that came in. At one point of time, Nifty mid cap was underperforming, but a recovery from the day's lowest point, managing to close on the positive side is something that was interesting there. But we have an exciting lineup for you all here on the show today. We'll start with the top movers and shakers of the day with Vivek, and then there are top buzzers. Tata Motors was buzzing in today's trading session and the stock fell after a JLR commentary that came in for FY26. We also had IGL and PI Industries that surged in trade today, and this was after a couple of brokerage notes that came in for both these stocks. Last but not the least, we'll delve into the key market events to watch out for in tomorrow's trading session. So that'll be on the top of our list.
All right, but on to our first segment of the day. Vivek joins in now from the big wall with all of the top movers and shakers.
Well, thank you so much for that. Like you rightly mentioned, second half of the session, we did see the line, especially as far as the broader end of the markets, inching towards the list of gainers. Well, when you're talking about the list of gainers, you can't look beyond IGL, one of the top gainers as far as the broader end of the market was concerned. News reports are indicating that the Delhi government may ease earlier proposed changes to the EV policy, and this is something that analysts as well as Citi believes could be quite positive for the company. The other stock that did very well, especially in the broader end of the markets, was Galaxy Surfactants. The company held the analyst meet over the weekend, and very strong guidance given over there, especially in terms of the internal targets that the company managed to go ahead and share with the analyst community. The insurance set of stocks, they did quite well in the session. In fact, some of the top gainers on the Nifty were insurance names, SBI Life as well as HDFC Life, among the top Nifty gainers. One stock, from the broader end of the market that did quite well in the session on the back of an order win was Newgen Software, over 4% higher. Multi-year deal that the company announced to the exchanges earlier today. And along with that, the mid-cap IT pack, that clearly stood out. Lot of momentum in that particular space. The names like Persistence, Emphasis, all of them gaining more than 2% in the session. A few laggards as well, not too many, but Tata Motors clearly stood out over there. A guidance cut coming in for JLR, EBIT margin getting trimmed, and on the back of that, one of the top laggards on the Nifty. You also saw shipbuilders, the stocks that have rallied significantly, take a bit of a pause today. Mascot Dock managing to recover quite a bit of ground, but still 1% lower today. And CCL Products, one of the top laggards as far as the NSE 500 was concerned. That particular stock ended lower by almost 3%. Not too many laggards in what is essentially a strong trading session today.
Absolutely, not too many laggards. A good, strong session. Thank you so much for that, Vivek. Those were the top stock movers, but thank you for that. Now, let's go across to our guests for today. We have Anand Tandon, market expert, and Jay Thakkar of ICICI Securities with us. Jay, I just want to understand in terms of levels, that we're actually keeping an eye out on now for the Nifty 50. 25,000 every time we just go above that mark and then we start seeing a fall coming in. What are we watching out for this time? Do you think that if we touch the 25,000 now, maybe that could see a bit of up move from here on, or is it still uncertain?
Hi, very good afternoon to you, Vini. Well, I would say that 25,000 still remains a critical resistance, but then taking off would not clear the hurdle, I would say, because what happened the last time is that Nifty was actually struggling to move beyond the levels of 25,000. It was trading within that range of 24,400, 500 on the downside to 25,000. Probably, it was precisely 25,100. So that was 500 to 600 points range which took off. In fact, Nifty thereafter, managed to close above these 25,000 levels for almost 2 to 3 consecutive trading sessions, made a high of 25,200 plus levels. So now I think the range has shifted upwards to 25,200 to 250 zone. Just being about 25,000 would not clearly indicate a breakout because it has actually moved above and below these levels many a times. So it's been floating around these levels. So now precisely 25,250. That's really critical level to have a final breakout on Nifty. The range has widened as compared to previous one. It was 600 points range. Now it is almost 750 points range. So that is widened. I think only about 25,250 you will be having a further confirmation of a breakout. Till then, you can assume that the market is still trading within the range.
Okay, quite a wide range you are pointing out there. But Anand, we seem to have shrugged off all of the concerns today, may it be global, may it be Brent crude. What do you think the market is thinking, and what's your sense in terms of what the FIIs did today?
You are assuming that the market is thinking. If it was, it shouldn't be where it is. So at this stage, I think it's more liquidity than anything else, and complete lack of understanding of the level of risk one is running. So at this stage, as I was saying in the previous segment, the best thing is to hold on to your positions and ride with the market. But think about it. You are at best 1,100 rupees EPS on the Nifty for the next year, for the current year, which means at 2,500, you're already trading at around 22, 23 times. That doesn't give you much upside. That is already at the highest level. And that is when the earnings are very, very anemic. At the end of the day, we had single digits. And while the current consensus assumes that there is a double-digit earnings growth, my own estimate is that, again, you will get a single-digit earnings growth in the current year as well. So I don't see where fundamentally there is an upside. Now, when people say that we are, magically turning bottom up and simultaneously are fully invested, I find that a contradiction which I cannot reconcile. You cannot be fully invested as a fund, at the same time be a bottom-up player. Because if you are a bottom-up player, it assumes that you have to find valuations which are comfortable. And if they are not comfortable, you'll be out of it waiting till you find that, which is what, for example, Warren Buffett is doing in Berkshire. That is bottom-up investing, not when you are fully invested and running with the market. So my simple suggestion is stay with your asset allocation, don't be very adventurous, and just ride this out.
Absolutely. Don't be very adventurous. Stay with your asset allocation. But let's get started with the first stock for today that was in focus, and that was Tata Motors, because it fell nearly 4%. And this came in after JLR told investors that it is expected to take a significant hit in FY26. So Darshan is joining in with us to give us the details of what actually came out of this, what was the outlook that the, JLR gave for FY26 as well. So Darshan.
So while market overall today had a very strong start to the week, one stock that has not participated in today's rally was Tata Motors, and it's on the back of JLR's muted outlook for FY26. So JLR is holding Investor Day meet today, and ahead of Investor Day, today early in the morning, JLR has released investor presentation giving FY26 outlook. Now in that, on EBIT margin front, company is saying that in FY26, EBIT margin is going to be in the range of 5 to 7% versus 8.5% reported in FY25. On free cash flow, it's saying that it would be close to zero against 1.5 billion pounds it saw in FY25. But beyond FY26, over FY27-28, it's saying that free cash flow is expected to improve. Even EBIT margin is seen improving. And now medium-term target on EBIT margin is to getting back to the levels around 10%. Also, it has made certain comments related to US tariff issue. It's saying that it's in engagement with both US and UK governments. As far as UK exports to the US is concerned, for that, tariff is going to come down to 10% versus current rate of 27.5%. Another important market for JLR, Slovakia, for where it exports its products. For that, tariff is going to remain at 27.5%. Now coming to another important market for JLR, that is China. In China, it's saying that for premium market, while market was challenging in FY25, JLR has basically done better than its peers. And going forward, it's saying that because of Freelander, it's going to do well in China. And first Freelander company is looking to launch in H2 of FY26. And over FY24-28, total investment that company is looking to make is $15 billion. But the main reason why the stock was under pressure was JLR's muted outlook for FY26.
Okay, well, Sudarshan, stay on. You're also looking at IGL. So if you could tell us more about that stock.
So IGL was amongst top mid-cap gainers today. It was at one point was up more than 7%. And the reason over the last few months, we have seen several reports related to Delhi EV policy. Now we understand that our sister channel Awaz has reported that Delhi's government is going to consider easing the EV policy. But more than that, what is most important is that it's also going to consider easing the cab aggregator policy announced by the previous Aam Aadmi Party government in November of 2023. And as per that policy, government was looking to basically regulate cab aggregators and also e-commerce players having more than 25 fleet. But now today also Citi has come out with a note on IGL after this update, and it has a buy call on the stock with a target of 250 per share. It's saying that earlier government's policy of all electric fleet transition by 2030 had dampened IGL's volume growth prospects. But now with new government, as per reports, is considering to ease the policy, it will help volume grow for IGL because cab aggregator contributes 12 to 15% to IGL's volume. Second important part is the CNG three-wheelers. As per the reports in the policy, CNG three-wheelers transition is unlikely. Now that contributes around 3 to 5% to IGL's volume. And last part is Delhi DTC bus, for which electrification is almost complete and contribution to IGL's volume by Delhi DTC is already down to 2 to 3% versus earlier contribution of 7 to 8%. So overall, it's looking positive for IGL, and that's the reason you have seen a big move in today, and at the end it was up almost 7%.
Absolutely, Sudarshan. Ending with gains of almost 7% in today's trading session. That was IGL. Anand, I'm going to come to you. I want to understand specifically in terms of Tata Motors, right? The outlook that we are seeing coming in from JLR, worried about cash flow concerns also. They're saying it could be zero next year as well. Does this overall get a bit of a sense in terms of a concern that we should watch out for from the auto sector?
Oh, of course, but JLR has a bigger problem. They are not really in India. So you are really looking at a global market there. And this was always a concern that at least I have voiced several times in the past, that you cannot have a situation where the global markets are shrinking for the auto. And many of the global companies have also mentioned that the US market, for example, is not doing that well, that JLR would continue to do well. I'm glad that the management has also brought that into their guidance. But that said, there is no question in India we have our own challenges. What with these magnets, etc., not coming through, most of the companies will not be able to provide. More importantly, even with the magnets, I mean, I can't see any company which is doing very well, in any of the segments in the auto space. So tractors may do a little better because it's a little more rural oriented. Two-wheelers, too many of them, the EV market is also booming. And there are so many new players that it's difficult for them to figure out who's going to be the winner. Passenger car market is shrinking, actually, other than the fact that the SUVs are doing well. And in the SUV segments, we have a whole range of new launches lined up. So the competition will actually strengthen a lot. And in my construct, consumer discretionary is going to be a somewhat weak space for the next 12 months going forward. And therefore, it's not something that I would be very bullish on. So net, I would not be very bullish on autos in India over the next at least 12 months.
Okay, not too bullish on autos in the next 12 months. But over to you, Jay. A chart check on both IGL as well as Tata Motors.
So, Ekta, overall, IGL has been trading within this range of say 280, 180 since quite long now, and it's a long consolidation. A lot of government policies or regulations around it is not helping the stock to in fact find the upward momentum. So for me, I think those who have been holding for the long term, they can continue to hold it. With the stop loss of say 180, one can hold, targeting around say 280 on the upside. As far as Tata Motors is concerned, I think that the trend overall is negative out there. So Tata Motors looks to me, negative as of now. I mean, there's again shorts that's getting built up out here, Ekta, but IGL relatively is better. With this kind of a news, I think it might be heading back to 250 to 80 range. That is the upper part of the range. Tata Motors have again started to look negative. In fact, shorts are getting built up out there. So I think any long should be avoided at present right now.
Okay, all right. Well, that's on a couple of these stocks, but let's focus on the pharmaceutical space. Sun Pharma was in the red today. This is after the US drug regulator has issued 8 observations to its Halol facility. The plant, which was inspected from June 2nd to the 13th, was under or is under an import alert since December 2022. Separately, the firm will get a new MD on September 1st in Kirti Ganarkar, who is the current founder and current CMD. Dilip Sangvi has stepped back to focus on strategy and the specialty portfolio. The firm has said that this marks the culmination of structured succession plan at Sun Pharma.
Okay. That is Sun Pharma, but we also have Biocon that was in focus. So shifting focus there, and Ekta, there are some report sources also coming in from Money Control, and the firm is planning to launch the proposed QIP shortly to raise up to 4,500 crore rupees, and this fundraise is aimed at reducing debt and strengthening the balance sheet of the company. The board had given the nod for this fundraise on somewhere around in April this year, so that is an important one there as well, and that's why we're seeing Biocon also closing with gains of 0.5% in the trading session today.
All right, well, PI Industries gained over 4% after the stock got a rating upgrade from global brokerage firm Morgan Stanley. The brokerage has upgraded the firm's rating to overweight with a significant uptick in its target price. Ria joins in with more details.
Well, yes, PI Industries remained in focus in today's trading session after Morgan Stanley came out with a note on the company. They upgraded it to an overweight rating with a target price of rupees 5,000. In fact, they also raised the multiple on PI's agrochemical segment to 23 times, and they've also raised the segment earnings target by 7%, which is being offset by the drag in the company's pharma segment. Now, Morgan Stanley has said that PI has the highest exposure to the agrochemical segment in their coverage, and they believe that the company should see a three-pronged volume increase across the domestic exports and the new molecules businesses as well. They're estimating that the new molecules and biologicals segments will each comprise a third of the custom synthesis exports and domestic portfolios by FY28, and they also think that multiples can re-rate by up to 20% higher to levels seen between 2022 to the first half of FY24, which was a period of robust exports momentum for the company. So overall for the industry, they're expecting a more constructive volume-led agrichem cycle in 2026, which is also going to support stronger asset runs and operating leverage-led margin tailwind. So on the back of this positive note coming in from Morgan Stanley, the stock was up around 4.5% today.
Okay, Ria, thank you so much for that. But thank you so much, Anand, as well as Jay, also for joining with us on the show as always and giving us your views on the markets as well as individual stocks. But on that note, we're going to slip into a very short break. And after the break, we'll get you the top corporate voices along with the key market events to watch out for in tomorrow's trading session. Welcome back to Markets Forward on CNBC-TV18. Now going across to the corporate voices and to the corporate corner segment on the show, the management of Prestige Estate is optimistic about the upcoming launches across Bangalore, Chennai as well as Hyderabad and Mumbai. The realty firm believes the first quarter will be one of the strongest quarters ever for the company. It also anticipates 5 to 7% rise in prices in the mid-market segment. And in luxury segment also, the company saying that it expects a large price hike coming in as well. About the hospitality arm, the management said that it is hopeful that Prestige Hospitality will launch its IPO this fiscal. It is looking to raise 3,500 crore rupees with this listing and becoming a debt-free company.
Okay, and next up on our list is Birla Corporation. The management expects volume growth in the range of 7 to 8% in FY26 since it doesn't see inorganic opportunities coming its way. It is committed to brownfield expansion, commenting on West Bengal government's decision to revoke incentives. The management says this was pertaining to the past and that it was stopped a while back. In addition, says it is not rattled by the move and that other states are meeting their incentive commitments. The company is still awaiting for the last word from the Bengal government on this. The company was recently declared the preferred bidder for the Goram Khan Dhani in Jaisalmer. On this win, the management says it should not be seen in isolation.
And next on our list is Bellrise Industries. The top boss told CNBC-TV18 that the firm expected to grow in mid-teens in the medium term. It also said that there would be no real impact of the H1 acquisition on the FY25 numbers. In the two-wheeler space, the firm reiterated its position as a top player and said that while it was working with almost all the two-wheelers OEMs, it expected, contribution from its four-wheeler segment to rise significantly over the next 2 to 2.5 years.
Okay, and before we wrap, we'll bring you some key market events to watch out for. Ria standing by.
Well, yes, let's take a look at the key events to watch out for tomorrow. First up, in Europe, we have the economic sentiment data coming out tomorrow. In the US, there's the core retail sales and industrial production data. So keep your eye out on both of these data points for tomorrow. We've also got the FOMC meeting as well as the Bank of Japan interest rate decision happening tomorrow. The IEA comes out with their oil market report as well, and some other events to watch out for. PM Modi will be attending the G7 leaders meeting, and President Trump is also likely to meet the Prime Minister of Japan. Apart from this, nothing significant for the domestic markets, but keep your eye out on all of these international events for tomorrow.
Okay, Ria, thank you so much for that. But with that, we're absolutely out of time on this edition of Markets Forward on CNBC-TV18. Thank you so much from Ekta, myself, as well as the team who put this show together. But don't go anywhere. Up next, we'll bring you more news and updates on the other side.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. Israel and Iran trade fire for the fourth day. A new wave of Iranian airstrikes target Tel Aviv and Haifa. More than 220 people have died due to Israeli strikes across Iran in the last 4 days. US President Trump hopes for a deal between Israel and Iran, even as he reiterates firm support of Tel Aviv. Reports suggest Trump rejected Israel's plan to kill Iran's supreme leader. India moves to relocate students studying in Iran's universities. 4 days since the devastating Air India plane crash, grieving families wait for bodies as DNA matching continues. 90 bodies identified so far. Mortal remains of former Gujarat Chief Minister Vijay Rupani, who was on the flight, returned to his family. Strong start to the week on Dalal Street. Sensex gains nearly 700 points. Nifty moves closer to 25,000. Bank stocks lead the rally. Oil prices remain firm with Brent crude trading above the $73 mark. GST Council likely to consider replacing compensation cess with a combination of health cess and a clean energy cess. Sources say group of ministers largely favour hiking the cess on cars and tobacco products to shore up revenue. 21 India-based companies awaiting licenses from China to import rare earth magnets. Times of India reports the number of companies awaiting clearance has doubled in the last 2 weeks. 4 people are dead and dozens injured after a bridge marked as unsafe collapses in Pune. Authorities end operations after rescuing 51 people. Opposition targets the state government, demands accountability. World leaders set to gather in Canada for the G7 summit amidst Middle East tensions and the Ukraine war. Prime Minister Modi holds bilateral talks with his counterpart in Cyprus before travelling to Canada for G7. Supreme Court advocates criticized the Enforcement Directorate for issuing summons to Arvind Datar in connection with legal opinion given to Rashmi Saluja in the Religare ESOPs case. The summons were withdrawn later. Advocates call the ED notice unwarranted, say it reflects a disturbing trend of executive overreach that threatens the legal profession. Heavy rain batters several districts in Maharashtra, where the department issues a red alert for Raigad and orange alert for Mumbai and adjoining districts of Thane and Palghar. 18 people have reportedly died in rain-related incidents in the state in the 24 hours, up to 11 this morning. The top story we are tracking this evening: the decades-long simmering conflict between Israel and Iran has now escalated into a full-blown war, with both Tel Aviv and Tehran training their ballistic weapons on each other. Iran launched a fresh wave of strikes attacking Tel Aviv and the port city of Haifa, killing at least 8 people. Tehran has said that it has no intention of yielding to international calls for de-escalation. Days after Israel's surprise attack on Iran's nuclear facilities triggered the worst confrontation between the long-standing enemies. As per Iran's health ministry, over 220 people, mostly civilians, have been killed in Israeli attacks against the country. At least 70 were women and children. The intelligence chief of Iran's Revolutionary Guard and 2 generals were killed in these attacks. Israeli defense minister has warned Iran that the residents will pay the price for Iran's deadly retaliatory strikes. Israeli authorities said that at least 14 people in the country, including children, were also killed in strikes over the weekend. Israel's military said it had hit more than 80 targets in Tehran since Saturday, including the defense ministry headquarters. The US embassy in Tel Aviv suffered minor damage from the force of Iranian missile strikes. The US ambassador to Israel confirmed that none of the staff suffered any injury. US President Donald Trump has said that he is hopeful that Israel and Iran can strike a deal. However, he has reiterated that his administration will continue its support for Israel.
Mr. President, can you give us a sense of what you're doing to try to de-escalate the situation between Iran and Israel?
Well, I hope there's going to be a deal. I think it's time for a deal, and we'll see what happens. But sometimes they have to fight it out, but we're going to see what happens. I think there's a good chance there'll be a deal.
The U.S. can continue to support Israel in its submission.
We do, yeah. Thank you very much.
The Iran-Israel conflict is set to be one of the top agenda items in the ongoing meeting of the G7 in Canada. NBC's Alice Barr is here with more on how the G7 is expected to address the escalating tensions in the region.
President Trump is going to be with top allies today at this G7 summit in Canada, and he arrived yesterday with a full plate of issues that he's bringing with him, domestic issues, and then, of course, a lot on the foreign stage to be looking at, with the expanding conflict between Israel and Iran front and center, no question. It comes amid these mounting concerns over a new round of attacks between the two major military powers. President Trump saying it's time for a deal to de-escalate, while adding, as you heard there, sometimes they have to fight it out. He promised to keep supporting Israel's defense, though Israeli Prime Minister Benjamin Netanyahu is spelling out a little bit more of what that looks like, saying in a new interview that American pilots are helping shoot down drones headed toward Israel. Iran has threatened to strike American military targets if the U.S. continues that assistance to Israel. Lawmakers are calling that a red line, with many in both parties defending Israel's goal of destroying Iran's ability to make a nuclear weapon, while still calling to prioritize diplomacy. U.S. embassy offices are closed in Israel today as this high-stakes conflict grows. And you're right to note, this is going to be center stage at the G7 conference ongoing. Exactly how the top economies and the top allies that are gathered there figure out how to address this, and whether there's kind of a formal document or statement that comes out of it, certainly is something that we're going to be watching for as really the meetings get underway in earnest a little bit later today.
The Indian embassies in Tel Aviv and Tehran have issued advisories for Indian nationals in the region. Both the embassies have shared hotline numbers and asked the Indian nationals to stay vigilant. The Indian embassy in Iran has also advised Indians to avoid all unnecessary movements in the country. India's foreign ministry has confirmed that the Indian embassy in Iran also relocated some Indian students to safer locations within the country. Parents of some students stuck in Iran have said that they are awaiting for government to shift remaining students to safer areas.
अभी 12 बजे मेरी बात हुई मेरी बेटी से, मुश्किल से आधे मिनट बात हुई है। उसने बोला कि हमारी एम्बेसी वालों से मैसेज उन्होंने की थी कि हम आपको किसी सेफर जगह पर शिफ्ट करेंगे, आप रेडी रहिए, लेकिन अभी तक नहीं किया। तेहरान में से कुछ बच्चों को शिफ्ट किया गया है, और जो शाहिद BSc में पढ़ रहे हैं उनको कुछ को आर्मीनिया शिफ्ट किया गया है, लेकिन जो शिराज या और यूनिवर्सिटी में बच्चे हैं अभी उनको शिफ्ट नहीं किया गया है।
And staying with tensions in the Middle East, Israel has killed at least 60 Palestinians in the last 24 hours. Out of these, around 17 were killed after the military shot at people who were trying to seek help at aid sites in Gaza. Medics in the region said that another 10 other aid seekers were reportedly killed and more than 50 injured in southern Gaza. Well, it's been 4 days since the devastating Air India plane crash in Ahmedabad. A team from Boeing has arrived at the crash site. They will join a team of 10 officers from the U.S. National Transportation Safety Board and the Federal Aviation Administration. Both black boxes have been retrieved from the aircraft. Grieving families are waiting for the bodies of their loved ones as DNA matching continues. My colleague Madiha Mujawar joins us from outside the Ahmedabad Civil Hospital. Madiha, how many victims have been identified so far?
Well, outside the mortuary complex here in the Ahmedabad Civil Hospital in Gujarat, families continue to wait for their turn, continue to wait for the call from the hospital to come and collect the mortal remains of their loved ones who were on that ill-fated plane that tragically crashed on the 12th of June. As per medical authorities, over 90 DNA samples have matched and over 60 bodies have been released, one of which was former Chief Minister of Gujarat, Vijay Rupani. His mortal remains were handed over to his family in the afternoon. The coffin was covered in the Indian flag and Chief Minister Bhupen Patel paid his last respect. hospital authorities are refusing to confirm a number on how many bodies have been recovered from the crash site and how many DNA samples have been collected so far. But what we know is many people continue to be missing. Rescue workers are even today discovering and pulling out body parts from the crash site. The DNA samples are as I said, the 90 DNA samples have matched. Besides the 241 passengers, there were many people present in the area during the plane crash. The hostel building is where many students were having their lunch. Then there were many people who were on their bikes, in their cars, walking in and around the hostel building. So there are many people who continue to be missing, and the final number on the death toll, the casualties, could be much, much higher. There were also 61 foreign nationals on that plane, and none of the family members have come to give their DNA samples so far. We've been told that they will arrive either this evening or tomorrow morning, but DNA samples of the foreign nationals have not been collected so far. And we also have to understand that the bodies were severely burned, so if the samples are not collected immediately, then the DNA testing process might even get more complicated. For now, these families are waiting for their turn to get into the ambulance and begin their most painful journey to spend time with the mortal remains of their loved ones.
Right. Thank you, Madiha, for these updates. Let's shift our focus to the day's market action now. Sensex and Nifty started the week on a strong note, clocking all-round gains today. The market regained Friday's losses with Nifty back above the 24,900 mark. Broader markets also saw sharp recovery from intraday lows, with Nifty mid-cap index gaining more than 1,000 points. 46 out of 50 stocks ended in the green, led by financials and Reliance Industries. Crude oil prices remained largely steady, holding on to gains from Friday as the Israel-Iran conflict increased concerns over oil exports from the Middle East. The latest strikes have stoked concerns about disruptions to the Strait of Hormuz, the strait through which 20% of the world's total oil needs pass. Meanwhile, gold prices surged to the fourth straight session to hit a near 2-month high. The fears of a wider regional conflict have given a boost to the demand for safe haven assets. India's wholesale price index declined to a 14-month low of 0.39% for the month of May. This is the third consecutive month of decline. The drop was primarily driven by sharp decrease in prices across key categories, including food, fuel, and primary articles. India's trade deficit for May 2025 narrowed to $21.88 billion from a 5-month high of $26.42 billion in April. This is also lower than the year-ago figure of $22.09 billion. Merchandise exports in May fell 2.2% on year to $39 billion, while imports fell 1.76%. The Commerce Ministry said that exports of electronic goods and pharma surged during the month. Commerce Ministry also says India is engaged with China on the import of rare earth magnets. China has restricted the exports for all countries, but some relaxations have been made for companies in the US and Europe. 21 India-based companies are awaiting licenses from China to import rare earth magnets. Times of India reports the number of companies awaiting clearance has doubled in the last 2 weeks. The shares of Tata Motors slipped in trade today after its British subsidiary Jaguar Land Rover trimmed its FY26 forecast. The company expects its margin to be between 5 and 7% for this fiscal. This is in comparison to the 8.5% margin it reported in the previous financial year. The company had reported a free cash flow of 1.5 billion euros in the previous financial year. However, it sees the number close to zero in the current financial year. The GST Council may reconsider replacing compensation cess with a combination of a health cess and a clean energy cess. Now, sources tell CNBC-TV18 that the group of ministers largely favor hiking the cess on cars and tobacco products to shore up revenue. A compensation cess is an additional levy on specific goods to compensate states for loss of revenue they are likely to have suffered when the GST regime came into existence. Now, Timsy Jaipuria is here with more. Timsy.
Well, the upcoming GST Council meeting could consider the proposal of replacing the current compensation cess with two new cesses, health cess and clean energy cess. That's what sources indicate, but this can happen only through the GOM process. The GOM on compensation cess, currently headed by MOS Finance Pankaj Chaudhary, is likely to have its final meeting, in which sources indicate that they are likely to come to a conclusion to proposing these two new cesses. Once this proposal is finally drafted by the GOM, it will go to the GST Council as a recommendation of the GOM, upon which the Council will deliberate and then decide whether this should be the roadmap ahead, because current compensation cess is ending on 31st March 2026. The goods on which this cess will be levied, that is the two new cesses which is being proposed, will remain the same: tobacco products, aerated drinks and cars. The overall incidence after replacing the current compensation cess with these two new cesses is also, sources say, might remain the same, because the government does not want to increase the tax incidence, because these are commonly used items, and though considered as luxury or sin goods, but still overall tax incidence is likely to remain the same. Now, what happens, because currently the law does not permit to introduce any new cess or any cess under the GST regime. Thus, there needs to be an amendment to bring any new cess or any cess under the GST regime via moving amendments in the Constitution Amendment Bill, which had paved the way for having a new indirect tax regime, that is GST, way back in 2017. So that needs to be amended to bring these two new cesses. Now, what is to be seen, whether government decides to chart this particular path or keep these two new cesses under the indirect tax regime, just like agriculture infra development cess or road and infra cess, which is separately accounted for and not under the GST. Something that we'll have to wait and watch for.
Right. Thank you, Timsy, for that. On that note, it's time for a short break. Coming up next, the Supreme Court advocates criticized the Enforcement Directorate for issuing summons to Arvind Datar in connection to legal opinion given to Rashmi Saluja and the Religare ESOP's case. More on that when we return. Welcome back. A quick look at other headlines. A 57-year-old man suspected of killing Democratic lawmaker Melissa Hotman and her husband in Minnesota has been detained by the police. The arrest followed 2 days of manhunt. As per the police, the suspect was armed at the time of his arrest in a rural area of Minneapolis, but gave himself up peacefully when challenged. The suspect is also alleged to have shot and wounded Democratic State Senator John Hoffman and his wife. Both are now in hospital. Prime Minister Narendra Modi finished his first official trip to Cyprus. This visit is the first ever visit by an Indian Prime Minister to the nation in 23 years. This is also Prime Minister Modi's first international trip since Operation Sindoor. He met the President of Cyprus, where both leaders discussed ways to boost ties in trade, energy and defence. Cyprus is set to hold the rotating presidency of the EU Council in 2026. India and the European Union have attempted to speed up negotiations for a free trade agreement. Government sources tell CNBC-TV18 that the meeting is now being held on a monthly basis instead of every quarter. 5 more chapters of the deal have been finalized out of the total 23 chapters. Speaking at the India-Cyprus CEO Forum, Prime Minister Modi also said that India and the European bloc will finalize a trade deal by the end of this year.
पिछले महीने भारत और यूके के बीच एक एम्बिशियस एफटीए पर सहमति बनी है। अब हम भारत और यूके के बीच फ्री ट्रेड एग्रीमेंट को इस साल के अंत तक संपन्न करने के लिए प्रतिबद्ध है। इसकी नेगोशिएशन में गति आई है। इसका लाभ आप सब साथियों को अवश्य मिलेगा।
A helicopter carrying pilgrims from Kedarnath crashed yesterday, killing all 7 people on board. As per preliminary analysis, the aircraft went down due to bad weather in the Rudraprayag district of Uttarakhand. The tragedy was the 5th incident on the same route in 6 weeks. Uttarakhand Chief Minister Pushkar Singh Dhami called an urgent meeting and ordered full investigation into the matter. 4 people are dead and dozens have been injured after a bridge that was marked unsafe collapsed in Pune. The National Disaster Response Force have called off operations after rescuing 51 people. Officials have said that the iron structure collapsed after it was overcrowded by tourists who ignored the warning board at the spot. Heavy rain battered several districts in Maharashtra. The Met Department has issued a red alert for Raigad and orange alert for Mumbai and adjoining districts of Thane and Palghar. 18 people have reportedly died in rain-related incidents in the state in the 24 hours up to 11 this morning. A gas leak in a well of an ONGC plant in Assam's Shivsagar district has entered 4th day. Officials have said that 70 families have been shifted to a relief camp around the area. Company director Vikram Saxena reached the spot on Saturday and a team led by him took operational control of the well. Reports have indicated that the well has not caught on fire yet and no one has been injured so far. The government has issued a notification that India's 16th census with caste enumeration will be conducted from the 1st of March in 2027. The census would be conducted in 2 phases. Phase 1 will be house listing operation, in which details of housing conditions and assets will be collected. Meanwhile, the second phase of population enumeration will involve the collection of socio-economic details. The Supreme Court Advocates Body has lodged its strong protest against the Enforcement Directorate for issuing summons to senior advocate Arvind Datar. The summons which have now been withdrawn are in relation to a legal opinion given by Datar in the ESOPs issued to Rashmi Saluja. The advocates have called the ED's move coercive and unwarranted. Ashmit Kumar joins us now with more. Ashmit, please take us through what the top court's advocates said.
Well, Arvind Datar, one of the senior most advocates in the country on all things related to tax and regulation, was in for a rude shock over the weekend when he received an ED summons to appear for questioning in case of the ESOPs that had been issued to Rashmi Saluja. The case in point, the ED's contention was that Arvind Datar, as a lawyer, had issued an opinion in favor of issuance of those ESOPs and therefore needed to be questioned. Now, in less than 24 hours, it was subsequently withdrawn. But nonetheless, this very act of summoning a lawyer for issuance of a legal opinion is something that's been widely condemned. In fact, a statement issued by an association of Supreme Court advocates went on to say that they fully condemn this move, that they fully they deplore this move that has been made by the Enforcement Directorate, going on to say that not only is it unwarranted, not only is it arbitrary, but it also impacts the rule of law. It's a case of it resembles, it represents executive overreach. Strong words being used there. Going on to say that summoning a lawyer for discharge of a professional duty, which is to issue an opinion, is in fact a clear case of misuse of authority, or going on to say that such coercive measures in fact take away from the independence of the judiciary, hurt the judicial dispensation process, and something that should be discontinued, and that the ED's actions are coercive in nature, and that it going ahead, it sends a chilling message to the entire legal community. So a strongly worded message being sent towards the Enforcement Directorate by some of the leading lawyers in the country.
All right, thank you, Ashmit, for that. India's G20 Sherpa Amitabh Kant has stepped down from his post, marking an end to his government service after 45 years. In a post on social media, Kant thanked Prime Minister Narendra Modi for the opportunity to serve as the country's G20 Sherpa and drive key developmental reforms. Kant will now engage with and support startups, think tanks and academic institutions in personal capacity. He has served as CEO of Niti Aayog from 2016 to 2022. The 1980 batch IS officer also played an instrumental role in campaigns such as Startup India, Incredible India and Make in India. And with that's a wrap on this edition of Business 360. News and updates continue right here on CNBC-TV18.
Presented by Policy Bazaar.
CNBC-TV18, the Policy Bazaar Insurance Show.
Welcome to the Policy Bazaar Insurance Show, the place where we decode complex insurance matters for an informed decision making. I'm your host, Yash Jain. Today, we navigate the critical terrain of war risk insurance in an increasingly uncertain geopolitical landscape. As tensions between India and Pakistan have recently demonstrated, geopolitical stability can no longer be taken for granted, even by businesses far from any front line. How should businesses navigate the risk arising from geopolitical uncertainties? To help us understand this thing, I am joined today by Neeraj Nayak, Joint President and Chief Underwriting Officer at HDFC Ergo, as well as Amitabh Diwan, the Head of Large Risk at Policy Bazaar for Business. To start this discussion with Mr. Diwan, the recent India-Pakistan conflict has left people and businesses wondering whether there is any standard insurance cover as an act of war. Now, if not, if there is no standard cover here, what kind of policies can business look at to insulate themselves against such risks? What are the different kinds of cover which are available in the market when it comes to war risks?
Sure. So thank you so much, Yash. Thank you for having me on the show. First is the war and warlike operations are a standard exclusion under any of the policies that are underwritten in India. While any warlike situation or a military action or an insurrection, everywhere in all the policies, this is a standard exclusion. However, there are a few insurance policies which are available, which do cover the companies for a war risk, which is something like a political violence insurance, if we specifically talk about. And those are very simple covers, which are basically covering the acts of terrorism, whether that's a mutiny, a civil commotion, or maybe an act of war or a military insurrection. So all of these policies are there to cover basically two kinds of exposures. First one is the property damage, which is the actual loss of damage to the assets. Second is a business interruption, which basically covers the consequential losses because of any kind of a attack or this kind of a political violence.
I want to come to you, Mr. Nayak. And it is very important to sort of distinguish between what's an act of war, what's civil unrest, what are the other forms of geopolitical uncertainty, including terrorism. How do insurers look at these different terms? What are the implications on the covers that these different terms have? Do they materially differentiate each other from what could be an act of war?
Well, Yash, firstly, thank you for having me on your show and having a discussion on this very important topic. Coming back to your question, and I will tell you, leaving aside the dictionary definition of what a war is, in general terms, war is looked upon as hostile actions between two countries or two military powers, which would politically transgress into each other's space. And it may or may not be declared. So in general, that is what an insurer would look upon as a war like an event. Coming to terrorism, terrorism is an event which is usually kind of done to terrorize people, to intimidate people, usually carried out by a non-state entity or a group, and hence this is how you would kind of differentiate between war and terrorism. An important aspect you said is how would an insurer look at it, and this is where it becomes onerous on the insurance company and also the insured to see how a war is defined in the policy contract. For an insurance company, it is also important to see that the policy contract that they have with the insured and the reinsurance contract they have with the reinsurer are kind of mirroring each other. War, terrorism, civil commotion should be clearly defined, and it should mirror in all the contracts that they get into.
Mr. Diwan, I want to understand a little more in terms of details now of such war risk insurance policies. What are certain exclusions, standard inclusions, which businesses should keep in mind while buying such policies and hence, claiming such policies at the time of any damage?
So on the war insurances, there are very few markets internationally who cover the war risk. And that is why the wordings or the coverages have to be very clearly understood before somebody binds a cover. For example, like we said, so under the war insurance, it is the sabotage, it is a civil commotion, it is a mutiny, insurrection. A lot of these things are insured. However, since it's a very high exposure for any insurance company or any of the industries, so any kind of the policy as such, there is a standard exclusion for the nuclear radiation risk. Any kind of a damage that happens because of a nuclear war or any of the nuclear weapons being used is certainly excluded under the policy. While it's more the damages due to the arms and ammunitions that is covered, any kind of a biological or the chemical impact which actually damages the overall society gets excluded under all the policies.
Fair point, sir. Mr. Nayak, I want to understand from you. Of late, we've had multiple events which either may be considered under the definition of act of war or may be considered under the definition of terrorism or social unrest, whichever way you want to look at it. In terms of the insurer's eye, have the recent events in the last 1.5 years, 2 years, opened up or thrown a few blind spots for insurance companies in terms of how, insurable risks in such situations should be looked at, what should be included, what should be excluded, and what are these blind spots, because they become equally important for the insured entity as well.
Right. Yes, this is a very interesting question, and see, nobody would expect a war, nobody would want a war, but the geopolitical landscape is certainly shifting, and that becomes very, in these times, it becomes very important for an insured as well as an insurance company to evaluate what is it that we are getting into from a contractual point of view. If you ask what is it, a blind spot that has been discovered by, let's say, an insurance company or insured, certainly insureds have woken up to the fact that no matter where their assets are, they may remain fragile, they may remain exposed to a war-like event. Today in this seamless world, no matter you are a SME, you could be a large company, you could be located far away from the border, you could be impacted in various ways. There are supply chain disruptions that could happen, which could lead to business losses, and hence insurance company and insureds need to be a little mindful of it. Another important aspect that has come to the light is cyber. Cyber risk has certainly taken significance, because in a war-like scenario, in a wartime scenario, non-state actors or even entities outside of India or outside the country where the war is happening, they could look at vulnerable companies, vulnerable organizations where they can breach into and see if they can penetrate and cause some damage. So certainly blind spots have been discovered by the insureds, and they are trying to do their best to see how they can cover. They are reaching out to insurance companies, they are seeking war cover to start with. They are also seeking whether business interruption can be covered. They are seeking whether contingent business interruption can also be covered along with their assets. So yes, companies have woken up to it, and insurance companies are also trying to figure out how they can best provide solutions to these entities.
Mr. Diwan, I want to come to you with one more very important question. In your understanding, as you've been looking at sectors which are opting for such policies, businesses that are opting for such policies, in your experience in the last 2 years, which are the sectors which have emerged as more geopolitically exposed sectors, if I could put it in those words, and how is the insurance strategy evolving from these sectors in terms of taking the best sort of protection against these unknown risks?
See, on the war risk, what happens is there are basically two kinds of assets that are there. The first one is the stationary asset, which are basically the location-based assets. It could be a solar power plant, it could be an onshore oil rig, it could be infrastructure, it could be dams, it could be assets, it could be tunnels, it could be anything, all the assets which are stationary. The other ones could be which are moving, which could be an aircraft or a ship while they are waterborne or airborne. So these are the two kind of exposures that a war, under the war policy, it is covered. But when we talk about the sectors specifically which get impacted, it now actually cuts across all the sectors and everything. Because see, when there is a war, every asset is exposed to that kind of a damage. Whether we talk about the roads that are being built, whether that's owned by a government entity or a private sector, we talk about the solar power plants, and because of, even if we talk on the Rajasthan area, which is very near to the Pakistan border, because of the high radiation levels, there are a lot of solar plants that are there. So they have a higher exposure, all of these companies which are near the borders. At the same time, because of the upgradation of the arms and ammunitions and the countries having long range missiles, these exposures are not only limited to the near border areas, rather it is spread across the country now. Recently, we saw some of the news, as we understand that there were some long-range missiles that were shot in India, and while those were neutralized, but they had the capacity to impact many 100 kilometers away. So it's not necessary that only the near borderline areas should be are exposed to the war risk. It's basically pan-India kind of a thing that we are looking at. And if we talk about how the strategies are being involved in terms of the insurance cover design for the war risk and the political violence, then yes, this has actually been a boardroom discussion for quite some time now. But of late, because of the recent activities, a lot of people have again come back and started exploring these covers.
Well, you spoke about how a lot of these sectors have started coming forward to explore these exact kind of policies, which is against the risk of, wars and social instability. But on that note, let's take a very short break. When we return from the break, we discuss exactly that in terms of adoption from different industries, businesses of this protection against the biggest risk when it comes to, the social and political instability and war-like situations.
CNBC-TV18, the Policy Bazaar Insurance Show. CNBC-TV18, the Policy Bazaar Insurance Show.
Welcome back to the Policy Bazaar Insurance Show. Today we are decoding war risk insurance and what qualifies as an act of war versus terrorism or civil unrest. Let's continue with our conversation. Mr. Nayak, I want to come to you with this particular point. Now this is to understand what is the adoption that you are witnessing when it comes to the on-ground inputs that you get. Sectors like shipping, aviation, cross-border logistics, critical infrastructure. These are the obvious sectors that we can think of which are most exposed to a war risk. What is been the adoption from such sectors? Is it at satisfactory levels according to you, or is it growing at a very strong pace, or does the adoption still lag?
You mentioned sectors such as shipping, aviation. See, these are sectors which have always had a war cover, so to say. Because of the kind of business that they're into, they have assets which are going across the globe. A shipping company which would be sending their vessels or the cargo in their vessels in any part of the world. Likewise, an aviation company, an airline or a private aircraft could be flying across the globe. So they in a way have been exposed to war in different geographies, and war is a cover which has always been in existence. What is important is now they've woken up to the minor details of a war cover. They've also realized that there is a war cancellation clause. So it is a cover which can be cancelled by an insurance company or a reinsurer, giving a notice of 72 hours, 48 hours or even 7 days. So they've realized this and they've started planning for it. Okay, what if there is a breakout and they were to stop doing business? So they've started their business continuity planning exercise in a more serious manner. The other sectors, now they are slowly waking up to the fact that they will also need a war cover. It could also happen in the times to come that it could be almost like a license to operate cover which will be needed by various industries. You could be a net exporter, you could be a net importer. Your supplier could insist that you have a war cover, or your customer, one of the large customers, could insist that, okay, you need to have a war cover in place before I start dealing with you. And that is where companies have now started seeking war as an insurance cover.
Mr. Diwan, I want to come to you with this question. Now, what I want to understand is that how are companies in the border regions or high risk zones being advised to reassess business continuity, and what is the message that you would want to sort of give to these companies which are located at these geographically exposed areas to look at their insurance adequacy?
See, insurance adequacy has always been one of the concerns of the corporates, and we as consultants do help them assess the adequacy of the covers and what exactly should be covered. Especially with the heightened tensions near the borderline areas, this has come up as one of the requirements which people are now exploring. Earlier, it was more on a book to say that yes, there is an exposure and we should look at it, but people were somehow retaining it. Just to assess the whole risk management strategy, what we intend to do is we try and speak to our what the best way to handle that is have a stress test on the policies. When we say stress test, we try and simulate a few things as to what can go wrong on any of the businesses, how would the policies respond to it, and whether they are adequately covered or not. During that test, we do understand, and during that particular risk assessment, we do understand as to what are the transfer mechanisms. We do understand as to what is the retention capacity of any of the companies. Or maybe we can also look at what could be the transfer in terms of the insurance contract and in terms of the transfer by way of the contracts that they sign with their vendors. So during this whole exercise, there is a lot of risk management, lot of understanding that goes into the right kind of a cover and help them decide as to what is the best cover possible. So irrespective whether that's a borderline area or whether that's anywhere in the country, that war exposure because of that recent activity has certainly gained limelight. And that is one of the things that needs to be added into any of the programs for them.
Makes sense. And you spoke about one point which I would take to Mr. Nayak. When we speak about such covers, we've barely sort of reached, businesses in India have barely sort of reached understanding property, fire, insurance, and we're speaking about war covers. Do you think such covers at this point of time are only needed by large corporates and government entities, or do you think it is equally important for SMEs, the small and medium enterprises also, to consider such covers?
Yeah, so Yash, I briefly touched upon this point in my earlier response. You are absolutely right. This no longer should remain a remit only for large corporates. So while the government entities, critical infrastructure, the large corporates, they are in a way more aware than what an SME would be. They are more aware of the covers that would be available if they want to cover war. SMEs may still have to go up the curve. Having said that, the SMEs are also equally exposed to war as an exposure, and slowly we have started seeing even SMEs inquiring about war. See, an SME could be a supplier to a large corporate who would in turn be supplying to the multinationals. Now, even if a large corporate is being forced to buy a war cover, they may also ask an SME company to do it. More importantly, the SMEs could also be located in a range where war could physically affect their assets. Another important point, and that I mentioned earlier as well, is nobody is immune to a cyber risk. An SME would also be looking out for these covers, because in times of heightened tensions, everybody would want all their assets to be covered. And to that extent, I think even the SMEs have woken up to the fact that war cover might be needed by them.
But one final question, and this is to both the guests that we have here on this panel. As we conclude this discussion, let's understand where are we lacking and what needs to be done from this point to make sure the adoption of such covers is more rapid and more widespread in terms of covering SMEs also, larger corporates also, government entities also. To you first, Mr. Diwan, what is that shift that you would want in terms of businesses approaching something like war risk insurance, and what is that one change that you would want out of insurers in this scenario?
See, insurance is finally a spread of the risk, where a lot of people contribute the premiums to make good the loss of a very few who occur. So certainly, once we gain more traction towards the war insurances, the covers would evolve over a period of time. The cyber warfare is something which is something to be looked at. All we'll say is that while we'll have the right strategies and the right policies in place, there are few limited markets available on certain exotic covers, if we may call it. The more the participation, I feel the more would be the evolved covers available to all the corporates.
Okay, same question to you, Neeraj, in terms of the shift required on the side of corporates, small, medium, large, in terms of how they look at something like war covers, and the shift required from the side of insurance companies as well. What would be your take?
Everybody needs to realize, and most companies have now realized it, these events are non-linear. Something that can happen in one part of the world can impact anybody else. They are also hybrid in nature. Now, it's not only physical, it's cyber, it's financial, and also they are not episodic. They can continue for a long time. We've seen conflicts which have been going on for 3 years now. Now, some bit is insurable, a lot of it would not be insurable. So all organizations need to go back to the drawing board. They need to chart out all their exposures, see what is it that they can transfer to the insurance companies, what is it that they can retain, and what cannot be transferred or retained, they'll have to avoid it.
Okay, that's a very important point that you bring up. Planning will be very important from any entity of any size in terms of assessing the risks that we have in a situation, in a potential situation like this thing. What is it that can be transferred? Can be taken by the insurance companies, allowed to be taken by insurance company, segregate that. How much can they retain? What is their risk bearing capacity in a situation like this thing, and what can be left without an insurance? I think that is the most important point made, but it's been a very interesting discussion as always. There's lots that I've learned in terms of a different kind of cover, but a very important one nevertheless, especially what we've seen in the last 2 to 3 years. But with that, it's curtains down on this episode of the Policy Bazaar Insurance Show. A big thank you to all our guests. Neeraj, Amitabh, thank you so much for joining us on this episode of the Policy Bazaar Insurance Show and for sharing your valuable insights. But with that, it's a promise that we'll return soon with another interesting episode, a few more interesting guests, and a lot more interesting views. Till then, stay insured, stay safe.
CNBC-TV18, the Policy Bazaar Insurance Show.
Hello and welcome to News Center. I'm Parikshit Luthra. The decades-long simmering conflict between Israel and Iran has now escalated into a full-blown war, with both Tel Aviv and Tehran training their ballistic weapons on each other. Tehran has said that it has no intention of yielding to international calls for de-escalation days after Israel's surprise attack on Iran's nuclear facilities triggered the worst confrontation between the long-standing enemies. Iran launched a fresh wave of strikes attacking the Tel Aviv city and the port city of Haifa, hours after Israel bombed its capital. At least 8 people were killed. Israeli authorities said that at least 14 people, including children, were also killed in the Iranian strikes over the weekend, as per Iran's health ministry. Over 220 people, mostly civilians, have been killed in Israeli attacks against the country. At least 70 were women and children. The intelligence chief of Iran's Revolutionary Guard and 2 generals were killed in the attacks. Israeli defense minister has warned that that residents will pay the price for Iran's deadly retaliatory strikes. Israel's military said it had hit more than 80 targets in Tehran since Saturday, including the defense ministry headquarters. US President Donald Trump has said that he is hopeful that Israel and Iran can strike a deal. However, he has reiterated that his administration will continue its support for Israel.
Mr. President, can you give us a sense of what you're doing to try to de-escalate the situation between Iran and Israel?
Well, I hope there's going to be a deal. I think it's time for a deal, and we'll see what happens. But sometimes they have to fight it out, but we're going to see what happens. I think there's a good chance there'll be a deal.
The U.S. can continue to support Israel in its defense.
We do, yeah. Thank you very much.
The Iran-Israel conflict is set to be one of the top agenda items in the ongoing meeting of the G7 in Canada. NBC's Alice Barr is here with more on how the G7 is expected to address the escalating tensions in the region.
President Trump is going to be with top allies today at this G7 summit in Canada, and he arrived yesterday with a full plate of issues that he's bringing with him, domestic issues, and then, of course, a lot on the foreign stage to be looking at, with the expanding conflict between Israel and Iran front and center, no question. It comes amid these mounting concerns over a new round of attacks between the 2 major military powers. President Trump saying it's time for a deal to de-escalate, while adding, as you heard there, sometimes they have to fight it out. He promised to keep supporting Israel's defense, though Israeli Prime Minister Benjamin Netanyahu is spelling out a little bit more of what that looks like, saying in a new interview that American pilots are helping shoot down drones headed toward Israel. Iran has threatened to strike American military targets if the U.S. continues that assistance to Israel. Lawmakers are calling that a red line, with many in both parties defending Israel's goal of destroying Iran's ability to make a nuclear weapon, while still calling to prioritize diplomacy. U.S. embassy offices are closed in Israel today as this high-stakes conflict grows. And you're right to note, this is going to be center stage at the G7 conference ongoing. Exactly how the top economies and the top allies that are gathered there figure out how to address this, and whether there's kind of a formal document or statement that comes out of it, certainly is something that we're going to be watching for as really the meetings get underway in earnest a little bit later today.
The Indian embassies in Tel Aviv and Tehran have issued advisories for Indian nationals in the region. Both the embassies have shared hotline numbers and asked the Indian nationals to stay vigilant. The Indian embassy in Iran has also advised Indians to avoid all unnecessary movements in the country. India's foreign ministry has confirmed that the Indian embassy in Iran also relocated some Indian students to safer locations within the country. Parents of some students stuck in Iran have said that they are awaiting a nod from the government to shift remaining students to safer areas.
अभी 12 बजे मेरी बात हुई मेरी बेटी से, मुश्किल से आधे मिनट बात हुई है। उसने बोला कि हमारी एम्बेसी वालों से मैसेज उन्होंने की थी कि हम आपको किसी सेफर जगह पर शिफ्ट करेंगे, आप रेडी रहिए, लेकिन अभी तक नहीं किया। तेहरान में से कुछ बच्चों को शिफ्ट किया गया है और जो शाहिद बीएसटी में पढ़ रहे हैं उनको कुछ को आर्मीनिया शिफ्ट किया गया है, लेकिन जो शिराज या और यूनिवर्सिटी में बच्चे हैं अभी उनको शिफ्ट नहीं किया गया है।
And moving on, Prime Minister Narendra Modi finished his first official trip to Cyprus. The visit is the first ever visit by an Indian Prime Minister to the nation in 23 years. This is also Prime Minister Modi's first international trip since Operation Sindoor. PM Modi met the President of Cyprus, where both the leaders discussed ways to boost ties in trade, energy and defence. Cyprus is set to hold the rotating presidency of the EU Council in 2026. India and the European Union have attempted to speed up negotiations for a free trade agreement. Government sources tell CNBC-TV18 that the meetings are now being held on a monthly basis instead of every quarter. 5 more chapters of the deal have been finalized out of the total 23 chapters. Speaking at the India-Cyprus CEO Forum, PM Narendra Modi also said that the India and the European bloc will finalize a trade deal by the end of this year.
पिछले महीने भारत और यूके के बीच एक एम्बिशियस एफटीए पर सहमति बनी है। अब हम भारत और यूके के बीच फ्री ट्रेड एग्रीमेंट को इस साल के अंत तक संपन्न करने के लिए प्रतिबद्ध है। इसकी नेगोशिएशन में गति आई है। इसका लाभ आप सब साथियों को अवश्य मिलेगा।
All right, let me go across to India's former ambassador to Iran, DP Srivastav, someone who was instrumental in negotiating the Chabahar agreement with Iran. Also, he has served on the board of governors of GAIL and also written a book on Pakistan's ideologies, strategy and interests in the current age. Ambassador Srivastav, thank you very much for joining us. Israel is saying they have now achieved full air dominance over Tehran. What is the current position that we are in as far as the Iran-Israel war is concerned? How would you describe the present situation?
Well, I cannot tell you about the ground situation. That only somebody who is present there can tell you. But it's very clear that Iran still has the retaliatory capacity, because even going by Israeli media, Iranian attack has affected some of the Israeli facilities. So it's not yet a conclusive thing. The second point I would like to mention here is that the Israeli attack took place just on the eve of 6th round of US-Iran negotiations. So the timing was very odd and it raises many questions. And the third is that the attack has resulted in strengthening a sentiment in Iran which may be just the contrary of what Israeli attack was supposed to accomplish. There is a debate going on in Iranian Majlis that the country should exit NPT. I do hope that this does not happen and the war is brought to a quick end and there's a resumption of nuclear negotiations.
Right. Ambassador Srivastav, I would also like to ask you about India's stakes in the region. Our exports to Iran in the year 2023 were around $1.6 billion worth of goods. Could you give us a sense of how many Indians are there in Iran? What is the stake of the Indian industry there? And how could there be a setback? Currently, we believe that a lot of Indians are trying to leave. I think the embassy is also advising citizens to leave as soon as possible. Could you give us a sense of how we are getting impacted directly on in a sort of a people way when it comes to our own citizens getting impacted?
I believe there are about 1,000 to 1,200 Indians there, and this includes about 600 odd students. And I understand that the embassy is trying to arrange for evacuation of these students. There are two different, through land route because the airspace is closed. And there are two different options. One is northwest through Azerbaijan. And the other is slightly to the northeast through Turkmenistan. So it's a very difficult situation because Iran is a large country, so the land route itself will mean traversing something like 600 to 800 kilometers over land before they reach the border post.
Right. Definitely a very difficult situation there. Sir, in terms of the Chabahar port, now this was a critical, probably a cornerstone of India-Iran engagement and cooperation for the future. 2015 is when we had signed an agreement on the Chabahar port. In 2024, we renewed it as a long-term contract. How do you think the Iran-Israel war could impact the cooperation on Chabahar port? And do you feel that has already been impacted over the last few days?
You know, one small correction, that the original agreement which I had negotiated in 2015, that itself was for 10 years, and a contract was signed in the presence of Honorable Prime Minister next year for 10 years. Now,
right.
Coming to the current status, the project implementation has been slow, partly because of the sanctions, and in the current situation, it's simply not possible to carry on work. This will last as long as the hostilities continue and the sanctions continue.
How do you think India-Iran relations are set to suffer a setback because of the current war between Israel and Iran?
We have excellent relations with both the countries. India has taken a measured approach and called for de-escalation. So I don't think that there will be a setback to our relations with Iran, but it is, of course, not possible to carry on normal trade and investment apart from Indians in Iran. In case the war spreads, this will affect the larger Indian diaspora in the Middle East, and there's a larger diaspora of 7.1 million in the Middle East.
Right. What's now the possibility of a larger involvement of the US, of the UK and other Western powers in the war, even though Donald Trump has gone on to say that if there is any attack by Iran on US, then the Iranian people, the Iranian government will feel the full force of US attacks?
I do hope that this situation does not come to pass, because we have to bear in mind that this region accounts for 20% of world's oil supply. The oil prices were on a downward trajectory before the Israeli attack of 14 June. Since then, there has been 7% increase. In case of India, $1 increase in the price of oil adds something like 14,000 crore rupees to India's annual import bill. It will have a similar effect on other oil countries, because even though India is not importing any oil from Iran, and that also applies to other countries, it's in, you know, if the Hormuz Strait is closed, this will affect 20% of world's oil supplies, and there is simply no way that that this can be replaced.
Absolutely, and that is a big worry for India and the world. And it remains to be seen, though many have said that this would be the last resort by Iran to actually shut down the Strait of Hormuz, but the fact is they can do that. Thank you very much, Ambassador Srivastava, for joining us on that big story. We're taking a short break, but when we return, we're going to speak about the GST Council meeting, which will be held over the next few weeks, and what are some of the changes related to compensation cess. Remember, compensation cess had received an extension to 2026, and there's now talk of replacing it with a clean energy and health cess. There is also an issue of rate rationalization. We are going to discuss all those preliminary discussions with Mr. Nagendra Kumar, who has been a member GST earlier. That's coming up. Welcome back. You're watching News Center. The GST Council may consider replacing compensation cess with a combination of health cess and a clean energy cess after March 2026. Sources tell CNBC-TV18 that the group of ministers has reached a near consensus on the matter. The health cess would apply to sin goods such as tobacco products, while the clean energy cess would target items like coal and luxury automobiles. The GOM has almost finalized its recommendations and is likely to present them to the GST Council when it meets before the monsoon session of Parliament. The GST law currently does not permit the introduction of a new cess, so such a proposal would need constitutional amendments as well. Joining me now to take this forward is DP Nagendra Kumar, former member of the Central Board of Indirect Taxes and Customs. Mr. Kumar, thank you very much for joining us. Now, as far as compensation cess goes, sir, this was only a temporary measure for 5 years, and during the pandemic, it was extended because you needed to give that compensation and revenues to states. Extension was till March 2026. Now, if compensation cess is replaced by a health and clean energy cess, wouldn't it go against the original intent of the GST?
Good afternoon. Insofar as the compensation cess is concerned, you are right. The compensation cess was operational for 5 years from 2017 to 2022. And as you're all aware, it got over on 30th June 2022. Now, what is being collected as compensation cess today, and it is expected to be completed by 2026 March, as per the reports available, is basically the compensation payable to the states in terms of the shortfall as against the expected revenue growth. Now, we are also aware that entire compensation cess payable to the states for the first 5 years has since been paid, one, from the compensation cess pool, what has been collected, and also what the central government has borrowed and given to the states way back in 2022. So that fund, what the cess is being collected today, is being used for recouping that loan repayment. Now coming to the continuation of the compensation cess, you are right that the constitutional amendment provided for only the 5 years for which this cess could be collected. Now, as to what should be the way forward, we are all aware that the government has constituted a group of ministers headed by the Honorable Minister of State for Finance, Government of India, under whose leadership the deliberations are happening. Now, I'm not privy to the remarks you have made with regard to the compensation cess is going to be replaced by a clean energy cess or health cess, but I think that's something which is not known to us large. Yes, the deliberations are happening within the government, especially in the GOM, as to what should be the way forward in terms of incorporating this cess which was being collected on those specific commodities going forward. It could be absorbed in the basic rate of the duty, or it could be collected over and above in some form of an amount which we are not very clear about here on date. Yeah.
Right. But do you think, sir, even though the discussions are at very preliminary stages, do you believe that such an exercise is necessary? Because the whole sentiment right now and expectation is for the simplification of the GST. So do you think having two different cesses after this would run contradictory to that sentiment?
Well, I think as on date, I think the cess is being collected on these commodities like motor vehicles, tobacco, aerated waters, things like that. But going forward, when the compensation cess collection comes to an end, let us say March 2026, whether these cesses hitherto being collected as compensation cess, this rate could be absorbed into the basic rate of duty, is one way of looking at things. So that I think the current level of taxation on these goods are continued even post March 2026. That's one option before the GOM.
Right.
The other option is to levy an amount as a GST over and above the basic rate what is being levied. If the committee will have to look into and discuss about this. And I'm not very sure whether you can partake the character of a cess at all, because cess can be used only for a specific purpose in terms of the constitutional scheme of things, and whether it could be used for a general purpose is a matter which need to be examined in detail.
Right. Now, rate rationalization is something that the government is going to be pursuing with different state governments. It needs consensus in the council, sir. But when it comes to rationalizing the rates, if you go ahead with this exercise, will you have to somehow also levy cess or increase GST on certain items, maybe sin goods like tobacco and automobiles, in order to offset that exercise?
Yeah, I think insofar as the rate rationalization is concerned, I think we are all aware that the rate rationalization committee constituted by the GST Council has submitted its interim report way back in 2022, consequent to which a number of commodities on which the inversion was happening were corrected. The rate rationalization committee is in the process of finalizing its report and submitting it to the GST Council, the details of which are yet to be known. But certainly, I think the rate rationalization is one exercise which is independent of this issue which you have flagged it. Now, some of these commodities which are attracting cess today could have a higher rate of tax in the form of absorption to the basic rate itself, and that could be a part of a different exercise, because rate rationalization committee today is under the leadership of the Deputy Chief Minister of Bihar. The compensations this issue which going forward, the way forward, will be under Mr. Pankaj Chaudhary, the Honorable Minister of State for Finance in the Government of India. Now, this could be a part of that committee recommendation which we'll have to wait and see. Yes, rate rationalization, I think it's a matter of the recommendation by the fiscal committee, and thereafter it's examined at the rate rationalization committee, and the recommendations are laid before the GST Council.
Right. Mr. Kumar, now there is also talk and reports that there may be a move to increase GST or cess on tobacco, on sin goods and cars, maybe even luxury cars as well. Currently, if you look at the GST structure on automobiles, especially cars, it's 28% plus 22% cess at a higher level. Do you feel that there is a case for increasing GST on automobiles, especially cars?
I think we need to wait for the recommendations of the Fitment Committee and then deliberations in the GST Council. Any statement at this point would be purely speculative. I would like to speculate on that.
All right. Mr. Nagendra Kumar, thank you very much for joining us. We appreciate the fact that you tried to explain all the nuances, despite the fact that these discussions are at a preliminary stage. Of course, but a lot of things are happening behind closed doors, and there's a lot of feedback coming from the industry, and the government is also seeking a lot of views from different stakeholders. Thanks once again for being with us. With that, it's a wrap on this edition of News Center. More news and updates continue right here.
Europe is starting to spend more on defense after a wake-up call from US President Donald Trump, who has been steadfast in demanding defense spending of at least 5% of GDP. Self-reliance is India's new war cry after Operation Sindoor, and India could be spending or deepening its ties with Russia, along with other nations as well. Sources say that the Indian government is actively considering Russia's Su-57 fighters to expand its fleet. There is no proposal to acquire the American F-35s, at least as of now. From Ukraine to West Asia to civil uprisings in Sudan, Congo, Ethiopia and several other African nations, this is the era of conflicts in many ways, and every country is looking to bolster its defense resources. Hello and welcome to our brand new series, the CNBC-TV18 Editors Playbook. Each week, our team of editors puts the spotlight on some of the most compelling events and stories that are playing out across the world, and we try and decode what these events could mean for all of us sitting here in India. I'm Surabhi Upadhyay, and with me, as always, editors Prashant. Of course, Nimesh is here with us. We have Sriram here with me in the Mumbai studios, and joining in, of course, is Parikshit from New Delhi. Gentlemen, it's a great conversation that we're having, and we are revisiting defense in a matter of, just 2-3 weeks, right? The first editor's playbook was on India's defense might and what we're doing because Operation Sindoor had just happened. And now we realize that, it's conflicts everywhere, and who knows? The latest headlines as we walked into this show is that Iran could be the latest flashpoint. So never a dull moment, Prashant.
Never a dull moment, guys. And glad that we're all together again, although we're missing Shireen.
Yeah.
But I think, if you think about it, is it so much about newer conflicts or is it preparing for potential conflicts? I think it is the latter, right? And I think that if you kind of go back, maybe take 2 steps back, that that preparation is coming because of this changed the potentially changed world order.
Call it offense budget, not defense budget.
Exactly. No, but where is it coming from? It's coming from the fact that US is withdrawn. US was always there as this, big daddy. Keeping order. Everybody stay in your own lane. And now America is saying, well, I want to mind my own business. So
you guys take
other NATO members, you guys
figure out your own way.
It's in a way free for all. So actually, in terms of newer conflicts, not so much, but it's just preparing for what may happen because you don't have that one single entity which was like the center of, all of this, which kind of kept order, which is not there.
And, contrary to what the big expectations were in the run-up to his inauguration, the 2 major flashpoints in the world, those 2 conflicts, there's no sign of a resolution, whether it's, Ukraine and Russia or even the Middle East. Whatever's happening with Israel and with,
upside of having a bully in the room is only the bully can start a fight. So they can go to Iran when they want to, they can go to Afghanistan when they want to, but they won't let others. But now it's a free-for-all market.
No, absolutely. And, let me just set this up with a couple of points. And I think it's exactly, I'm just going to repeat pretty much what we're talking about. How US is now asking, and I thought, by the way, that US is only asking Europe. That security blanket which US provided for 50, 60 years, US weapon system placed and pointed towards Russia, but on European soil. But now, US is saying either you pay me for what the services I'm providing or you do your own stuff, right? And but it's not just Europe; it's countries in Asia as well. So there was a security conference, the Shangri-La Security Conference. Parikshit, of course, was covering that, and the US Defense Secretary has delivered pretty much a forceful call for Indo-Pacific allies to sharply increase their defense budgets. That 5% number of spend 5% of your GDP is not just for Europe; it's for Asian countries as well. So that same thing he's asked Asian countries, Indo-Pacific allies to do as well. Commit 5% of GDP to defense spending, and of course aim to counter a real and potentially imminent threat from China. That's the some would say the rivalry with Russia is a thing of the past. It's China, which is the conflict of the future in that sense. I just looked at numbers in terms of what Asia spent so far. Asia spent about 2% of GDP on defense on an average in 2024. And you're saying you add another 3% on top of it to a potentially larger GDP, hopefully. So you're talking about very, very large.
It has a vested interest in saying that, right? You increase the budget, where will you buy it from? It's either from US or Russia?
Hopefully not. We'll make it. But that will come to, right? But military, and again, military expenditure in East Asia, this part of the world, rose 8% in 2024. It was the biggest year-on-year increase since 2009. And it hit about $450 billion. But that is at 2%. All right, I mean, we're talking about 5% potentially. I mean, if this warning is this, if countries start to spend a lot more. And of course, there is the European thing. It's the same thing. Spend 5% as new spending target. There is a NATO summit which is coming up in the middle of June.
That's going to be very important.
And I think in that, some of these things will be finalized. And again, there we're talking about if countries start to spend 5% instead of actually Europe spends even less than Asia, surprisingly. But if they get to 5%, we're talking about almost 700-800 billion euros.
That's the irony of Europe, right? They get to call themselves like a very chill place, very developed. Work-life balance, all kinds of progressive thoughts, because you don't have a defense budget. You didn't have to have one for decades. You could spend on, Autobahn.
Security blanket.
Correct.
Which,
so I was looking at some numbers and data points. And I'll come to the rest of it later, but this is just a quick snippet before we get to Parikshit to understand what India's been doing. So India's defense spending today, and this is numbers as per the World Economic Forum and the Stockholm Institute for Peace Research. So according to that, our defense spending as of 2024 is more than Germany, it's more than the UK, and it's increased many-fold. In fact, if I could just...
One of the biggest military powers
so I
by
looked at the delta over the last decade in terms of how the top 5 or 6 spenders, how much are they spending more? So from 2014 to 2024, this is a percentage change that I'm just going to quickly throw out. For US, that increases 54%. For China, it's 72%. So US is still the largest, with $997 billion, roughly rounded off, is what they're doing. China comes in at number 2, 313 billion, and their spends in the last decade have gone up 72%. Russia's increase is also 76%. Germany has doubled its spend. In 2014, it was just about 44 billion. Now it's almost 88, 89 billion dollars. And then kind of we come in at roughly $86 billion. This is 2024 data. Of course, numbers for calendar year 25 would be very different, and 26 it'll be very different as well. Parikshit, in fact, talk about this and...
Surabhi, just one thing. US, you said US number 1, right? I think US outspends, if you add the next 9 combined, US outspends
absolutely.
them.
And the distance is so, we're talking almost $1 trillion, and the next is China at 320
that shows
billion.
up everywhere, even in terms of the top market cap companies in the US, in terms of defense and all. It's all US.
And by the way,
in terms of spend, in terms of market cap, everywhere.
We're not look after yourself. It's not as if that $900 billion is going to come down. It's only, if you look at what has been proposed, they're looking at significantly expanding defense spending. So that's the other thing.
Absolutely. But for us, of course, we've been taking big strides. And again, if I go back in time, again, same sort of resource that I looked at, the Stockholm International Peace Research Institute, in 2000 at the...
CIPRI, right?
Yeah, it's easier. I don't know how many people would understand CIPRI.
You've done that. You've done the hard work once.
It sounds like Shimli.
Exactly. So I was like, CIPRI. People will not know what is the CIPRI she's quoting. But anyway, at the turn of the millennium in 2000, our defense spend, was a small trickle. It was about 14.5 billion. Now we're talking 86 to 87 billion. So we've come a long way in the last 2.5 decades, but there's a long distance to cover as well. So let me get to Parikshit, because Parikshit's the one that's been telling us. And Parikshit, we're so, we are being wooed by international powers. It feels good, right? The Americans want us, the Russians want to do business with us. Of course, we've been buying from the French as well. So what's the latest as we continue to build on our, our defense arsenal?
One thing is for certain, the defense budget has been increasing significantly year on year, and we are going to see a significant increase in the next year's budget as well, especially the capital acquisition part. But what is more important is how they will structure it. And the big focus right now of the government, according to sources, is to have domestic capabilities and capacities to have drones, combat drones, early warning systems, satellite imagery, and be ready for new age warfare. So this seems to be the big focus of the government on how to make sure that the private sector can buy technologies from abroad or develop them, collaborate with DRDO, and make these combat drone technologies in India itself. As far as the total procurement from the private sector goes and from the public sector, we're learning it could be in the range of 2 lakh crore in FY26 or even more. And it's in line with what had happened last year as well. You're very right that there are different countries wooing India right now, and Israel is one of them, which is leading right now, and they are looking to partner with many companies in the private sector in India to make domestically, because co-production, co-development is the focus for India. Now, let's start with the United States. US wants to sell F-35s to India. India has not really considered and is not looking at buying F-35s from the United States, and this is probably because we have never got the kind of weapons platforms or the weapons package we wanted from the US. Russian Su-57s are being considered because Russia will offer you technology transfer. It's ready to make in India, and there is already an existing Su-30 line in Nasik. At the same time, we want to see whether a collaboration with Safran or Rolls-Royce for making fighter jet engines in India can be a reality as well. And both these companies are the only ones giving full technology transfer and IP transfer as well. Then you've got the AMCA program, the Advanced Medium Combat Aircraft, our own 5th generation fighter development program. And we've opened this up. Next week, a request for proposal would be issued. So there is a three-pronged strategy that the government is implementing. Now, going back to the United States, we're looking at diversifying our military strengths across Russia, across Israel, France, Sweden, and the US. And for example, with the US, we are considering making and also buying Stryker land combat vehicles. We're thinking of buying more Javelin vehicles, Javelin missiles from the United States as well. But there is also a concern that many of the contracts that the US and India have had, such as Apache, Romeo, F-404 engines, all of them are running behind schedule. So there is a hope that while we will buy more from the US, hopefully all the defense contracts, the timelines will be honored in the months and years to come.
If you look at the last 30 years, all the wars that we've seen around the world, there are two trends that are very visible. One is nobody goes to war with an equal, right? It's only a weaker power gets bullied, and it's pretty much a sort of, a proxy war for something else that is at play. And the second trend is that even if it is a weaker power, A, it does not guarantee submission, B, the result is not what you desire. On paper, US could have thumped, Afghanistan or Vietnam or any other. Russia can, gobble up Ukraine in a day. Israel and Hamas are no match for, Hamas is no match for Israel. But the result is not exactly, it's not a walk in and win the war, right? Nobody storms into the capital and takes over. So that really makes me ask the question, is offense really the best form of defense anymore?
Defense is the best form of offense. Therefore, I turn it on its head.
So I have a point here. I think the deterrence, if at all, any, will come in three forms. Deterrence does not have one D. It works better with three Ds. Debt, demography, and diplomacy. Debt and demography are already in favor of deterrence. Most countries which can afford to go to war have more debt than national income. And most of them are aging societies. So if they want to increase their defense budget, the money has to come from somewhere. And it is coming out of healthcare, environment. Climate action is possibly more important now than ever before. You don't need to wait for China to come and bomb you or US to come and bomb you. The sun will do it. So in such a situation, if the money is going to be, and aging societies need more healthcare, not less of it. So so debt and demography is already against war. It's an impediment to war, and it's going to be increasingly so in the coming years. Diplomacy is what is missing in an era of alpha males running governments everywhere. I think diplomacy, the art of diplomacy is required. Maybe the so-called global south can take the lead, form a new something like a non-aligned movement, build a coalition. I think a coalition. See, what is stopping China from taking over Taiwan? The only uncertainty is how will US react, right? Otherwise, Taiwan is no match. So such coalitions need to be built than building up defense arsenal or budget side.
to us.
But Nimesh, I mean, you know, with so much money that's flowing into defense, what are the valuations looking like? I mean, is there a bubble there?
So, okay, a bubble or no bubble, only time will tell. But let me put into like context as to what defense is all about and what kind of market caps companies command and where India stands in that global setup, right? So, first look at the top 5 big market cap companies in the world. 3 are from US, 2 are from France. So, which obviously, you know, explains what it is. So, the biggest market cap company in the world currently is General Atlantic. It commands a market cap of $270 billion. Wow. And guess what? You know, we talk about bubbles at 50, 60, 70 times. GE is trading at, on a 5-year average PE of 266 times, 288 times.
5-year forward PE?
5-year average PE.
Average, okay.
5-year average PE is 288 times, almost 300 times. So that's what GE commands currently right now. Okay, that's the biggest market cap company in the world.
Somebody at the peak of the pandemic said there is going to be a war.
So the second big company, again from US, is RTX Corp. That commands a market cap of $190 billion. Third is Boeing, commands a market cap of $164 billion, followed by Airbus from France, $150 billion. And Safran is the other France company which commands a market cap of close to $130 billion. So these are the top 5 in terms of market cap companies. Come to India now. The biggest company in the country right now in terms of market cap is HAL. Trading it's commanding a market cap of $40 billion. So it's still 1/3 of what the 5th largest market cap company in the world is. Forget you're comparing to GEs of the world, but
it starts delivering on time, maybe it will get a better premium.
Well, and it will, right? But again, at a $40 billion, it's still quoting at almost 20 times on 5-year average. It's not very expensive or like a bubble kind of a territory. So that's the first name. The second big stock within the defense in India is BEL. That commands a market cap of $33.5 billion. Then you follow Mazgaon Dock, Bharat Dynamics, Garden Reach, all between $4 to $16 billion. So as I said, the biggest company in India right now commands a market cap of $40 billion, which is compared to your
multiple
of 20 times on a 5-year average. So there is a lot of room
even the
for multiples to upgrade and even the market cap to go up. So it's not a bubble kind of a thing, so to speak. But I also talk about the top 5 most expensive companies in the defense space in terms of where they trade in terms of PE. Of course, GE I spoke about 288 times. There is a company called Aero Windrow. That is quoting at a valuation of close to 185 times. There is a company called Evic. That is at 113 times. Then there is a company called AECC. That is commanding, that is trading at a multiple of close to 110 times. So there are companies in the defense space trading over 100 times to all the way up to 288 times, which GE is commanding. So as far as India is concerned, the problem is not with the HALs and BELs because they're going to get orders, they're going to go big, and they will expand the PE as well. The problem with a lot of the companies in India currently, Shriram, is there are a lot of smaller companies which are just talking about being into defense, but the contribution to defense is very minuscule. So from an investor point of view, one needs to be careful about the smaller defense
differentiating the wheat from
using
the chaff.
defense
The thing is, if you I went onto the websites of a lot of the smaller companies. Some are obscure, some are unlisted, some are listed. So the thing is that phrases like systems integrator, they become catchphrases, and you will find them.
Drones.
Supplier, key systems integrator, facilitator.
Comes and fixes the radar.
Yes, all that we are talking about.
They're being used very, very loosely as well, and that's where investors also need to be cautious.
When you spoke about drones and everything, Idea Forge got listed last year, and from there it's half.
Oh, okay.
It's half or more than half.
Idea for absolutely. It's
and it came at some crazy valuations, and then people realize, after a year.
Yeah. Nimesh, but from the last time we did our show,
it started going up after our last show.
Right. It will. So
because I think they're now looking at getting into, so they got into civilian drones in a big way, but I think they're looking to get back into defense.
No. So I think what happened is after that the Ukraine Trojan horse attack happened.
Yeah.
So the
and then they realized what is the power of
drones.
Yeah.
I think that's the difference.
By the way, I'll say one more thing. Nimesh's data on stocks, etc. Korean defense companies, for example, I mean, they are some of the best performing stocks in the world this year. I was looking at companies like Hanwha, HANWHA. Yeah. There's Korea Aerospace, all listed companies, and I think there's one more. I mean, they're all up 150, 200%. So when we look at stock performances in India and kind of say, well, worry, you I think have a rally
in fact,
around
there are
the
a lot
world.
of global fund managers who look at global portfolios. they've started looking at defense companies globally, including India.
Yeah.
And they are looking at opportunities and where there is an opportunity to invest and which company is still trading at a decent multiple. I spoke to somebody who runs a very large EV, emerging market mandate, and he was like, "We missed out on the defense play in India. Now we're looking at very
I spoke to Rajiv Jain, the largest FI in India, and he said, "Well, I missed out." I mean,
Right.
so
Everybody
you kind of
So I think what the events of the last month and a half have done is that they have firmly established that defense in India, maybe not, that's always up for debate, but they firmly established that the defense sector in India is way beyond just being a market narrative.
Yeah.
It's real, it's here, it's growing, the direction is just up in terms of spends and the kind of business opportunity that's out there.
But like you said, the companies will also have to prove themselves.
That is true.
I mean, including HAL, even after this Operation Sindoor and all the narrative, we had the Indian Air Force chief coming again saying that there is a reliability problem.
Yes,
right? I mean,
and delivery is the
correct.
issue.
And even if you want to buy from Russia or wherever.
But the delivery issue is not only because of HAL's problem, it's a problem of they not getting supplies from
GE
I'm saying, or
at the end of the day, it's a supply chain.
So just to quickly also to talk about this, I get just some numbers to throw up again. So the domestic defense production in 2024, FY24 was 1.3 lakh crores. Which was a gigantic increase over the last couple of years. Now the target is that from 1.3, we should move to at least 1.6 lakh crores this year in FY26. The export target for the current fiscal year is 30,000 crores. The last available number was around 21,000 crores. So I mean, the exports are also moving higher, domestic of course.
Yeah.
Right now, I think rough estimates, going by a lot of the reports that I read, 70% of our needs are being met domestically or with some of the co-production, a lot of the co-production that's happening, whether it is for, the Su-30s, etc. Going forward, the countries that are showing interest in buying from India, and I think that's the next piece of the opportunity. And again, I don't think that's something that's just up in the cloud. I think it's getting real, but which companies prove themselves is the critical question. So you have the Pinaka multi-barrel rocket system, Akash. I mean, it's become a big name on the global map, right, after Operation Sindoor. The Dornier aircraft, then there are, of course, the regular stuff, which is your radars, armored vehicles, artillery guns. Bharat Forge always talks about the opportunity that they're looking at in the international markets as well. And then simulators and, the avionics and the electronics opportunity. So it's there, but who will capitalize on it? Which will be the winners and the losers? I mean, the big marquee players, like you also said, BEL, HAL, Bharat Dynamics, that we know.
But the others...
Beyond that, who are the others?
I just want to bring in Parikshit. Parikshit, so Europe is going to spend a lot more. And when we speak with listed defense companies, we always ask, is there an opportunity where you can supply something? Export is an opportunity. Is there anything you've picked up, Parikshit, on that particular front? There is also the other angle, right? I mean, while we do business with everyone, but we're traditionally allies with Russia. And there is the big conflict is Russia-Ukraine. So is that a factor at all? I mean, do you hear anything on that front?
Well, India is definitely looking to become a big defense exporter in the world. So, for example, in the last fiscal, our defense exports were almost to the tune of 24,000 crores. We want to have 50,000 crore worth of defense exports from India by 2029 or 2030. So there are about around 70 to 80 countries where we import items to. This includes defense components and defense platforms also. What India is trying to do, one, is also showcase BrahMos to more nations. We're already offering and supplying BrahMos to some nations in South Asia. We're showcasing the Tejas aircraft quite heavily to countries in South Asia. And anybody who is interested, Africa would be one country where we would really like to increase our defense exports. But, a lot of this comes back to the fact that how much of these platforms is India also using? Because when you go abroad, you're always asked the question, how much of this is battle tested? And that's why when we saw indigenous missile systems, air defense systems like Akash being used very heavily, that somehow has improved India's image, so to say, as a defense supplier. And the government believes that in the months and years to come, there will be more inquiries to that effect. But this is probably one reason why we're focusing a lot on indigenization and improving the capability of our defense equipment, is because whenever you go abroad, every country or armed force would ask you how much of this is being used by your own armed forces, how much of this is being tested in combat. And now many of our air defense systems have been used quite extensively during Operation Sindoor, and we saw that as part of the air defense shield. But the big factor for India, and I'm going to say this again because we're going to see a greater push for this in the next few months, would be on drones, on new age warfare. How much of that capability that we can develop here in India, and even listed entities, companies that are going to benefit are those who can deliver on those contracts in shorter timelines. We're going to see a defense acquisition procedure rules being revised. Expedited licensing procedures will be brought in. So companies which can deliver on high technology platforms in shorter periods, can get technology from abroad, can co-develop and manufacture in India, they are the ones who are likely to gain.
And Parikshit, you're not talking about the smaller drones, right? What you're talking about is like what do you call, Predator program? Raptor drones, those things which can stay up in the air for...
We would need both.
Both, okay.
We would not need both. We would need high stealth drones as well, which are drones like suicide drones, or drones which we can use to carry out deep strikes.
That was one of the most effective ones during the Sindoor one.
Yeah, and you would also need swarm drones. We saw swarm drones being used between India and Pakistan. You've seen their use in Ukraine, Russia as well. Yeah. You will need those low-cost drones which you can use in large quantities in any kind of warfare situation.
With that, it's curtains on this edition of Editor's Playbook. From all of us here, thank you very much for watching. See you again soon.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. Israel and Iran trade fire for the fourth day. A new wave of Iranian airstrikes target Tel Aviv and Haifa. More than 220 people have died due to Israeli strikes across Iran in the last 4 days. US President Trump hopes for a deal between Israel and Iran, even as he reiterates firm support of Tel Aviv. Reports suggest Trump rejected Israel's plan to kill Iran's supreme leader. India moves to relocate students studying in Iran's universities. 4 days since the devastating Air India plane crash, grieving families wait for bodies as DNA matching continues. 90 bodies identified so far. Mortal remains of former Gujarat Chief Minister Vijay Rupani, who was on the flight, returned to his family. Strong start to the week on Dalal Street. Sensex gains nearly 700 points. Nifty moves closer to 25,000. Bank stocks lead the rally. Oil prices remain firm with Brent crude trading above the $73 mark. GST Council likely to consider replacing compensation cess with a combination of health cess and a clean energy cess. Sources say group of ministers largely favour hiking the cess on cars and tobacco products to shore up revenue. 21 India-based companies awaiting licenses from China to import rare earth magnets. Times of India reports the number of companies awaiting clearance has doubled in the last 2 weeks. 4 people are dead and dozens injured after a bridge marked as unsafe collapses in Pune. Authorities end operations after rescuing 51 people. Opposition targets the state government, demands accountability. World leaders set to gather in Canada for the G7 summit amidst Middle East tensions and the Ukraine war. Prime Minister Modi holds bilateral talks with his counterpart in Cyprus before travelling to Canada for G7. Supreme Court advocates criticized the Enforcement Directorate for issuing summons to Arvind Datar in connection with legal opinion given to Rashmi Saluja and the Religare ESOP's case. The summons were withdrawn later. Advocates call the ED notice unwarranted, say it reflects a disturbing trend of executive overreach that threatens the legal profession. Heavy rain batters several districts in Maharashtra, where the department issues a red alert for Raigad and orange alert for Mumbai and adjoining districts of Thane and Palghar. 18 people have reportedly died in rain-related incidents in the state in the 24 hours, up to 11 this morning. The top story we are tracking this evening, the decades-long simmering conflict between Israel and Iran has now escalated into a full-blown war, with both Tel Aviv and Tehran training their ballistic weapons on each other. Iran launched a fresh wave of strikes attacking Tel Aviv and the port city of Haifa, killing at least 8 people. Tehran has said that it has no intention of yielding to international calls for de-escalation. Days after Israel's surprise attack on Iran's nuclear facilities triggered the worst confrontation between the long-standing enemies. As per Iran's health ministry, over 220 people, mostly civilians, have been killed in Israeli attacks against the country. At least 70 were women and children. The intelligence chief of Iran's Revolutionary Guard and 2 generals were killed in these attacks. Israeli defense minister has warned Iran that the residents will pay the price for Iran's deadly retaliatory strikes. Israeli authorities said that at least 14 people in the country, including children, were also killed in strikes over the weekend. Israel's military said it had hit more than 80 targets in Tehran since Saturday, including the defense ministry headquarters. The U.S. embassy in Tel Aviv suffered minor damage from the force of Iranian missile strikes. The U.S. ambassador to Israel confirmed that none of the staff suffered any injury. U.S. President Donald Trump has said that he is hopeful that Israel and Iran can strike a deal. However, he has reiterated that his administration will continue its support for Israel.
Mr. President, can you give us a sense of what your two ways to slide to de-escalate the situation between Iran and Israel?
Well, I hope there's going to be a deal. I think it's time for a deal, and we'll see what happens. But sometimes they have to fight it out, but we're going to see what happens. I think there's a good chance there'll be a deal.
The U.S. continue to support Israel in its defense.
We do, yeah. Thank you very much.
The Iran-Israel conflict is set to be one of the top agenda items in the ongoing meeting of the G7 in Canada. NBC's Alice Barr is here with more on how the G7 is expected to address the escalating tensions in the region.
President Trump is going to be with top allies today at this G7 summit in Canada, and he arrived yesterday with a full plate of issues that he's bringing with him, domestic issues, and then, of course, a lot on the foreign stage to be looking at, with the expanding conflict between Israel and Iran front and center, no question. It comes amid these mounting concerns over a new round of attacks between the two major military powers. President Trump saying it's time for a deal to de-escalate, while adding, as you heard there, sometimes they have to fight it out. He promised to keep supporting Israel's defense, though Israeli Prime Minister Benjamin Netanyahu is spelling out a little bit more of what that looks like, saying in a new interview that American pilots are helping shoot down drones headed toward Israel. Iran has threatened to strike American military targets if the U.S. continues that assistance to Israel. Lawmakers are calling that a red line, with many in both parties defending Israel's goal of destroying Iran's ability to make a nuclear weapon, while still calling to prioritize diplomacy. U.S. embassy offices are closed in Israel today as this high-stakes conflict grows. And you're right to note this is going to be center stage at the G7 conference ongoing. Exactly how the top economies and the top allies that are gathered there figure out how to address this, and whether there's kind of a formal document or statement that comes out of it, certainly is something that we're going to be watching for as really the meetings get underway in earnest a little bit later today.
The Indian embassies in Tel Aviv and Tehran have issued advisories for Indian nationals in the region. Both the embassies have shared hotline numbers and asked the Indian nationals to stay vigilant. The Indian embassy in Iran has also advised Indians to avoid all unnecessary movements in the country. India's foreign ministry has confirmed that the Indian embassy in Iran also relocated some Indian students to safer locations within the country. Parents of some students stuck in Iran have said that they are awaiting for government to shift remaining students to safer areas.
अभी 12 बजे मेरी बात हुई मेरी बेटी से, मुश्किल से आधे मिनट बात हुई है। उसने बोला कि हमारी एम्बेसी वालों से मैसेज उन्होंने की थी कि हम आपको किसी सेफर जगह पर शिफ्ट करेंगे, आप रेडी रहिए, लेकिन अभी तक नहीं किया। तेहरान में से कुछ बच्चों को शिफ्ट किया गया है और जो शाहिद BSc में पढ़ रहे हैं उनको कुछ को आर्मी ने शिफ्ट किया गया है, लेकिन जो शिराज या और यूनिवर्सिटी में बच्चे हैं अभी उनको शिफ्ट नहीं किया गया है।
And staying with tensions in the Middle East, Israel has killed at least 60 Palestinians in the last 24 hours. Out of these, around 17 were killed after the military shot at people who were trying to seek help at aid sites in Gaza. Medics in the region said that another 10 other aid seekers were reportedly killed and more than 50 injured in southern Gaza. Well, it's been 4 days since the devastating Air India plane crash in Ahmedabad. A team from Boeing has arrived at the crash site. They will join a team of 10 officers from the US National Transportation Safety Board and the Federal Aviation Administration. Both black boxes have been retrieved from the aircraft. Grieving families are waiting for the bodies of their loved ones as DNA matching continues. My colleague Madiha Mujawar joins us from outside the Ahmedabad Civil Hospital. Madiha, how many victims have been identified so far?
Well, outside the mortuary complex here in the Ahmedabad Civil Hospital in Gujarat, families continue to wait for their turn, continue to wait for the call from the hospital to come and collect the mortal remains of their loved ones who were on that ill-fated plane that tragically crashed on the 12th of June. As per medical authorities, over 90 DNA samples have matched and over 60 bodies have been released, one of which was former Chief Minister of Gujarat, Vijay Rupani. His mortal remains were handed over to his family in the afternoon. The coffin was covered in the Indian flag and Chief Minister Bhupen Patel paid his last respect. Hospital authorities are refusing to confirm a number on how many bodies have been recovered from the crash site and how many DNA samples have been collected so far. But what we know is many people continue to be missing. Rescue workers are even today discovering and pulling out body parts from the crash site. The DNA samples are as I said, the 90 DNA samples have matched. Besides the 241 passengers, there were many people present in the area during the plane crash. The hostel building is where many students were having their lunch. Then there were many people who were on their bikes, in their cars, walking in and around the hostel building. So there are many people who continue to be missing, and the final number on the death toll, the casualties, could be much, much higher. There were also 61 foreign nationals on that plane, and none of the family members have come to give their DNA samples so far. We've been told that they will arrive either this evening or tomorrow morning, but DNA samples of the foreign nationals have not been collected so far. And we also have to understand that the bodies were severely burned, so if the samples are not collected immediately, then the DNA testing process might even get more complicated. For now, these families are waiting for their turn to get into the ambulance and begin their most painful journey to spend time with the mortal remains of their loved ones.
Right. Thank you, Madiha, for these updates. Let's shift our focus to the day's market action now. Sensex and Nifty started the week on a strong note, clocking all-round gains today. The market regained Friday's losses with Nifty back above the 24,900 mark. Broader markets also saw sharp recovery from intraday lows, with Nifty mid-cap index gaining more than 1,000 points. 46 out of 50 stocks ended in the green, led by financials and Reliance Industries. Crude oil prices remained largely steady, holding on to gains from Friday as the Israel-Iran conflict increased concerns over oil exports from the Middle East. The latest strikes have stoked concerns about disruptions to the Strait of Hormuz, the strait through which 20% of the world's total oil needs pass. Meanwhile, gold prices surged to the fourth straight session to hit a near 2-month high. The fears of a wider regional conflict have given a boost to the demand for safe haven assets. India's wholesale price index declined to a 14-month low of 0.39% for the month of May. This is the third consecutive month of decline. The drop was primarily driven by sharp decrease in prices across key categories, including food, fuel, and primary articles. India's trade deficit for May 2025 narrowed to $21.88 billion from a 5-month high of $26.42 billion in April. This is also lower than the year-ago figure of $22.09 billion. Merchandise exports in May fell 2.2% on year to $39 billion, while imports fell 1.76%. The Commerce Ministry said that exports of electronic goods and pharma surged during the month. Commerce Ministry also says India is engaged with China on the import of rare earth magnets. China has restricted the exports for all countries, but some relaxations have been made for companies in the US and Europe. 21 India-based companies are awaiting licenses from China to import rare earth magnets. Times of India reports the number of companies awaiting clearance has doubled in the last 2 weeks. The shares of Tata Motors slipped in trade today after its British subsidiary Jaguar Land Rover trimmed its FY26 forecast. The company expects its margin to be between 5 and 7% for this fiscal. This is in comparison to the 8.5% margin it reported in the previous financial year. The company had reported a free cash flow of 1.5 billion euros in the previous financial year. However, it sees the number close to zero in the current financial year. The GST Council may reconsider replacing compensation cess with a combination of a health cess and a clean energy cess. Now, sources tell CNBC-TV18 that the group of ministers largely favor hiking the cess on cars and tobacco products to shore up revenue. A compensation cess is an additional levy on specific goods to compensate states for loss of revenue they are likely to have suffered when the GST regime came into existence. Now, Timsy Jaipuria is here with more. Timsy.
Well, the upcoming GST Council meeting could consider the proposal of replacing the current compensation cess with two new cesses, health cess and clean energy cess. That's what sources indicate, but this can happen only through the GOM process. The GOM on compensation cess, currently headed by MOS Finance Pankaj Chaudhary, is likely to have its final meeting, in which sources indicate that they are likely to come to a conclusion to proposing these two new cesses. Once this proposal is finally drafted by the GOM, it will go to the GST Council as a recommendation of the GOM, upon which the Council will deliberate and then decide whether this should be the roadmap ahead, because current compensation cess is ending on 31st March 2026. The goods on which this cess will be levied, that is the two new cesses which is being proposed, will remain the same: tobacco products, aerated drinks and cars. The overall incidence after replacing the current compensation cess with these two new cesses is also, sources say, might remain the same, because the government does not want to increase the tax incidence, because these are commonly used items and though considered as luxury or sin goods, but still overall tax incidence is likely to remain the same. Now, what happens, because currently the law does not permit to introduce any new cess or any cess under the GST regime. Thus, there needs to be an amendment to bring any new cess or any cess under the GST regime via moving amendments in the Constitution Amendment Bill, which had paved the way for having a new indirect tax regime, that is GST, way back in 2017. So that needs to be amended to bring these two new cesses. Now, what is to be seen, whether government decides to chart this particular path or keep these two new cesses under the indirect tax regime, just like agriculture infra development cess or road and infra cess, which is separately accounted for and not under the GST. Something that we'll have to wait and watch for.
Right. Thank you, Timsy, for that. On that note, it's time for a short break. Coming up next, the Supreme Court advocates criticized the Enforcement Directorate for issuing summons to Arvind Datar in connection to legal opinion given to Rashmi Saluja and the Religare ESOPs case. More on that when we return. Welcome back. A quick look at other headlines. A 57-year-old man suspected of killing Democratic lawmaker Melissa Hotman and her husband in Minnesota has been detained by the police. The arrest followed 2 days of manhunt. As per the police, the suspect was armed at the time of his arrest in a rural area of Minneapolis, but gave himself up peacefully when challenged. The suspect is also alleged to have shot and wounded Democratic State Senator John Hoffman and his wife. Both are now in hospital. Prime Minister Narendra Modi finished his first official trip to Cyprus. This visit is the first ever visit by an Indian Prime Minister to the nation in 23 years. This is also Prime Minister Modi's first international trip since Operation Sindoor. He met the President of Cyprus, where both leaders discussed ways to boost ties in trade, energy and defence. Cyprus is set to hold the rotating presidency of the EU Council in 2026. India and the European Union have attempted to speed up negotiations for a free trade agreement. Government sources tell CNBC-TV18 that the meeting is now being held on a monthly basis instead of every quarter. 5 more chapters of the deal have been finalized out of the total 23 chapters. Speaking at the India-Cyprus CEO Forum, Prime Minister Modi also said that India and the European bloc will finalize a trade deal by the end of this year.
पिछले महीने भारत और यूके के बीच एक एम्बिशियस एफटीए पर सहमति बनी है। अब हम भारत और यूके के बीच फ्री ट्रेड एग्रीमेंट को इस साल के अंत तक संपन्न करने के लिए प्रतिबद्ध है। इसकी नेगोशिएशन में गति आई है। इसका लाभ आप सब साथियों को अवश्य मिलेगा।
A helicopter carrying pilgrims from Kedarnath crashed yesterday, killing all 7 people on board. As per preliminary analysis, the aircraft went down due to bad weather in the Rudraprayag district of Uttarakhand. The tragedy was the 5th incident on the same route in 6 weeks. Uttarakhand Chief Minister Pushkar Singh Dhami called an urgent meeting and ordered full investigation into the matter. 4 people are dead and dozens have been injured after a bridge that was marked unsafe collapsed in Pune. The National Disaster Response Force have called off operations after rescuing 51 people. Officials have said that the iron structure collapsed after it was overcrowded by tourists who ignored the warning board at the spot. Heavy rain battered several districts in Maharashtra. The Met Department has issued a red alert for Raigad and orange alert for Mumbai and adjoining districts of Thane and Palghar. 18 people have reportedly died in rain-related incidents in the state in the 24 hours up to 11 this morning. A gas leak in a well of an ONGC plant in Assam's Shivsagar district has entered 4th day. Officials have said that 70 families have been shifted to a relief camp around the area. Company Director Vikram Saxena reached the spot on Saturday and a team led by him took operational control of the well. Reports have indicated that the well has not caught on fire yet and no one has been injured so far. The government has issued a notification that India's 16th census with caste enumeration will be conducted from the 1st of March in 2027. The census would be conducted in 2 phases. Phase 1 will be house listing operation, in which details of housing conditions and assets will be collected. Meanwhile, the second phase of population enumeration will involve the collection of socio-economic details. The Supreme Court advocates body has lodged its strong protest against the Enforcement Directorate for issuing summons to senior advocate Arvind Datar. The summons which have now been withdrawn are in relation to a legal opinion given by Datar in the ESOPs issued to Rashmi Saluja. The advocates have called the ED's move coercive and unwarranted. Ashmit Kumar joins us now with more. Ashmit, please take us through what the top court's advocates said.
Well, Arvind Datar, one of the senior most advocates in the country on all things related to tax and regulation, was in for a rude shock over the weekend when he received an ED summons to appear for questioning in case of the ESOPs that had been issued to Rashmi Saluja. The case in point, the ED's contention was that Arvind Datar, as a lawyer, had issued an opinion in favor of issuance of those ESOPs and therefore needed to be questioned. Now, in less than 24 hours, it was subsequently withdrawn. But nonetheless, this very act of summoning a lawyer for issuance of a legal opinion is something that's been widely condemned. In fact, a statement issued by an association of Supreme Court advocates went on to say that they fully condemn this move, that they fully they deplore this move that has been made by the Enforcement Directorate, going on to say that not only is it unwarranted, not only is it arbitrary, but it also impacts the rule of law. It's a case of it resembles, it represents executive overreach, strong words being used there, going on to say that summoning a lawyer for discharge of a professional duty, which is to issue an opinion, is in fact a clear case of misuse of authority, or going on to say that such coercive measures in fact take away from the independence of the judiciary, hurt the judicial dispensation process, and something that should be discontinued, and that the ED's actions are coercive in nature, and that it going ahead, it sends a chilling message to the entire legal community. So a strongly worded message being sent towards the Enforcement Directorate by some of the leading lawyers in the country.
All right, thank you, Ashmit, for that. India's G20 Sherpa Amitabh Kant has stepped down from his post, marking an end to his government service after 45 years. In a post on social media, Kant thanked Prime Minister Narendra Modi for the opportunity to serve as the country's G20 Sherpa and drive key developmental reforms. Kant will now engage with and support startups, think tanks and academic institutions in personal capacity. He has served as CEO of Niti Aayog from 2016 to 2022. The 1980 batch IS officer also played an instrumental role in campaigns such as Startup India, Incredible India and Make in India. And with that's a wrap on this edition of Business 360. News and updates continue right here on CNBC-TV18.
Hello and welcome to Startup Street. I'm Arundhati Ramnan and with me is Ritu Singh. These are the top headlines from the startup world. Fintech startup Aspora has raised $53 million in Series B, giving it a post-money valuation of $500 million. The firm claims to jump from $400 million in processed remittances to over $2 billion over the last 6 months. Pluto, a fintech startup offering non-custodial crypto wallet, has raised $500,000 in a pre-seed funding round led by angel investor Manit Gupta's strategic funding will fuel Pluto's next phase of growth aimed at expanding its global user base, deepening its presence in emerging and underconnected markets, and accelerating the delivery of crypto financial tools. NCLT has allowed Meesho to flip its headquarters back to India from Delaware in the United States. Regulatory filings showed Meesho, which began the process of flipping back to India sometime in 2024, has been simultaneously preparing for its IPO scheduled around Diwali this year. The Karnataka High Court has upheld its earlier decision to suspend bike taxi services in the state, dismissing appeals from aggregators like Ola, Uber and Rapido. The court's refusal to grant interim relief means that the suspension order remains in effect until at least June 24th. Meta has appointed Arun Srinivas as managing director and head of its India business. Srinivas will assume the role from the 1st of July. This comes after the role of Meta's vice president of India Ops, Sandhya Devanathan, was expanded to oversee the company's Southeast Asia operations. Homegrown EV maker Ultraviolet made its foray into European market by expanding its retail presence across Germany, France, the UK, Italy, Switzerland, among others. This entry is driven by strong motorcycle culture in Europe, the company management tells CNBC-TV18. Those were the headlines that we're tracking for you this evening on What's Brewing Today. Binge watching just got a serious makeover. Say hello to Flick TV, a bold new startup that's reimagining entertainment for the mobile generation. Backed by $2.3 million in fresh seed funding that was led by Stellaris Venture Partners, Flick TV is serving up high-quality, emotionally packed micro-dramas, all under 5 minutes, made for vertical viewing. With big plans to launch 100 original titles and expand into regional languages, is this the future of OTT? We are now joined by Kushal Singhal, the co-founder of Flick TV. Kushal, thank you so much for taking time out and being here with us on Startup Street. You know, you're calling Flick TV India's first micro-drama OTT platform. You know, if you could sort of tell us what exactly is a micro-drama and what kind of gap does it fill in the current content ecosystem? If you could take us through how you're leveraging AI to make this happen.
Correct. So thank you for having me on the show. So if I have to explain micro-drama to you, imagine your favorite TV series full of drama, punches, emotions, being told in fast-paced, hooky episodes of 1 to 3 minutes each. Each microdrama is spread across 50 to 100 episodes. This format is built for mobile-first audience, people with short patches of time, and they consume these stories while they are maybe sitting in a cab, waiting in a line, or just having their lunch.
Sure, absolutely. You know, and you've raised this $2.3 million in seed funding, right? If you could sort of tell me what the top priorities are for deploying this capital in the next 12 to 18 months?
Correct. So what we use the funding for will be used to scale content production, enhance the platform experience, and grow the user base. So this year, we plan to create 100 originals, and we plan to launch in 4 regional languages, bringing the deep-rooted stories to the Indian audience. Our focus is right now to build a world-class OTT experience on the mobile device. We are building on our tech strengths to create the right kind of experience in terms of content recommendation and viewing experience.
Sure. And, you know, you're entering a space that's dominated by like YouTube Shorts, Reels, and sort of also long-form OTTs, right? Which, you know, people very easily use on their phones. How do you plan to stand out and build a loyal user base? If you could also then take us through what your monetization strategy would be.
Sure. So the first thing that we are doing is we are incubating production partners on ground. As a new content format, microdrama lacks a mature production ecosystem. So to accelerate this, we are incubating production partners, solving their on-ground challenges like location scouting, casting, and many more. So our aim is to create next big production houses for microdrama industry, just like we have film and television studios. We're also introducing AI workflows in production process. So starting from script generation to visual creation to audio generation, what this really helps us is in bringing the efficiency and faster production cycles.
Sure. And, also you aim, and speaking about this, you're looking to produce at least 100 plus original titles, as well as expand into regional languages. So how are you sort of approaching content creation at scale without compromising quality? And how many languages do you hope to sort of be in, considering India has so many languages?
Yes. So what we are doing is we are really working with production partners on ground. The kind of supplier that you work with in this format has to be comfortable with fast-paced storytelling and very fast production times, right? So in fact, one micro drama takes less than 25 days to produce. So that is one way with that we're really optimizing on the production velocity, right? So like the idea is that can we really put content fast for the audience so that they can consume as they're watching on the go?
Sure. And, China's $7 billion microdrama market is, a key reference point, right, considering what they've done with this particular space. How do you see the Indian market evolving, and what are the kind of trends that you're betting on?
Yes. So India is a big market. Right now, if you see 90% of Indians are basically consuming these vertical videos on social media. And if you see, there is no dedicated OTT platform which is solving for that, right? So at Flick, our aim is to bring that great storytelling through our mobile-first vertical viewing OTT experience. In fact, we see that this market will become like $5 billion in value in the next 5 years.
So $5 million market value is what you've assigned to it. If you could then sort of give us a sneak peek into the genres or, the storylines that have resonated most with your, early users, what's kind of working for you so far?
Yes, correct. So typically right now, what we are doing is we are working with PGC categories. If you see the snackable space, it is dominated by UGC categories like travel, health, fitness, beauty, where the cost of content creation is very low, almost zero. What we are really trying to bring is high quality production into PGC categories, the professionally generated categories. So the kind of categories that we're really seeing that are working well for us are drama, love, heartbreak, and crime.
Right. And, before I let you go, if you could quickly tell us, you've sort of assembled a founding team with experience, across ShareChat, Pocket FM, Elo, Meesho, all of these, right? So if you could tell us how this is shaping your strategy, as well as, what's the one-year outlook for Flick TV?
Yes. So I think I've been very fortunate in terms of the team that I have, right? So my co-founder, Prateek, he comes from a audio OTT first platform, has really seen user activation, acquisition at scale. Sanidhe, who is the third founding member, comes with over 12 years of working experience in technology, 6 years building out the entire ad infrastructure for a major UGC platform. Between all of us, we have worked in almost all the content startups which have monetized content at scale in India. Now, what we plan to do in next 1 year is to come up with 100 plus originals. We plan to go really deep into 4 regional languages. We plan to grow our user base. And of course, we want to start the monetization on the platform.
All right, Kushal, thank you so much for taking time out and being here with us on Startup Street.
Sure. Thank you.
On our hot seat today, aerospace and defense startup Sunlion Technologies has raised 186 crore rupees in its latest round of Series A funding from investors like Ashish Kacholia and Jungle Ventures. This comes after the 36 crores funding raised by the company in March of last year. Now, the company founded in 2023 says it will use these funds to accelerate indigenous technology development. It also plans to increase its engineering headcount 5-fold in the next 6 months. For more on the company's journey so far and plans ahead, joining me now is Rohan Gala, the co-founder and CEO of Sunlion Technologies. Rohan, thanks very much for your time here on CNBC-TV18. In very simple terms to begin with, tell our viewers exactly what Sunlion does and your journey since you started the company in 2023 and how it really came to be.
That's correct, Reddy. First of all, thank you for having us over. Sunlion basically is a company that provides integrated solutions in defense electronics. To put it simply, as simple as it, electronics systems for defense applications. Going back to how we incepted, as you said, 2023, we are three co-founders. All three of us were at the same company before this. We had worked together. Rohan and I, in fact, go back to IIM Calcutta as well. We all three of us are extremely, acutely aware of defense platforms and the systems and the technologies, and very excited about that. And having seen all of the B2B sectors, we felt that defense in India requires a lot of fillip. And that's why, that's the sector that we had chose to start up in, where we also see that the customer requirements are not being met at this particular point of time. So very simply, that is the reason why we chose defense as a sector. And the three of us know each other from our previous companies as well.
Well, you raised that 186 crore rupees in your Series A round. What specific capabilities are you going to deploy this capital towards, especially in light of your focus on counter unmanned aerial systems, electronic warfare systems? So where exactly will the money go?
So we are, suo moto, that is ourselves investing in these technologies without even waiting for an order, really. Although we do have orders. We want to have a cutting-edge technology when it comes to counter-unmanned solutions, aerial solutions, because as you have seen in Operation Sindoor very recently as well, that is the new warfare. The whole landscape of warfare has changed. It's all non-contact warfare. So to bring the cutting-edge technology, I think there needs to be a lot more R&D in this sector, led by the private sector, of course, complemented by the government sector. So that's really where we'll be deploying our capital. Apart from acquiring capabilities in the subsystems levels as well, which would be power electronics, which could be optoelectronics, which could be communication systems. So the subsystems level acquisition capabilities and building R&D for the entire system level as well.
Okay, so give us a sense of who your clients are and how large the client base is, or if it's largely the government of India and the kind of use cases you provide with your technology.
Our customers would typically be the armed forces, the defense public sector units, your HAL, BAL, etc., and the DRDO labs as well. This is the set of customers that we'll be dealing with. The use cases would be, as you again clearly saw, in the theater that we recently saw. It's all about electronic warfare now. So those would be largely the use cases and the subsystems within that as well. Apart from that, your fighter aircrafts, your submarines, your ships, your control systems, all of them require various subsystems in the electronics side of things. We'd be contributing to that as well. So all of them would be directly used by the end users, which is the armed forces.
Well, Sunlion has adopted this three-pronged strategy, right? You're looking at acquisitions, in-house R&D, and also global partnerships. How are you prioritizing amongst all of these three, and what is the kind of roadmap you have for your next inorganic acquisition after Dexcel?
So instead of reinventing the wheel and taking 10, 20, 30 years to develop products, we think that companies with existing capabilities should be given the platform to grow much quicker and solve the customer's problems much faster, because what the customer wants is a solution yesterday. It's not even tomorrow. So to do that, I think acquisitions and inorganic growth is definitely something that we are looking at. We have done that in the past in our various capacities, various roles in the past as well, and in this company as well. So wherever we can buy, we will certainly buy. Wherever you cannot buy, for example, the R&D for cutting-edge solutions that we want to do, that is currently not available in India at all. In such scenarios, we build it ourselves. So this is the second part of the three-pronged solution, which is building our own capabilities. And to that end, we have been hiring. We are going to hire. In fact, in 2 months, we're going to be about 300, 350 employees, all scientists, engineers with a huge ton of experience in the sector. That is the second prong. The third prong of the business model is basically tie-ups with foreign OEMs. There are technologies that are already available outside, which are not available in India at the moment. In such scenarios, we can have a tie-up in various structures, of course.
Well, Dexcel itself has contributed to programs like Tejas and Chandrayaan-3. So after the acquisition that you've done, how are you repurposing that legacy competency or technology to serve next-generation programs like the Unmanned Underwater Vehicle Initiative or any other exciting programs you're working on?
Dexcel has latched on to another prominent aircraft in India as well. We are shortly expecting a large order for Dexcel for a large aircraft, another aircraft as well from the Air Force. Apart from that, Chandrayaan, etc., these are technologies that are rapidly evolving. There is always a case of obsolescence when you come to into legacy systems that are even 5-10 years old need to be updated every once in a while. To that extent, Dexel is constantly innovating.
Well, finally, how has Sunlion fared financially so far? What kind of revenues and, if any, profits are you generating and the projections that you have for the next year or so?
We are, technically just over a year old, but we're looking at substantial revenues. And one thing I can say for sure is that we are extremely focused on profits. We are always going to be profitable. That much I can assure you.
All right, Rohan, that's all the time we had. Thank you very much for your time here today. It was a pleasure speaking with you.
On that note, it is time for us to head into a short break. But coming up next, homegrown EV maker UltraViolet has made its foray into the European market, marking a significant step towards expanding its global retail footprint. Stay tuned for that and more. Welcome back. You're still with us on Startup Street. Homegrown EV maker UltraViolet made its foray into the European market by expanding its retail presence across Germany, France, the UK, Italy, Switzerland, among others. This foray is driven by strong motorcycle culture in Europe. That's the word coming in from UltraViolet CEO and co-founder Narayan Subramanian. He further says once business takes off in 2 continents, it will mull over going public. Here's a slice of that conversation.
Yes, it is a huge milestone for us. It's been 8 years of R&D. We've started retailing the F77s in India, and the same products are now going to be retailing in Europe today with the launch in Paris. And for us, the vision when we started the company between Neeraj, my co-founder, and myself was to create a brand out of India that can lead cutting-edge innovation in technology and design and can scale globally. And we felt when it comes to the world of electric mobility, we have an opportunity to develop technology ground up. And of course, with the right kind of design that resonates with consumers both in India and overseas, this is a market waiting for disruption.
Well, this is a market waiting for disruption. So could you shed some light on what are the key markets that you are eyeing at this point? And also, Europe is a mature and fiercely competitive two-wheeler market. How do you plan to stand out against legacy ICE and EV brands in Europe?
Right, for us, we see that exact point as a matter of advantage because the motorcycling culture is quite strong. The two-wheelers here are a means of commute and a means of necessity means of commute for most people. And the awareness in the IC world is quite strong as well. And if you look at the countries that we're targeting to begin with, which is Germany and South, which is Germany, France, Italy, Spain, Portugal, UK, these are markets with a good level of awareness in two-wheelers, a good level of awareness when it comes to electrification in four-wheelers, and the market in the motorcycling segment is at a crossroads where the current electric options are prohibitively expensive. And that is where Ultraviolet is targeting our F77s to be priced at parity with the comparable IC engine products in these markets.
You have made your Europe foray. The startup is doing really great. Does this European foray mark the beginning of Ultraviolet's IPO ambitions? What's next? Southeast Asia, the Middle East, or the US?
Interesting markets. US is, of course, quite interesting. Southeast Asia, two-wheelers is a very strong means of commute and necessity here as well. And Latin America is also a very interesting opportunity for us as you look at the quantum of two-wheelers retailing there. And moving on to an IPO, I think that point may be close to 2 years from now, where we have a stable business operating out of a few of these continents and multiple product lines across all forms of two-wheelers.
Okay. And how are you dealing with the EU regulations around battery traceability, recycling, and carbon footprint? What is the long-term play here? Will you manufacture or assemble locally in Europe eventually?
Yeah, so this year is a pilot for us. So the Europe market expansion is pilot, while we actively expand across India. And as part of being compliant to retail in Europe, a lot of what you mentioned are situations that we need to be geared up for as well, and not just Ultraviolet, our network, our ecosystem, and the supply chain as well. So battery recycling is already actively being figured out globally. It is simpler to recover lithium from older generation battery packs than to mine it from the earth. So in that regard, there are a lot of recycling plants that have been coming up across the world, and we know of companies that are doing it in India today as well.
Okay, Narayan, so we are looking at a 2-year timeline for the IPO, and we are looking at bigger plans for the US, Latin America, and more. Thank you so much, Narayan, and congratulations and best of luck to you and to Ultraviolet as well. Thank you for joining us here on CNBC.
Pleasure joining you.
A made-in-India handbag brand has quietly crossed the 100 crore rupee mark without a single international store. As fashion retail shifts online and deeper into Tier 2 and 3 India, Miragio is emerging as a serious player in the mass premium space. So what's driving this homegrown success? Fast design cycles, smart pricing, or untapped demand from Bharat's women shoppers? Aishwarya Anand brings you the story behind the numbers.
In India's evolving fashion landscape, handbags are no longer just accessories. They are statements for aspiration, mobility, and identity. Sitting at the center of this shift is a homegrown brand that is quietly reshaping the industry, Miragio.
Founded in 2019, Miragio has grown into a 100 crore plus brand, carving a niche in the mid-luxury space with trend-led design and a digital-first engine powering sale from metros to Tier 3 towns.
But what does it really take to build a homegrown brand in India that sits at the juncture of being affordable and aspirational? Today, we're delving into the world of Miragio to not just decode the business, but also its playbook and the person behind it.
Mohit Jain started Miragio after a failed e-commerce stint, a business he just launched at the age of 20, funded with borrowed money. With a fresh marketing degree from Canada, he quickly spotted a larger opportunity in India's underserved handbag market: stylish, well-made handbags priced for the working woman.
After dropshipping, I actually wanted to create a more long-term, sustainable, branded business. In the handbag specifically, there were actually a lot of opportunity gaps and problems. One of them not being able to have aspirational bags with affordable price point. That's what exactly Miragio is trying to solve. So we became the first brand to be launching bags every month in India. Functionality and style, people had to choose out of the both. I think we merged the both.
From clutches to micro bags, Miragio offers over 500 SKUs with plans to nearly double that this year.
Tell me, what are the top 3 best-selling products of Miragio?
Dennis tote bag. It has now its own Dennis 2.0 version as well. Ace tote bag. And then very recently we launched and became one of the most hit was ice cream micro bags. So it comes in 4 different flavors or 4 different colors. So pistachio micro bag or a vanilla micro bag are the most highest selling bags at this point in time.
What does your average cart value order would look like? And what's the price point that you're playing in?
We are sort of mass premium to premium range. We have offerings starting as low as 1,000 rupees, goes up till 6,000 rupees, and you will soon see 7,000 and 8,000 rupees offerings as well. So average order value, one bag would be about 3,000 to 3,300 price point.
Miragio clocks 50 to 60,000 monthly orders with over 1 million units sold to date. Its supply chain spans China, with plans of expanding new capacity to Vietnam and Myanmar. Miragio is doubling down on brick and mortar. With $6.5 million in fresh capital, it plans to launch flagship stores, expand warehousing, up their quick commerce play, and deepen its product lines, including tech upgrades and leadership hiring.
What's the target of opening stores by the end of this year, if I have to ask? How many stores are you targeting?
Within 2 years, we're looking at about 15 to 20 stores of Miragio in India. Tier 1 cities, of course, to begin with, because 50% of the consumers comes from Tier 1 cities. So I think that's, of course, a good start to begin with, but also Tier 2 cities as well.
Miragio's core audience is 24 to 35 years old women, with half their orders coming from Tier 1 cities. While 30% of its revenue comes from their own website, the remaining is from marketplaces. With retail expansion, the company aims to take the revenue share to over 60% from its own sales channels in the next 2 to 3 years.
This year, we have done about 132% growth again. By the end of this year, we will also be targeting another 100% growth as well for the company. Path through profitability is I think, very soon for us.
India's handmade market is projected to hit over $1 billion in size by 2030. While global players still dominate the premium shelf, the D2C players are building niche empires. Miragio's playbook, which was built on fast design cycles, monthly drops, and omni-channel expansion, signals what the modern Indian retail segment could look like next. With camera person Gaurav Tyagi, Aishwarya Anand for CNBC-TV18.
And with that, it is a wrap on this edition of Startup Street. More news and updates coming up on the other side. Stay tuned.
Welcome to Genomics. Does the massive CRR cut of 100 basis points indicate a trend in Reserve Bank to remove constraints on bank profitability? That's our debate today. And why am I asking this question? In the past 5 years, bank deposits have risen just by an average of 11% a year, while the assets of mutual funds have risen by an average of 30% per year. Also, banks are fast losing long-term deposits or stable deposits and are having to pay much more for term deposits. So is the CRR cut intended to remove some of the costs imposed on banks? Historically, Indian government and Reserve Bank have imposed many constraints on banks. They have kept CRR 4% of their deposits as idle cash. They have to invest 18 to 20% of their deposits in government bonds, which give you very little returns. And they have to mandatorily lend to weaker segments like agriculture. But now that banks are not getting enough of lazy deposits, is the Reserve Bank leaning towards making life a little easier for bankers by cutting the CRR? That's my question. And joining me is a veteran cast of bankers, two former deputy governors, Mr. H.R. Khan and S.S. Mundra, and former SBI chairman Dinesh Khara. Also joining us is Harshvardhan, the banking expert from Bain & Company. Gentlemen, thank you very much indeed for your time. Mr. Khan, I'll start with you. I think you've got a 50-year association with the Reserve Bank, and I have covered it for 30 years. You tell me, I have never heard this 1% cut in CRR except during the Lehman crisis. So does this signify a different kind? It is more a banking regulation rather than a monetary policy move.
No, thanks, Lata, for getting me. It's not 50 years, it is slightly less than 40 years, my association with Reserve Bank. So coming to your question, whether it is meant to provide some leeway to the banks for their deposit mobilization, we know the background under which banks are functioning in terms of deposit mobilization. I would say this is not the direct objective of this massive CRR cut, just to help banks to garner deposits, but this would be a byproduct because with massive rate cut and CRR cut, there will be pressure on NIM, and CRR cut will provide some offset to that, and they will be in a position to maintain some semblance of rate in terms of giving to the depositors. As you know, in Indian context, still we have a positive rate of return. So there should be a natural tendency towards deposit mobilization. But as you have seen, the way people have moved towards capital market and the massive flows which are happening to mutual fund, this is having impact on the bank deposits. So at margin, this CRR cut will help in offsetting their impact on NIM, and that will help in giving little more in terms of cut in the lending rate, not so much in deposit rate. I think the whole purpose is to increase credit flow and reduce the cost of credit. I think this is going to be impacted positively by this.
I take your point that, there is better monetary transmission because of CRR. But Mr. Khara, you come in on this. There are a zillion ways that the Reserve Bank has to improve liquidity and transmission. I mean, they can do OMOs, they can do FX swaps, they can simply give a bigger dividend to Reserve Bank, they can do long-term repos, the TLTROs that they did during COVID. RBI can create money from thin air if it wants. Why is it deliberately doing something it has never done before? A 1% CRR. Is there an eye that banks need to be commercially profitable?
I think I would like to draw your attention to the fact that around the COVID, the CRR was actually increased. And this was actually long overdue as the CRR readjustment was concerned. And apart from that, it has to be seen in a little different context also. We have seen that all the developed economies normally have got the lower CRR. So actually, when you look at it, the financial system in the country, it is actually evolving to becoming a very developed one. As actually speaking, many of the advanced countries also don't have the financial system as strong as and as robust as perhaps India has. So I think in that context, there was a room for CRR reduction also. Having said that, what you mentioned in terms of if at all transmission has to be expedited, then perhaps this was warranted, because unless and until the NIM aspect of the banks have been addressed, there would have been a challenge for banks to raise the capital. And today, as you're aware, that many of the global participants are very much there as a shareholder for the banks. So having said that, I think this must have been there at the back of the mind. If at all transmission has to be expedited, then unless and until there could be some kind of a relief given in the CRR, which will help in reducing the cost of funds for the banks, and also it will help in transmission, which will eventually help in the growth of the economy. Perhaps these were the considerations why it was looked at.
Yeah, you're making a new point about capital also. And actually, I've heard this from the Reserve Bank higher ups, that we have to think of capital as well, so that, banks are prepared for a continued 7% growth. Mr. Mundra, you have actually been both in Mr. Khara's chair and Mr. Khan's chair. You've been a chairman of a bank and a central banker. You tell me, would you look at this as something different? This is not to be taken as just a liquidity step. It is also a banking profitability step.
Okay. Lata, thanks for having me here. And first, let me start with challenging both of your premises.
Okay.
Really, I don't agree with that. Why? Number one, profitability of the banks are at all-time high at this point of time. So I don't think that there is any concern around the profitability. And the second premise that by cutting the CRR, banks will have the ability to, say on deposit front and all that. But let I understand, this is one-time measure. Okay, you give CRR today, it maybe enables the bank for a few months or for a year. But ultimately, race is on forever. And it is a matter of fact that the whole dynamics in Indian system has changed. Banks will no more have the luxury of having what you call as a lazy deposit or those kind of term deposit. The shift has come to remain forever. So I think for that, banks will have to be more smart. Probably the bank who can manage more money in transition would be a winner. And at some point of time, like any developed economy, market forces will also come into play where funding will be done. So I started with these both premises, but then little bit, then what could be? I see 3-4 clear things if I read at the policy. Number one, I would like to say with successive policy, I think the footprint or the imprint of new governor is clearly seen in the communication. There is a subtle change in the communication in the policy. February policy was too early. He had just come into the saddle. But April and then now June policy, one thing is coming out very clearly that the market participants are getting a much clearer communication and much clear roadmap. To be brief, we have time, we will elaborate on this point. But the second thing, I think both in monetary policy resolution and governor statement, there is a clear call that the private consumption and private investment should now take over. There could be, government cannot keep on doing the heavy lifting all the time. Transmission should be better while it has reflected in the short term, but it is yet to reflect in the credit pricing. So that message is also very clear. And again, there is a lot of clarity that the stance should not be confused with the management of liquidity. These are two different things and they would be handled in a different way as per the evolving situation. So I think I take it like this. Important point, the private consumption and investment spur and a better transmission. Those will be the thing. I won't see it as a sea change coming in the regulatory stance. I think regulatory stance, there are so many things in the regulatory stance, which includes, how you treat the customers, how is your control systems, how is your cyber security. All those things would continue to remain on focus and on. Of course. Let me pause here.
Yeah, no, I agree. I maybe the word profitability is poorly chosen by me. But my point is, I have not seen a 100 basis cut in normal times. And that's why I'm asking whether they want to put fewer constraints on banks. Time was when banks were an extension of the fisc. I mean, they did everything that the fisc did. Slowly, we started listing the banks. And then a priority sector was also made on market rates. Otherwise, priority sector loans had to be given at fixed rates. So to you, Mr. Harshvardhan, would you agree that this is showing a sea change or certainly a step change in Reserve Bank's attitude to banks that, they have to be commercially viable?
Yeah, but Lata, I go with Mr. Mundra. There was no question of commercial viability. I mean, last year was the highest profit on record, 3.5 trillion for Indian banking system. So even if you imagine 25, 40 basis point compression in NIMs, which I am expecting,
yes,
this year also will have a substantially higher profit than what we've seen in the past. So I don't think profitability was a concern. Balance sheets of Indian banks are as strong as they ever have been. So there is no capital question, right?
So in that case, what is your guess as to why this extraordinary step?
This is a tacit recognition of the RBI that deposit market still remains very tight and it is likely to remain so because the underlying drivers of that tightness are structural. They are not going to go away anytime soon. So this is, and remember, other tools of liquidity infusion like OMA and all are selective. Only few banks get it. This is system-wide. So this is like Brahmastra. This is final instrument that has been used. Now we are at statutory minimum on CRR. So I think I also read a little bit of a hidden concern about a slowing economy that RBI is doing. So they have basically taken very, very aggressive policy action, both on CRR and the policy rate cut, probably because they are concerned about the economy slowing down. And however, remember, credit growth has never been slow because of supply side issues. The demand for credit itself is low. As Mr. Mundra was saying, private capex has actually collapsed. And I don't know whether 50 basis point cuts is going to rejuvenate it. I will hold my opinion on this one. In the short run, I don't think that's going to happen. So I don't think this is going to spur credit growth. What you might see is the 1%, 2.5 lakh crore going into SLR initially, because I don't see any significant business credit pickup. The consumer credit and all of it anyway coming down. So I think it's partly very aggressive action to spur credit growth, as Mr. Mundra was saying that the private sector has to do heavy lifting now, and partly recognition of the fact that deposits are really going to remain out because of household savings falling and so on and so on. That's how I read it.
Okay. Well, I don't know if we should look at a 6.8% GVA that we reported in the last quarter as really all that slow. 7.4 GDP I'm not taking, okay, because it is net taxes. But 6.8 in the fourth quarter doesn't look like an economy that needs a bazooka of, 50 basis and 100 basis cuts. This is, something out of character with the Reserve Bank's DNA. And I want to pose that question again to you veterans after the break, whether we will see more steps. After all, we don't get lazy deposits. And therefore, should you also give banks less responsibilities in terms of weaker sections, priority sector? Will we see more of this kind of behavior from the Reserve Bank? Those questions after the break. Welcome back to Indianomics. We are in conversation with two former Reserve Bank Deputy Governors, H.R. Khan and S.S. Mundra, former SBI Chairman Dinesh Khara, and Bain Capital's Bain and Company's banking expert Harshvardhan. We've been discussing whether this 100 basis point CRR cut signifies something more than a liquidity tool, whether it shows Reserve Bank's desire to give banks lesser constraints under the new circumstances. So, let me get back to you, Mr. Khan, on the same issue. Like I said before, the current economic growth situation is not that dire that we are in a 5% handle. We are almost close to 6% when you 7% when you have a 6.8% GVA. This year we will have headwinds, but those are global headwinds. They are not domestic headwinds, and reducing rates is not going to help that. So do you think that Reserve Bank is likely to address this problem of lack of lazy, long-term, stable deposits by giving banks some other advantages? Do you think that the next step could be also removing some constraints of priority sector?
I would agree with my friend and colleague, Mr. Mundra, that there has been in the recent past a lot of understanding of banking sector's requirement. And this is one way, as I said, is a byproduct in terms of helping the NIM, but not a direct objective. Other actions which RBI has taken in the recent past in terms of regulatory relaxation is to reduce those constraints. So far as the priority sector and weaker section part is concerned, I think this is, given the political economy, this is less likely to happen in the near future. But what possibly it can be done is that over time, we have to build some consensus and keep a very small part of priority sector, maybe 10 to 15% for small and marginal farmers, and the micro sector, the rest can be free. But this is something which may not happen very quickly, but over time, maybe with some consensus building.
Okay. No, I take your point on that. Yeah, I take a point on that, Mr. Khan. Just a few months back, RBI actually rejigged priority sector. So we should not expect them to go away from this stand anytime soon. But will you broadly agree that they want banks to be commercially, better off because they are not getting easy deposits? And therefore, maybe in a year or so, will priority sector also be on the radar?
No, the situation is quite dynamic, so they may do a review again, but I don't think the review is going to happen so soon. Coming to the other point, why the growth is around 6.5%, why it has been, why such a bazooka action? Let me remind you two things. One is, at the current stage, the potential growth rate is 7%. So we have to achieve that if you have to talk about Vikasit Bharat and becoming a high-income country by 2047. Of course, that's a long term, but immediate 7% potential growth, if you have to achieve, I think we need to remove further constraints for the growth. The second part is both direct and indirect methods have been used to see that the transmission, which has been muted so far, actually is impacted much more. Both CRR cut is a direct method and repo rate cut is indirect method. So combined effect is what RBI is looking at.
Mr. Khara, do you see, a change? For instance, SMBC has been, I think, more or less allowed. The actual permission hasn't come. They've been allowed to take 20% in Yes Bank. Fairfax was already allowed. Is there, some liberalization we will see even in the attitude to capital? The governor in his interview to Times of India did say that we are looking at overall ownership. So are we going to see, more steps which will ease capital raising, allowing foreign banks, for instance?
I think as far as my understanding on the subject is concerned, my sense is that RBI would prefer that if at all strategic investors can come in, they can actually help in the growth of the sector. So this is what my understanding is. And as and when there are strategic investors who are coming in, RBI is now looking at the situation on a case-to-case basis. And that is one of the reasons why SMBC also has come in. And I think it will eventually help in terms of lending support to the sector. So this appears to be a bit of a transition, because earlier all these investors were permitted to come in only at some number in terms of up to 10% or so. But even now also there is one challenge which is essentially coming from the Banking Regulation Act that says that no investor would be permitted to have the voting power for more than 26% of the voting rights. So that is something which is there. But I think within that, there is enough flexibility which RBI is demonstrating. Earlier, more than 10% also there was at times a challenge. But of late, we have seen that some of the private equity investors have also come in at around 10% or maybe even more than that in some of the banks. So, and they have been permitted a board seat also. So I would say that with the passage of time, there is a change in the thinking at the RBI level.
Okay. Mr. Mundra, your thoughts? Are there any non-commercial constraints on banks which you see going at all?
Yes, Lata. And normally when I come, I find it very difficult to disagree with you on few of the things. But somehow this time, many disagreements are coming. But first, quickly, I would, on the point which Mr. Khan was also mentioning, at least too early to say, but I see a clear trend that probably there is a more willingness to listen to the market and probably to have little more faith in that. That is something at least my perception is, and I hope it continues. It will be a good thing. Means putting my hat of commercial banker for that. Now, 2-3 points which you mentioned. Number one, I don't agree that priority sector is anymore a burden on the banks. If you again go into the database in recent past in terms of credit cost as well as the yield available to the bank, I don't think this priority sector has fared any bad than the so-called, the industry sector. Rather, it is slightly better. And again, coming to the growth, as Mr. Khan mentioned, growth is good, is still below the potential, and I would say much below than the aspiration. And I think that word is used a couple of times in the monetary policy statement also. Quickly on the 3 points, as I see what this rate cut could be. Number one, I feel that maybe it is giving a breathing space to the bank to get their act together in the race for deposit mobilization, be innovative, come out with something, because it is a temporary relief. It's not a permanent relief for the bank.
Of course.
And the second thing, there is a roadmap which is given for CRR cut, not that it is happening today. If you look at the roadmap, probably it is coinciding with the busy season and the festive season, which would be coming in the country. Probably this will enable the bank to fully leverage on that, opportunities which will be coming in the busy season. So to very, short, quickly, this is how I look at it.
Okay. No, there can also be that $40 billion of short positions in the FX market, which will mature. So, I'm not denying that there are liquidity issues, but my repeated point is that liquidity can be tackled in other ways, and it has always been tackled by RBI in other ways, like OMOs or repos or, dividends to RBI, dividends to the government. 1% CRR for me is out of character, out of the RBI's DNA. Mr. Harshvardhan, your last interpretation of this.
Yeah, so I said that this is almost exercising a nuclear option, so to say, on liquidity. And so there would be enough concern there. That's why I mentioned the growth point. But to Lata, your priority sector point, I think this is very, very, very important. Remember, priority sector obligation came in the aftermath of nationalization. Our national economic priorities were very different at that point of time. They are very different now. And the obligations haven't changed much. So there is a very important need to actually review them. Let me give a concrete example. We all recognize that climate change, energy transition is a huge challenge. Enormous amount of capital is needed. Yet it doesn't find a place in priority sector. It's an overwhelming national economic priority, if you ask me. So I think there is not from a profitability or commercial point of view, but just aligning it to more our current national priorities, economic priorities. I think it's important to take a relook at that. At the same time, I don't see that happening because behind every line item of priority sector, there is the constituency, which can lobby very heavily. So I don't see any change happening anytime soon. But if you ask me, yes, it needs to be comprehensively reviewed and redesigned.
Okay. Unfortunately, out of time, and I have not found that much support for my view, that perhaps the Reserve Bank's attitude to banks has changed a bit. The CRR cut, at a time when the economy is not in dire difficulty, seems to signify that they're looking at banks more kindly. We'll continue with this debate. Thank you very much, Mr. Mundra, Mr. Khan, Mr. Khara, and Mr. Harshvardhan.
Let's talk money.
Hello and welcome to another edition of Let's Talk Money with me, Surabhi Upadhyay. The passive investing industry is slowly but surely making its presence felt in India. Out of the total mutual fund industry AUM of approximately 72 lakh crore rupees, almost 12 lakh crores is now coming in from passive funds. By the way, when I say passive, I mean funds that hug an underlying benchmark index, funds where stock selection is not left to a human fund manager. So this industry is surely growing. So how should we investors use passive investing to our advantage? How do we use it to build long-term wealth? That's what we're discussing on the show. And joining me to talk about this are two representatives. people, AMCs that are in the business of passive investing, also active as well. We're not, ruling that out. But let me welcome my guests, Anand Vardarajan, Chief Business Officer at Tata Asset Management, and Vishal Jain, CEO at Zerodha Fund House. Gentlemen, thank you so much for joining in. I'm really looking forward to this session because, we have with us today one young fund house of India that's all passive. And then, of course, we have Tata AMC that gives investors a choice of both active and passive. So let's start by getting your bird's eye view on where we are, that number that I just spoke of, right? I mean, almost 12 lakh crores of AUM. So Vishal, you go first. And why has Zerodha chosen to go all passive? Let's start there.
Well, you said the numbers, 12 lakh crores, approximately about 75% of that is in ETFs. And I think about 25% of that is in index funds. We've seen a huge growth, especially in the last couple of years in terms of traction, in terms of, retail investors. So if you looked at the history of passive investing, which started off in the early 2000s in India, I would say the first 15 years was taken by traction coming in more from institutions. Say from 2015 to 2020, traction side from, HNI side. And over the last 5-6 years, we are seeing traction now coming in from the retail segment as well. If you look at number of investors who are using ETFs, currently there are approximately about 1.8 crore investors using ETFs. And that growth, if you looked at the last 9 months, if you looked at April 24 to December 24, approximately about 45 lakh new ETF users have been added. And 45 lakh new investors, 45 lakh investors were what we had accumulated in the first 20 years of ETFs. So that is what has got added in just 9 months. And approximately the same number of investors, about 45 to 50 lakh folios have been added in index funds as well. And those numbers speak by themselves that now traction is even coming, from retail investors. When it comes to Zerodha Fund House, the main reason why we have, why we are there is because of the fact that at this point of time, if you look at penetration of mutual funds, you have about 5.4 or 5.5 crore unique PAN folios in India. And that's approximately just about 3% of the Indian population. And we feel this number needs to go up far higher than what it is. And we believe that, if you want the next, say, 15-20 crore investors to come in to mutual funds, you need to give them simple products. And what could be simpler than, introducing passive products to them?
Okay, absolutely. But whether all passive products are simple or not, that is, a conversation that we'll get into later, because there's a lot of product evolution also happening. And Anand, let's start by getting your take. So it's very simple. When you talk about a passive fund that will simply replicate the Nifty 50, instead of, picking your brain too much on this stock versus that stock, that sounds like a very simple concept. But now you have new indices coming up every day. The exchanges, BSE and NSE, are creating newer and newer indices. And there are more and more products coming out on these indices. So where are we headed?
See, I think we'll have to offer the entire plethora of options to investors, and it's really up to them to choose whether you are a sophisticated client. I think Vishal outlined the cohorts of clients who've entered this space over the last couple of years. And I think about it this way, that their needs, their evolution in terms of understanding of each of these could be at different levels. A simple Nifty 50 index could be a starting point, and as investors get sophisticated, they may say, okay, can I get something better than that in broad market index? Can I look at a mid cap or a small cap, or can you give me a smart beta passive? Or these are sectors which we think are in vogue. There is a cyclical play in some of these sectors. So I would like to invest in some themes or some sectors which can give me additional alpha, where I see some structural change or cyclical change. So these are the kind of options which one would like to have, and you would like to have a full suite of products as far as passives are concerned.
Absolutely, and and I track the monthly mutual fund data pretty regularly, and even there, most of the times when you see the NFO category, a lot of the launches are actually on the passive side. In fact, let's pull up these numbers if we can. Let's talk about FY25, the year that just closed out. So if you're looking at the data coming out of the Industry Association, AMFI, then we had a total number of 150 mutual fund schemes get launched on the passive side. 102 of these were index funds. There were gold ETFs, 3 new gold ETFs that got launched. Gold prices, of course, running away, so that obviously was aiding sentiment. And then there were other ETFs, which were 45 schemes that got launched. So yeah, that in a nutshell is telling you how the industry evolved in the last 12 odd months. So, for a lay investor, like I said, it's easy to understand that Nifty 50 to hona chahiye. It's simply mirroring the index. But then what should be the next few steps, Vishal, for a person who wants to use passives in a more evolved way to complement an existing portfolio?
So the beauty of passive products, Surabhi, is the fact that, look, you can create many different cuts and themes and sectors and segments, in a passive product. But I think what investors should always be aware of is that build a good asset allocation mix. You should not just be loaded towards equity or one particular segment or a sector. It's good to have a good, an asset allocation mix, across equity, debt, commodity, and through passive products, you can take exposure to all the 3 segments, all the 3 asset classes that are there. So in your equity portion, you can have exposure to, large cap, mid cap, small cap. Now you can make a mix of these 3 categories depending on your risk-taking appetite. Now, if you're somebody who wants to take a lot of risk, you could load your portfolio more towards small caps and mid caps, right? But if you're somebody who's very conservative, you can, kind of take exposure larger towards large cap. One good way is also to kind of, have a good asset allocation across debt and gold as well. Gold has a very low correlation with equity. So the day you add gold to your portfolio, it brings down the risk of your portfolio. So that's one way to, kind of use passive products and build a good asset allocation. There are always, so you can look at a portfolio as a core and satellite, where your core becomes passive and your satellite becomes a place where you can go and take additional risk, which could be through an active fund, which could be a sector, thematic. Now you could decide how you want to play the core and satellite bit. Do you want to have a 75-25%, or do you want to have a 60-40%? Is something that you can decide based on, your risk-taking appetite and financial
No,
needs.
absolutely. And the thing is, you have products on both sides. You can build this core and satellite portfolio through active funds or through passive funds or through a mix of both. The question is, what's the right balance? And here, let's start by addressing the large cap category, because traditional wisdom has been telling us that when it comes to large caps, perhaps it's time to play a large part of that through passives. One advantage, obviously, is that passive funds are cheaper. I mean, the expense ratios are much, much cheaper than active fund management. So there, Anand, what would you say? I mean, have we come to a time where, say, 50 to 60% of my large cap requirement should be met through passives? Or is there still a case, at least in India, to put some money, into active management, even for large caps?
See, there are 3 ways there are a couple of nuances that we have to understand in as far as even large caps are concerned. One is you'll have to look at which phase are you in. I mean, it's like just like in monsoon season in Mumbai, it rains heavily. You just don't know which day it rains. Similar the case with active versus passive, if you were to think about it. And we really don't look at it as active versus passive, because if you were to think about 2016 to 18 phase, you had a situation where passives did extremely well. There were some large cap heavyweights which did well, which took the index higher. And if you were in active set of funds, you could have underperformed, because those heavyweights took it higher, and active by design could not have had that kind of participation, because there are stock level limits, etc. Now, conversely, if you were to look at now, where the rally is broad based, I mean, you would find that it is really alpha coming out of stock picking and not out of,
not just a
and
broad
not really
index
beta moves or broad index moves, like you said. So that's one nuance. The other nuance is that of investor. Just to add to what Vishal said in terms of asset allocation, risk appetite. What is the investor good at? Are you a stock picker? Can you pick up the right stock, or are you better off, picking the entire index? So if you can find diamonds, then you can go narrow and deep, and you can find it. The other option is, if you cannot, then you go shallow and wide and just grow paddy, which
cast your net
wide. Cast your net wide and just
try and catch all the fish.
Catch all of it. And the third part of it is, while we say passive, it's not really, the index is not so passive, because it has an automatic cleanser. It weeds out the bad stocks, it pulls up the better stocks automatically over periods of time. If you were to look at jog your memory 40 years back and look at what Sensex used to have, It used to have a lot of textile companies back then, and today you'll struggle to find even one in the mighty Sensex. Whereas the nature of companies have changed, the sectors have changed dramatically, and that tells you that it has the ability to cleanse itself and weed out the not so good ones.
No, that's a great point, that the index itself is a dynamic beast. It's not static.
Absolutely.
You don't have the same set of stocks in any index over a course of whether it's a twice a year reset or if it's once a year reset. I mean, most indices have an element of churn as well. But Vishal, weigh in on this debate, because I remember we used to get this report, SPIVA, right? S&P indices versus active. And basically, these reports, industry reports, used to come out with screaming headlines that XYZ percentage of funds are underperforming their benchmark indices. And that gave rise to the whole argument that if the actively managed fund is going to be underperforming, then why should I pay 2% or 2.5% expense ratio for active management? Where are you on that debate?
So that's still there, Surabhi. I mean, in the large cap space, maybe about 80-85% are still underperforming the index. In the mid cap, I don't have the right numbers with me, but if I remember correctly, it's about 70 to 75% even in the mid cap space. But I think the larger point here is not your ability of a certain segment to beat the index, right? It's, as he said, it's the ability for you to pick the right stock, the right sector, the right fund manager, the right scheme. I mean, if someone showed me data and said that, look, Vishal, this is the benchmark, there are 5 guys above the benchmark and there are another 40 guys below the benchmark. I mean, it's those 5 guys who are changing all the time, right? How do I pick the right fund manager? How do I pick the right stock? Which will always be a challenge, whether it's a small cap or a mid cap, or, or a large cap in that sense,
But tell me this. So just to complete the large cap versus mid cap debate, and I think, let me tell viewers the reason why I'm taking a step back, in case you're wondering why are we saying that for large cap exposure, passives are a good way. It's because in the large cap universe, there's a lot of information and data available. Large cap companies come and talk very frequently to the media. So therefore, there is no information arbitrage as such. Everybody knows everything. And therefore, maybe the chance of picking a hidden gem is that much lesser through active fund management. That's why that was the point on large caps. But in small and mid caps, where you have a much wider universe of stocks, there what's the sense? I'll be honest, when I saw the first of the small cap, passive launches hugging the small cap index, I was wondering, how is this going to happen? I mean, you were talking about buying the whole set of 250 stocks, so to speak. But isn't that the exact place where human intelligence is supposed to trump the index, Anand?
Yeah, you're right. I think I can argue on both sides. One is, if like they say, if you know the risks, hedge it. If you don't know, diversify. Small and mid is exactly the kind of place where you can get trapped if you get stuck in a wrong stock. The second best option is why the entire index, it kind of cancels each other out. And hopefully, you end up with a positive outcome net of that. Think about it, because one, it has too many stocks. The point that you made earlier in terms of how much information is available. Do you get to see, hear the management as often? Disclosure, governance. I mean, and then do you have the skill set, time, some of the stuff that we discussed earlier today in the show. So all this makes it very, very complex. What's the second best thing that you can do is, buy the entire index. You at least know that, you will end up mirroring the index over a period of time.
Returns.
Yeah.
At least you won't land up with the duds.
Absolutely. I mean, it's a bit like boarding the Mumbai local. The best seat is the window seat. The second best place is just getting into the train. Both the window seat guy and the guy who's on the train get to the next station at the same time. One can have a rough ride, one may have a better ride.
A breezy ride.
But the point,
when you reach your destination.
But the point is that how sure are you to get the window seat? I think that's the metaphorical window seat that you're looking for in small caps and mid caps. You get it right, well and good. Second best option is not so bad.
Well, point well made. Very quickly, 30 seconds, you have to hit a break. But Vishal, he's already made a strong argument of why do passives even for small caps. So you want to add anything?
So they always say that with passives, you'll always be a silver medal, right? So I mean that's all.
At least
I
a
can
silver
say.
medal is guaranteed.
So and the chance if you land up with a bronze one could be a bad
silver's
one. So,
better. That's true. That's true. Okay, great. We'll take a quick break on that note, but we continue the conversation on the other side because now there are passive products for thematic funds. There are passive products that are combining a lot of complex factors, the so-called smart beta passive mutual funds. So are they worth your while? We'll discuss this after the break.
Let's talk money. Let's talk money.
Welcome back. You're with us on Let's Talk Money, and this week we are discussing passive mutual funds and whether some of the more evolved, newer passive products, which let you invest in, say, certain themes, certain sectors, or certain complex strategies, whether they are worth your while. And of course, we're in conversation with Anand Vardarajan and Vishal Jain. Anand is from Tata AMC, and Vishal, of course, the CEO at Zerodha Fund House. So now, gentlemen, I want to talk about sectors and investing in sectors and themes. And here I always play the investor's self-appointed advocate, right? A lot of funds get launched when sectors are doing well. It's the nature of the market. There's excitement, so defense funds will get launched, or, railway and PSU funds will get launched. And many a times, we've seen that these launches are on the passive category. And that's when, at least, I get sometimes a little, uneasy, wondering whether people understand the risks involved well enough. Anand, what's your thought? Because if it's let's say a defense sector index or any other sectoral index, which is fairly narrow, and then within that, it's a passive product, so you're just hugging the underlying index. Isn't that very concentrated risk?
Yeah, you're right. I think one is there are fads that you have to avoid. And if it's the most popular thing and everyone and their uncles are talking about it, then you know that this is getting a little too much, overheated, and best to kind of avoid. I think I will distinguish this into two parts. One is whether the story is cyclical or structural. Take the case of, there have been themes like, say for instance, India over the last couple of years, tourism as a theme has kind of evolved. Or capital markets, for instance, like pre-COVID, I think there were about 4 or 5 crore demat accounts. Post-COVID, now we have roughly 20 crore demat accounts, and 15 crore demat accounts have been added post-COVID. So tough to call it cyclical. So if it's a structural theme where we see financialization of savings, we think capital markets group booming and so on, then possibly all the players in the ecosystem, which could be, say, brokers, RTAs, asset managers, wealth managers, and so on, could benefit. So an index of that sort could potentially do well over a period of time.
Okay.
If you were to look at something where, like you mentioned, if the sector is very narrow, very few stocks, hardly even churn has any kind of space because you just keep rotating in and out of the same 12, 15 stocks, that becomes a little tricky to manage. And the risks obviously then become much higher. So you have to really see whether the sector theme is tailwinded, whether those tailwinds are already there in play, and if that is the case, then perhaps it's not a bad idea to look at some of them favorably.
Okay, now let's ask both of you to wear the hat of advisor, which I know could be unfair because you guys are, product manufacturers. But Vishal, maybe give us your own example, or someone in the family, friends or family ask you to create a portfolio using maybe an all-passive portfolio or a reasonable blend of active and passive. Just give us a broad composition. What would you go with? Small cap, large cap, sector, themes, etc., etc.
So I'd go for about, keeping in mind that I'm conservative in general. So I'd possibly look at about 40% large cap, maybe about 20% mid cap, about 10% small cap, 15% gold, and the rest in debt is something that I'd look at.
Now within that's the question. Will it be all through passives?
Yes, if I think that there is something which, I think that maybe might outperform, like you're saying, if there's some sector theme or some product like that, maybe max 10% of that portfolio I could allocate towards, one of those, I would say, flavors of the month.
Okay, all right. But all fully, passive investing portfolio there. cutting across, of course, some of the segments and asset classes that you spoke about. Anand, same question to you. What's the perfect blend portfolio?
I don't know perfect. It's horses for courses. That's why it's called personal finance. It's
yes.
Not, it's
personally for you. Let me
correct.
ask you.
But I would think that maybe 80-20, 80 in favor of active, 20% passive.
Okay.
And within that, if I were to split, I have a 40-30-20-10 rule,
okay,
which is 40% large caps, 30% could be mid and small caps, 20% could be some of these kind of sectoral bets that you that I feel convinced about, and maybe 10% is something which I would just keep aside for any kind of opportunity or just some cushion.
Okay, and the 20% that would be passives through passive funds. That would be what kind of passive? Will it be all large cap indices based? What are the other things that you feel very convinced about?
See, some of these sectoral bets is what I could be a wrong investor because I could be slightly aggressive. It could be different for different set of investors, but I would have a slightly more aggressive tilt to some of these sectors or themes, depending on what I feel constructive about at that point in time.
Okay, all right. And what we've not discussed, obviously, viewers, you need to go back and discuss this with your own individual advisors, take your own informed calls, and then decide. First of all, what's your asset allocation? And then within that asset class, do you want to do it through the active route or the passive route? But one of the things that we haven't discussed, one of the greatest advantages of passive investing, that is, it's such low cost, a fraction of what active investing would cost us. Just a quick sense on whether the costs are already at rock bottom or, Vishal, would they head even lower? How do they compare with, the global average?
If you look at the large cap ETFs now in the market, most of them are at about 4 or 5 bips, which is comparable to international markets as well. So I don't think in the large cap space, you can go down any further. At this point of time, mid caps and small caps and the other products are, products which are still gaining economies of scale. And, once the industry or those products get economies of scale, I mean, slowly costs will start coming down in those as well.
Okay. Your final tips and advice, I mean, the checklist, important checklist to keep in mind before you go in for passive investing.
I've said all that, Surabhi. Asset allocation, look at a core and satellite kind of an approach, and keep investing at regular intervals in the market.
And when you choose within passives, are there any metrics to track or parameters that you should be aware of?
So if it's if you're looking at index funds, then definitely look at the tracking error and the expense ratios. If you're looking at ETFs, then definitely do look at the liquidity as well as an additional criteria.
Okay. And Anand, your final piece of advice to our viewers?
First, don't fall for fads. Be very clear whether you're getting into something which you understand, first of all. Second, this active-passive debate is kind of overdone. I think you should have a blend of both because each of these work differently at different points in time. 3, cost to customer that I look at is basically your tracking error, tracking difference, plus your cost. I think overall you should really look at it in toto and see whether it makes sense because TETD becomes an important thing to look at when you're investing in passives. So please pay attention to that. Yep.
Okay. All right. I think that's a very helpful advice, and it's a good mini classroom on passive investing for those who may not have started so far. Thank you so much, both of you, for joining in and giving us important context when it comes to passive funds. Thanks for joining in.
Thank you. Thank you.
Well, with that, we're out of time on this edition of Let's Talk Money. Thank you so much for being with us. Keep sending us your feedback, comments, and queries. We'll see you again next week with another theme.
Let's Talk Money.
Welcome to Indianomics. Does the massive CRR cut of 100 basis points indicate a trend in Reserve Bank to remove constraints on bank profitability? That's our debate today. And why am I asking this question? In the past 5 years, bank deposits have risen just by an average of 11% a year, while the assets of mutual funds have risen by an average of 30% per year. Also, banks are fast losing long-term deposits or stable deposits and are having to pay much more for term deposits. So is the CRR cut intended to remove some of the costs imposed on banks? Historically, Indian government and Reserve Bank have imposed many constraints on banks. They have kept CRR 4% of their deposits as idle cash. They have to invest 18 to 20% of their deposits in government bonds, which give you very little returns. And they have to mandatorily lend to weaker segments like agriculture. But now that banks are not getting enough of lazy deposits, is the Reserve Bank leaning towards making life a little easier for bankers by cutting the CRR? That's my question. And joining me is a veteran cast of bankers, two former deputy governors, Mr. H.R. Khan and S.S. Mundra, and former SBI chairman Dinesh Khara. Also joining us is Harshvardhan, the banking expert from Bain & Company. Gentlemen, thank you very much indeed for your time. Mr. Khan, I'll start with you. I think you have got a 50-year association with the Reserve Bank, and I have covered it for 30 years. You tell me, I have never heard this 1% cut in CRR except during the Lehman crisis. So does this signify a different kind? It is more a banking regulation rather than a monetary policy move.
No, thanks, Lata, for getting me. It's not 50 years, it is slightly less than 40 years, my association with Reserve Bank. So coming to your question, whether it is meant to provide some leeway to the banks for their deposit mobilization, we know the background under which banks are functioning in terms of deposit mobilization. I would say this is not the direct objective of this massive CRR cut, just to help banks to garner deposits, but this would be a byproduct because with massive rate cut and CRR cut, there will be pressure on NIM, and CRR cut will provide some offset to that, and they will be in a position to maintain some semblance of rate in terms of giving to the depositors. As you know, in Indian context, still we have a positive rate of return. So there should be a natural tendency towards deposit mobilization. But as you have seen, the way people have moved towards capital market and the massive flows which are happening to mutual fund, this is having impact on the bank deposits. So at margin, this CRR cut will help in offsetting their impact on NIM, and that will help in giving little more in terms of cut in the lending rate, not so much in deposit rate. I think the whole purpose is to increase credit flow and reduce the cost of credit. I think this is going to be impacted positively by this.
I take your point that, there is better monetary transmission because of CRR. But Mr. Khara, you come in on this. There are a zillion ways that the Reserve Bank has to improve liquidity and transmission. I mean, they can do OMOs, they can do FX swaps, they can simply give a bigger dividend to Reserve Bank, they can do long-term repos, the TLTROs that they did during COVID. RBI can create money from thin air if it wants. Why is it deliberately doing something it has never done before? A 1% CRR. Is there an eye that banks need to be commercially profitable?
I think I would like to draw your attention to the fact that around the COVID, the CRR was actually increased. And this was actually long overdue as the CRR readjustment was concerned. And apart from that, it has to be seen in a little different context also. We have seen that all the developed economies normally have got the lower CRR. So actually, when you look at it, the financial system in the country, it is actually evolving to becoming a very developed one. As actually speaking, many of the advanced countries also don't have the financial system as strong as and as robust as perhaps India has. So I think in that context, there was a room for CRR reduction also. Having said that, what you mentioned in terms of if at all transmission has to be expedited, then perhaps this was warranted, because unless and until the NIM aspect of the banks have been addressed, there would have been a challenge for banks to raise the capital. And today, as you are aware, that many of the global participants are very much there as a shareholder for the banks. So having said that, I think this must have been there at the back of the mind. If at all transmission has to be expedited, then unless and until there could be some kind of a relief given in the CRR, which will help in reducing the cost of funds for the banks, and also it will help in transmission, which will eventually help in the growth of the economy. Perhaps these were the considerations why it was looked at.
Yeah, you're making a new point about capital also. And actually, I've heard this from the Reserve Bank higher ups that we have to think of capital as well, so that banks are prepared for a continued 7% growth. Mr. Mundra, you have actually been both in Mr. Khara's chair and Mr. Khan's chair. You've been a chairman of a bank and a central banker. You tell me, would you look at this as something different? This is not to be taken as just a liquidity step. It is also a banking profitability step.
Okay. Lata, thanks for having me here. And first, let me start with challenging both of your premises.
Okay.
Really, I don't agree with that. Why? Number one, profitability of the banks are at all-time high at this point of time. So I don't think that there is any concern around the profitability. And the second premise that by cutting the CRR, banks will have the ability to, on deposit front and all that. But let us understand, this is one-time measure. Okay, you give CRR today, it maybe enables the bank for a few months or for a year. But ultimately, race is on forever. And it is a matter of fact that the whole dynamics in Indian system has changed. Banks will no more have the luxury of having what you call as a lazy deposit or those kind of term deposit. The shift has come to remain forever. So I think for that, banks will have to be more smart. Probably the bank who can manage more money in transition would be a winner. And at some point of time, like any developed economy, market forces will also come into play where funding will be done. So I started with these both premises, but then little bit, then what could be? I see 3-4 clear things if I read at the policy. Number one, I would like to say with successive policy, I think the footprint or the imprint of new governor is clearly seen in the communication. There is a subtle change in the communication in the policy. February policy was too early. He had just come into the saddle. But April and
Hello and welcome to India Business Hour. I'm Parikshit Luthra. Here are the headlines we are tracking this evening. Israel and Iran trade fire for the fourth day. A new wave of Iranian airstrikes target Tel Aviv and Haifa. More than 220 people have died due to Israeli strikes across Iran in the last 4 days. Tehran claims 90% of them were civilians, threatened to leave the nuclear non-proliferation treaty. US President Trump hopes for a deal between Israel and Iran, even